Good morning to all of you. Welcome to all for Financial Accounting Marathon. In this marathon, I'm going to cover the important areas, important chapters from examination point of view. Now, if you look at the past question papers relating to financial accounting, accounting fundamentals, this is the first chapter. Minimum 20 marks they are asking from this chapter. MCQs also every attempt minimum 3 to 5 MCQs are coming from first chapter. So first chapter is a very important chapter. Definitely from first chapter you can expect 20 marks. Minimum 20 marks. And in first chapter the topics like BRS, depreciation, provision for doubtful debts, rectification of errors. These four areas are very important. Bills of exchange 7 marks. Consignment 7 marks. Alternatively, bills of exchange, consignment, mostly bills of exchange they are asking. And preparation of final accounts from incomplete records, 14 marks question they are asking, sir. Partnership account, you see every attempt 2 questions, one 14 marks, one 4 marks, 18 marks they will ask. Branch accounts, every attempt 7 marks coming. Departments, not insurance, hire purchase. And as far as the accounting standards is concerned, accounting standard 1, 10, 12 and then 22. These are the standards they are testing. So first chapter, bills of exchange, preparation of final accounts from incomplete records, partnership accounting, branch, insurance, hire purchase. These are the main topics. And as far as accounting standards is concerned, AS 1, 10, 12. These standard 22. These are the 4 standards, very important. And accordingly, I will try to cover the important chapters for this marathon. And all the materials, notes I am going to use in this marathon, it is readily available in the website freely under free resources. You can download and you can use it. Okay. Let's start our marathon. First, I am going to start first chapter accounting fundamentals. In that, the important topics I am going to cover. Okay. Okay. First, we are going to cover chapter number 1, accounting fundamentals. Very important chapter from examination point of view, as I already told you. In this chapter, the important topics we are going to cover is 4 topics. One is BRS topic. Another one is depreciation topic. Another one is provision for doubtful debts, that topic. Last one is rectification of errors. These are the 4 areas. So definitely they are asking 2 questions. So very important. First, let's start with the concept of BRS, sir. Okay. What is this concept of BRS, sir? See, we prepare cash book, right? Cash book, we have bank column. In that bank balance we will arrive, right? And there is passbook. In that passbook there is a passbook balance. Ideally both should match, but they are not matching. So we need to identify the reasons and we need to prepare one statement showing the reasons why they are not matching. That is called bank reconciliation statement, BRS. So ideal situation, your cash book bank column, passbook, they should show the same balance, right? But they are not showing same balance. Why? Because there are some reasons. What could be the reasons? One reason could be timing differences. Another reason could be unrecorded transactions. Unrecorded transactions or timing differences. Another reason could be errors. Now identify and prepare one reconciliation statement showing the differences. That is called bank reconciliation statement. So what are the reasons why the cash book bank balance and passbook bank balance are not matching. Some reasons could be, common causes is checks issued but not presented for payment. We issued the checks but the other party not presented the payment. So the moment we issued the checks, we will write in our books, we will affect our bank balance, bank column in the cash book. But in the bank, passbook transactions was not affected. Our bank balance was not affected. So there could be difference. Checks deposited but not yet collected or cleared by the bank. We deposited the check. The moment we deposit the checks, we will record in our books, but it was not credited to our bank balance. Amount directly deposited into bank account by third party. Some third party has deposited directly into our bank account. We have not recorded in our cash book. That's why difference is coming. Bank charges, incidental fees, interest on overdraft debited by bank. Bank has charged some banking charges directly affected in my bank passbook, but they have not recorded in my cash book bank column. That could be the reason for difference. Next, interest credited by the bank on deposits. So bank has given on my deposits interest. It was directly credited to my bank account, but it was not recorded in the cash book. Dishonor of checks deposited. We deposited the check, that check was dishonored, but we don't know the information of dishonor. So we have not recorded that dishonor in our books, but bank has updated. And clerical errors by the organization or the bank. Bank has done some errors or we have done some clerical errors, because of that they are not matching. And also payments made by the bank as per the standing instructions. We give some standing instruction to the bank, bank had made the payment, but we don't know. We have not updated. So these are some reasons why they are not matching. What they are not matching, sir? Cash book, bank balance, and then passbook balance. They are not matching. What we need to do? We need to identify the reasons and we need to prepare a statement. That statement is called bank reconciliation statement, BRS. Now see, what are the different possible items will come in BRS. Look at this. All these items I have given here. If you learn this, I think BRS topic you can do. See, when reconciliation is started with, we started reconciliation with the balance as per cash book, and our goal is to reach the balance as per passbook. Sometimes we start with what? Balance as per passbook, then our goal is to reach balance as per cash book. Okay, so first you need to see in the question what will be the starting point they have given. And if you learn balance as per cash book, if this is the starting point, what I need to do? If you learn this properly, I think remaining you need not learn. Just you remember the opposite effect has to be given. I will tell you. So first we will focus on this one. Balance as per the cash book. That means first we will start with the balance as per cash book and we will add less the differences. Then you will get balance as per passbook. So what are the different items or different transactions which are the reasons for disagreement? See this, learn properly. First I am going to start with balance as per cash book. Okay, you see this first item, checks deposited in bank but not cleared. Sir, see this, this is my cash book bank balance, this is my passbook balance. Right hand side passbook, left hand side cash book bank balance. Checks deposited in bank but not cleared. Checks deposited in bank but not cleared. When we deposit the checks, our cash balance will increase. Checks deposited. That means this was not affected. So therefore what we need to do? Less to match with this. Correct? When we deposit the checks in our books, we have increased our bank balance, but passbook balance not yet affected because it was not cleared. So therefore we need to match with the passbook balance. So what we need to do? Less. Next, second item, you see, checks issued but not presented in bank. Suppose when you issue the check, in your books your balance will reduce, but passbook balance not yet changed because it was not presented in the bank. So therefore, in order to match with the passbook, what we need to do? Add. See, simple. You need to match with the passbook. In our books, what you have done? You have reduced it. So in order to match with the passbook, what you need to do? Add. Similarly, interest debited in passbook only. Say this. This is your passbook, right? They have debited interest in your passbook. That means your bank balance as per passbook reduced. Now you also reduce to match with it. Less. Next, payment by bank debited in passbook only. Payments done by the bank debited in passbook only. So when payments done by the bank, my passbook balance reduced. So in order to match with this balance, I also need to reduce. So less. Next, direct payment by customer in passbook. Direct payment by customer in passbook. So this customer has made a direct amount payment in my passbook. So my passbook balance increase. So I also need to increase. Correct? Next, bills discounted and dishonored in passbook only. See this. This is passbook, this is cash book. Bill discounted and dishonored. Sir, when bill dishonored, what happens, sir? Bank will charge the amount from the customer account. So customer account reduced. My passbook balance reduced. So in order to match with my passbook balance, I also need to reduce. Less. Next, checks deposited, dishonored in passbook only. We deposited the check and they dishonored in passbook. The moment they dishonored, your bank balance will come down. So you also need to reduce to match with it. Next, interest, dividend, commission collected by bank not recorded in cash book. See this. Interest, dividend, commission collected by whom? Bank. That means my passbook balance increases. So I also need to increase to match with it. So add. Next, overcasting of payment side of the cash book. See this. This is cash book. Overcasting of payment side. If I overcast the payment side, my balance will come down. So in order to match with passbook, what I need to do? Add. So that's what I done. Add. Next, undercasting of payment side of the cash book. Suppose payment side of the cash book, payments are there. Payments 100 rupees, but I shown only 50 rupees. Because of that, my balance increased. So match with it, I need to less. So therefore, less. And deposits recorded twice in cash book. See this. There is a deposit. I recorded twice in cash book. Therefore, my cash balance increases. So in order to match with passbook, I need to reduce. Less. Next, undercasting of credit side of the passbook. Suppose see this. Passbook. Passbook credit side will have deposits. Debit side withdrawals. So undercasting of credit side of the passbook means passbook balance reduced. So see, they have undercasted the credit side. That means bank balance as per the cash book has been down. So I also need to reduce. See this. Next, checks deposited into bank and credited without recording in cash book. See this. Checks deposited in bank and credited without recording in cash book. See, I deposited the check, but I have not recorded here. But it was recorded in passbook. So what I need to do? Increase. Add. Correct? Next, wrong debit in passbook. Suppose there is a passbook. Wrong debit. Debit means my passbook balance reduced. I also need to reduce to match with it. Next, checks drawn but not actually issued to the suppliers or creditors. Sir, I draw the check, but I have not issued to the suppliers. I have not issued to the suppliers. Checks drawn but not actually issued to the suppliers or creditors means what happens? Tell me. The moment you draw the check, your balance is reduced. Cash book balance reduced, but passbook balance not affected. So therefore, in order to match the passbook, what I need to do? Add. Next, bank charges recorded twice in cash book. If you record something in cash book twice, your bank balance will reduce. Cash book bank balance reduce. In order to match with passbook, what I need to do? Add back. And last one, amount withdrawn from bank but not recorded in cash book. See, suppose you withdraw some amount from the bank. That means bank balance reduced, but not recorded in cash book. So in order to match with it, you also need to reduce. So that's it, pa. So you need to understand what is the treatment I need to do. If my starting point is balance as per cash book, if my starting point is balance as per cash book, this is what I need to do. So randomly we'll see first 5 items once again. See the first one, checks deposited but not cleared. Tell me. checks deposited. The moment you deposit the checks, what happens to your cash balance, your bank balance as per cash book? Up. But passbook balance not yet affected. So therefore to match it, what I need to do? Less. Next, checks issued but not presented for payment. You issued the check. The moment you issued the checks, your balance reduces. Your cash book balance reduces, but passbook balance not affected. So to match with it, add. Next, interest debited in passbook only. Interest debited in passbook only. Interest debited in passbook only. In passbook, suppose if interest is debited, their balance come down. I also need to reduce. I also need to reduce. Next, payments by bank debited in passbook only. Payments by bank. So if any payment is made, my passbook balance reduces now. I also need to reduce. Direct payment by customer. When customer makes a direct payment in my cash passbook balance increased. I also need to increase. So like this, I need to do. In order to match with what? I started with balance as per cash book. I need to match with what? Balance as per passbook. So these are the adjustments I will do. Now see, suppose if balance as per cash book is the starting point, this I am doing, right? Suppose if there is an opposite balance, overdraft, OD as per cash book is there, just I need to do reverse. In place of less, I need to add. In place of add, I need to less. If I started with what? Overdraft as per cash book. If cash book is having any negative balance, just I need to do the reverse thing. Suppose I started with the passbook balance as the starting point. Suppose balance as per passbook I started. What you need to do is, as per cash book, what you are doing, just you do the reversal. If you are doing less here, you need to add. If you are adding here, less. So that's why I'm saying you learn this one properly, first one properly. Automatically, if you are starting balance as per cash book, you do the reverse. You do the reverse. And this one OD as per passbook is reversal of this one. If it is add, less. So therefore you learn this one properly, balance as per cash book properly, and if you are starting balance as per passbook, just you need to do the reversal. Okay, if there is a negative balance, opposite balance, you need to do the opposite of the original. Suppose if the balance as per cash book is positive, less, here add less, like this you need to do. So this is available, sir. I will make sure that this is available with you, and these are the maximum reasons, sir, why the difference is coming, and I have explained this. Okay. Okay, sir. Now see, in order to prepare bank reconciliation statements, sir, there are two methods. There are two methods available, sir. One is without amended cash book method. Second one is amended cash book method. Methods for preparing the bank reconciliation statement, sir. One is without amended cash book method. Second one is amended cash book method. What is this without amended cash book method? Without amended cash book method is very simple. First you need to start with one balance, either balance bank balance as per cash book, or you start with the balance as per passbook. Identify the differences. So add less, you will get the balance of the other. This is without amended cash book. There is another method called amended cash book method. This is important. See, in amended cash book method, first what we will do is, whatever the items already recorded in passbook, but it is not yet entered in the cash book, we will update. And any errors made in the cash book will also update it. Any omissions done in the cash book will also be updated. Once we updated the cash book, then for the remaining items, we will prepare bank reconciliation statement. So in amended cash book, what we will do? We will first find out the corrected bank balance as per cash book. So items include the following items in the amended cash book. Items already recorded in passbook but not yet recorded in cash book. First we will update them. And then any errors made in the cash book, we will rectify them. But remember guys, any transaction which is not yet recorded in passbook, we don't update in cash book. That will come in only bank reconciliation statement. We will update in cash book only those items which is already recorded in passbook but not recorded in the cash book, and also any errors, omissions we made in the cash book, we will update. So do not include any errors made by bank. These are shown only in the bank reconciliation statement. Once you arrive the corrected balance, as per the cash book, amended cash book, then you need to prepare the bank reconciliation statement for the remaining differences. Okay. So these are the two methods, sir, for bank reconciliation statement: without amended cash book, with amended cash book. See this, in the study material, one beautiful question is there. Illustration number 4. If you solve this illustration number 4, you will get a complete idea about bank reconciliation statements. Both the methods they have covered in this question. See this question, everybody. On comparing the cash book of Saksham with the bank passbook for the year ending 31st March 2023, following discrepancies were noticed. So they have comparing the cash book and passbook. They find out some differences are there, discrepancies are there. They have given the list. What they are asking here, they are asking prepare bank reconciliation statement as on 31st March 2023. If the balance as per cash book on 31st March was how much? 1,58,280. Balance as per cash book given, sir. If balance as per cash book is 1,58,280, then you need to prepare the bank reconciliation statement. So what is your starting point, sir? Balance as per cash book. That means your ending point should be balance as per passbook. Okay. See the differences. First we are going to solve according to without amended cash book. Just first we will start with 158,280, correct? Say this. First one, out of 82,000 paid in checks into bank on 25th March, checks amounting to 30,000 were collected on 5th April. Sir, we deposited, say this is balance as per cash book, this is passbook balance. We deposited how much? 82,000, correct? Into the bank when 25th March. But checks amounting to 30 were collected on 5th April. That means 30,000 difference is there. This 30,000 in your books you have already increased, but as per passbook it was not created, correct? So in order to match with passbook, what we need to do? Decrease. So therefore this will be less. 30,000 will be less. Okay, next. Second one, out of checks drawn amounting to 31,200 on 28th March, a check for 10,000 was presented on 3rd April. See, 31,000 check, 200 check drawn, sir. In that 10,000 was presented on 3rd April. That means checks drawn. When you draw the check, your balance has been reduced by that 10,000 also. But the 10,000 was not recorded in passbook. So therefore, in order to match with passbook, what I need to do? Add. So add that 10,000. Next, a check for 4,000 entered in cash book but omitted to be banked. See, check 4,000 was entered in cash book. That means your cash balance, your bank balance as per cash book increased, but passbook balance not affected. So what I need to do? Deduct less to match with the passbook. Less 4,000 I need to do. Next, a check for 2,400 deposited into bank but omitted to be recorded in cash book but was collected. See this, check 2,400, sir. We deposited, but we have not recorded in cash book. But in our passbook, it was already created. So therefore, passbook balance might have been increased now. So we also need to increase to match with the passbook. So what I need to do? Add. How much? 2,400. Next, a bill receivable for 2080 previously discounted, discount 80 with the bank had been dishonored, but advice was received on 3rd April. Say this, there was a bill which is dishonored, How much amount? 2080, including discount, 2080 dishonored. But we received communication on 3rd April. That means on 31st March, if you see, my balance as per passbook was reduced because bill was dishonored. So the moment the bill was dishonored, the amount will be deducted from my bank account balance, customer bank account. So therefore, in order to match with the passbook, what I need to do? Less. So therefore, less. How much less? 2080. Including discount, they will deduct. Including discount amount, gross amount of the bill will be deducted. Next, a bill for 40,000 was retired paid by bank under a rebate of 600, but the full amount of the bill was credited in the bank column of the cash book. See this, sir, bank paid 40,000, sir, but there is a discount of 600. That means how much balance was paid? How much amount is paid? 39,400. Hello. So therefore our passbook balance reduced by 39,600. But in your cash book, how much you recorded? 40,000 you recorded. 40,000 you recorded. That means excessively your balance as per cash book reduced how much? 600. So therefore in order to match with what I need to do? Add. So add 600 will be added to match with the passbook. Next, a check of 10,000 wrongly created in the passbook on 29th March was reversed on 2nd April. Say this, a check of 10,000 was created to my passbook wrongly. That means my passbook balance has been increased, but it was reversed on 2nd April. Therefore on 31st March, if you see, there is a difference. My passbook balance increased by 10,000. So in order to match with it, I also need to add. So add 10,000. Add 10,000. Next, bank had wrongly debited 20,000 in the account on 31st March, but reversed on 10th April 2023. See this, bank has wrongly debited 20,000 in the account. Debited means my balance reduced as per passbook. So in order to match with the passbook, I also need to reduce. So less 20,000. Less 20,000. Next, a check of 800 drawn on the savings account has been shown as drawn on which account? Current account in cash book. See, we draw a check. How much check we draw? 800. On which account we draw? Savings account. But it is shown as drawn on which account? Current account. That means my balance reduced by 800 in the cash book. So in order to match with passbook, what I need to do? Add 800. That's it, pa. So you check here, 1,58,280. These things, less, add, less, all these things you do. So these are the answers. 1,58,280, sir. These are the things added. So what are the things they have added, sir? 10,000, 2,400, 600, 10,000, 800. Correct? 10,000, 2,400, 600, 10,000, 800. What are the things they less? So 30,000, 4,000, 2,080, 20,000. See this. So automatically you will get the balance as per passbook. This is one method. This method is called what? Without amended cash book. Without amended cash book. Now the same question I can solve through amended cash book also. In amended cash book method, what we need to do first? We need to first update our cash book bank balance. Amended, corrected cash balance, cash book balance we need to find out. I told you which entries will be updated in our cash book. The entries which is already recorded in passbook but we have not recorded in cash book, first we will update. Second, any omissions, errors happen, they will be recorded. Any errors will be rectified. Now you check out of all these things, which items already recorded in passbook but not recorded in cash book. Check one by one. For example, you see this. Checks issued on 28th March but were not presented. That means it is already recorded in cash book. So no need to take this. Second one, you see a check deposited in bank but not recorded in cash book. Therefore, this will be updated in our books, in our cash book. Next, rebate on bills not entered in cash book. Not entered. This will also be updated. See, the transaction which is updated in passbook but not updated in cash book, you update. Next, check wrongly created by bank. Check wrongly created by bank. This is, I think, already. See, any errors committed by bank in the bank and any transaction not affected in bank, don't update. They will update it only in BRS. They will update only in BRS. Next, checks drawn on savings account but wrongly created in current account. This was the mistake from my side. So therefore I need to update this. So therefore you see these three items I need to update. And also checks deposited but not collected. This is already recorded. A check entered in cash book, already entered. Discounted bills receivable dishonored. This was not recorded in cash book. Updated in passbook but not recorded in cash book. Update now. And amount wrongly debited by the bank. Wrong, any errors committed by the bank, anything not recorded in bank, don't update. So therefore in the amended cash book, what things you need to update? Only which are already recorded in passbook but not recorded in cash book, or any omissions in the cash book, or any errors, these things only done. Any errors committed by the bank, don't record, don't update it. They will update only in BRS, or anything they have not recorded, don't update. They will be updated only through BRS. Now see, that means if I need to do the amended cash book, right? So my cash balance is how much? 158, 280. These things I need to update. These 4 items. So see this. First I need to prepare the amended cash book. My bank column. This is my balance given. What are the things I need to update? See this. First this 2400. Checks deposited but not recorded in cash book. Now I will record. So my bank balance will increase. My bank balance in the cash book is increased. So 2400. Next 600. See this. Rebate on bill not entered in cash book. If I entered this rebate, my bank balance will increase. Add debit side. Sir, debit side represents what? All receipts. Credit side represent all payments. Next, checks drawn on savings but wrongly recorded in current account. So I need to increase now. 800. One thing I need to deduct is what? Discounted bills receivable dishonored but not recorded in cash book. 2080. This is reducing my cash balance, right? Less. So therefore, what is my updated balance? 1,60,000. 1,60,000. Now once you got this updated balance, now you prepare bank reconciliation statement. So this balance as per cash book you take 1,60,000 and identify the remaining differences. The things which the transactions which you already recorded. Apart from this, what are the items are there? This one is there now. So this 10,000, 600. No. I think 10,000 is there. Another 10,000. 2 items here. And here 30,000. 4,000 and then 20,000. These items you do. For example, you see 10, 10. These 2 items will be added. 10 add, 10 add. Normal BRS. Just like, what are the items we need to less? These items. Less already done na? 3420. 3420. Okay? 3420. So you will get 1,26,000. So therefore answer is same under both the methods. There is no difference. So what is the basic difference between first method and second method, sir? In first method, directly we will start with one balancer. We identify the differences, add less, we will arrive at the balance. But in second method, amended cash book method, first we will update the cash book. Which items we will take into account for updation? Items which are not recorded in cash book but already recorded in passbook. Suppose passbook any errors committed, we don't update it, and anything not recorded in passbook, we don't update it. So the only thing which we updated, which is already recorded there but not recorded here. Any omissions you do, record it now. That's it. Any errors you do, rectify it. That's it. The things which is not there in the passbook, don't update here. They will all update it in BRS. They will all update it in BRS. This is the question, sir. If you solve this question properly, I think you can solve all the questions relating to BRS. So this is the first concept. I have explained BRS concept, sir. Okay, sir. In first chapter, another important area is depreciation topic, sir. Normal depreciation questions everybody will solve, sir. Depreciation, you know, depreciation is nothing but loss in value of asset due to wear and tear, usage, time. Because of so many reasons, asset may loses its value over a period of time. That we call it as what? Depreciation. In case of intangible assets, we call it as what? Amortization. For any natural resources, we call it as what? Depletion. But here in this topic, the most important area we need to focus is methods of recording depreciation. See this is important. Mostly questions they will ask relating to this. Methods of recording depreciation, sir. See, there are two methods to record depreciation, sir. One is without maintaining provision for depreciation account. Second one is by maintaining provision for depreciation. So without maintaining provision for depreciation is not maintained. This is called ordinary method. Second method is when provision for depreciation is maintained. Say this. When provision for depreciation is not maintained. See the entries. First we will purchase the asset now. When you purchase the asset, what is the entry? Asset to cash or bank. And at the end of the year, you provide depreciation on the asset. When you provide depreciation on asset, what is the entry? Depreciation to asset account. Because in this method, we are not maintaining separate account for provision for depreciation. So therefore, depreciation is directly deducted from the asset value. Next, this depreciation is a loss. It will go to P&L account. P&L to depreciation. So 3 entries. Purchase of asset, depreciation, transferring depreciation to P&L. Next, you sell the asset. When you sell the asset, what is the entry? Cash or bank to asset account. At what value? At a sale value, gross sale value. Now in this sale value, there is a profit or loss. That profit or loss we need to transfer to P&L account. Suppose there is a profit, asset to P&L account. Suppose if there is a loss, P&L to asset account. For example, sale value is 1 lakh. WDV 80,000. That means written down value after depreciation is 80. You sold it for 1 lakh. So therefore, first sale entry, cash or bank to asset account, 1 lakh we will write. And we know that in this 1 lakh, how much is the profit is there? 20,000. Because sale value 1 lakh, WDV 80. So 20,000 profit is there. This profit you transfer to P&L account. From asset to P&L account, P&L to asset account if there is a loss. If there is a loss, P&L account will be debited. If there is a profit, P&L account will be credited. These are the entries when provision for depreciation account is not maintained. So the main thing is what? When provision for depreciation is not maintained, depreciation cost is directly deducted from the cost of the asset. That means asset is appearing at the WDV value. Asset is appearing at the WDV value in the balance sheet. Okay. Suppose when provision for depreciation account is maintained, sir. This is important. Listen. When provision for depreciation account is maintained, sir, how things will be? First we purchase the asset to cash or bank. Next, at the end of the year, you provide depreciation. In this method, depreciation will be charged to provision for depreciation account. It will not be deducted from the asset. It will be directly credited to an account called provision for depreciation account. So depreciation account debit to provision for depreciation account we will write. So what is the effect if you are transferring depreciation to provision for depreciation instead of the asset? The effect is asset is maintained at cost. The cost of the asset is not disturbed. And depreciation you are transferring to a separate account called provision for depreciation. This provision for depreciation indicates total depreciation. Next, as usual, depreciation is a loss. It will be transferred to P&L account. So P&L account debit to depreciation account. These are the first 3 entries. Now, the most important entries are sale of asset. See, when you sell the asset, already in respect of that asset, what is there? Provision for depreciation is there. Then what is the entry? You can write a combined entry. When you sell the asset, cash or bank account will be debited. Provision for depreciation account will be debited. Because when you sell an asset, sir, in respect of that asset, whatever the depreciation accumulated so far, provision for depreciation, that will also be cancelled. So therefore, cash or bank account debit, provision for depreciation account debit to asset account. Asset will be credited at cost value. Cash or bank is debited with sale value. Provision for depreciation at depreciation value. So from the cost of the asset, if I reduce provision for depreciation, I will get WDV. Compare with sale value. If the sale value is more than WDV, profit, that is credited to P&L account. If the sale value is less than WDV, loss, debited to P&L account. Therefore, the combined entry in this case, when provision for depreciation is maintained, cash or bank account debit, provision for depreciation account debit, P&L account debit if there is a loss, to asset account, to P&L account if there is a profit. The same thing only I have recorded through 3 entries here. So what is the difference between method 1 and method 2? When there is no provision for depreciation, Depreciation is directly reduced from the cost of the asset. Therefore, depreciation to asset we have written. Depreciation to asset. Asset already reduced by depreciation. And when you sell the asset, you return sale value. As gross sale entry you have written cash or bank to asset. And in this asset, whatever the profit or loss there, you transfer to P&L account. But when you are maintaining provision for depreciation, asset is maintained at a cost. Asset is maintained at a cost value. So when you sell the asset, that cost of the asset will be credited. Provision for depreciation account will be debited. Cash or bank account will be debited. The difference is profit or loss. The difference is profit or loss. For example, you see sale value 1 lakh. Cost of the asset also 1 lakh. Provision for depreciation 40. WDV is 60. So therefore, what is the entry we will write here? The entry we are going to write is cash or bank account debit. What is the sale value? 1 lakh. To asset account. For example, the cost of the asset is 1 lakh. Provision for depreciation. So far, what is the provision for depreciation accumulated? 40. See how I am comparing. Your cost of asset 1 lakh. Till now, how much is the depreciation? 40. That means WDV of the asset is 60. But you are selling for 1 lakh. So therefore, what is your profit? 40,000. That will be credited to P&L account. That's it. Always compare sale value with the WDV. Okay. This is the entry. These are the things. This is when, sir, when provision for depreciation is maintained. Now, listen. Sometimes, sir, some companies, what they will do is, they will open an account called asset disposal account. What is that? Asset disposal account. Whenever they are selling an asset, sir, asset disposal account they will maintain. They will brought asset disposal account. Listen to me carefully. This asset disposal account, first whatever the asset you are selling, transfer that asset cost value to this asset disposal account. Suppose you are selling machinery number 1. So asset disposal to machinery. Transfer that to asset disposal account. First you need to do that. Asset disposal to asset account. And next, in respect of the asset which you are transferred to asset disposal, whatever the accumulated depreciation is there, that is also transferred to asset disposal. Generally, provision for depreciation is showing which balance? Credit balance. So now debit it, transfer to asset disposal account. So the entry is provision for depreciation to asset disposal account. Next, you sell the asset. When you sell the asset, cash or bank to asset disposal account you write. Automatically the balance figure is what? Profit or loss. Suppose for example, we have transferred cost of the asset to asset disposal 1 lakh. On this asset, the provision for depreciation is 40. We sold this asset, cash or bank to asset disposal account for 80,000. So see this, credit side 1 lakh 20,000, debit side 1 lakh. So what is the difference? 20,000. What is this 20,000, sir? Profit. So it will be transferred to P&L account. So therefore, in asset disposal account, first asset will be transferred. Cost of the asset will be transferred, the asset disposal to asset. Then provision for depreciation will be transferred. What is the entry? Provision for depreciation to asset disposal. Then sale. Whenever you sell the asset, cash or bank to asset disposal. Then asset disposal account will be closed. The balance figure is what? Profit or loss. See this, P&L, asset disposal to P&L account, P&L to asset disposal account. See, sometimes, not every time, sir, companies will open this asset disposal account also. And sometimes in the questions they will particularly ask you, prepare asset disposal account. Then in such situations, you need to assume that that company, whatever the asset they are selling, they have transferred to this disposal account. And main purpose of asset disposal account is what, sir? To ascertain ultimately what is the profit or loss on sale of that asset. Okay. So tell me, methods of providing depreciation, how many methods are there? 2 methods. What is the first method? Without maintaining provision for depreciation. When you don't maintain provision for depreciation, what are the entries? When you purchase an asset, asset to cash or bank. When you provide depreciation, depreciation to asset. Then depreciation will be transferred to P&L account. Now when you sell the asset, cash or bank to asset, at what value? Sale value. And in that sale value, what is their profit or loss? That is transferred to P&L account. If there is a profit, asset to P&L account. P&L account will be created if there is a profit. If there is a loss, P&L to asset account. Suppose when you maintain provision for depreciation, purchase of asset, same entry. Depreciation providing entry, depreciation to provision for depreciation. Depreciation to provision for depreciation. And depreciation is transferred to P&L account. Now, if you are selling the asset in respect of which there is a provision for depreciation, what is the entry? Cash or bank account debit, provision for depreciation account debit to asset account. Asset account is created with the cost. Cash or bank is debited with sale value. Provision for depreciation is the total depreciation accumulated. So the difference is nothing but profit or loss. Sometimes companies will maintain an account called asset disposal account. When they are maintaining asset disposal account, first the cost of the asset they want to sell, they need to transfer it to asset disposal account. What is the entry? Asset disposal to asset. And also whatever the provision for depreciation is there in respect of that asset, they will transfer. What is the entry? Provision for depreciation to asset disposal. And when they sell the asset, cash or bank to asset disposal. See, when you open asset disposal account, sir, whatever the asset you are disposing, selling, everything relating to that asset will be transferred to asset disposal account only. And finally you close the asset disposal account, you will get profit or loss. That profit or loss will be transferred to P&L account. So these are the methods for maintaining depreciation, sir. Okay. Next. So in study material, sir, yeah, come to this question, sir. Illustration number 13. See this illustration. They are testing these type of questions. S and Co purchased a machine for 1 lakh on 1/1/2021. Another machine costing 1,50,000 was purchased on 1/7/2022. On 31st December 2023, the machine purchased on January 2021 was sold for 50,000. That means first mission. See, this is mission 1, this is mission 2. The company provides depreciation at 15% on straight line method. SLM basis they are providing depreciation. The company closes its accounts 31st December every year. So the calendar year they are following, sir. Now what they are asking, sir, prepare machinery account, machinery disposal account, provision for depreciation account. That means they are maintaining provision for depreciation. Now see, in this case, we need to prepare these ledger accounts. In order to prepare ledger accounts, first in your mind, you need to frame what? Entries. If you frame the entries properly, then ledger accounts will automatically come down. So suppose for example, here if I want to pass the journal entries, what entries I am going to pass? See, first I purchased an asset now. When I purchased? January 1st, 2021. What is the entry for purchase of asset? Asset to cash or bank. Correct? See this. See this, everybody. First asset account, machinery to cash or bank, 1 lakh, 1 lakh. First entry number 1. When this is? January 1st, 2021. Next, at the end of the first year, 31st December 2021, we need to provide depreciation. Here depreciation, what is the entry? Depreciation to provision for depreciation, because we are maintaining separate account for provision for depreciation. How much is the depreciation, sir? 15%. Correct? On SLM basis, right line method. So therefore, 1 lakh into 15%, 15,000 is the depreciation. And this depreciation will be transferred to P&L account because it's a loss. It is debited to P&L account. So P&L to depreciation. So first year is done. First year is over. Now come to second year. What happened in second year? We purchased another machine. When we purchased it, sir? 1/7/2022. Second year we purchased a machine. Again, what is the entry for purchase? Machinery account debit to cash or bank. Correct? Machinery to cash or bank. 1/7/2022. Now at the end of the year you provide depreciation. Now second year we have two missions to provide depreciation. First mission cost is 1 lakh. On that 15%. Second machinery when you purchased 1/7/2022, 1,50,000. Therefore you need to provide depreciation for 6 months. Sir, second machinery purchased on 1/7/2022. So therefore 1,50,000 into 15% for 6/12. So therefore total depreciation at the end of the second year is how much? 26,250, 26,250. And this depreciation will be transferred to P&L account. P&L account debit to depreciation. So second year done. You understand second year? Now next, important. What happened next? See this. Third year, on 31st December 2023, the mission purchased on 1/1/2021, that is first mission, was sold for 50,000. So there is a sale of machinery. Tell me what is the entry you are going to write for sale of a machinery in respect of which already there is a provision for depreciation. Just now I told. First, cash or bank account will be debited. Provision for depreciation account will be debited. To asset account will be created. Asset account is maintained at cost. So the difference is nothing but profit or loss. Here what is the cost of the asset we purchased? 1 lakh. 1 lakh is the cost of the asset. Correct? Huh? So what is the sale price? 50. So cash or bank 50,000. Asset account is created with 1 lakh. Now sir, in respect of this mission which we purchased, what is the total depreciation accumulated till now? What is the total depreciation accumulated till now? Total depreciation accumulated till now is 45,000. How? We purchased on 1/1/2021. So in the year 2021, 15,000 depreciation. 2022, another 15,000 depreciation. This is at the end of 2023. That means third year depreciation. Total how much depreciation? 45,000. So therefore, cash or bank account debit, provision for depreciation account debit to asset account. Differences will transfer to profit or loss. But guys, in this problem they are saying that this company is maintaining what? Asset disposal account. If I don't maintain asset disposal account, this is the entry I will write. But they are maintaining asset disposal account. Now you need to understand, sir. First third year you provide depreciation. At the end of the third year you provide normal depreciation. So depreciation is on machinery number 1 15%, on machinery number 2 we purchased in second year 1,50,000, total year depreciation. This is 37,500 is the depreciation for third year. Now in third year another thing is happening is sale. Now I told you this company is maintaining asset disposal. The moment they are maintaining asset disposal, what we need to do? We need to transfer the machinery cost to asset disposal account. I told now, what is the entry for that? Asset disposal account debit to machinery account. Correct? See this. At what value? Cost. And also provision for depreciation in respect of that asset also will be transferred. What is the provision for depreciation we are maintaining? 45. So therefore provision for depreciation to asset disposal. And you sold it, cash or bank to asset disposal, 50,000. So therefore if I prepare asset disposal account, say this. The cost of the machinery 1 lakh, depreciation so far 45. That means 1 lakh minus 45, 55,000. But we sold for 50. Therefore there is a loss of 5,000 that is transferred to P&L account. So therefore that is what we have written, P&L to asset disposal. Are you guys understanding? See, tell me what is the entry for in asset disposal, what items will come? First asset transferred. When you transfer the asset, what is the entry? Asset disposal to machinery. What value? Cost 1 lakh, 1 lakh. Then provision for depreciation in respect of the asset sold will be transferred to asset disposal account. What is the entry? Provision to asset disposal. So therefore asset disposal is created with 45. Correct? And then sale. You sold for 50,000. What is the entry? Cash or bank to asset disposal. So and ultimately this asset disposal account is prepared to find out what? Profit or loss. So in this case we got a loss of how much? 5,000. That loss will be debited to P&L account. P&L account. So this is how we need to. Next we need to prepare the machinery. Once we know the ledger entries, I mean journal entries, ledger accounts is quite easy now. So say this machinery account. Opening 1 lakh. Closing 1 lakh. 31st December. Because see, machinery account is depreciation we don't deduct now. Because depreciation we are maintaining a separate account. Provision for depreciation. That means asset is maintained at cost. So first year 1 lakh machinery 1. Next year another machinery 1,50,000. Total 2,50,000. Third year what happened? Out of this 2,50,000, 1 lakh was sold. So remaining balance 1,50,000 will continue. If you see the provision for depreciation account. First year depreciation is how much? 15,000, which we transferred to provision for depreciation. This is the balance will carry forward to the next year. Second year depreciation 26,250. Total 41,250 will be carried forward to third year. Third year depreciation 37,500. Now see, out of this total depreciation, the depreciation of the asset we sold, How much we cancelled? 45,000. So that way debited. Remaining balance will continue. And machinery disposal account, I already told you. First cost of the asset will be debited. Accumulated depreciation will be created. Sale value will be created. The difference is profit or loss. So this is how you need to do the things in case of this problem, sir. Okay, sir. So this is one area, sir. Methods of providing depreciation and methods of providing depreciation. This is the second area in the first chapter, one of the important areas, sir. And few concepts relating to assets will be covered in accounting standard 10, sir. Accounting standard 10. In the accounting standard 10, when you acquire any asset by exchange, how it will be accounted for, all those things are covered in accounting standard 10, not here. Here basic fundamental accounting treatment, methods of providing depreciation, all these are covered, sir. This is second area in the first chapter, sir. The first area we covered it what, sir? BRS. Second area, methods of providing depreciation. Okay, sir. Next important area we are going to cover from chapter number 1, accounting fundamentals, is accounting treatment of bad debts, provision for doubtful debts. This is one area, sir. There is a chances that they may ask a question. Okay. What is this accounting treatment of bad debts and provision for doubtful debts? Observe carefully. See, generally when you sold goods on credit basis, you need to receive the amount from the customers, right? So whatever the amount you are going to receivable from the customers or debtors is called what? Basically debt. Now whether this debt will be collected or not, that's a important question. Based on the chances of collection, from the debtor, sir, they have classified debts into 3 categories. One is good debt. Good debt means it is likely to be realized fully. Next, bad debt. Bad debt means it won't collect. That means it is a loss, confirmed loss, irrecoverable. Bad debt means irrecoverable. It's a confirmed loss. Third is what? Doubtful debt. What is doubtful debt? Collection is not certain. Whether it will come or not, we don't know. So basically, based on the chances of collection from the customers, the debts are divided into 3 categories, sir. Good debt, bad debt, doubtful debt. Sir, bad debt is a confirmed loss, sir. No need to think about it. Doubtful debt is what the area is. Whether amount will collect or not, we don't know. It may collected, may not be collected. So when it comes to bad debt, since it is a confirmed loss, what we will do? We will directly debit to P&L account and deduct it from the debtors. Because debtors balance reduced our asset. Collection is not possible and it's a loss. So therefore it will go to P&L account. So therefore, what is the entry for bad debts, sir? Bad debts to debtors. These bad debts will go to P&L account. This is the treatment for bad debts. Now come to doubtful debts. Doubtful debts is not a confirmed loss. It may become a loss, possible loss. So therefore it cannot be directly written off like bad debts. So what to do then? Tell me. When you know that your amount is, there is a doubt that it is going to collect or not. You have a doubt. What you are going to do? Just we create a provision. Create a provision for doubtful debts. Create a provision. Anticipate possible loss and for that you create a provision. Basically what is provision here? Provision is nothing but a charge against the profit for the purpose of providing for any possible loss or liability. In future there is a loss for you. There is a chance that a loss may come or a liability may come. To meet that loss or liability, what you can do? Some of your profits you transfer to a separate account called provision for doubtful debts account. So provision for doubtful debts is nothing but an estimated amount of likely and non-recoverable debts. Okay. And this we will do based on the conservatism or prudence concept, because prudence concept says we need to anticipate all possible losses. So we are going to anticipate. So therefore tell me, bad debts means confirmed loss. So what is the entry? Bad debts to debtors. Next, doubtful debts means possible loss. So you create a provision. That provision is charge against profits to meet the future possible losses or a liability. Okay. Now, what are the methods of accounting for this bad and doubtful debts? See, there are two methods, sir. Important. Listen to me carefully. What are the methods for accounting of bad and doubtful debts? There are two methods. Method number one. This method says you are maintaining provision for doubtful debts account, right? You have bad debts. You do one thing. This bad debts you directly adjust with provision for doubtful debts account. Bad debts is directly adjusted with provision for doubtful debts. Provision for bad and doubtful debts account, you adjust this bad debts. And at the end, check how much is the provision you need to maintain. What is the balance provision available? Accordingly, you create the provision. You see whether you want to create the provision or if there is an excess provision, you need to written off. This is method number one. So basically in method number one, what we will do is provision is adjusted against, bad debts is adjusted against provision for doubtful debts. See this, a provision for a doubtful debt account is opened and all bad debts are adjusted against the provision for doubtful debt account. That means in this case, what are the entries will come? First bad debts is there. What is the entry for bad debt? I told you. Bad debts to debtors. Then later on, this bad debts you written off for writing off the bad debts to provision for doubtful debt account. Provision for doubtful debts to bad debts account you will do. And creating necessary provision at the end of the year. Suppose if at the end of the year you need to create provision, P&L to provision for doubtful debts you write. Normal entry. Suppose you see, for example, everybody please check. Your opening provision is 1 lakh, sir. Opening provision is 1 lakh. Provision for doubtful debts opening 1 lakh. Your debtors is 10 lakhs. Your debtors is 10 lakhs. Bad debts 40,000. Bad debts 40. So 10 lakhs minus 40, 9 lakh 60. Company policy is creating 10% provision on doubtful debts. So 9 lakh 60,000 into 10%. 96,000 is my closing provision I need to maintain. Closing provision I need to maintain. My opening provision 1 lakh. Against this opening provision, bad debts 40,000 will be adjusted na. So therefore, what will be the balance available? 60. But closing how much I need to maintain? 96. So therefore 36,000 provision I need to create from the current year profits. What is the entry for that? P&L to provision for doubtful debts. 36,000, 36,000. You understand this? Or else this can be calculated like this also. First to take the closing provision required. What is the closing provision required? 96. How much is the bad debts written off against it? 40. So 1,36,000. Compare with the opening provision of 1 lakh. So what is the balance? 36,000. This is the provision we need to create from the current year profits. This is method number 1. So can you tell me what is method number 1? Bad debts are adjusted against provision for doubtful debts. And at the end we will check whether further provision required to be created or excess provision there to written off. So when there is a bad debts, what is the entry? Bad debts to debtors. Then this bad debts is adjusted against provision. What is the entry for that? Provision for doubtful debts to bad debts. And at the end you check whether provision required to be created or not. Compare the opening and closing. Either you can prepare this provision for doubtful debts account. Here opening provision, bad debts adjusted, closing provision, balance is to be created, or you can prepare in statement manner also. First you take the closing provision, for that add bad debts written off. From that opening provision, the difference is nothing but closing provision to be amount to be created from the current year profits. Sir, method number 2 is also available. In this method, sir, what we are going to do is bad debts we don't adjust against provision. Bad debts we will directly charge to P&L account. Bad debts directly charged to P&L account. In method number 1, what we have done? Bad debts adjusted against provision. In method number 2, what we do? This bad debts is there na. This bad debts we charge to P&L account as a loss. So bad debts to debtors, then P&L to bad debts. Then at the end of the year, create necessary provision. Suppose if the closing provision you need to create is greater than the opening provision, create. Suppose closing provision required is less than the opening provision, that means excess provision already created, reverse it. Hello, what is the basic difference between method 1 and method 2? You understood? In method 2 what we have done? Bad debts is directly transferred to P&L account. Okay. And at the end, what is the provision I need to maintain? Check it. Closing provision required is more than opening provision. For example, closing provision 1 lakh required. Opening provision already 90,000 is there. So how much I need to create now? 10,000. P&L to provision for doubtful debts. Suppose opening provision 1 lakh, closing provision 1.2 is there. I need to maintain only 1 lakh provision, but my opening provision is 1.2. So therefore excess provision I need to written off. Provision to P&L account. Now in balance sheet, how will you present this debtors, sir? This provision, bad debts and all. See this. Sundry debtors, bad debts will be deducted, and then provision for doubtful debts will also be deducted. Sundry debtors minus provision for doubtful debts we will deduct. Now recovery of bad debts. Suppose in future if the bad debts are recovered, we will directly credit it to P&L account. Bad debts recovery. We will credit directly to P&L account. Okay. So simple treatment for bad debts, sir. There are two methods for accounting treatment of bad and doubtful debts. First method, you are maintaining provision for doubtful debts account, and bad debts when it created, bad debts to debtors, this bad debts adjust against the provision, and at the end how much provision required, see the requirement, how much provision is there after adjustment of bad debts, create the balance provision from the current year profits. In second method, sir, bad debts directly transfer to P&L account. Okay, and then find out the closing provision to be maintained. What is the opening provision? If balance provision required, you create from the current year profits. If already created excess provision, written off. Okay. Now relating to this, I will show you one question, sir. Yeah. See this question, illustration number 15, sir. Messrs. Aduna and Co. had a provision for bad debts. How much provision is there? 13,000. Against their book debts on 1st April 2022. This is the opening provision. During the year ending 31st March 2023, 8,500 proved what? Irrecoverable, bad debts. And it was desired to maintain a provision for doubtful debts at 5% on debtors, which stood at 3,90,000 before writing of bad debts. Sir, before writing of bad debts, your closing debtors is 3,90,000. That means I need to reduce bad debts. Bad debts is how much? 8,500. So therefore 3,90,000 minus 8,500 into what is the provision I need to maintain? 5%. So how much it is? 19,075. This is the closing provision I need to maintain. So see this provision for doubtful, bad and doubtful debts account if I prepare. Opening balance 30 na. Closing provision I need to maintain this one na. And in method number 1, bad debts is directly adjusted to provision na. Provision to bad debts. So therefore what is the balance provision required? 14,575. This is the further provision required. Now see illustration number 16. On 1st April 2022, the balance of provision for bad and doubtful debts was how much, sir? 13,000. Bad debts during the year 22-23 were 9,500 bad debts. The sundry debtors as on 31st March 2023 stood at 3,25,000. Out of these debtors of 2,500 were bad and cannot be realized. You have to read the wordings carefully, sir. So this debtors 3,25,000, sir. Of these debtors, 2,500 has become bad. During there, how much bad debt, sir? 9,500. At the end, how much bad debt, sir? 2,500. So total 12,000 bad debts. In this 3,25,000, 2,500 bad debts is there. Current year during 22-23, 9,500 bad debts is there. Okay. Next, the provision for bad and doubtful debts is raised to how much? 5% on sundry debtors. You are required to pass necessary entries for bad debts and its provision on 1st March 2023, and also prepare necessary ledger accounts and show the relevant items in the statement of P&L and balance sheet. Now first they are asking necessary adjustment entries, sir. Tell me what entries you will write for bad debts and provisions. First bad debts account debit to debtors account. How much? They are asking on 31st March 2023. During the year, no. At the end. At the end, still how much bad debts is there? 2500. So therefore, bad debts to debtors 2500, 2500. Correct? And if nothing mentioned means we will follow method number 1. In method number 1, bad debts is adjusted against provision. What is the entry? Provision for doubtful debts to bad debts. Bad debts. Provision to bad debts. See this. Provision to bad debts. So how much you will adjust provision, sir, along with the bad debts? 12,000, 12,000. Why 12,000, sir? Current year 9,500, at the end 2,500. Total 12,000. Adjust. Now you tell me. You tell me, sir. How much is the current year provision we need to create? If I prepare provision for bad and doubtful debts account, my opening provision is 13. Opening provision how much, sir? 13,000. During there, how much bad debts is adjusted against provision? 12. And at the end, how much provision I need to maintain? My debtors 3,25,000. On this 2,500 is bad. You should not reduce total 12,000 because clearly mentioned that at the end debtors is 3,25,000, out of which 2,500 is bad. So therefore 3,25,000 minus 2,500. How much? 3,25,000 minus 2,500 into 5%. How much, sir? 16,125. Now you check it, sir. Your opening provision 13,000, sir. You adjusted 12,000, sir. That means 1,000 balance is there in the opening provision. But closing you need to maintain 16,125, sir. Therefore current year provision is how much, sir? 15,125. How much provision to be maintained? How to find out, sir? Closing, you can calculate like this. Closing 16,125 plus bad debts written off 12,000 minus opening 13,000. So 15,125 is the provision from the current year. So therefore the entry is P&L to provision for doubtful debts 15,125. And necessary ledger account. Suppose if I prepare bad debts account 9,500 on 31st March 2023, two balance brought down. Their intention is, since they are preparing at the end of the year, by that time this 9,500 already came bad debts during there. That's why on 31st March 2023, this they have considered like a opening balance. And then current year 2,500 at the end 2,500. So total 12,000, which is adjusted against provision for bad and doubtful debts. And debtors account if I prepare na, sir, my debtors total how much, sir? 3,25,000. In this 2,500 is the bad debts adjusted. So 3,22,500. How you are going to present in P&L account, sir? P&L account. P&L account, how much amount will come, sir? This one, 15,125. See this, 15,125. This is the provision we create now from the current year profit. What is the entry for that? P&L to provision. So in P&L account, 15,125 will come. In balance sheet, sir, sundry debtors 3,25,000. Further bad debts 2,500 minus provision at the end 16,125. So this is how you need to do the accounting for bad and doubtful debts. So unless otherwise prescribed, sir, which method you will follow? First method. So in first method, tell me finally, when we create when there is a bad debts, what is the entry? First of all, tell me what is the entry for bad debts? Bad debts to debtors. This bad debts we will adjust to provision in method number. What is the entry? Provision to bad debts. Then you need to check closing. I mean, how much provision I need to maintain, how much balance is there. That you need to create in the current year. Correct? That's it. This is the treatment, sir. If you create any provision in the current year, what is the entry for that? If you create any provision for doubtful debts, P&L to provision. P&L to provision. So like this, there are questions, sir. So remaining questions also you can practice, sir. Very easy. Same concept, whatever I told you. If you apply that concept, these questions will be done. Okay. This is one area, sir. Okay, sir. From the first chapter, accounting fundamentals, next important area we are going to discuss is rectification of errors topic, sir. This is one of the most important area. Definitely there is a chance that a question may come. Listen to me carefully. I'm going to discuss rectification of errors from examination point of view. If you learn what I'm going to taught for next 30 minutes, that will be more than sufficient to handle the questions in examinations. First, see here, what is the topic name, sir? Rectification of errors. That means first of all errors happened. Now we are rectifying them. So there are two things here. First, there is an error already there. Now I am rectifying it. So we are learning rectification of errors. In order to rectify the error, first you need to understand what type of errors are possible. What type of errors are possible. See, there are 4 broad categories of errors, sir, when you are doing accounting. Like right from journal, ledger, trial balance. This is the accounting cycle, right? 4 types of errors are possible, sir. Mostly these errors are possible in journal and ledger. These 2 places most of the errors will come. Okay. These errors are divided into 4 categories, sir. One is errors of principle, errors of omission, errors of commission, and then compensating errors. 4 types of errors: principal errors, omission, error of commission, compensating errors. First, errors of principle. What is this errors of principle? See, when you enter any transaction in contravention of accounting principles, that is called principal errors, errors of principle. Like for example, capital expenditure is treated as revenue expenditure. You purchase an asset, but you treat it as a normal purchases. For example, you purchase an asset to cash or bank, but you have written purchases to cash or bank. That is called error of principle. Principally, you have done the error. That is one type of error. Next, errors of omission. Very common, sir. Human beings will omit. So there is a 2 possibilities: complete omission, partial omission. Complete omission means one complete transaction may be omitted to record, or maybe omitted to post in the ledger account. Maybe one thing is completely omitted, complete omission. Partial omission means half. For example, you recorded debit, credit not recorded. Or one aspect of the account you posted to ledger, another aspect you have not posted. So therefore that is called partial omission. Next, errors of commission. These are very, very dangerous and important errors. Errors of commission. What is these errors? Errors of commission means wrong casting of subsidiary books. See, we have subsidiary books, sales book, purchase book, sales returns, purchase returns, like this we have now. Wrong casting, totaling wrong. For example, purchase book total 10,000, but you taken 1,000. Sales book total 10 lakhs, but you taken 10,000. Wrong casting, totaling errors. Wrong amount posted in ledger. For example, goods sold to Mr. M, 1 lakh. You recorded, but when it posts to the M ledger account, you posted only 1,000 rupees. That means wrong post happened in the ledger account. Next, posting amount on the wrong side. Instead of debit, you credited it. Instead of credit, you debited it. Possible? Yes. Next, wrong balancing. When you are preparing a ledger account, sir, you need to find out the balancing amount, sir. That balancing you have done wrongly. These are called errors of commission, sir. So error of commission means totaling, wrong casting of subsidiary books, or posting in the wrong amount posted in the ledger account, or posting amount on the wrong side, or wrong balancing of ledger accounts. Any one of these things may happen. Wrong balancing, totals are wrong, written on the wrong side, amount posted on the wrong account. These are the mistakes happen. These are all called which errors? Errors of commission. Last errors is compensating errors. Sir, what is this compensating error? You do errors in such a manner that they compensate each other. The effect will be cancelled out each other. They are called compensating errors. For example, sir, purchases book overcasted by 10,000. When you are totaling the purchases book, sir, 10,000 increased, overcasted. Same manner, sales return book 10,000 undercasted. Sales returns book 10,000 was undercasted. Generally, sales returns is debit balance. Purchase also debit. One debit account you have overcasted. Another debited account you undercast. Both will nullify the effect. Those are called compensating errors. If the effect of the errors committed is cancelled out, they are called compensating errors. Correct? These are 4 types of errors possible. Now the point is, sir, okay, these errors happened. Now out of these errors, which errors have the capability to affect my trial balance? Because of which errors my trial balance will not tally? Which errors trial balance will not tally? See, listen. Sir, errors of principle, trial balance will tally. There is no chance that trial balance will not tally. Errors of omission, complete omission, trial balance still tally. Partial omission, maybe there is a chance that trial balance may not tally. Errors of commission, there is a chance that trial balance will not tally normally. Compensating errors, trial balance will tally. Sir, tell me why trial balance will not tally? For example, this is the trial balance. Okay, debit items, credit items. You write all the debit, you write all the credits. Total must be same, right? Suppose one side 10 lakhs coming, another side 9 lakhs coming. So that means credit side how much missing? 1 lakh. Why it is not tallying? The reason is simple. Either you have not recorded one item, or somewhere you have recorded excess amount, or somewhere you have recorded lower amount. Like these errors happen. That means what are those errors? These are errors of commission. Suppose if there is error of principle, error of omission, trial balance will tally. For example, one transaction completely I forgot it, still trial balance will tally. Suppose error of principle I done. For example, capital expenditure I treated as revenue expenditure. Instead of asset account debit, I debited purchases account. Both are debit balances only, na? So trial balance still tally. So because of these errors, error of principle, complete omission, compensating errors, mostly trial balance will tally. Any cost they will tally. Mostly they will tally. The only error, there is a chance that trial balance may not tally is what? Error of commission. Errors of commission. Okay. So we identified that error of commission will result into trial balance disagreement, because this is the most important thing. So we discussed about what? Errors. So tell me how many errors are there? 4. What are those? Principle, errors of omission, commission, compensating. Out of these errors, which errors will have the which will affect the trial balance, which will result into disagreement of trial balance? Errors of commission or errors of partial omission. These 2 errors. Remaining errors, trial balance anyway mostly will tally. Okay. Now I am going to rectify these errors. These errors happened. Now I am to rectify. Sir, how I am going to rectify? Listen to me carefully. In order to rectify any error, 2 things are very important. First, you need to understand what is the type of error. Second, at which stage, at the stage at which this error is detected. The stage at which the error is detected. In which stage the error is detected, one thing, and also what is the type of error. Depending upon these 2 things, rectification will be done. Rectification of errors depends upon 2 factors. One is type of error, another one is the stage at which the error is detected. Now what is the type of error? Type of error means, is it a single side error, one sided error, or is it a double sided error? What is one sided error? Which affect only one account. Two sided error means which affect 2 accounts. Now because of this one sided error, mostly trial balance will not tally. Two sided error, definitely trial balance will tally generally. Okay. And when it comes to the stage at which the error is detected, sir, there are 3 stages. See, first stage, okay, before preparation of trial balance, one stage. We have not prepared trial balance. Before preparation of trial balance, one stage, sir. Second stage, after preparation of trial balance. Third stage, after preparation of final accounts. Before preparation, after preparation of trial balance, but before preparation of final accounts, after preparation of final accounts. So type of error, stage at which the error is detected. Now we will try to rectify, sir. So before preparation of trial balance, error can be single sided error, double sided error. After preparation of trial balance, single sided, double sided. After preparation of final account, single sided, double sided. Now you see, first, before preparation of trial balance, important part, listen. Before preparation of trial balance, suppose the error is single sided error. Single sided error. What we are going to do? Still trial balance not yet prepared. Still trial balance not yet prepared. Therefore, no need to pass any rectification entry. Just since it is a single-sided error, which account I need to rectify, go to that account. If it is undercast or overcast or whatever the mistake happened, just rectify it. In that account itself, do the rectification. No need to pass any rectification entry. At what stage? Before preparation of trial balance. Suppose for example, see, only rectification statement is passed, no rectification entry is passed. No double entry is passed. No double entry is passed. For example, you see, there is a subsidiary book, purchases book. This purchase book is undercast by 5,000. Purchase book is undercast. That means purchase book shown 5,000 less balance. Still I have not prepared any trial balance. I came to know that my purchases was reduced by 5,000 undercast. What I can do? I can do rectification. How I am going to do the rectification? Just purchase account is debited by 5,000. If I want to increase the purchase account, what I need to do? Debit purchase account by 5,000. So therefore, this is the purchase account. Date, particulars, amount. So particulars column, to undercasting of purchase book 5,000 I will debit. Over, rectification is done. So tell me, I am rectifying in which stage? Rectification is happening which stage? Before preparation of trial balance. Which error? Single-sided error. Single-sided error, one-sided error, one account affected. Now if I am rectifying a single-sided error before preparation of trial balance, what I need to do? Just rectification statement, not to pass any rectification entry. Suppose if the error is double-sided error, then we need to pass a rectification entry. Why? Because see, for example, I will give one example. So see this. I purchased a building, sir, 10 lakhs, but it was wrongly debited to purchases account. See, if you purchase a building, what is the entry? Correct entry. Building to cash or bank. This is the correct entry, right? Building to cash or bank, but you have debited to purchases. So what will be the correct entry? Can you tell me? See, here building has to be debited, but I debited purchases. So I need to cancel purchases. I need to debit building account. So rectification entry is what? Building account will be debited, purchase account will be created. That means here rectification can be done through passing one entry. So that entry you will pass. So this is double entry, double-sided error. Because in case of double-sided error, is anyway two accounts got affected. Here see, building account should affect, but they have not recorded. Record it now. And purchase account not to be debited, but they debited. Reverse it. So since two accounts are affected, these are called double-sided error. And in case of double-sided error, rectification entry can be passed. Double entry can be passed. Hello. That's why. Next, come to second stage. What is second stage, sir? After preparation of trial balance, but before preparation of final accounts. See, this is where most of the students are not understanding. I am going to explain in the simplest logical way. Listen to me. Already trial balance preparation over. Trial balance preparation over. That means trial balance not tallied. In case of single-sided error, trial balance will not tally. That means the difference is already transferred to suspense account. Suspense account. Now, every rectification is done through suspense account only. Already, suppose for example, you prepared a trial balance. See this. Suppose you prepared a trial balance. Credit side 10 lakhs came. Debit side 10 lakhs should come. But 9 lakhs only came. 1 lakh difference is there. This 1 lakh you debited to suspense account. That means already the error was debited in suspense account. Now if I rectify, it should be credited. Already my error is debited to which account? Suspense account. Now if I find out the correct debit account, automatically suspense account should be credited. So since I am rectifying the errors after preparation of trial balance, at the time of preparation of trial balance, any difference is already transferred to suspense account. Now the error is there in the suspense account. Now I need to cancel the suspense account by writing the correct account. That's why you see here. For example, same side, single-sided error you take. Here rectification entry is passed by involving what? Suspense account. How? Same entry I am taking. Suppose purchase book undercast by 5,000. Tell me, sir, your purchases undercast by 5,000 means you prepared trial balance, right? You prepared trial balance. Purchases 5,000 undercast means which side there is a shortage? Which side, sir? Purchases shows debit balance. Debit balance 5,000 shortage is there, na sir. That means that 5,000 where you have transferred? Suspense account. You already prepared trial balance. Purchases book 5,000 under cash. That means there is a debit side shortage of 5,000. That 5,000 you transfer to suspense account. Now you identified, after preparation of trial balance, you identified that I have done this mistake. This error happened. What is that error? Undercasting of purchases book. Now what I need to do? I need to increase purchase by 5,000. But already this 5,000 was there in which account? Suspense account. Debit or creditor? Debit. Now suspense account will be credited, purchase account will be debited. The entry is this. See this. The entry is purchases to suspense account. That means the rectification is eliminated. The error is there in which account? Suspense account. Suspense account is debited. Now if I pass the rectification entry, the suspense account will be cancelled. Which account will be debited? Purchase account will be debited. You understand? Hello. So therefore, after preparation of trial balance, if you are rectifying single-sided error, already the error was reflected in suspense account. Now if I find out the correct account, that suspense account I need to reverse and the correct account has to be debited or credited. In this example, purchase book was undercast. I identified that after preparation of trial balance. That means I already prepared trial balance. The difference of 5,000 I transfer to suspense account. So therefore there is a suspense account debited by 5,000 that I will rectify now. So purchase account I will debit, suspense account I will credit. Hello. So like this, when you are preparing trial balance, whatever the differences came, all the differences you are transferring to suspense account. Now when you rectify, already suspense account is debited, credit. Already suspense account credited, now debit. The corresponding account is correct account. Correct? Suppose for example here, same, sales book overcast or undercast. Sales undercast, sir. Sir, tell me, when your sales book was overcast, for example, overcast or undercast, I will take undercast. Sales undercast. What happens? Tell me, sales undercast means 10,000. That means credit side shortage will come. Correct? That means that 10,000 is transferred to suspense account. Now I need to rectify it. What I need to do? Suspense account I will debit, sales account I will credit. This is which side of error? One-sided. Suppose if it's a double-sided error, same rectification entry like in first case. That is even before preparation of trial balance. How we rectified two-sided error? The rectification, correct entry, rectified the things na same manner. Rectification entry is passed without suspense account. No, it does not. If it is a double-sided error, suspense account will not involve because it is not affecting my trial balance. It is not affecting my trial balance. Therefore, if it is a double-sided error, same treatment. In every case, same treatment, sir. If you are rectifying before preparation of trial balance, after preparation of trial balance, after preparation of final account, same. But only one difference will come after preparation of final accounts, that I will tell you. Hello. Now the last case. What is the last case, sir? After preparation of final accounts. Final accounts also prepared. Now you identified the mistake, error. What you are going to do? Suppose single-sided error. Same. Suspense account. With the help of suspense account, you will rectify. But the only thing is that if that account is a nominal account is affecting my P&L, right? Therefore, in place of that account name, if it is a nominal account, write P&L adjustment account. Why? Because already final accounts prepared means this error belongs to last year. You identified in the current year. In order to make sure that this is not current year item, we will write P&L adjustment account as a prior period item. So therefore, see this. After preparation of final accounts, if it is a single-sided error, rectification entry is passed with the suspense account, but nominal accounts are replaced by P&L adjustment account. See this. Don't write, suppose for example, discount is there, discount to customer. We have not recorded discount. Now you record it, discount to suspense account. But this discount don't write. In place of discount, you write P&L adjustment account. Why? Already final accounts are prepared. Already final accounts prepared means because of this discount our profits got affected. So that's why instead of writing discount to suspend, if I write discount, what happens now? This discount again will be transferred to my current year P&L, which is not correct now. That's why this is transferred to which account? P&L adjustment account. Double-sided error, same manner. Rectification entry is passed without suspense account. But nominal accounts are replaced by same. Nominal accounts is replaced by P&L adjustment account. Same. Suppose nominal accounts is there now, it is replaced by P&L adjustment account. So therefore, systematically you think. Once again I am revising. Very simple. Rectification of errors, as you all thought, it's a difficult task. No, it's easy. Only thing is that proper analysis is required. And rectification of errors. Listen. In order to rectify an error, two factors you need to take into account. First, what is the type of error? One-sided, two-sided, single, double-sided error. Single-sided, double-sided error. Single-sided error generally will affect my trial balance. Double-sided will don't affect my trial balance. Second, at what stage you are rectifying? There are three stages here. Before preparation of trial balance, one stage. After preparation of trial balance, but before final accounts, one stage. After preparation of final accounts, one stage. Like this, three stages are there. Now, first, stage number one. You are rectifying before preparation of trial balance. Before trial balance, if you are rectifying any error, if it is a single-sided error, no need to pass any rectification entry. Just pass rectification statement. That corresponding account you affected. That's it. If it's a double-sided error, rectification entry is passed without suspense account. Suspense account concept will not arise if you are rectifying any error before preparation of trial balance. Next, you are preparing trial balance. You already prepared trial balance. Now you identified the mistake, error. Now you want to rectify it. If that error is a single-sided error, already the error effect is already debited or credited to suspense account. Now reverse the suspense account, write the correct account. That means rectification entry is passed through suspense account in case of a single-sided error. If it's a double-sided error, rectification entry is passed without suspense account. Because if it's a double-sided error means it is trial balance will not affect. Therefore, the difference is not transferred to suspense account. Therefore, you pass a rectification entry. That's it. Without suspense account. Hello. Next, last stage. What is that? After preparation of final accounts. Already final accounts is prepared. Now you identified a error. How to rectify? If it is a single-sided error, same. Rectification through suspense account. But if any nominal account involved, P&L adjustment account you write. If it's a double-sided error, same. Rectification entry you passed without suspense account. But if any nominal account involved, P&L adjustment account you write. I told you the logic also. Because P&L account adjustment, if I don't write, that will affect my current year profits, which is not correct. This is actually belongs to last year. So in order to make a difference, in order to make sure that this is a prior period item for the current year, I need to write P&L adjustment account as a prior period item. Now here I have given a summary also, sir. See this. This summary you remember more than sufficient. See this summary table, single-sided error, double-sided error. Before trial balance, tell me if you are rectifying before trial balance, single-sided error. No, only rectification statement. If it's a double-sided error, rectification entry without suspense account. If you are rectifying after trial balance preparation, single-sided error, rectification with the suspense account. If it's a double-sided error, without suspense account rectification. That means double-sided error treatment is same in every stage, except that if you are rectifying after preparation of final accounts, if it is a nominal account involved, we need to write P&L adjustment account. And last stage, after finalization preparation of final accounts, single-sided error, simple rectification through suspense account. But if nominal accounts involved, P&L adjustment account I will write. Hello. For example, you see here discount to customer, sir, 10,000. Discount is which account, sir? Nominal account, right? So suppose for example I need to rectify single-sided error, discount was not recorded, now I need to rectify. Already it was there in suspense account. So therefore suspense account will be created, discount account will be debited. But since I am rectifying after preparation of final accounts, in place of discount I will write P&L adjustment account. So this is how I need to rectify the errors, sir. I will show you some questions, sir, so that you will understand this concept better. Yeah. Come to illustration number 19, sir. Illustration number 19, which covers all the cases. Very good question actually. See this question. Think and tell me the answers. Rectify the following errors, assuming that errors was detected. A. Before preparation of trial balance. B. After preparation of trial balance. C. After preparation of final accounts. So 3 stages they are asking, sir. One is before preparation of trial balance, another one is after preparation of trial balance, last one is after preparation of final accounts. First one, purchase plant for 10,000, wrongly passed through purchases account. Purchased plant, but wrongly passed through purchase account. First of all, tell me what is the nature of error? One-sided or two-sided? Two-sided error. Why? Here plant purchased. What is the entry? Plant to cash or bank. But we have debited to purchases. Purchase to cash or bank. That means what is the rectification? Plant to purchases. Purchases wrongly debited we will cancel. Plant account not debited we will write. That means it's a double-sided error. So if it's a double-sided error, how you are going to rectify? Before preparation of trial balance, rectification entry without suspense account. Plant to purchases. After preparation of trial balance, same. What is the entry? Plant to purchases. After preparation of final accounts, same. Plant to purchases is a nominal account. Therefore, I will write P&L adjustment account. See this. Before preparation of trial balance, plant to purchases. After preparation of trial balance, plant to purchases. But after preparation of final accounts, plant to P&L adjustment account. Because it's a nominal account. Purchase is a nominal account. Second, see this. Sales day book was cost short by 1,000. Tell me. Sales day book. Think. Sales day book was cost short by 1,000. So, one-sided or double-sided? One-sided. Sales book was undercast, sir. Sales book was undercast. Now tell me, if you are rectifying this before preparation of trial balance, any entry required? Only statement, rectification statement is sufficient. If you are rectifying after preparation of trial balance, tell me. Suppose for example, see this is the trial balance. Sales will come on the credit side. But credit side there is a shortage of 1,000. That means suspense account is credited na? Suspense account is credited by how much? 1,000. Now I am rectifying means I have to debit suspense account. Sales I need to credit. So therefore what is the rectification entry? Suspense to sales. Suspense to sales. And if I am rectifying the same entry after preparation of final accounts, suspense to sales is a nominal account. Therefore P&L adjustment account. Suspense to P&L adjustment account. See this. See if I am rectifying before preparation of trial balance, just sales account will be created. If I am rectifying after trial balance preparation, suspense to sales I will write. If I am rectifying after preparation of final account, suspense to P&L adjustment account because it's a nominal account. Next, see the next one. Cash paid to Mr. X 1,000 was posted to his account 100. Sir, we paid cash to Mr. X, sir. What is the entry? X to cash. 1,000, but we recorded 900. 100, sorry. We recorded 100. So therefore, this was cashed to his account, only his account. Sir, cash account was properly created, only X account was not debited correctly. You are understanding? When we pay the cash, what is the entry? X to cash. 1,000 we need to write, but we have recorded his account, we debited only 100. Cash account was correctly created. So therefore tell me, one-sided or two-sided? One-sided. Only one account is affected, X account is affected. Now if you are rectifying before preparation of trial balance, just rectification statement. X account will be debited by 900. Correct? X account debited 900. Now if you are rectifying the same error after preparation of trial balance, now see, you prepare trial balance here. See this. X account is having which balance? Debit. It should be debited by 1,000, but debited only 100. That means how much under? 900. Short. This 900 we debited to. Now I need to reverse suspense account. That means suspense account will be credited. X account will be debited. So therefore X to suspense. X to suspense. If the same entry I am rectifying after preparation of final accounts, X to suspense only. X is not a nominal account. Therefore X to suspense only will come. See this. X to suspense, X to suspense. You understand now the concept? Yes. Now last, see the next one. purchase goods from Mr. T for 3,500 was entered in the purchases day book 500, sir. See, we purchased goods 3,500, sir, but it was entered in the purchase day book 500, sir. That means purchases 3,500, we entered only 500. That means how much we have not recorded? 3,000. So under cash of purchases book, I mean not recorded 3,000. If it is rectified before preparation of trial balance, just purchase book is debited by 3,000. Correct? No. Here purchase goods from Mr. T for 3,500 was entered in the purchase day book 500. That means entire transaction, sir. Entire transaction. They have not recorded. They have recorded at 500. Entire transaction in the purchase day book they have recorded at 500, sir. That means now the balance we need to record. Correct? Actually it was 3,500, sir. Whenever purchases happen, what is the entry, sir? Purchases to T. So same entry. See this, purchases to T. 3,000, 3,000. It's a double-sided error. Actually double-sided error. Two accounts. Here also purchases to T. And if you are rectifying this after preparation of final account, this purchase account, nominal account. Therefore P&L adjustment to T. And the last, sir, paid salary 3,000 was wrongly passed through wages account. Salary, instead of debiting salaries, we debited what? Wages. So salaries account will be created, wages account will be debited. So therefore salary to wages. Correct? Wrongly passed through wages. So wages was debited instead of salaries. So therefore wages will be created, salary will be debited. Even after preparation of trial balance also same. Why they have not written anything after preparation of final accounts? Because anyway they are not going to impact my profits. Whether you debit to salary or wages, both are expenses, nominal accounts only, sir. Hello? That's why they have not recorded anything. You understand this? And next question. Illustration number 20, sir. This is an important model. This type of questions they are asking, sir. See this question, illustration number 20. A merchant, while balancing his books of accounts, notices that trial balance did not tally. Sir, trial balance did not tally. Trial balance did not tally means? That means the balance is transferred to suspense account. Correct? It showed excess credit of how much? 17. This excess credit is now created to suspense account. He placed the difference to suspense account. Now subsequently he notices the following error. See this. That means we prepared the trial balance, difference is transferred to suspense account. Now we identified here rectifying. So when you rectifying, suspense account will be reversed. Correct? See this. 4 items they given, sir. First, goods bought from Narayan for 5,000 were posted to the credit of Narayan's account as 5,500. Tell me, sir, when you purchase goods, what is the entry? Purchases to Narayan. In this case, how much to be posted? 5. How much is posted? 5,500. So excess how much posted? To Narayan account only. One-sided error. Narayan account we posted 500 extra. Now tell me, you are in which stage? After preparation of trial balance. So that means this excess 500, when you prepared the trial balance, credit side 500 excess posted. That means your suspense account is credited by how much? 500. Now I need to rectify it. What I need to do? Suspense account. Suspense account will be debited. Narayan account will be, suspense account. See. When Narayan account was created 500 extra, the balance will come in debit side. Suspense account was debited with 500, sir. Hello. Now that I need to cancel the suspense account, I need to debit Narayan account, because Narayan account has to be debited by 5,000, but I should be created by 5,000, but it is created by 5,500. So excess created, I have to reverse. Correct? So this Narayan to suspense. Sorry, you understanding? When I should credit only 5,000, if I created 5,500, credit side 500 excess came. That was debited to my suspense account, sir. Shortage will came there, debit side. So that was there in the suspense account. So suspense account I need to reverse, credited. Narayan account is debited. Next, an item of 750 entered in the purchase return book, but was posted to the credit of Pandey, to whom the goods have been returned. Sir, here in the second case you need to understand, sir, there is a purchase returns. Whenever there is a purchase returns, what is the entry? Pandey to purchase returns. but they have posted to the credit of Pandey. That means instead of debiting, they created 750. First that has to be rectified, and their account has to be debited by another 750. Total 1500. So Pandey account has to be debited with 1500. Suspense account has to be created with 1500. Because this is rectifying after preparation of trial balance. Because of this wrongdoing, what happened? Pandey account was created. What happened? So whatever the excess it was created, na sir, the balance is transferred to suspense account, na sir. Now I need to rectify it. See this, Pandey to suspense account, 1500, 1500. So goods bought from Pandey were returned back to him. It should have been appeared on the debit side of his account. For rectifying, he will need to debit his account with double the amount, 750, to cancel the wrong credit, and another 750 to give effect of the correct debit. And the effect will go to suspense account. So the correct entry is Pandey to suspense account. Correct? Next, sundry items of furniture sold for 26,000 was entered in the sales book. Sir, when furniture sold, what is the entry? Cash or bank to furniture. But they have created to sales. So therefore, it's a double-sided error, right? What is the actual entry they have written? Cash or bank to this furniture we need to write. But what they have written? Cash or bank to sales they have written. So that means, is it impacting my trial balance? No. The effect is not transferred to suspense account. So therefore, here it is a double-sided error. When I want to rectify double-sided error, how I am going to rectify? Rectification without suspense account. So therefore, what is the entry here? Sales account will be reversed, furniture account will be created. So sales to furniture. See this, 26, 26. Next, the last one, discount of 300 from creditors. So when you receive discount from creditors, what is the entry, sir? Creditors to discount received. Correct? Discount received should be created. When you receive discount, sir, discount received is a gain. Correct? Has been duly entered in creditors account but was not posted in discount account. So it's a single-sided error. Discount account was not created. Now I need to see, because suppose if you prepare a trial balance, discount received will come on the credit side, right? So you have not posted credit side 300. That means this 300 was transferred to suspense account. Now I need to reverse it. So suspense account will be debited, discount received account will be credited. See this, suspense to discount received. See this, the discount received from creditor is not entered in the discount account but was correctly recorded in creditor's account. This is one-sided error and will therefore routed through suspense account for correction. Discount received, it must be credit being an income. Now you see the best point is, when I prepare the suspense account here, see, suspense account in the question they said, what will be the balance showing? 1700. Correct? See this, 1700 balance is there, suspense account. Excess credit balance means suspense account will have a debit. When they prepared, there is an excess credit balance. Trial balance excess credit means debit side there is a shortage. So that means suspense account is debited with how much? 1700. Now see, we have passed the rectification entries. Here suspense account is created with 500, here 1500, here debit 300. See this, 500, 1500, 300. So it is automatically get tallied. Suspense account is tallied. That means we have done rectification of all errors. Suspense account has become 0. So when I am preparing trial balance, there is an excess credit balance which I transfer to suspense account. Now I rectified everything. So suspense account automatically got 0. So please observe that after correct passing all rectification entries, the suspense account tallies automatically. So automatically suspense account got tallied, sir. So this is how rectification of errors will be done, sir. So tell me final conclusion, when you want to rectify an error, especially after preparation of trial balance. So what you going to see? First thing, nature of error, single-sided or double-sided. Now in this, tell me which error is single-sided. A, first case, single-sided, double-sided? Single-sided, because Narayan account, instead of 5000 his account was created with 5500, single-sided. So that's why rectification is happened through suspense account. Second case, sir, single-sided or double-sided? Single-sided only, 750 posted to the credit of Pandey account. Pandey account was wrongly handled. Instead of debiting, his account was created. So therefore first we need to eliminate that 750. Again his account will be debited with 750. Total 1500. So that is also one-sided error. It is also rectified through suspense account. Because his account was wrongly created, so excess credit was transferred to suspense account, sir. Actually it has to be debited, not debited. That is one effect. You created because of that excess credit balance. That is second effect. That means suspense account was in this case 1500 is there. That we have rectified it. Pandey case, suspense account was debited by 1500. Now we have created it. Similarly, third, sundry, furniture sold but routed through sales. This is double-sided. This is a double-sided error because here two accounts are involved. That's why. And the last one, discount, single-sided. We missed only one thing here. What is that? Discount received. That was not recorded. If you don't record discount received, credit side there is a shortage, no, sir. That was created a suspense account. Now you rectified it by debiting suspense to this one. So simple thing, sir. Because of this error, what happened to my suspense account? Is it debited or credited? Now reverse it with the current account on the opposite side. This is rectification of errors, sir. And now you tell me, sir, in the last case, this discount case, suppose if the same error I am rectifying after preparation of final accounts, what entry will write? Suspense to P&L adjustment account, because this discount received is what? Nominal account. If I am rectifying through after preparation of final accounts, I will write P&L adjustment account. That's it, sir. This is rectification of errors. Okay. The next chapter we are going to revise is incomplete records, sir. Preparation of final accounts from incomplete records. If you see the past examination papers, 14 marks question they are asking from this chapter. So I must say it is an important chapter from examination point of view. Incomplete records, also known as single entry system, sir. We have double entry system. Generally for accounting we follow double entry system. Every transaction have both debit aspect, credit aspect, and we will record both of them in our books. That is complete recording of a transaction. But some organizations, especially the sole proprietorship, small business organizations, non-corporate entities, they don't maintain complete records. Lack of proper accounting system, maybe they can't afford to appoint a accountant, qualified accountant. So therefore they don't maintain complete records. They will maintain only few records, like maybe cash related transactions, maybe sales purchases, maybe assets purchases. Like this, some selected transactions they will record in their books. Okay, so if your records are not complete, if your records are not full, but at the end of the year every business wants to know about their profit, how they have performed, what is their financial performance, they want to know. Now how can you ascertain the financial performance, I mean profits, without having complete records? With this incomplete records, how you are going to ascertain the profit of the business and thereby ascertaining the financial performance of the business? Actually in this chapter we are going to learn that from this incomplete records how we are going to draw the accounts. So that's what, see this, how to ascertain the profit of a business where there are incomplete records. Basically there are two methods, they say, sir, or two techniques we have. One technique is net worth or statement of affairs method or capital comparison method. Another technique, method number 2, is conversion method. See, in this method 2 is a detailed method. Method 1 is, it will not give you much information, it will not give you much details, but this method will give you the profit earned by the business organization at the end of the year. Now when we are going to apply which method, that depends upon the information given in the question. Now let us try to focus first on method number 1, sir. If you think properly, sir, how I am going to ascertain the profit of a business without having complete records? You will get one link, sir, that is capital. capital account. You know, we will take opening capital. To that opening capital, we will add additional capital minus drawings, and also current year profit we will add back to opening capital. Then we will get closing capital. When we prepare the balance sheet of a sole proprietorship, when you prepare the balance sheet of a sole proprietorship, generally you do this. First, we will take the opening capital. To this capital, additional capital introduced minus drawings plus the profit earned during the year. Then you will get the closing capital, right? So therefore, the requirement, that is the net profit, is one of the adjustments in the capital. Therefore, by comparing the capitals, maybe we will get the required profit of the business. So that's why this method is also known as capital comparison method. So in this method, I want opening capital, I want additional capital introduced, I want drawings. Maybe sometimes if the business had any interest on capital, that one interest on drawings, closing capital. If I know all these details, just I will ascertain the profit as a balancing figure. Okay, that is what this method is all about. Sir, sometimes they won't give you opening capital and closing capital. Then you need to find out opening capital, closing capital by prepare statement of affairs, like kind of a balance sheet. They will give you opening assets and liabilities, right? Balancing figure is capital, nothing but. So opening capital you ascertain, closing capital you ascertain by preparing statement of affairs. So opening capital, closing capital, if given we will take it, if don't given, prepare statement of affairs, ascertain opening and closing capital as a balancing figure. Additional capital they will give you, drawings they will give you. So the balancing figure is nothing but net profit of the business. But in this method, as I told you, you don't find details like sales how much, purchases how much, expenses how much, incomes how much. We don't know. Just we want we will know the profit, because here lack of information. With the available information, by comparing the capitals, we are ascertaining the profit. For example, you see my opening capital 1 lakh, my closing capital 1 lakh 50. Now why the capital will change? The capital will change. One of the reason could be profit. For example, forget about all other thing, only profit is there. So that means this 50,000, the difference between closing and opening capital is nothing but what? Profit. So the closing capital minus opening capital, you will get the profit of the business. If I improve it little bit but with additional items, for example, you see your opening capital 1 lakh, sir. You introduce during their additional capital 50, drawings 20,000, and current year profit 10,000. So you got closing capital. This is what we follow. Now I want this profit. I don't know this profit. I want this. Simple. You do one thing. You take closing capital as the base. See this. Closing capital as the base. While arriving this closing capital 1 lakh 40, what are all the things included? Add back. Sorry, what are all the things included? Deduct. What are all the things already deducted? Add back. Suppose for example you see 1 lakh 40, opening capital obviously included, minus it. Additional capital introduced, included, minus it. Drawings deducted, add back. Automatically you will get the profit, because that is the only remaining balance. So therefore the how to find out the profit, or how to prepare the P&L account of the business in case of net worth method or statement of affairs method is closing capital minus opening capital minus additional capital, add drawings, you will get profit for the current year. Okay, very simple technique. Yes, or else you can ascertain this through by preparing capital account also. Capital account opening balance 1 lakh, closing capital we know 1 lakh 40. During their additional capital introduced 50,000, drawings 20,000, balance figure is nothing but profit. Yes. So sometimes they won't give you the opening capital and closing capital. Then prepare statement of affairs at the beginning and at the end of the year. Ascertain capital as the balancing figure. Okay. This is method number 1. Sir, in examination, which method they are testing, sir? Both the methods they are testing. If you see the past examination questions, it is not that method 1 they won't test. They are testing method 1 also. Okay. But more frequency, if you see method 2, they are testing more frequently. Now come to method number 1. Some questions I will explain, sir. For example, you see this question illustration number 1, sir. In this question, Mr. Prakash is maintaining books on single entry system, sir. He has given following information of assets and liabilities 31st March 2022, 31st March 2023, that is opening assets and liabilities, closing assets and liabilities given, sir. During the year, Prakash brought additional 7,500 in cash in business. He withdrew goods of 2,100, cash of 7,200 for personal use. That means additional capital and then drawings. Interest on opening capital is given at 5%. Interest on drawings is charged at 10%. Prepare statement of P&L for the year ended 31st March 2023. Now the first you need to see in examination, the moment you see single entry system, so it is accounts from incomplete records. Second thing is, okay, we need to prepare the P&L account. That means we need to ascertain the profit for this sole proprietor, Mr. Prakash. Which method I need to follow? I told you, depending upon the information given in the question. If the question gives you opening assets and liabilities, closing assets and liabilities, additional capital, drawings, generally this is capital comparison method or net worth or statement of affairs method, because you don't know here, see, any incomes, expenses available, no, sales, purchases, salaries, rent, all these are not available. That means it is indirectly suggesting that you need to follow method number 1. What you are going to do here, tell me. By comparing the capitals, you will ascertain the profit. Take the closing capital, from that reduce opening capital, additional capital introduced, deducted, drawings, add back, automatically you will get the profit. So I want opening capital and closing capital, but opening and closing capital is not given, na? So ascertain it. How I am going to ascertain it, sir? By preparing statement of affairs. You know all the assets and liabilities. For example, first opening capital assets and liabilities, I will tell you. Take all the assets. 18,000 plus 66,200 plus 31,000 plus 45,600 plus 16,200 plus cash balance 600. These are all assets. Bills payable minus creditors minus. Automatically you will get what? Opening capital. So see this statement of affairs as on 31st March 2023. Write all the assets. You will get 1,77,600. Liabilities, creditors, bills payable. So balance figure is 96. So therefore opening capital is how much? 96,000. Similarly, you do it for closing capital. 1,31,400. So I know opening capital as well as closing capital. Now you start with it. Closing capital 1,31,400 minus opening capital 90,000 minus additional capital introduced 7,500 plus drawings 2,100 plus 7,200, total 9,300. And also in this question there is a interest on opening capital. Opening capital is how much? 90,000. Just now, sorry, 96,000. This is 96. Yeah, 96,000 into opening capital interest 5%, 4,800. Like I mean, interest on opening capital, like additional capital, interest on opening capital will also be deducted. Drawings, interest on drawings is charged at 10%. So drawings is how much? 9,300 into 10%. See here, on which day drawings happened we don't know, so therefore I take it for 6 months average. So 465. Okay, like drawings, interest on drawings is also added back. So 131,400 minus 96,000 minus 7,500 plus 9,300 minus 4,800 plus 465. So therefore my profit is 32,865. See this. Okay, this is how you need to ascertain the profit under method number 1, statement of P&L. You may ask, sir, what kind of statement of P&L is this? Generally in P&L account we have incomes, expenses, right? But we don't have that information here. That's why it is incomplete records. So here how we are going to ascertain the profit? Take the closing capital minus opening capital, add back drawings, add interest on drawings also, less interest on capital, fresh capital introduced, net profit for the year. So to the opening capital, to arrive the closing capital, what are all the things added? Less. What are all the things already less? Add back, because we are starting from closing capital. Then automatically you will get what? Profit for the year. See, date of drawings is not given in the question, hence interest on drawings is charged for 6 months. This is one question, sir. Now come to second question, sir. Mr. Kannan is running a business of ready-made garments. He does not maintain books of accounts under double entry system. See, these are all the hints to identify the question is from incomplete records. While assessing the income of Mr. Kannan for the financial year 22-23, income tax officer feels that he has not disclosed full income earned by him from his business. He provides the following information. See, for the year 22-23, he filed return of income, but income tax officer somehow feels that Mr. Kannan has not disclosed information properly. I mean, he has suppressed the income. He is feeling that he has not disclosed the full income, okay, earned by him. On 31st March 2022, sundry assets to liabilities. On 31st March 2023, sundry assets to liabilities given. Mr. Kannan monthly drawings given. Income declared to the income tax officer given. During their 22-23, one life insurance policy of Mr. Kannan was matured and amount received of 50,000 was retained in the business. That means it is what, sir? His personal insurance policy matured, sir. Whatever the amount he received, sir, he kept it in the business. So it is kind of what, sir? Fresh capital introduced. Correct? Additional capital introduced. State whether the income tax officer's contention is correct. See, what is the contention of the income tax officer? Mr. Kannan suppressed the income. He has not disclosed the full income. Find out the full income. Compare with the income already declared. How to find out the income for the current year? Have I know all incomes and expenses? No. I know what? Opening assets and liabilities, closing assets and liabilities. I know the additional capital introduced. I know the drawings. Correct? So simple. First prepare statement of affairs at the beginning of the year. Sundry assets minus sundry liabilities. You will get opening capital. Similarly, closing statement of affairs. Closing assets minus closing liabilities. You will get capital at the end of the year. So 16 lakhs 65,000 minus 4 lakhs 13,000. So it is 12 lakhs 52,000. This is opening capital. 28 lakh 40,000 minus 5 lakh 80,000. It is 22 lakhs 60,000. This is closing capital. Okay, so simple. See this. My closing capital 22 lakh 60. My opening capital 12 lakh 52. So how can I ascertain the profit? Take closing capital first. 22 lakh 60 minus opening capital 12 lakh 52,000. 12 lakh 52,000 minus additional capital introduced 50,000 was added while ascertaining closing. So now you deduct. Add back the drawings because it was already deducted. Now you need to add back the drawings. How much is the monthly drawings, sir? 32. So 32 into 12. 32,000 into 12. So we need to take 3 lakh 84,000. So 22 lakh 60,000 minus 12 lakh 52,000 minus 50,000 plus 3 lakh 84,000. So it is 13 lakhs 42,000. This is the income, profit for the current year. Profit for the current year. Profit for the current year is 13 lakh 42,000. You see this. But how much he has declared? 9 lakh 12,000 he declared. Therefore, definitely there is a suppressed income of 4 lakh 30,000. So therefore, the contention of income tax officer Mr. Kannan that he has not declared his correct income is very correct, and 4 lakh 30,000 he has not disclosed. Okay. Now illustration number 3. See, this question they have already tested in the examination, sir, for 14 marks. Same question. If you see the past examination, you will find this. Now see this. There is a sole proprietor, Mrs. Shashi, who maintains his books of accounts on single entry system. Again, opening, closing, assets and liabilities given, sir. What they are asking, say additional, Mrs. Shashi withdrew 5,000 from the business every month for meeting her household expenses. Drawings. During the year, she sold investments held by her privately for 35 and invested the amount in her business. Fresh capital introduced. Her private investments sold, and whatever the amount they received, they brought it to the business. Now at the end of 22-23, it was found that full year's interest on loan from Mrs. Shashi has not been paid. See, 10% loan from Mrs. Shashi is there. On that, interest was not paid. Okay, till now. Full year's interest not paid. Depreciation at 10% per annum was to be provided on furniture for the full year. We need to provide depreciation on furniture. Shop assistant was to be given a share of 5% of the profits ascertained before charging such share. So shop assistant will be given 5% share in the profits. Calculate the profit earned during the year ended 31st March 2023 by Mrs. Shashi. So they are asking us to calculate the profit. Okay. So how you are going to ascertain the profit, sir? First of all, look at the information given in the question, sir. Based on that, you take a call which method I need to follow first. In this question, do you know normal incomes expenses? No. You know opening assets and liabilities, closing assets and liabilities. You know the additional capital introduced. You know the drawings. So that indicates that you need to follow capital comparison method initially to ascertain the profit. Once you ascertain the profit from that interest on loan, depreciation, you will deduct, then you will get one profit, net profit. From that 5% share will be given to shop assistant. Correct? Now in this case, first you ascertain the opening capital and closing capital. So how to ascertain the opening capital? Simple. All assets at the beginning. 20,000, 17,000, 40,000, 29,000 minus creditors minus loan. So opening capital I think 44,000, sir. Yeah, 44,000 is the balance of year. All assets minus liabilities. Similarly, you do this to this one also. 83,000. So you know the opening capitals and closing capitals. So closing capital, if you see, 83,000. From this, first I need to reduce opening capital. Opening capital is how much? 44,000. And while ascertaining this closing capital, 5,000 monthly drawings, sir. That means 60,000 is the drawings. So drawings might have been deducted, so add back now. And also you see additional capital introduced 35,000. It was already included, so deduct now 35. So 83,000 minus 44,000 plus 60,000 minus 35,000. So it was 64,000. 64,000 is the initial profit, sir. See this trading profit 64. But you need to understand, sir, they have provided in the question two things. Interest on loan yet to be provided. See this, look at the wordings. At the end of the year, it was found that full year's interest on loan from Mrs. Shashi has not been paid. So therefore, interest we need to consider. The loan amount is how much, sir? 30,000. So 30,000 into what is the interest? 10%. Full year's interest. So 3,000. And also, sir, depreciation. They clearly said that depreciation has not been provided. We need to provide 10% per annum. So depreciation is provided on furniture. Furniture balance is 29,000. So 29,000 into 10%, sir. How much, sir? 2,900. So you deduct, sir, because these things are not included. 64 not adjusted. 64,000 minus 3,000 minus 2,900. How much, sir? 58,100. This is the correct net profit of the business. Now they said one more thing, sir. The shop assistant will be given 5% share on profits, sir. So share in profits, sir. This is also to be deducted. Share in profits, 58,100 into 5%. 5%. So it was 2905. So 58,100 minus 2905. So it was 55,195. 55,195 is the total overall profit. See this, 55,195. This is the profit. Okay. So this question they have tested in examinations. But look at how they are answering. how the presentation is, presentation aspects, statement of affairs like this, opening, closing, all assets minus liabilities, and statement of P&L for the year ended. Here capital account itself they have prepared in the form of P&L account. For example, you see opening capital, additional capital, minus closing capital, minus drawings, automatically trading profit. From this trading profit, depreciation, interest on loan, then you'll get net profit. From this net profit they have given commission to the shop assistant. So like this they have presented. So finally they got a net profit of 55,195. The very same question they have tested in examination. You see the past examination questions, you will understand. So these three illustrations they have given in respect of method number 1. So when any business organization is not maintaining proper records, incomplete records, our object is to ascertain the profit from those incomplete records. So one of the method available is method number 1, that is by comparing the capitals you can ascertain the profit earned by the business. Okay, that's why this method is called capital comparison method, net worth or statement of affairs method also. Why? Because here opening capital, closing capital, if it is doesn't know what we are doing, we are ascertaining that as a balancing figure. That's why. Okay, sir, can you tell me what are the drawbacks you observed in method number 1? Sir, we are ascertaining profit, no doubt about it, but can you tell me what are the drawbacks in method number 1? Suppose if somebody asks you how much is your sales, can you able to tell in method number 1? Can somebody ask you what's your incomes, what's your expenses, can you able to tell? No, we don't know, just we know the profit. So that's why they say method number 1 has not sufficient, because it is not giving complete key information. It is giving profit of the business, but it is not sufficient. So that's why there is a need of another method which will give much more details relating to the business accounting items. For example, you see what are the drawbacks you can find in method number 1. Key information is not known, like for example sales, how much we don't know, purchases, expenses. So we don't know all these things in net worth method, because we are just comparing the capitals. One of the element is profit, we are ascertaining it, but the important information in the business we don't know. So that's why we want a better method. They have brought another method called conversion method. So conversion method, why they are calling it as, your incomplete records we will try to convert into complete records. Sir, how can you convert incomplete records into complete records? We will identify the missing figures. Whatever the missing figures are there, we will ascertain those missing figures. How? By using different accounting techniques. Like for example, we don't know sales, cash sales or credit sales. If you don't know, I want to ascertain cash sales, maybe I will prepare cash account. I want to, credit sales not available, maybe I will prepare debtors account. Purchases, cash purchases I don't know, I will prepare cash account. Credit purchases I don't know, maybe I will prepare creditors account. So this method is more depends upon your accounting knowledge, how strong basically you are in the fundamentals of accounting. So which item will be available from which account, if you know that, then this method is very easy. And let me tell you one thing, sir, conversion method there is no proper structured theory. This is the theory you cover and you can solve all the questions. No, it's all depend upon the information given in the question. What are the missing figures? Now in this case, to ascertain this missing figure, what information I have to use, depending upon that you have to do the sum. The basic idea is what, incomplete information is available, I want to convert them into complete information, and my object here in conversion method is I should be able to prepare the trading account, the P&L account and the balance sheet. Now tell me, in trading account generally what items will come? Opening stock, purchases, sales, closing stock, right? So I should know all these things. And also P&L account, P&L account what items will come? All indirect incomes, all indirect expenses. So all expenses income should be available, should I need to ascertain. Of course they will give you some information, we need to ascertain the other information. And then balance sheet, generally balance sheet consisting of what? Assets and liabilities. So I must able to ascertain assets and liabilities also. So basically what is missing in statement of affairs method, that I am going to fulfill it in conversion method. Okay, method number 2. Okay sir, okay, we understood that in method number 2 whatever the information available in the question. See, if the question is relating to conversion method, sir, by reading, at the time of reading of the question itself you can easily identify. They will definitely give you some incomes, some expenses, some cash related transactions, they will give you assets, liabilities. Not like in case of first method, where they will give you opening assets and liabilities, closing assets and liabilities, additional capital drawings. That much information only they will give. We have seen in all the three illustrations. Of course, in illustration number 3, they have given interest on loan or depreciation, these small expenses they have given. But generally, incomes expenses will not be available if the question is relating to method number 1. But if the question is relating to method number 2, definitely there is a chance that they will talk about the incomes, the expenses, and also the cash transactions. All this information they will give you. Okay. Now you see, generally what are the accounts required to be prepared for ascertaining the various items. Suppose I will prepare cash and bank account. Why I will prepare cash and bank account? Maybe I can ascertain opening and closing balances of cash. Sometimes I require opening and closing balance of cash, because in order to prepare balance sheet, for example, opening balance sheet I need to prepare, opening cash I want, closing balance sheet I need to prepare, I need closing cash balance. Cash sales maybe I want sometimes, because in order to prepare trading account I want sales, but sales are not available, cash sales. Sometimes cash purchases not available, maybe drawings not available, proprietor withdrawing some amount, some cash from the business, I don't know how much drawings is there, because without drawings how can you prepare balance sheet? Not possible. So therefore maybe I will prepare cash and bank account to ascertain any one of these things. Generally for majority of the problems, for cash sales or maybe for cash purchases we will use this. Next, debtors account. Tell me why we will prepare debtors account. One of the main things to prepare debtors accounts is I mean to ascertain the credit sales. This is the most important thing. Of course, not only credit sales, by preparing this debtors account you can ascertain the opening and closing balance of debtors as a balancing figure, collection from debtors as a balancing figure, maybe bills received from the debtors as a balancing figure. We don't know, depending upon the information we need to see debtors account is prepared for which purpose. See, majority of the students are of the opinion that they are thinking that debtors account is only for credit sales. No, credit sales is one of the elements in debtors account. Debtors account will have collection from debtors also, maybe bills received from debtors also. These elements are there. So we will prepare debtor account for ascertain that item which is missed depending upon the information given in that question. So you have to be very careful. But majority of the cases it was credit sales. Next, preparation of creditors account. Why we will prepare creditors account, sir? Maybe I want to know the opening and closing balance of creditors. Maybe I want to know the credit purchases. Maybe I want to know how much amount I paid to creditors, because if I don't know how much amount I paid to creditors, I cannot prepare cash book, because maybe suppose sometimes it is like this. I want cash sales. If I want to know cash sales, I have to prepare cash book, cash account. But in order to ascertain cash sales as the balance figure, I should know all the cash inflows and outflows. Maybe amount paid to creditors is not available. Therefore, first I need to prepare creditors account, ascertain the amount paid to creditors as a balancing figure, and that I will take it in the cash book and ascertain cash sales as a balancing figure. See, it is like interlinking, sir. One account balance is linked with another account balance. So that's why it is like a puzzle, this conversion method. Missing figures. In order to ascertain this missing figure, what I want, which account I need to prepare, in that account what information is available which will make me to ascertain this figure. So like that you have to connect the dots, and then you need to find out. Sometimes bills payable accepted, sometimes bills receivable endorsed, sometimes whatever the bills is there we endorsed in favor of our creditors, right? So maybe that information I want to know, I can ascertain by preparing this creditors account. Sometimes bills receivable account will prepare, sometimes bills payable account will prepare, and then opening statement of affairs to ascertain the capital at the beginning. See, like this we will prepare different accounts to ascertain different types of balances. So in conversion method, generally what type of accounts you will prepare, sir? Means cash account, cash and bank account, and what is that, debtors account, creditors account, and then bills receivable, bills payable, these 5. And if required, asset account also sometimes we will prepare. So automatically, once we know all the missing figures, we'll try to prepare the trading P&L balance sheet. Okay. Now, sir, okay, the common missing figures I will explain, sir. The common missing figures in the question, majority of the questions, the missing figures is sales, nothing but. See, when it comes to total sales, how to ascertain total sales? Tell me. Cash sales plus credit sales. If you add both of them, you will get total sales. but sometimes cash sales is missing, sir. They won't give you cash sales. So you need to ascertain cash sales as the balancing figure. So I mean, you need to ascertain cash sales. How you are going to ascertain cash sales? Prepare cash book. Ascertain cash sales as a balancing figure. Suppose credit sales missing, sir. Sometimes cash sales they will give you, credit sales they won't give you. Now if I want credit sales, I need to prepare debtors account, or sometimes the combination is like that. Debtors and bills receivable account both I need to prepare, because the balancing figure of the bills receivable will come in debtors. For example, bills receivable accepted by the debtors, bills receivable account to debtors. I don't know bills receivable accepted by the debtor, so first I need to prepare bills receivable account, ascertain the bills receivable accepted as a balancing figure, then I will reflect this in the debtors account, and credit sales I will ascertain as a balancing figure. So combination. Suppose you see debtors account, you should have an idea what items will come generally in debtors account. Here I have given all the items which will generally come in debtors account, sir. See this, suppose I want credit sales, this is my main object. By preparing debtors account, how can I ascertain it? Simple, take the opening balance of debtors, closing balance of debtors, opening balance, closing balance of debtors. Okay, next you see generally collection from debtors, cash or bank to debtors account will be created. Bills receivable accepted by debtors, debtors account is created. Bad debts, debtors account is created. Sales returns, debtors account is created. Discount allowed, debtors account is created. So what are all the items which will reduce the debtors? Debtors account is created. So collection from debtors, so bills receivable, bad debts, so sales returns, so discount allowed. Which reasons the debtors account will be debited? One of the reason could be bills receivable dishonored. For example, when bills is received from debtors, bills receivable to debtors. When bill is dishonored, drawee account debit to bills receivable. Drawee here is nothing but our debtor only. So therefore debtor account debit to bills receivable, dishonored. Automatically the remaining thing what left is credit sales, balancing figure. Of course in the question all these information may not be available. Maybe few items are available like opening balance, closing balance, collection from debtors, maybe bad debt, sales returns, discount allowed. These items usually will come. Okay. So but you should have an idea about what items will come in debtors account, what information is available in the question. So if I want credit sales, so I need to write all the items available, then ascertain this as a balancing figure. Now sometimes what happens now, this bills receivable accepted maybe, or bills receivable dishonored may not be available. Therefore you need to prepare bills receivable account. So I told you there is a connection between debtors account and bills receivable account. That's why in order to ascertain credit sales, sometimes only debtors account is sufficient. If all the information is available, then credit sales can be ascertained as a balancing figure. But sometimes what happens, this debtors account alone it cannot be give you credit sales because all the information may not be available. Maybe in that case you prepare bills receivable account and ascertain the balancing figure like bills receivable dishonored or maybe bills receivable received as a balancing figure, and you will reflect this in the debtors account and ascertain credit sales as the balancing figure. For example, you see bills receivable account, generally bills receivable account is like a asset, opening balance, closing balance. Now bills receivable will be created when bill was discharged by the drawee, cash or bank account debit to bills receivable. When bill is endorsed in favor of creditor, creditors to bills receivable. And when bill is discounted with bank, okay, when bill is discounted with bank, bank account debit, discount account debit to bills receivable. Okay, so these are the situations, three situations: when amount is received, when bill is endorsed, when bill is discounted, and also when bill receivable is dishonored. When bills receivable is dishonored, what is the entry? Drawee account debit to bills receivable. Drawee means debtor, nothing but. And maybe the bills accepted by the drawee during the year, that will be the balance figure. Bills receivable account debit to drawing, debtors. Okay, so this is what I am saying. See here, this here bills receivable account should be created to debtors, whatever the bills accepted by the debtors during the year, but this information is not available. But by preparing bills receivable account, this I can ascertain as a balancing figure. Sometimes this balancing figure I will use it here, then I can ascertain this as a balancing figure. That's what I'm my intention is. So that's why sometimes the combination is what, debtors and bills receivable account. Sir, in order to understand this bills receivable account, you should know all the items relating to bills receivable. Actually there is one chapter called bills of exchange chapter. See my revision video, revision chapter, revision of this bills of exchange chapter. There I have covered all the entries relating to this. Okay, Now come to the next aspect. The most missing item is purchases. How to ascertain total purchases? Cash plus credit purchases. Two things you add, you will get purchases. Suppose cash purchases I want. Prepare cash book. Very simple. Now I want credit purchases. How can I ascertain credit purchases? Prepare creditors account, or the combination is creditors bills payable account. Now when it comes to creditors account, generally what items comes in creditors account, sir? Opening balance, closing balance. Now when creditors account is debited, when creditors account is credited. For example, when you make the payment to creditors, when bills payable accepted from creditors, any purchase returns, discount received, when bill is endorsed, in all these cases creditors account balance will reduce. For example, uh, you know our creditor is there to whom we need to make the payment, so he draw the bill, we accepted. The moment we accepted the bill, what is the entry? Creditor to bills payable. So in creditors account, to bills payable. For example, we make the payment to creditors, creditor to cash or bank. Suppose creditor has given a purchase returns, his account will be debited. He has given discount to us, discount received. To that extent creditors balance account has been debited. And then bills receivable endorsed. Suppose if any bills receivable is there, we endorsed in favor of our creditor. What is the entry? Creditor to bills receivable endorsed. Okay. And similarly debit side, credit side, you see bills payable dishonored, endorsed bill dishonored. For example, bills payable dishonored. When we accept bills payable, we have written creditors to bills payable. When the same bill we have dishonored it, we have not honored it, what is the reverse entry? Nothing but creditor again liable to, we need to pay the amount to creditor, so creditor account is credited, bills payable account will be debited, right? So bills payable to creditors. Similarly, sometimes what happens, we endorse the bill in favor of creditors, right? So if on the due date our debtor has dishonored the bill, then what is the entry we will write? So debtor to creditors, so by debtors. And then purchases is ascertained as the balancing figure. Students should need to understand that they should know the basic entries in order to complete this conversion method. For example, in this case, bills endorsed in favor of creditors, what is the entry? Creditors to bills receivable. Now when the bill is dishonored, how it is going to dishonor? See, first I received bill from my debtor, bills receivable, I endorsed it in favor of my creditors, right? So therefore when I endorsed, what is the entry? Creditor to bills receivable. Now on the due date, if the drawee dishonors the bill, what happens? What happens, sir? What happens is, from my point of view, I will reinstate the amount receivable from debtor, I reinstate my liability to creditor. So therefore the entry I will write is debtor account debit to creditor account, right? So that's why in creditors account, by debtors account, endorsed bill dishonored. And I will ascertain credit purchase as the balancing figure. Now you know all these items I have to write to ascertain this amount. Sometimes what happens, this bills payable accepted may not be available in favor of our creditors, any bills payable accepted may not be available. Then you prepare bills payable account. Bills payable account, for example, opening balance, closing balance. Bills payable account, when bills payable honored, what is the entry? Bills payable account debit to cash or bank. Generally when bills are accepted, the entry is what? Creditor to bills payable. Now liability has been discharged, bills payable to cash or bank. Suppose endorsed bill dishonored, bills payable dishonored, sorry, when bills payable is dishonored, what is the entry, sir? Bills payable account debit to creditors. And during there, the bills accepted from creditors, what is the entry? Cash or bank account debit to, sorry, creditors account debit to bills payable account, creditors to bills payable. See, that's what I'm saying. If you want to prepare this creditors account, and if you want to ascertain this credit purchase as a balancing figure, sometimes you should write this bills payable accepted also, but you don't know the bills payable accepted. So what you are going to do, you will prepare bills payable account, and bills payable accepted is ascertained as a balancing figure, and this balancing figure you will use here, and then you will ascertain this as a balancing figure. So therefore you should identify the connection between creditors account and bills payable account. What items will commonly come in all these two accounts? For example, you see here in creditors account and bills payable account, what are the common items? this one, bills payable accepted 1, and bills payable dishonored, these two, you see, these two are common, right? So if any one of these two things are there but not given, maybe first we need to prepare bills payable account, ascertain them as a balancing figure, and then use it in the creditors account to ascertain the credit purchases. Similarly, when it comes to debtors and bills receivable combination, which are the things are common, sir? The common thing is bills receivable received from debtors, bills receivable, this one is common here and here. And also one more thing, sir, I think bills receivable dishonored, this one, see this, bills receivable dishonored. When bills receivable dishonored is entry is what, debtors to bills receivable, right? So it is affecting both debtors account as well as bills receivable account. So therefore if any one of these things are missing, either this one or this one, maybe first I need to prepare bills receivable account, ascertain them as a balancing figure, and then use it in the debtors account to ascertain credit sales as a balancing figure. Okay, these are the most common items, sir. So when you are solving a question in incomplete records, especially under conversion method, so the missing figures can be, most common missing figures can be sales. So cash sales, you will prepare cash account. Credit sales, you will prepare either debtors account, or sometimes the combination is debtors and bills receivable account, because there are some common items. So, and if I want to know the total purchases, I want to know the, I can add two things, cash, credit. Cash purchases I will ascertain by preparing cash book. Credit purchases, maybe I will prepare creditors account, or maybe I will prepare sometimes creditors and bills payable, because there are some common items. I explained this. Now this is the knowledge you required, sir. Now you see, so the idea of conversion method is what, sir? I want to prepare trading P&L balance sheet, depending upon the information given in the depending upon the requirements of the question. So I should identify the missing figures, and I need to find out those missing figures. Okay, so I will solve few questions, sir. One good question will give you comprehensive idea. I will solve. See this question, sir, very good question. Illustration number 6, this question, you see how the connection will be, how we are going to solve. Through this question you will get idea about this conversion method. Statement of affairs of Mr. R on Saturday 31st December 2022 was as follows. So on 31st December 2022, statement of affairs given, sir. Fixed assets, stock, debtors, bank, cash, capital, creditors, liability for expenses. Okay, this is on 31st December 2022. Okay, Mr. R did not maintain books in double entry system. Okay, but he carefully follows the following system. In examination, how to identify, sir, method 1 or method 2 or, that's what you need to observe carefully. First thing is whether this question is relating to incomplete records or not. Yes, you see, R did not maintain double entry system. The moment they have not following double entry system, they are following single entry system, that means you need to say that is an accounts from incomplete records question. Second thing is whether it is method 1 or method 2 now. You see, every week he draws 200 after meeting his weekly sundry expenses 100 on average and his drawings. The balance of weekly collection is banked at the commencement of the next week. Okay, no cash purchase is made and creditors are paid by checks. Sales are at a fixed price which include 20% profit on sales. He is talking about sales. Credit sales are few and are not noted in a diary. Payments are received in checks only from such parties. Credit sales are very few, sir, and are noted in a diary. Okay, expenses other than sundries and other special drawings are made in checks, so therefore they are making drawings also in checks. All unpaid bills are kept in a file carefully. Okay, now the following are his bank transactions for 13 weeks. See this, 31st December 2022 over, after that next 13 weeks what will be his bank transactions given, sir? I told you in the question they will give you all cash bank related transactions, sales, purchases, details. Then you say this is method number 2. What are the bank transactions happened in the next 13 weeks, sir? Opening balance 5, checks deposited 2000, checks cash deposited 42,000, creditors paid 40,000, rent paid 600, expenses other than sundry expenses 3,000, balance on 1st April, so 5,400. The moment you see the details relating to cash amount, expenses paid, cash deposited, cash received, so creditors paid, this is giving information link, I mean this is relating to method number 2, sir, conversion method. Okay, after 13 weeks on 1st April, the entire cash was missing. See what happened is, after 13 weeks on 1st April, the entire cash was missing when it was to be deposited in the bank. So when we want to deposit the cash into the bank account, sir, the cash was missing. The following further facts are ascertained. Stock on the day was valued at 4,000. Sundry debtors 20,000 as per diary. Sundry creditors 8,000 as per unpaid bills file. Find out the amount of cash missing. How much cash is missing on the day? See here, these are the bank transactions they have given, sir. Some students say, sir, 5,400 is the cash missing. Wrong path. This is bank transactions. Bank transactions. I want cash missing. How much is the cash missing? See this cash missing. I want to know the cash missed on 1st April. Okay. How can you ascertain the cash missing from the business on 1st April? You know, on 31st December 2022, assets and liabilities. Next 13 weeks, what happened? They have given weekly drawings 200. After meeting his sundry expenses of 100. The balance weekly collection is every week, sir. He will deposit the amount, whatever the cash he is having, he will deposit in the bank in the commencement of the next week. No cash purchase is made, sir, and all purchases are nothing but credit purchases, and payment made to the creditors are by checks only. Okay, and sales are fixed at a fixed price, which include 20% profit on sales. Maybe this is one of the hint available. 20% profit on sales. Sales are making it profit of 20%. Okay, credit sales are there. Few credit sales are there and are noted in a diary. Okay, we will record this in a diary. Payments are received in checks only from such parties. We will receive payment from debtors only in checks. Expenses other than sundries and other special drawings are made in checks only. Now here you need to understand how to find out the cash missing in the business. Okay, how you are going to ascertain the cash missing? Generally, if cash is missed, what I need to do, tell me. If I want to, suppose cash is missing from my business, okay, I want to know the cash balance. We will prepare cash account. Generally cash account I will prepare, cash book or cash account. In cash account generally we have what? Receipts, payments, all the receipts, all the payments, whatever the balance is left, that is I want. This is what I want. But the question is, if I want to know the closing balance as the balancing figure, I should know all the receipts and payments. Here in this question, sir, if you observe carefully, majority all the payments are done in checks only, but I am preparing cash account. But if you observe carefully, credit sales are few. Sales, when I'm talking about sales, credit sales are there. And when it comes to purchases, no cash purchases. But what about sales? Is cash sales also not available? Available. Cash sales are available. Because he never said that sales are only in checks. No. So credit sales are there. That means cash sales also there. I want to know the cash sales also. Because without cash sales, writing on the receipt side, I can't ascertain the balance figure. I want to know the cash sales in this question. So first you need to understand cash sales not available. Available are cash sales? Not available. Cash sales not available. So I want to ascertain the cash sales. So how can you ascertain cash sales? I told you to ascertain cash sales. Again, I will prepare cash accounts, sir. Actually here in the cash account itself, the balance figure is cash sales. So therefore I should find out some other way to ascertain cash sales. How can I ascertain cash sales here? How can I ascertain, sir? Come on, think about it. Cash sales. Maybe see, opening stock plus purchases minus closing stock. If I do, what I will get, tell me? COGS, cost of goods sold. To this cost of goods sold, if I add the profit, I will get what? Sales, total sales. From this sales, if I can able to deduct my credit sales, maybe the balance figure is what? Cash sales. because in the question, I know opening stock 10,000. I know, I can ascertain purchases because all purchases are which purchases? Credit purchases. So by preparing sundry creditors account. So purchases I don't know. So I will prepare sundry creditors account to ascertain these purchases. Closing stock is available. For example, you see opening stock, how much is there? 10,000 is there. Plus purchases I will ascertain. Closing stock given. See this. Closing stock 4,000. Then I will get automatically COGS. To this I will add back the profit. The profit is how much? In the question clearly said that profit is 20% on sales. 20% on sales means, for example, my sales is 100. How to ascertain sales? Cost plus profit. If sales is 100, what is the profit, sir? 20% profit on sales. So therefore profit is 20, cost is 80, correct? So if I want to ascertain this on cost, 20 divided by 80 into 100. So 20 divided by 80, it will be 25%. So therefore 20% on sales, 20% on sales, which is nothing but 1/5 on sales. 25% on cost, which is nothing but 1/4 on cost. 1/4 on cost. 1/4 on cost. So I can apply this 1/4 on this amount COGS. I will get total sales. Then I will deduct credit sales. But credit sales, how I am going to ascertain? By preparing sundry debtors account. So therefore I will prepare sundry creditors account to ascertain the purchases. I will prepare sundry creditors account to sundry debtors account to ascertain the credit sales. Sundry creditors account to ascertain the purchases, because all purchases are anyway credit purchases. So therefore you see here, actually I will show you. Yeah, in this question you see, first I will prepare sundry debtors account. If you prepare debtors account, sir, what is the opening balance of debtors? 15. So take it 15,000. And closing debtors also given 20,000. Closing debtors 20,000. So opening debtors, closing debtors available, we have recorded. Next, checks deposited 2,000. Credit sales are there, payments received in checks only. So therefore these 2,000 checks we have deposited, right, is nothing but collection from debtors. So by bank. So balance where is nothing but what? Sales, credit sales 7,000. Now similarly, if I prepare sundry creditors account, in sundry creditors account, creditors 10,000 balance is there, opening, closing 8,000 is there. So 10,000, 8,000. And if you see the bank transactions, how much we paid to creditors? 40. Take it 40. So balance figure is nothing but purchases. So now I know the credit sales as well as credit purchases. So how can I ascertain cash sales? See this, opening stock given, purchases I ascertained 38,000, closing stock given, COGS, profit is 25% on cost 11,000. So my total sales 55,000. From this I will reduce credit sales. Credit sales I ascertained by preparing sundry debtors account. So the balance is nothing but what? Cash sales 48,000. So the cash sales is 48,000, sir. Now once I know the cash sales, what I can do? Once I know the cash sales, now I can prepare cash account. Cash book I will prepare, and I will ascertain the closing cash balance on 1st April. So see this, opening cash 1,000, sir. And what transactions are relating to cash happened? One is cash sales. Just now we ascertained cash sales 48,000 debited to cash account. And you see here drawings 200. So 200 into weekly drawings 13 weeks, actually 200 into 13, 2,600 created to cash account. And also sundry expenses 100, 1300, and also you see how much amount of cash is deposited, 42,000 by bank, 42,000. So therefore balance figure is 3,100. This is how we need to ascertain the cash missing. Now I want every one of you to observe the pattern of the question, how we are solving it. See, I want cash missing. How much is the cash missed? I know how to prepare cash book and ascertain this as a balancing figure. But to ascertain this as a balancing figure, I want cash sales also, but that is not available. Okay, cash sales required. How to ascertain cash sales? Generally by preparing cash book only cash sales will be ascertained. But you know, here cash book itself requires not cash sales. It requires this one as a balance figure. Therefore, cash sales have to work it out somehow. Immediately in my mind, I should get an idea that how they are making sales. They are making sales based on 20% profit, 20% profit on sales. So therefore, 1/5 on sales, that means 1/4 on cost. Maybe I can find out COGS because I know opening stock, purchases, closing stock, I can ascertain. So immediately I got an idea that that's why opening stock, closing stock, purchases. Maybe purchases, all purchases, credit purchases, because by reading the question we understood. Maybe this is not available. Credit purchase is not available. Ascertain it by preparing sundry creditors account. So sundry creditors account you prepare, ascertain this as a balance figure. COGS I got, I applied the profit, I get total sales. But I want cash sales. From this I need to reduce credit sales. Maybe credit sales not available. Prepare debtors account. So look at the interlinking. In order to ascertain cash sales, I need to prepare creditors account, I need to prepare debtors account, then I got cash sales. Once I got the cash sales, I need to complete cash account and ascertain the closing cash balance as the balancing figure. So this is how the questions will be solved under conversion method search. It's all about the missing link, sir. Little bit of accounting knowledge you had, I think these sums will be very easy, sir. So this is one question, sir. We can solve. We'll see one more question, sir. Illustration number 8. See this question. Lucky does not maintain proper books of accounts. However, he maintains a record of his bank transactions and also is able to give the following information from which you are requested to prepare final accounts for the year 22-23. So he does not maintain proper books of accounts. He maintaining only few bank related transactions. Okay. Now they are asking us to prepare final accounts. See this. Opening debtors given, closing not given. Debtors, creditors opening given, closing not given. Opening missing, closing given. Stock, okay. Bank balance opening not available. Fixed assets given. Details of his bank transactions were as follows. I told you in the question they will give you bank related transactions, so mostly it is relating to method number 2. Additional capital, sale of fixed assets, book value 2500. We sold it for 1750, so there is a loss. Paid to creditors, expenses paid, personal drawings, purchase of fixed assets. No cash transactions took place during there. There is no cash transactions. Goods was sold at cost plus 25%. See this. Goods are sold at cost plus 25%. If cost is 100, 25% profit is added. So we sold for 125. Cost of goods sold was 2,60,000. So COGS, cost of goods sold 2,60,000. So if I want sales, how to ascertain sales? COGS, cost plus 25% you add. So 3,25,000 is the sales. Okay. Now I need to prepare the final accounts, sir. So how can you prepare final accounts? Come on, tell me. First I will start with trading account. I want opening stock. Opening stock available. Purchases, during their purchases available, not available. I need to ascertain purchases. Sales available, yes, available. Closing stock available, available. So you can ascertain gross profit directly. Let's solve one more question relating to conversion method, sir. Illustration number 8. Lucky does not maintain proper books of accounts. However, he maintains a record of his bank transactions and also is able to give the following information from which you are requested to prepare his final accounts for the year 22-23. So he is maintaining bank transactions. That itself is an indication that conversion method we need to apply. And they're asking us final accounts. Trading, P&L, balance sheet we need to prepare. opening closing balances, debtors closing not available, creditors opening not available, bank balance opening not available. Following details of his bank transactions were as follows: received from debtors, additional capital brought in, sale of fixed assets. 1750 is the sale value, sir. Book value 2500. So there is a loss on sale, right? 2500 minus 1750. 750 is the loss. This loss will go to P&L account. Paid to creditors, expenses paid, drawings, purchase of fixed assets. No cash transactions took place during the year. There was no cash transactions. Everything is through checks, bank, nothing but. Goods was sold at cost plus 25%. Goods are sold at cost plus 25%, sir. Cost of the goods sold was 2,60,000. Cost of the goods sold is also given. So can I find out sales very easily? So sales is equal to cost of goods sold plus profit. Profit is 25%, which is nothing but 2,60,000 plus 25%. So 3,25,000 is the sales. Sales. Okay. So sales is 3,25,000. Now what they're asking, final accounts. Trading account, first we need to prepare. In order to prepare trading account, we want what? Opening stock we want available. Purchases during the year. Any purchases given? Not given. We need to ascertain purchases. And this side sales. Sales available? Not available. We need to find out. Sales available. We just now find out. 3,25,000. Closing stock available. And also here in this question we can find out GP, gross profit. In trading account, opening stock, purchases, gross profit, sales, closing stock. Gross profit also we can ascertain. How we are going to ascertain gross profit, sir? Profit is given on cost, it is 25%. Or you can apply on sales. For example, you know, if cost plus profit is equal to sales, you know this. Suppose, imagine your cost is 100 on the 25%, so 125. So if I want to know the profit on sales, profit divided by sales on 25. 25 divided by 125, 20%. So 20% on sales. Nothing but 1/5 on sales, 1/4 on cost. Okay. So trading account, I think purchases will be ascertained as what? Balancing figure. Because opening stock available, closing stock available, sales available, we ascertain sales. Gross profit 20% on sales. Obviously purchases is the balancing figure. So trading account is done. Next, coming to P&L account. Gross profit first we will write. And what items will come in P&L account? One item is loss on sale of asset, 750. That loss on sale of asset, one item will come. Any other item which will come in P&L account? See, during the year, if you observe carefully, fixed assets opening balance 7,500, closing 9,000, and during the year there was a sale of fixed asset, there was a purchase of fixed asset. Let's prepare fixed asset account, and maybe the balance figure is what? Depreciation. Okay. So if I prepare fixed assets account, sir, opening balance I will take 7,500. During the year there was a sale, right? 1,750. So what is the entry for sale value? What is the entry for sale? Bank to fixed asset, and there is a loss. P&L to fixed asset. Two entries will come. One is sale entry at gross sale value. Another one is the loss. Okay. Or else you can write a combined entry also. Bank account debtor 1,750. P&L account debit 750. To fixed asset 2,500. And there was a purchase of fixed asset also during the year 5,000. So if I prepare fixed asset account, sir, see this here, I will prepare fixed asset account. So in this fixed asset account, opening balance 7,500 available, closing balance 9,000 available. I will take it. During the year there was a sale. So bank account debit, P&L account debit to fixed asset account. So fixed asset account will be created by bank P&L. And during there was a purchases also. There was a purchases also. Clearly given. Purchase of fixed asset. So to bank 5,000. So obviously what is the balance figure of fixed assets, sir? Depreciation, right? This depreciation will come in P&L account. So take it, depreciation. And also if you analyze the banking transactions, sir, they paid expenses 49,250. So expenses incurred and paid. So what is the expenses incurred? 49,250. So therefore loss on sale of fixed assets, depreciation, expenses. Obviously net profit got 14,000. So trading and P&L account is over. Next, balance sheet. Okay, I want to prepare balance sheet at the end. Now to prepare balance sheet, I want debtors. Debtors closing balance not available. I need to find out. And also, you know, in order to prepare the balance sheet, sir, I want capital account also, but capital account balance not given. So I need to find out the opening capital, what action, what additions, additional capital introduced, drawings, and then current year profit I will add back, then I will get closing capital. So in this problem, opening capital is not available, so I need to find out the opening capital. But in order to get opening capital as a balancing figure, what I need to do, I need to prepare a statement of affairs. That means I will write all the assets, all the liabilities, the balance figure is nothing but capital. But opening balances, if you observe, creditors balance is not available, bank balance also not available. So therefore I need to ascertain creditors balance at the beginning, bank balance at the beginning. So I will prepare creditors account, bank account. So I will prepare these two and I will ascertain them as balances, and I will ascertain the opening capital. To that opening capital, I will make adjustment of the additional capital brought in. I will add drawings, I will deduct current year profit. Already I got 14,000, that I will adjust, and automatically I will get the closing capital. Now in order to prepare the closing balance sheet, I want debtors as well as closing capital. So debtors, I will prepare debtors account. Okay. Now suppose if I prepare debtors account, you know, debtors opening balance 1,02,500 is available, and also what is the amount received from debtors available? 3,40,000. Okay. And during the year no cash transactions took place. That means all sales were what? Credit sales. 3,25,000 sales I will record in the debtors account. So debtors account, opening debtors, collection from debtors, credit sales. The balance figure is nothing but what? Closing debtors. You see, debtors account, if I prepare, opening balance of debtors 1,02,500 available, and then amount collected from debtors, bank account debit to debtors, how much amount received? 3,40,000. And also, you know, this one, sales during the 3,25,000, debtors to sales 3,25,000. So the balance figure is closing debtors. So to prepare closing balance sheet, I need closing debtors available 87,500. Now I want closing capital also, because in order to prepare this balance sheet, debtors I want, closing stock, bank balance, fixed assets available, but capital, closing capital not available now. In order to get closing capital, first I need to ascertain opening capital. How I am going to ascertain opening capital? By preparing opening statement of affairs. So opening, if you see, debtors available, stock available, fixed assets available, you take it, debtors, stock, fixed assets. Bank balance not available, that I need to ascertain. This side if you see, creditors not available, that I need to ascertain, and then I will get the opening capital. Okay. How you are going to ascertain the creditors, sir? By preparing creditors account. So see this, sundry creditors, 46,000 is what? Closing balance of creditors. And during the year, if you observe, there was purchases. Trading account balance figure is nothing but purchases, 272,500. That I will take. And also, you know, what is the amount paid to creditors? 2,80,000. Obviously balance figure is opening sundry creditors, 53,500. Similarly bank balance, you know, all the banking transactions are available. Opening bank balance we don't know, we want to find out. Closing bank balance 50,000. And what transactions had happened in the bank balance, related to bank? Received from debtors 3,40,000, additional capital brought in 5,000, sale of fixed assets. These are all receipt side. Payment side, payment to creditors, expenses paid, drawings, purchase of fixed assets. Payment side 4. Obviously opening balance, that 62,500. Now you know the all the items. Prepare opening Statement of affairs, ascertain capital as a balancing figure, 1,69,000. Now this 1,69,000 current year net profit you will add, additional capital you will add, drawings you deduct, closing capital you got. So therefore you can finish the balance sheet. So therefore you need to understand, sir, how you are going to solve a question relating to conversion method. That purely depends upon what information, what balance figures I want. Finding the missing figures. How you are going to find out the missing figures? Based on the information available. In this question, if you start from trading, and you see trading account, P&L account, balance sheet, one by one you see. First, trading account. Opening stock available or not, purchases available or not, gross profit available or not, sales available or not, closing stock available or not. In this problem, opening available, purchases not available, gross profit can be ascertained, sales available, closing stock available. So therefore purchase is the balancing figure. Next, come to P&L account. Depreciation expenses, depreciation loss available, loss on sale of fixed asset available, any other expenses available. Depreciation is not available. Prepare fixed asset account, ascertain depreciation is the balancing figure, so that you can close the P&L account. And if you close the P&L account, you will get net profit, that will go to capital account. I mean, that will be adjusted to capital. Now in order to prepare the closing balance sheet, I don't know the debtors. Prepare debtors account, ascertain the closing debtors as the balancing figure. And then I want closing capital, but I don't know the closing capital. So first, the opening capital itself you don't know. So prepare statement of affairs at the beginning of the year. At the beginning of the year, I don't know creditors as well as bank balance. Prepare creditors account, ascertain opening balance. Prepare bank balance, ascertain the opening balance. Right? Then you can get the first opening capital. To that opening capital, adjust drawings, additional capital, current year profit. Then you will automatically get closing capital. So that's how you can close it. See, relating to incomplete records, you need to solve it. Completely depends upon your fundamental accounting knowledge. So the basically you need to learn debtors account, bills receivable account, creditors account, bills payable account. These four accounts basic knowledge you should have. What entries will be posted in the debtors account, what entries will be posted in the creditors account. Without having the basic knowledge of these transactions or these accounts, you cannot solve any question relating to incomplete records. So my suggestion to students is, you first priority is solving only the study material questions. Don't solve any other question, just solve the study material questions. And in this marathon video, whatever the missing figures I have explained, whatever the ledgers I have explained now, first concentrate on those ledgers. The knowledge of those things will help you to solve all these questions. And for this chapter, it's not about the listening, I mean the marathon and all. It's about solving on your own. You should be able to solve at least 2 to 3 questions. You need to think and you need to solve, because the missing figure, I mean, you need to sort it out. It is not that every time missing figure would be same. It could be different depending upon the information given in the question. So you have to make an effort to identify, in order to prepare the complete final accounts, what things missing, what things I need to find out, how I am going to ascertain it. See, I explained 2 problems. In these 2 problems, you see the link. First problem I explained, cash sales is missing. Now I ascertained cash sales. How? Opening stock plus purchases minus closing stock, COGS. Then I applied profit on that. Then I got so total sales. From that credit sales I deducted. Then I got cash sales. Now with the help of that cash sales, I could able to finish the cash bank account balance and ascertain closing. I mean cash account I can able to prepare and ascertain the closing cash, which is the missing cash. So that's how the linking is. That's how the linking is. And while ascertaining COGS, opening stock available, purchases not available, let's prepare creditors account, right? Like that, because the missing figure what I want to find out may be linked with some other item. First I need to find out that item, then only this item will come. So this chapter you will get through only by practice, only by practice, only by practice. And based on my observation, I can say you that in the past examination questions, they are repeating what is there in the study material questions are there. So therefore, relating to the first method, 3 questions are there. Relating to conversion method, maybe 6 or 7 questions are there. Make an effort, and 2 questions I solved here itself. So remaining 4 or 5 questions are there. You just solve them. Okay, all the best. Okay sir, the next chapter we are going to cover is bills of exchange chapter. If you see the past examination papers, From this chapter, they are testing a 7 marks question, and you can expect one MCQ also, sir. So from examination point of view, this is one of the important chapters, I must say. See, basically in bills of exchange chapter, we are going to cover the accounting treatment for two types of bills, sir. One is trade bills, another one is accommodation bills. Now let us focus first on the accounting for trade bills, sir. Sir, first of all, what is this bills of exchange is all about? Let me explain you the concept of bills of exchange with one simple example. Suppose there is one party, Mr. A, who sold goods to another party, Mr. B. Now A is the seller, B is the buyer. Sale value 1 lakh, sir. Credit period 3 months. Date of sale January 1st, 2025. Now, in the sale transaction, Mr. A, the seller point of view, Mr. B will be his debtor. Now, if you think from B point of view, he purchased the goods from Mr. A. Now, Mr. B point of view, Mr. A is what? His creditor. Okay. So, A point of view, B is debtor for him. B point of view, A is his creditor. Now, as a seller, I want security for my sale amount. What are the options available to me? One of the option is, as a seller, what I can do is I can draw one bills of exchange. In that bills of exchange, I will write, dear Mr. B, my debtor, you need to pay me 1 lakh rupees, pay after 3 months, either to me or any person whomsoever I will give directions, you pay. Like that, I will execute one bill, and which is legally accepted as per the Negotiable Instrument Act, because there is an act called Negotiable Instrument Act which says Negotiable Instrument Act includes bills of exchange. Now this bills of exchange is drawn by the seller on the buyer. Now in the context of bills of exchange, the party who draws the bill is called drawer. The party who accepted the bill is drawee. So basically in this chapter we are going to learn the accounting treatment in the drawer books, drawee books. Okay. So the bottom line is, what is bills of exchange? It is basically a promise to pay. But this bill is actually drafted. I mean, it is executed by the drawer, accepted by the drawee. Okay. So in this example, A writes the bill, that is a written promise to pay, and he will give it to Mr. B. Mr. B signs and accepts the bill. So it will become a bills of exchange, which is a negotiable instrument, and it is covered under Negotiable Instrument Act. Okay. Now see, every bill will have a time limit. For example, in this case, the goods are sold on January 1st, 2025. 3 months time is there, credit period. So January 1st, 2025 to 3 months means February 1st, March 1st, April 1st. April 1st plus 3 days grace period will be given. So it will be 4th April 2025, that is the maturity date of the bill. On that date, the party who accepts the bill, that is drawee, will make the payment. Either he will make the payment or sometimes he may not make the payment. That is called dishonor of a bill. Okay. And the drawer point of view, bills receivable is an asset. Drawee point of view, bills payable is a liability, sir. Okay. So what is the bottom line, sir? What is bills of exchange? Basically, a bills of exchange is according to the Negotiable Instrument Act, a bill of exchange is an instrument in writing. Instrument means anything which creates legal rights is called instrument in writing, containing an unconditional order, signed by the maker. Maker means the drawer. Directing a certain person. The drawer is directing a certain person, that is drawee, to pay certain sum of money. You pay this much amount only to or to the order of a certain person or to the bearer of the instrument. Either you pay the amount to me or to any person whomsoever I direct. Okay. Sir, actually we are not focusing on the legal side of the bills of exchange. we don't want also, because our main object is the accounting. So I'm purely focusing on the accounting from examination point of view for bills of exchange. So in bills of exchange there are three parties involved, sir. Drawer, first party, the party who draws the bill. Basically, who draws the bill? The seller will draws the bill. Drawee means the party who accepts the bill. Basically, he is the debtor to somebody. Pay means ultimately to whom the payment will be made against this bill. Okay. So in this bills of exchange chapter, we are going to learn the accounting treatment in the books of drawee, drawer, and then drawee. Okay. Now, see, when it comes to accounting for trade bills, see, first of all, what is trade bill? Basically, there is a commercial transaction, there is a consideration for transaction, and to this consideration, if bill is drawn, for example, Mr. A sold goods to Mr. B for 1 lakh, so there is a commercial transaction, there is a consideration. Now bill is drawn by A on B, so this is called trade bills. Sometimes without any commercial transaction, without any consideration between the parties, just to satisfy the financial needs between them, the bills will be drawn and accepted. They are called accommodation bills. Now let us focus on the first, accounting for trade bills. See, when it comes to trade bills, sir, there are 6 situations. First situation, drawer retains the bill till maturity. Second situation, drawer discounts the bill with bank before maturity. Third, drawer endorses the bill to a person before maturity. Fourth, drawer sends the bill for bank for collection before maturity. Fifth, retirement of a bill under rebate. What is this retirement of a bill under rebate means? Sometimes drawee wants to make the payment of the bill early. So he requested the drawer that I am going to make the payment early, give me some discount. That is called retirement of a bill under rebate. Last one, renewal of a bills. Sometimes drawee requests the drawer, please renew the period, please extend the period of the bill. So what happens is automatically old bill will be cancelled, new bill will be drawn. That is called renewal of a bills. Now in all these 6 situations, how the accounting will be done in the books of the drawer and drawee, and in case of this endorsement, there is a person called endorsee will also comes into picture. In his books, how accounting will be done, we need to understand. Now please understand, sir, in the example, Mr. A, who is the seller, draw the bill on Mr. B. What Mr. B has done? Mr. B accepts the bill and he send it back to Mr. A. Now the bill is there with whom? Mr. A. From his point of view, it is bills receivable asset, right? Now there is a possibility that this bill receivable, he may retain it till maturity. Sometimes he will discount this with bank, right? Sometimes this bill he will endorse to some other person, to his creditor. Like this, different possibilities are there with the drawer. But drawee point of view, whatever you do, I am not bothered. I will accept the bill first, then on the due date, either I will make the payment or I will dishonor the bill. That's it. So therefore, irrespective of what drawer will do, drawee point of view, accounting will remain unchanged. Okay, we'll see it. Okay. Now let us discuss these cases, sir. Yeah. Come to situation number 1. When the drawer retains the bill till maturity. Okay. In this case, how entries will be passed? First of all, when the bill is drawn, what is the entry in the books of drawer? Bills receivable account debited to drawee account. Bills receivable to drawee. Because drawer point of view, whenever bill is accepted by the drawee and he receives the bill from him, it is an asset for him. So bills receivable account will be debited. Drawee account he will credit. Okay. Basically drawee is my debtor. Drawer point of view, debtor. When I sold the goods, debtor to sales I have written as, for example, Mr. X. I sold the goods to Mr. X. Mr. X to sales. Now I draw the bill, Mr. X accepts. So therefore bills receivable to X. So therefore in place of debtor I have written bills receivable. Debtor account is cancelled because he has accepted bills receivable. Bills receivable account debit to debtor account, drawee account. In the context of bills of exchange, he will not be called as debtor. He will be called as what? Drawee. That's why Mr. Bills receivable to drawee account. Okay. Next, drawee point of view, think drawee. Drawee means the party who accepts the bill. In our example, Mr. B, when drawer draws the bill, Mr. B accepts the bill, right? When he accepts the bill, what is the entry he will write? Bills payable is a liability for him, so he will credit bills payable, he will debit the seller account, that is nothing but drawer account. So drawer account debit to bills payable. See, in his books already, when he purchases the goods, he has created the creditor account. For example, Mr. Y, from whom he purchased the goods. So already Mr. Y is my creditor in my books at the time of purchase. Now he draw the bill, I accepted it. So when I accept, what happens? Creditor will be cancelled, bills payable will come. So in the context of bills of exchange, he will be called as drawer. Okay, anyways, I explained the background also. So if you are a drawer, whenever a bill is drawn, bills receivable to drawee. If you are a drawee, whenever you accepts the bill, drawer to bills payable. For you it is a liability, for him it is a asset. Okay. Next, what happens on due date? Two possibilities. Either drawee will make the payment of the bill, or he will dishonor the bill. Now see the first payment on due date. Suppose if the drawee makes the payment, as a drawer, what happens is bank account debit to bills receivable. I will receive the amount, so bank to bills receivable. Now think from drawee point of view. Whenever he makes the payment of bills, bills payable to bank account, his liability will be reduced. Bills payable liability to bank account. Okay. Next, what happens? Suppose sometimes drawee may not honor the bill, dishonor of a bill. Now when there is a dishonor, sir, you need to understand the fact of dishonor of the bill will be mentioned in the bill. That has to be done by a notary. Now for recording this fact of dishonor of the bill as per the act, some charges will be collected by the notary. Those are called noting charges. Basically these noting charges are paid by the holder of the bill, and later on he is going to recover it from drawee, because it is because of the drawee's dishonor of the bill. This fact of dishonor we need to mention in the bill by a notary. For that we are incurring noting charges. So therefore you need to understand, as a holder of the bill, if I have the bills of exchange on the date of dishonor, I will make the payment of notary charges to the notary, but I am going to recover it from the drawee. Okay. Now see, suppose you are the drawer. On the due date, you retain the bill till maturity. On the due date, drawee dishonor the bill. So what you are going to do, tell me? In your books already, bills receivable account is there now. Asset, cancel it. Bills receivable account will be created. Suppose the bill amount is 1 lakh. Bills receivable account I will credit. Drawee account I will debit, because I will again reinstate the amount recoverable from drawee. When I draw the bill, bills receivable to drawee account I created now. Now since he has not paid the amount, again I will write drawee account in my books. So drawee account debit. But the most important thing is, since I am the holder, I paid the noting charges as a drawer. So in my books, to bank account, also there is an outflow. Debit what comes in, credit what goes out. Cash is going out because of the noting charges. But I know this 1000 rupees I am going to collect it from drawee. So drawee account is debited with noting charges also. So therefore, as a drawer, whenever bill is dishonored, if the bill is retained till maturity, drawee account I will debit, bills receivable account I will credit, bank account I will credit. Drawee account is debited with bill plus noting charges. Now think from drawee point of view, sir. What happens from drawee point of view? Whenever bill is dishonored, drawee will cancel bills payable, and again he knows that he need to make the payment to drawer. So drawer's liability will be reinstated in his books, and he knows that the amount is going to be recovered from him as a noting charges, his expenses. So he will debit noting charges. So therefore bills payable account debit, noting charges account debit to drawer account. See, bills payable 1 lakh, suppose noting charges 1000, drawer account 1 lakh 1000, because he need to make the payment to drawer 1 lakh 1000. Drawer point of view, he will debit drawee account for 1 lakh 1000. Okay. This is situation number 1, sir, when the drawer retains the bill till maturity. For example, you see this question, illustration number 3. Suppose Mr. X is there, sir. He sold goods for 15,000 to Mr. Y and immediately draw a bill upon him on January 1st, 2023, payable after 3 months. On maturity, the bill was dishonored and rupees 50 was paid by the holder of the bill as noting charges. The journal entries will be recorded in the books of X and Y as given below under the following circumstances. First, when the bill was kept by Mr. X till maturity. Now you see here, Mr. X sold goods to Mr. Y, okay, and immediately draw a bill upon him. So if I write the entries in the books of Mr. X, first, whenever sale happened, what is the entry? Y account debit to sales. When? On January 1st. So this on January 1st, Y to sales. 15,000 is the bill amount, right? Next, what happens, sir? Bill is drawn. Mr. X draw the bill on Y. Y accept it. So X point of view, bills receivable account debit to Y account. On January 1st, bills receivable to Y. Okay. Next, on maturity date. Actually, January 1st is the bill date. February 1st, March 1st, April 1st plus 3 days. So April 4th is what? Maturity date. On maturity date, what happens? Our bill was dishonored. On the date of dishonor, who is the holder of the bill? X in first case, because Mr. X held the bill till maturity. Now he paid the noting charges 50. So tell me, Mr. X, as a drawer, what you will do? I will cancel bills receivable. I will debit drawee account. I will credit bank account. So the entry is drawee account debit, bill amount 15,000 plus noting charges 50. 15,050 to bills receivable 15,000 to bank 50. That is the entry I will write. See this. Y account debit to bills receivable to cash account. Okay. So Y dishonored is acceptance and paid rupees 50 as a noting charges. Now same if I write in the books of Y, how I am going to write? See this in the books of Y. First he purchased the goods, right? When he purchases the goods, purchases to X 15. And next, when X draw the bill, Y accepted it. So Y point of view, when he accepts the bill, X account debit to bills payable. Next, due date dishonored, bill is dishonored. So when bill is dishonored, what he will do? He will cancel bills payable, noting charges he will debit as his expenses, and drawer account he will credit, because he need to make the payment to him again. So his liability towards X will be reinstated. So bills payable account will be 15,000, noting charges 50 to X account 15,050. So this is first case, sir, when the bill is retained till maturity. Situation number 2, sir. Sir, sometimes what drawer will do is he will discount the bill with bank before maturity, sir. Okay. When he discounts the bill with the bank before maturity, what happens? First, when bill is drawn, same entries. Drawer point of view, bills receivable to drawee. Drawee point of view, drawer to bills payable. Okay. Next, he discounts the bill with bank. Drawer. See, usually when you discount the bill with bank, what bank will do is bank will deduct some discounting charges. So bank point of view, those are incomes. Drawer point of view, these are losses. Okay. How this discount will be calculated? Take the amount of the bill, for example 10,000. What will be the remaining period of the maturity of the bill? Suppose 3 months. What will be the rate of interest? 10%. So 250 is what, sir? Discount amount. So if 10,000 is the bill amount, sir, bank will deduct 250 and they will give 9,750 to drawer. So drawer point of view, whenever he discounts the bill with bank, what is the entry they will write? Bank account debit 9,750, discount account debit 250 to bills receivable account 1,000. And in the books of drawee, no entry. When drawer discounts the bill with bank, no entry will be recorded in drawee books because doesn't make any difference to him. Now next, on due date, drawee makes the payment. As a drawer, I don't write any entry because already bill is there with whom? Bank. So directly amount will be paid by drawee to bank. Now as a drawee, whenever I honor the bill, what is the entry? Same entry, bills payable to bank. Now the most important thing is dishonored. So if drawee dishonor the bill, as a drawer, if I discount the bill with bank before maturity, what entry I will write for dishonor? Simple. I will reinstate my amount recoverable from drawee. So drawee account will be debited with bill amount plus noting charges, right? I will credit bank account because the moment the bill is dishonored, bank is going to recover the amount from my bank account. And now in this case, who is the holder? The bank. So bank will pay the noting charges and they are going to recover it from my bank account. So therefore you see, bank will deduct the amount from my bank account including the noting charges, and I am going to recover it from the drawee. So whenever bill is dishonored as a drawer, what I will do, drawee account I will debit bill amount plus noting charges. Bank account I will credit noting charges plus bill amount. See this, drawee to bank account. Suppose in the first case, when the bill is retained till maturity, what is the entry I have written for dishonor? Drawee to bills receivable I have written. But since here bill receivable is no more there with me, I can't cancel bills receivable. Already it was cancelled at the time of discounting entry. So therefore, what is the entry now I am going to write? Drawee to bank account. So bill plus noting charges. Okay. Now think from drawee point of view, whenever bill is dishonored, in this case, if the bill is discounted with bank before maturity, doesn't make any difference. When the bill is dishonored as a drawee, what I will do? Simple, I will cancel bills payable, noting charges I will debit, drawer account I will credit. So bills payable account debit, noting charges account debit to drawer account. See, I will cancel bills payable account and I will reinstate my liability towards drawer, including noting charges this time, because I know that I need to pay the amount to drawer including noting charges, because the bill was dishonored, noting charges was incurred. Actually it was deducted from my bank account, but I need to recover it from drawee. So that's why when bill is dishonored, drawee account debit bill plus noting charges. Bank account is credited bill plus noting charges. And of course, at the time of discount, whatever the discount charged by the bank, it is a loss for me. I will transfer this to P&L account. Okay. So therefore, what is the point you need to understand, sir? In first situation, second situation, drawee books accounting doesn't change. And first situation, second situation, when the bill is dishonored as a drawer, in the first case, drawee to bills receivable to bank. In the second case, drawee to bank. That is the entry I will write. Suppose same question you see, when the bill is discounted by Mr. X with bank immediately at 12% per annum. If this is the case, how entries will be recorded? Let us see. Suppose I am Mr. X. First, when I sell the goods to Mr. Y, same entry, Y to sales. See this, Y to sales on January 1st. Next, on the date, same date, I discount the bill with the bank. So when I discount the bill with bank, what is the entry? Bank account. First I need to draw the bill. On January 1st, Mr. X draw the bill on Mr. Y. So when the bill is drawn, what is the entry? Bills receivable to Y account. Bills receivable to Y. Next, this bill is discounted with the bank. When bill is discounted with bank, bank account debit, discount account debit to bills receivable account. Bank account is debited with how much amount? Bill amount actually 15,000. 3 months bill, 3 by 12 into 12%. So it was 450. So 450 is the banking charges. So bank account debit, discount account debit to bills receivable account. Okay. Now on the due date, bill was dishonored. So when bill is dishonored as a drawer, what entry I will write? Drawee account debit to bank account. See this. Drawee Y account debit to bank account. How much amount? 15,000 bill plus 50 rupees noting charges. Including noting charges, I will recover it from drawee. That's it. So if you think from Y point of view, Y, that is the buyer. When the bill is discounted with bank before maturity, same entries, doesn't make any difference. See this, in Y, the following journal entries will be made in the books of Y in all three cases. Therefore, irrespective of what happens to bill before maturity, drawee books accounting treatment remains the same. He accepts the bill, either he will make the payment or bill is dishonored. When bill is dishonored, bills payable account debit, noting charges account debit to drawer account. Okay. This is case number 2, sir. Next situation, endorsement of the bill before maturity, sir. Sir, what is this endorsement of a bill? Very simple, sir. Suppose A sold goods to B, sir. So A is the seller, B is the buyer. A point of view, B is the debtor. right? From whom we need to collect the amount. At the same time, sir, A purchased the goods from Mr. C, sir, or else you can say like that. C sold goods to Mr. A. So C point of view, A is the debtor. A point of view, C is his creditor. He need to make the payment to C. So what A can do is, A draw the bill on B, B accepts the bill and given to A. So A, there is a bills receivable is there. This bills receivable he will endorse in favor of his creditor because he need to make the payment to creditor, right? On the due date, the party who accepts the bills, the drawee, will make the payment to the endorsee. So who is endorser? In this case A. Who is endorsee? C. So endorsement is nothing but my right of receiving the amount of the bill I am transferring to you. On my behalf you can collect the amount. Now there are three parties here. A is called endorser, C is called endorsee, B is called drawee. So A is what? Drawer, endorser. B is drawee, C is endorsee. Okay. So see this: drawer books, drawee books, endorsee books. So first, when the bill is drawn, same entry, doesn't make any difference. When the bill is drawn, drawer point of view, what is the entry? Bills receivable to drawee. Drawee point of view, same, drawer to bills payable. Endorsee point of view, no entry. He was not there in the original bill drawn transaction. Next, endorsement happens, sir. Whatever the bill receivable is there, that was endorsed in favor of the endorsee. So as a drawer, what I will do, when I endorse the bill, endorsee account I will debit, bills receivable account I will credit, because now this bill I am transferring to endorsee. So endorsee account, endorsee is basically my creditor, so creditor account debit to bills receivable. Now when I endorse the bill, what is the entry? Drawee will write. No entry will write. He has nothing to do with. His books will not be affected. Now as a endorsee, whenever he receives the bill, what is the entry? Bills receivable to drawer account. Okay. So because in his books the drawer is his debtor, right? So when debtor endorsed the bill in his favor, so he will credit drawer account, bills receivable account he will debit. Suppose on the due date payment was done, no entry will be recorded in the books of drawer because bill was not there with him, bill is there with endorsee. Now when the payment is made by the drawee on the due date, same entry. What is the entry? So bills payable to bank. Endorsee point of view, endorsee point of view, endorsee point of view, tell me what is the entry? He receives the payment, right? So bank to bills receivable. Bank account debit to bills receivable account we will credit. Suppose if the bill is dishonored in this case, what happens? Tell me, come on. Bill is dishonored, so as a drawer, I will debit drawee account, I will credit endorsee account, because I need to recover the amount from drawee and I need to make the payment to endorsee again. So in my books I will reinstate the asset as well as liability. So I will reinstate drawee account, I will reinstate the liability account. So drawee to endorsee. See, when I endorse the bill, endorsee account I have debited. Now since the bill is dishonored on due date, again I need to make the payment to endorsee. So I will credit endorsee account, I will debit drawee account. But here the important thing is, in case of endorsement, the bill is there with whom? Endorsee. Who paid the noting charges? The holder, endorsee. Now endorsee is going to recover the amount from drawer. Drawer is going to recover the amount from drawee. That's why drawee account is debited with bill amount plus noting charges. And endorsee account will be created with bill plus noting charges, because we know that we need to pay the amount to endorsee including noting charges. So therefore as a drawer, drawee account debit to endorsee account. So if all the three situations you see, when the bill is retained till maturity and bill is dishonored, as a drawer, what is the entry I am writing? Drawee to bills receivable to bank account. Drawee account is debited with bill plus noting charges. Second situation, when bill is discounted with bank and the bill is dishonored, what is the entry I will write? Drawee account debit to bank account. With what amount? Bill plus noting charges. Third situation, when the bill is endorsed in favor of endorsee and the bill is dishonored, what is the entry? Drawee account debit to endorsee account. What amount? Bill plus noting charges. And drawee point of view doesn't make any difference. I told you, drawee point of view, whenever bill is dishonored, so what he will do? He will cancel bills payable, noting charges he will debit, drawer account again he will credit. So therefore the entry is bills payable account debit, noting charges account debit to drawer account. Now when it comes to NRC, what happens, tell me? NRC, since bill is dishonored, what he will do is, again in his books, he will reinstate the amount recoverable from drawer. So he will debit drawer account, he will cancel bills receivable account, and he has paid the noting charges. Since he is the holder of the bill, to bank account he will credit. So therefore drawer account debit, including noting charges, bill plus noting charges, in his books he will debit drawer account. Bills receivable he will cancel in his books. Bank account he will write as a noting charges, because he is the holder of the bill, he has incurred the noting charges. So drawer account debit to bills receivable to bank account. And drawer point of view, see, drawee to NRC. Okay, suppose see this case, when the bill is endorsed by Mr. X in favor of his creditor Miss Z. Now in this case, you see, suppose situation number 3, when I write the entries, how I am going to write? Suppose Mr. X books. First Mr. X sold goods to Mr. Y, same, Y to sales, that entry. Next X draw the bill on Y, bills receivable to Y. These two entries are common in situation number 3 also. See this. First Y to sales, sale entry, then bills receivable to Y account. Next what happened? Endorsement happened, right? The bill is endorsed in favor of his creditor Miss Z. So what is the entry Mr. X write when he endorsed the bill in favor of Miss Z? Z account debit to bills receivable account, correct? See this, Z to bills receivable, endorsed. Next due date came April 4th. What happened on the due date? The bill was dishonored. So when bill is dishonored, which is already endorsed in favor of Miss Z, what is the entry drawer will write? Drawee account debit to endorsee account. So drawee is whom here? Y. So Y account debit to Z account. What amount, sir? Bill amount plus noting charges. He need to recover it from drawee, because endorsee is the holder of the bill. He paid the noting charges. He is going to recover the amount from drawer. Drawer is going to recover it from drawee. So drawer books, drawee account is debited with 15,000 plus 50. And he will credit endorsee account 15,000 plus 50. Okay. And Y point of view, same interest, doesn't make any changes. Okay. This is situation number 3. So therefore, if you see carefully, sir, the accounting treatment is changing in the books of drawer only. Drawee books, it was same in all the situations. Okay. Situation number 4, sir. Sometimes what happens, sir, drawer sends the bill to bank for collection. Before maturity, he sent the bill to the bank for collection, sir. So when bill is drawn, same entry. Drawer point of view, bills receivable to drawee. Drawee point of view, drawer to bills payable. Next, when the bill is sent for collection by the drawer, so bills for collection to bills receivable. Drawee point of view, no entry. Next, when the payment is made on due date, bank account debit, collection charges to bills for collection. So bank will collect the amount, bill amount, so they will make some charges, they will collect some charges from you, so it is an expense for you, so debit. Bank account debit, collection charges to bills for collection. So drawee point of view, when he makes the payment on due date, same entry, bills payable to bank. Now suppose if the bill is dishonored on the due date, as a drawer, what I will do? I will debit drawee account, bill plus noting charges. I will credit bills for collection account, and I will pay bank noting charges, because I was retaining the bill and I sent the bill for bank for collection. So therefore noting charges, whatever I pay for dishonor, I will credit to bank account, and I am going to recover it from drawee. So drawee account debit, bill plus noting charges. Bills for collection account I have opened when I send the bill for collection, so I cancel it. Bank account I will credit. Drawee point of view, same entries. Whenever bill is dishonored, bills payable account debit, noting charges account debit to drawer account, because the noting charges is going to be recovered from him. So from his point of view, these are his expenses. This is situation number 4, sir. Situation number 5, retiring a bill under rebate. Sir, what is this retiring of a bill under rebate? Simple, very simple, sir. See, suppose Mr. X, Mr. Y, there are two parties, sir. Mr. X draw the bill on Mr. Y, Y accepted it. So Mr. X point of view, bills received is a bills receivable. Y point of view, bills payable. Suppose the bill is 3 months, sir. 1 lakh rupees the bill amount. Now Y wants to make the payment before maturity for some discount or rebate. Suppose 3 months bill na sir. So he wants to make the payment 1 month early. 1 month early he wants to make the payment. And for that Mr. Y asked Mr. X, since I am making the payment 1 month early, give me some discount. Suppose for example, how the discount will be calculated, it is like this. Suppose the bill amount is 10,000, 12% rate of interest 1 month, the unexpired period. So 10,000 into 12% into 1 by 12. How much sir? 100 rupees. See, the drawer point of view, the discount is going to give, the rebate is going to give is a loss for him. So he will debit. Drawee point of view, the discount what he is going to get is a kind of a gain. So he will credit. So therefore tell me, the drawer point of view, what is the entry is going to write whenever a bill is discharged under rebate? He is going to receive the amount right first. So cash account debit, discount or debate account he will debit all expenses and losses, bills receivable account he will credit. Right? From the point of view of the drawee, are like nothing but acceptor. He makes the payment, right? When he makes the payment, as a drawee, what is the entry? Bills payable account debit to cash account, and he is getting discount or rebate, right? So he credit discount or rebate because it is his gain. So whenever a bill is retired under rebate, the drawer point of view, discount will be debited because it is his loss. Drawee point of view, since he is discharging the bill early, it is his gain, it will be credited. Remaining is same. When you receive the amount against bill, cash to bills receivable. But here discount, after discounting whatever the amount you receive, that will be debited. Okay. Now relating to this, any question is there? I think yeah. See this question. X sold goods 10,000 to Y on January 1st, 2023. Immediately draw a bill on Y for 3 months for the same amount. Y accepted the bill and returned it to X. On March 4, 2022, Y retired acceptance under rebate of 6% per annum. You are required to pass journal entries to record the above transactions in the books of X and Y. So first what happened, tell me. X sold goods to Y. So in the books of X, what is the first entry? Y to sales, correct? Sales entry. Immediately on January 1st, X draw the bill on Y. So when X draw the bill on Y, what is the entry? Bills receivable to Y account. That is also same. Next what happened? March 4th. Actually the transaction is January 1st, 2023. 3 months bill means February, March, April 1st. April 1st plus 3 days. April 4th is the due date. But on March 4th itself, Y wants to retire the bill under rebate of 6% per annum. That means 1 month early. So therefore 10,000 bill, 6% rate of interest for 1 month early. So therefore 50 rupees. So 50 rupees is what's the discount given by X to Y. So X point of view, this is loss. Y point of view, gain. So therefore whenever bill is discharged on March 4th, what is the entry X will write, sir? Bank account debit 9,950. Discount account debit 50. To bills receivable 10,000. That is the entry will write. See, bank, rebate on bills, bills receivable. Okay, that's it. Now same entry Y point of view. Y point of view, first he purchases the goods. When he purchases the goods, purchases account debit to X account on January 1st. Next he accepts the bill. When he accepts the bill, what is the entry? Drawer account debit to bills payable. That is X account debit to bills payable. See this. First he purchases the goods, then he accepts the bill. Then on March 4th, what happens? He is making the payment for discount. So therefore when he makes the payment, what is the entry? Bills payable account debit to bank account to discount account. So bills payable 10,000, cash account 9,950, rebate 50 rupees. Right? Rebate on bills. That's it, sir. This is retirement of a bill under rebate. Very simple concept. Next, last case, renewal of bills, sir. Sir, what is this renewal of a bill? See, the drawee requests the drawer, please renew my bill. In the sense, already there is a bill, old bill, but drawee couldn't honor the bill. So the old bill will be cancelled, a new bill will be drawn. That means I'm extending the time period for you. Whenever I extend the time period, definitely I'm going to charge some extra amount from you. So whenever there is a renewal of a bill, interest will be charged by the drawer from drawee. So drawer point of view, that interest is his income. Drawee point of view, that is his expenditure. Okay. So see this. First, the old bill will be dishonored. So when bill is dishonored, what is the entry from drawer point of view? When bill is dishonored, drawee to bills receivable. Suppose when he retains the bill till maturity and the maturity date bill is dishonored. So as a drawer, what I will do? Drawee account debit to bills receivable account. I will write. As a drawee, when bill is dishonored, what is the entry I will write? Bills payable to drawer account. Next, since I extended the period, interest for the renewal period I will charge as a drawer. For me, this interest is my income and I am going to collect it from drawee. So drawee to interest. Drawee point of view, for the extended period, interest is his expenses. So interest account, and he knows that he is going to make the payment to drawer. And if the interest is paid in cash, I am going to receive cash to drawee. And drawee point of view, drawer to cash. And finally a fresh bill will be drawn and accepted. So when fresh bill is drawn, again same entry, bills receivable to drawee. His point of view, he accepted it. So drawer to bills payable. Right? So old bill is cancelled, new bill is drawn. So that's why first it starts with what? Dishonor of a bill. Once bill is, why bill dishonored? Please understand. See, suppose the originally bill is drawn for 3 months. Now before 3 months, the drawee requested the drawer that please extend for another 2 months. So therefore as a drawer, what I will do, that original bill I will dishonor. First I will dishonor in my books. Dishonor will happen in both the parties' books. And I will draw a new bill for 2 months, right? For the 2 months I will charge interest. So think from drawer point of view. Drawer point of view is going to collect 200, interest for 2 months from drawee. So drawee account debit to interest. When he receives the amount, cash to drawee. And finally a new bill will be drawn and accepted by the other party. When accepted, bills receivable to drawee again. So first old bill will be dishonored, interest will be charged for the renewal period, interest will be received, and a new bill will be drawn and it is accepted. Drawee point of view, first dishonor of the old bill, and he knows he need to pay the interest for the renewal period. So therefore he will write interest to drawer. Again he make the payment, drawer to cash, and finally a fresh bill will be accepted by him. I think there is one question, sir. I will show you. Yeah. See this. On February 1st, 2023, X sold goods to Y for 18,000, sir. 3,000 were paid by Y immediately, and for the balance he accepted 3 months bill drawn upon him by X. Okay. On the date of maturity of the bill, Y requested X to cancel the old bill, see this, and draw a new bill upon him for a period of 2 months. So the drawee requested the drawer that please cancel the old bill and accept and draw a new bill for him for 2 months. He further agreed to pay interest in cash to X at 12% per annum. X agreed to Y's request and cancelled the old bill and draw the new bill. The new bill met on maturity by Y. Pass necessary journal entries in the books of drawer and drawee. Now suppose in this case, sir, what will be the interest which is charged for the renewal? Actually bill amount is 18,000, 3,000 paid immediately. So remaining bill is 15,000, sir, and 12% interest, and renewal is done for 2 months. So 15,000 into 12% into 2 by 12. How much, sir? 300 is the interest which is going to charged by X from Y. Okay. So what are the entries you are going to write in this case? Tell me. First X point of view. First he sold the goods. So Y to sales. First sale entry. Y to sales. When? On February 1st. Next 3,000 he immediately received. Remaining 50,000 a bill is drawn and accepted. So what is the entry? Bank account debit 3,000. Bills receivable account 15,000 to Y account. Right? cash 3000, bills receivable 15,000, Y account 18,000. Now next what happened? Next, before maturity of the first bill, Mr. Y requested X to cancel the old bill. So therefore there is a dishonor of the bill. So drawer point of view, whenever there is a dishonor, what is the entry? Drawee, that is Y account debit to bills receivable account. See this, Y to bills receivable. Noting charges not given, so no need to consider. So on May 4th, Y to bills receivable. But important guys, here you are cancelling old bill for drawing a new bill. We have to extending the period. How much period you are extending? 2 months. So 300 interest will be collected. So therefore interest account I will credit in my books because it is my income. So therefore Y account debit bills receivable to interest account. Then I will receive the amount. So when I receive the amount, cash account 300 to Y account. Now at the same time the new bill is drawn and accepted, right? Bills receivable account debit to Y. So combined entry they have written, sir. And this bill is honored on the due date. So bank to bills receivable on July 7th. Because February 1st, March, April, May plus 3 days. So May 4th is what? Due date for the first bill. 3 months means May 4th, April, June. June 4th plus 3 days. Sorry, I think May, June, July. July 4th plus 3 days. So July 7th is the due date for the maturity date for the second bill. That's why on the second bill, duly honored, bank to bills receivable. So X point of view, first dishonor of the old bill, Y account debit to bills receivable, 15,000, 15,000. 300 interest is going to collect it, correct? So interest account is created with 300 and is going to recover it from Y. So Y account is debited with 15,300, that is bill amount 15,000, interest 300. Later on he collected the interest in cash and he draw the bill and he accepted by Y. Bills receivable cash to Y. And the original bill, second bill was honored on the due date, bank to bills receivable. Now think from Y point of view, sir. First he purchases the goods. When he purchases the goods, purchases to X. Same day he makes the payment 3,000, X to cash 3,000, remaining bills payable accepted. So X account debit to cash to bills payable. Next on May 4th what happens? Dishonor happen. When dishonor happen in the books of drawee, what is the entry? Bills payable account debit to drawer account. But here I know I need to pay the interest for the renewal period also. So therefore bills payable 15,000, interest 300 to X 15,300. Next, so on May 4th again I accepted the second bill. So X account debit to bills payable to cash. Interest I pay, so therefore cash account I will credit. Bills payable X to bills payable, new bill accepted, and on the due date I honored it. So when I honor the bill, what is the entry? Bills payable to bank. This is the second bill. Here they have written a combined entry. You can write a separate entries also. For example, here you can write cancellation entry separately, this one also separately. For example, cancellation entry, bills payable account debit to X account, 15k, 15k. Interest 300 you need to pay to the X. So therefore X account you credit 300. Interest is your expenses, he will debit 300. Now next, when you make the payment of interest, X to bank, X to cash, 300, 300. And for this 15,000 what happens? We accepted the second bill. So when we accept the bill, what is the entry? Drawer account debit, that is X account debit to bills payable account. That's it. So this is one situation, sir. Renewal of a bills. So therefore in case of trade bills, all the situations we have covered, sir, along with the questions. 6 situations we have covered. Now we are going to discuss accommodation bills. So basically I told you what is accommodation bills. There is no commercial transactions, there is no consideration for the transactions, but just to satisfy the financial needs of the parties, one party will draw the bill on another party. Those are called accommodation bills. Now let us I'm going to solve one question relating to the accommodation bills. important question I am going to solve, so that you will understand this concept. Yeah, illustration number 8 we are going to solve, sir. Illustration number 8. Of course, see, in study material we got 4 or 5 models, 4 or 5 questions like this. If you solve illustration 8, all other questions easily you can solve, sir. Vijay draw a bill for 60,000 and Anand accept the same for mutual accommodation of both of them to the extent of Vijay 2/3, Anand 1/3. Vijay draw a bill on Anand sir 60,000. Anand accepts it. It is for mutual accommodation of the parties. That means actually there is no commercial transaction between them. There is no amount to due between them. Just to satisfy their financial needs, one party Vijay draw the bill on Anand. And what happens next is they will discount this bill with bank, and then the proceeds will be shared by them. Vijay 2/3, Anand 1/3. Okay, see this. Vijay discounts it with bank for 56,400 and remits 1/3 share to Anand. Before the due date, Anand draws another bill for 84,000 on Vijay in order to provide funds to meet the first bill on same sharing basis. First bill is drawn by Vijay on Anand. They discount it. 1/3 of the proceeds given to Anand. Now next, before the due date of the first bill, this time Anand draws the bill on Vijay for 84,000 in order to meet, or in order to provide funds to meet the first bill. First they need to pay the first bill. Next, the second bill is discounted at 81,600. Okay. With these proceeds, the first bill is settled and rupees 14,400 remitted to Vijay. Before the due date of the second bill, Vijay becomes insolvent and Anand receives a dividend of only 50 paise in a rupee in full satisfaction. Pass journal entries in the books of Vijay. Pass journal entries in the books of Vijay. Okay. So first of all, properly analyze this question, sir. Tell me, who are the parties? Vijay, Anand. First, who draw the bill? Vijay on Anand, right? Okay. Let me explain you with the solved answer in my classroom. So I have analyzed this like this. This analysis is very much necessary, sir, because I will tell you where students are lacking to understand this type of questions. First, take first bill. Keep the question with you. First bill. Who draws the bill? Vijay. Vijay draws on Anand. Bill amount 60. Now, this bill is discounted with the bank, right? Now, how much they received? 56,400 they received. 56,400 they received. Now, in this 56,400, 2/3 will be given to Vijay, 1/3 will be given to Anand, correct? So, see this 56,400, 2/3, 37,600. Anand 1/3, 18,800. Sir, please understand, sir. 60,000 bills, sir. After discounting, they received 56,400. So therefore, what is the discount amount, sir? 3,600. Discount is basically what? Loss. See, when the bill is drawn for mutual accommodation, when the proceeds are shared in 2/3, 1/3 ratio, the loss will also be shared in the same ratio. So therefore, this 3,600, how much will be given to Vijay? 2/3. How much will be given to Anand? 1/3. So in Vijay books, he will recognize discount as his loss. He will debit 2,400 because out of this 3,600, 2/3 will be given to him. Anand 1/3, 1,200. So this is first bill. So if you see, in respect of first bill, Vijay 37,600 amount he will receive, discount 2,400, it will be 40,000 out of a bill of 60,000. So it will be 2/3. And Anand, you see, cash received 18,800, discount he borne 1,200. So therefore it will be 20,000. It is 1/3 of the bill. So you need to understand, when the bill is drawn for mutual accommodation, in what proportion the proceeds are shared, in the same proportion the discount will also be given to the parties. They will bond the loss also in the same proportion. Now, the interesting point is second bill. First bill is gone. Okay. Come to the second bill. Very interesting. What happens in the second bill? Anand draws on Vijay. Correct? In the second bill, Anand draws on Vijay. What is the bill amount? 84,000. And they discount it with bank. The second bill is discounted for 81,600. 81,600. Tell me. The proceeds after discount 81,600. Now in this 81,600, if you see carefully, they said the second bill is 81,600. With these proceeds, the first bill will be settled. First bill will be settled, and 14,400 is remitted to Vijay. Correct? See this. 81,600 is the second bill proceeds. First bill amount 60,000 will be paid to the bank. Bank, I will pay 60,000. You need to pay the total bill amount to the bank. Bank will cut the deduction, I mean discounting charges. At the time of payment, you have to pay the total bill amount. So 81,600 you got, na sir, after discount. 60,000 you will pay first bill. And what is the amount remaining? 21,600. Out of this 21,600, how much will be given to Vijay? 14,400. Clearly given in the question. Therefore, in the second bill, how much is the proceeds enjoyed by Vijay? This 14,400 plus 40,000. How this 40,000, sir? Simple. Sir, second bill is used for what? Payment of the first bill. Correct? In the first bill, what is the Vijay's liability? 40,000. So therefore, in the second bill, he enjoyed his share of liability of the first bill, which is paid through proceeds of the second bill, plus 14,400, which is given by Anand to Vijay. That means 54,400 out of this 81,600 is Vijay's portion. You understand this? Second bill 81,600 we got. First it will be used to settle the liability of the first bill. In the liability of the first bill, what is the Vijay share? 40. That means in the second bill he enjoyed 40,000 plus after payment 21,600 left. In that 14,400 is given to Vijay, which is given in the question. So therefore, in the second bill, what is the Vijay proceeds? 54,400. What is the Anand proceeds? Remaining 27,600. 27,600. Nothing but in the first bill, Anand share is 20,000, which is paid through second bill proceeds, plus the remaining amount 7,200. So it is 27,200. See, the important point is the second bill is amount is 84,000 now, but after discounting it is 81,600 now. So what is the discount amount? 2,400. Now how much discount will be given to whom? How much? For example, in this 2,400, how much will be given to Vijay? How much will be given to Anand? Sometimes this they will ask as a MCQ. Most of the students will do wrong. Why na? They are unable to decide in the second bill who shared how much proceeds. That's why I have taken this much time to explain this. See, in the second bill of 81,600, Vijay enjoyed 54,400. How we got 54,400? Because the second bill is used to settle the first bill. So in the first bill, what is the share of liability of Vijay? 40 plus 14,400 he has taken. So therefore total 54,400 out of 81,600. So therefore discount on the second bill will also be given to parties based on the proceeds they enjoyed on the bill. So therefore you see, discount 2,400, 81,600 is the total amount. In that 54,400 is Vijay share. So 1,600 discount will be Vijay's discount. He has to bear the discount loss. Anand, total discount 2,400. In this 2,600, 27,200 out of 81,600 he enjoyed the profit, so 800. Okay, you understand this one? This is the most important thing, sir. Okay. Now actually finally what happens, sir? Vijay becomes insolvent. Actually, what is the total liability of Vijay? In the second bill, if you observe carefully, the second bill is total 84,000. First bill is already paid with the proceeds of the second bill. Now the second bill is pending 84. Suppose on the due date, who has to pay how much? In this 84,000, Vijay share is 54,400 plus 1,600, 56,000. Anand share is 28,000. 27,200 plus this discount of 800, 28,000. But now Vijay become insolvent, sir. When Vijay become insolvent, who has to pay the bill? Anand has to pay the bill to the bank, right? Because Anand draw the bill discounted with the bank, so to the bank Anand has to pay. He will pay 84,000. But out of this 56,000, how much is going to recover? Since Vijay become insolvent, he is going to pay only 50 paise. That means out of 56,000, 28,000 he will pay. Correct? So out of 84,000 bill, Anand share is 28. He will make the payment. Remaining 56,000 actually paid by whom? Vijay. But in this 56,000, we are going to recover only 28,000 from the Vijay estate. Remaining will be deficiency. Okay. So this is basically analysis I have done, sir. Now why this analysis is required? Because if you want to write the entries, you should know exactly how much in the first bill each party received the proceeds and discount. How much in the second bill each party received the proceeds and discount. Most importantly, the second bill discount sharing is very, very important. In order to share the discount of the second bill, in the second bill proceeds, who enjoyed how much? That is very important, because the second bill is used to settle the liability of the first bill. So therefore the first bill, who share how much? Vijay liability is 40. That is paid from the proceeds of the first bill. So therefore in the second bill 40,000 and then 54,400. Anand 27,200. So if I share this one. Now they are asking entries in the books of Vijay, sir. So come on, tell me, sir. In the books of Vijay, how you are going to pass the entries? Suppose you are the Vijay. What happened? Vijay first draw the bill on Anand. So when he draws the bill, what is the entry? Bills receivable to Anand. 56, 60,000, 60,000. First bill amount. 60, 60. Correct? Being bill is drawn. Second, he discounts the bill with bank. When he discounts the bill, what is the entry? Bill, bank account debit, discount on bills to bills receivable. On the first bill, what is the discount? First bill, the discount is 3,600. Yes. So bank 56,400, discount 3,600, bills receivable 60,000. Now think from Vijay point of view. Out of this 3,600, what is the discount of Anand? 1,200. Give it to Anand. And out of this 56,400, what is the proceeds of Anand? 18,800, 1/3. In discount 3,600, 1/3. Give it to him. So when I given the proceeds and discount, what is the entry? Anand account will be debited because I am giving him Anand account debit. Discount I will credit. Bank account I will credit because I am giving the proceeds of 1/3. So first bill is done. Now second bill, what happens? Anand draw the bill, Vijay accepted. So Vijay point of view, when he accepts the bill, drawer account debit to bills payable. That is Anand account debit to bills payable. How much? 84, 84. Now see, in this 84,000, okay, after meeting the first bill, so 14,400 cash is given. So therefore bank account debit 14,400. And in the second bill, what is his share of discount? He will debit in his books 1,600. See this, 1,600 to Anand account. So because from Anand I received bank, discount also shared by Anand with me on the second bill. Next, what happened next? Bill dishonored on the due date. So bill was dishonored. Second bill was dishonored because Anand Vijay has become insolvent, right? Before the date of the second bill, Vijay become insolvent. So dishonor the bill. When bill is dishonored, Vijay point of view, what is the entry? He is the drawee. So when bill is dishonored, what is the entry? Bills payable account debit to drawer account Anand 54, 84. And from his estate he is going to pay only 28,000. So therefore Anand account debit, because see, when he becomes insolvent, the bill is dishonored, right? When the bill is dishonored, his share in the second bill 56,000. Now this 56,000 Anand account I will debit, bank account 28,000 I will recover. So deficiency 28,000, because from my estate only 50 paise will be recovered. Remaining 50 paise will go to deficiency. Okay. So if you prepare the Anand account, automatically this account got tallied. Sir, why you debit to Anand account 56,000? See, when from my side, if I become insolvent, the other party has to make the payment. So in the second bill, my share is 56,000. So my share, if borne by Anand, so I need to now make the payment to Anand. So Anand account debit 56 to bank account 28,000. Deficiency remaining 28. I can't pay it because I become insolvent. Only 50% I paid, remaining 50% becomes bad debt. So this is accommodation bills accounting treatment, sir. So in accommodation bills, sir, please concentrate on how discount is shared on the second bill. This is the important thing, sir. I think remaining, when you see the entries properly, you will get it, sir. So this is one question I have explained you, illustration 8. See the remaining question, same manner. You follow this pattern, you practice it. Okay. So this is accommodation bills. Okay, sir. The next chapter we are going to cover is insurance claims chapter. If you see the past examination trend, sir, every attempt you will find one question from this chapter. Usually a 7 marks question they are asking from this chapter, sir. In this chapter, basically we are going to cover the procedure for calculation of insurance claims under two types of policies. One is loss of stock policy, another one is loss of profit policy. Under each of these policies, how much amount of insurance claim we need to ask from the insurance company when loss occurs. That is what we are going to learn. Okay. So basically there is a stepwise calculation, sir. You need to learn those steps and you need to apply and find out the insurance claim. Let us first focus on the loss of stock policy. See, if you are a manufacturer, you have raw material, work in progress, finished goods, stock will be there. If you are a trader, you have stock in trade. So in your godown or factory, there is a stock. Now this stock is subject to different kinds of losses, different kinds of accidents. One of the most common loss we business enterprises face is fire. Among accidental losses, loss by fire is the most common. So what business enterprises will do? They will take fire insurance policy. And this fire insurance policy basically covers loss of stock. So there is an insurance policy. In the godown or factory, we have a stock. Now loss occurs, stock destroyed. Now you are going to claim the amount from insurance company. So what are the steps in determination of these insurance claims? Actually, there are 4 steps here, sir, to determine the insurance claims under loss of stock policy. All these 4 steps are very simple, common sense. Okay. Suppose loss occurred, fire occurred, stock destroyed. Now you need to ask the insurance company the claim amount. How much you will ask the insurance company? In order to determine the claim amount, first I should know what is the stock actually I lost, right? To determine how much stock I lost, first I should know what is the value of the stock on the date of fire in my godown or factory. So the first step is determination of the value of stock on the date of fire. On the date of fire, how much worth of stock is there with me? First thing. Then what I will do, I will calculate step number 2, that is salvaged stock. How much stock I saved where loss is occurring, where fire is happening. Sometimes we'll try to save some stock from loss, right? So that is called salvaged stock or saved stock. That stock you calculate. Usually it will be given in the question. Then find out the value of stock lost or value of stock lost by fire. Step 1 minus step 2. You know the value of stock on the date of fire. From that you deduct the salvaged stock. You will get the value of stock lost by fire. Once you know the loss, then you can calculate insurance claim. Okay. Of course, I'm going to explain each step in detail. Now the first step, value of stock on the date of fire. Sir, I want to know the value of stock on the date of fire first, because I want to determine the loss of stock by fire. For that, first I should know the value of stock on the date of fire. Now, how will you know the value of stock on the date of fire? Simple. If stock records are available, generally business enterprises will maintain stock records on daily basis. If stock records are available, ascertain the stock value from the records on the date of fire. You will get the value of stock on the date of fire. Your job is very easy. But the problem is sometimes these records are also destroyed. Then in that situation, how to ascertain the value of stock on the date of fire? Simple. Prepare memorandum trading account. In the year in which the fire happened, in that year, from the beginning of that year to the date of fire, prepare one memorandum trading account. Generally, you know what items will come in trading account: opening stock, purchases, gross profit, sales, closing stock. Now here I want to know the value of stock on the date of fire. Simple. For this period, the period in which the fire happened, from the beginning of that year to the date of fire, suppose fire happened on 30th June 2025. For this period, prepare trading account. Write the opening stock, purchases, sales, gross profit also you write down. How to find out gross profit? Sales into GP ratio you apply. You write all these items, automatically you will get closing stock as the balancing figure, which is nothing but the value of stock on the date of fire. Okay, so how to ascertain the value of stock on the date of fire, sir? Prepare memorandum trading account, ascertain the closing stock as the balancing figure. And here the important point is, in order to ascertain gross profit, I require GP ratio. Sometimes they won't give GP ratio. If it is given, we will directly take. Sometimes they won't give GP ratio. If GP ratio is not given in the question, what we need to do is we need to calculate GP ratio. Sir, which year GP ratio we need to take? Previous year. In the year in which the fire happened, preceding year. Current year you should not take. Last year GP ratio you need to calculate. For that you need to prepare the trading account. See, in order to get GP ratio, I want two things: gross profit to sales. Gross profit divided by sales. Generally gross profit is not available. Therefore, prepare trading account for the preceding accounting year. Suppose the fire happened in 25-26. Prepare trading account for 24-25. In this trading account, opening stock, purchases, sales, closing stock, everything is available. Gross profit you ascertain. Gross profit divided by sales, then you will get GP ratio. Generally GP ratio is given on sales. Sometimes to confuse you, they will give it on cost. You need to convert into GP ratio on sales. And once you know the GP ratio, apply it on the sales of the current year, you will get gross profit. Once you know the gross profit and remaining items filled up, then you will know the value of stock on the date of fire. So this is how the first step will be done, sir. So predominantly memorandum trading account will be prepared, sir. Now here one more important point, sir. When you are preparing this memorandum trading account, sir, you need to make certain adjustments to opening stock, purchases, sales, closing stock, depending upon the information given in the question. Similarly, when you are preparing trading account for the last year, certain adjustments if required we will do. Especially there is one concept in insurance claims, sir, especially in loss of stock policy, normal items, abnormal items. Whenever there is any abnormal slow moving items are there in the business, we need to eliminate the effect of those abnormal items, because we need to find out gross profit ratio only for this normal items, because normal items only will give you normal gross profit. Abnormal items, small moving items, slow moving items, sorry, poor selling line items, they won't give you normal profits. That's why whenever in the question if there is any abnormal stock like slow moving items, poor selling line items, we need to differentiate the normal stock, abnormal stock. Of course, I am going to solve one important question relating to it, which is examination question. I am going to solve. More chances that may be repeated in the examination. Okay, so hope you understood the first step. Now once I know the value of stock on the date of fire, what is the second step? Second step is salvaged stock. They will give it in the question. Then step 3, find out the value of stock lost by fire. Step 1 minus 2. Now once you know the value of stock lost by fire, then you determine insurance claims. Now important, sir, insurance companies will not admit the total loss claimed by you. They will see, before admission of claim, they will see whether your insurance is full insurance or under insurance. I mean, whether your insurance is sufficient or not sufficient. So we need to check whether the insurance policy taken is full or over insurance, under insurance. Simple. Here most of the students are doing mistake. See, listen to me carefully. You need to determine whether your insurance is full over insurance or under insurance. For that, you need to compare two things. What are those? You need to compare the policy amount with the value of stock on the date of fire, not with the loss of stock by fire. You need to compare with value of stock on the date of fire. In the first step, we decided now value of stock on the date of fire. With that, you need to compare, because according to insurance company point of view, ideally your insurance amount should be this one. Policy amount should be the value of stock on the date of fire. So that's why they are comparing these two. Suppose if your policy amount, also known as sum assured, is equal to value of stock on the date of fire as per step 1, this is called full insurance. Or if policy amount is greater than the value of stock on the date of fire, this is called over insurance. Very good actually, because you have taken more insurance than the value of stock on the date of fire. So in case of full insurance or over insurance, sir, whatever the loss occurred to you, that entire loss will be admitted as a claim. So therefore insurance claim is value of stock lost by fire. As per step number 3, whatever the loss occurred to you, that will be the insurance claim. Now the most important case is under insurance. When we call an insurance is under insurance under loss of stock policy, simple. If your policy amount is less than the value of stock on the date of fire, if policy amount is less than the value of stock on the date of fire, suppose on the date of fire the stock amount is 10 lakhs, but you take an insurance only for 5 lakhs. That means 50% only you covered. So insurance companies will follow average clause. They will apply average clause whenever there is an under insurance. That means whatever the loss occurred to you, they won't admit this as a claim. What they will do is proportionately they will give the claim. That means whatever loss of stock lost by fire as per step number 3 is there into policy amount divided by value of stock on the date of fire. Nothing but policy amount divided by policy amount ideally should be taken for what value? That is value of stock on the rate of fire. So sum assured divided by sum assurable. Nothing but, in this case you see, for example, value of stock lost by fire 8 lakhs. Proportionately, value of stock on the rate of fire 10 lakhs, but you taken policy for 5 lakhs. So 50% of 8 lakhs will be admitted as a claim. Students should be very careful. I know where they are doing mistake. In step number 4, majority of them are doing mistake. Why? They are unable to compare proper figures. You need to compare what? Can you tell me? Policy amount is compared with the value of stock on the date of fire. Value of stock on the date of fire is the ideal insurance amount, but you are taking insurance for which amount? Compare. If the insurance amount you taken, policy amount, and the value of stock on the date of fire equal, or policy amount is much more than the value of stock on the date of fire, no problem, it is a full or over insurance. Whatever the loss occurred to you, that will be admitted as an insurance claim. But if it is under insurance, insurance companies will apply average clause and they will give you claim amount proportionately. That is, whatever the loss occurred to you in step number 3 into what is the policy amount you have taken, actual what is the value of stock on the rate of fire, that is actually ideally how much amount you need to take insurance. Proportionately they will calculate, sir. Sir, I think we have completed steps in determination of insurance claims. All these 4 steps we need to follow, sir. Okay. And as I told you, when you're determining the value of stock on the date of fire, sometimes you need to prepare memorandum trading account. In that opening stock, purchases, sales, closing stock, all these items will come, right? So relating to them, sometimes we require adjustment for slow moving absolute items, abnormal defective items, free samples, goods withdrawn by the proprietor, overvaluation, undervaluation of stock, omission in stock recording, all these things. All these adjustments we will do to the different items of trading, memorandum trading account items, depending upon the information given in the question. Okay. Yes. Now let us see some questions relating to this, sir. Yeah, see this question, December 2024, there is a question, 7 marks question they have tested, sir. Loss of stock policy. On 10th December 2024, a fire occurred in the premises of Chendu. Date of fire is important, sir. 10th December, because on that day I should know the value of stock on the date of fire. All stock except to the extent of 28,800 were destroyed. That means salvaged stock 28,800. Chendu values the stock at cost less 10%. So he is valuing the stock at cost less 10%. So therefore now we need to make it at cost. Stock was insured for 1 lakh. So policy amount is 1 lakh. From the following information, ascertain the amount of claim to be lodged by Chendu. Now they are asking how much amount of claim you are going to ask from the insurance company. First of all, whenever you are solving a question relating to insurance claims, first see what is the current year, what is the previous year. That distinction you should have. 2024 10th December. Okay. So current year is 24-25. Right? Last year 23-24. So 23, 24, 24, 25. 2 years. This is current year, this is previous year. Fire happened on 10 December 2024. Okay. Look at the information given. Stock on 1st April 2023, purchases less returns during 23-24, sales less returns during 23-24. Last year data. Stock at 31st March 2024, purchases less returns from 1st April 2024 to date of fire, sales less returns from 1st April 2024 to date of fire. This is the information they given. Apply the as usual steps. First, determination of value of stock on the date of fire. So for that we need to prepare what? Memorandum trading account. So memorandum trading account will be prepared from which period? From 1st April 2024 to 10th December 2024. First we will take opening stock, then purchases, then GP, gross profit, then sales, then ascertain closing stock as the balancing figure. Okay. Suppose you see this. Calculation of claim. First, value of stock on the date of fire. Fire happened on 10th December 2024. So you need to prepare memorandum trading account for the period beginning to the date of fire. Now opening stock first you take. What is the opening stock given for the current year? 1st April 2024. What is the opening stock, sir? Last year closing stock is current year opening, right? 90,000. But in the question clearly said that the stock was undervalued. So therefore opening stock 90,000 into 100 divided by 90, 1 lakh we need to take. Okay. Next, purchases less returns from 1st April 2024 to date of fire. 5,84,000 purchases given. Next, sales also given. 6 lakhs 40. Take it. 6 lakhs 40. But I want gross profit, right? I want gross profit. To determine gross profit, sales available but GP ratio not available. I need to find out GP ratio. How to find out GP ratio, sir? I told you. If GP ratio is not available, then you need to prepare trading account for the preceding year. So that means last year 23-24 prepare trading account. So if I prepare trading account of the last year, then I will get gross profit. The formula is gross profit divided by sales into 100, you will get GP ratio. So if I prepare trading account for the last year, see this, last year opening stock 1,44,000. Again the stock was undervalued, so make it for cost. And last year purchases 5,60,000. Take it. Last year sales, see this 8 lakhs. Consider it. And closing stock of the last year, this one 90,000, which was undervalued. Make it proper valuation 1 lakh. So last year opening stock, purchases, sales, closing stock, everything I know. So this is gross profit 1,80,000. So gross profit 1,80,000 divided by sales 8 lakhs. So I get 22.5. This is the GP ratio. So this GP ratio of the last year I will apply here, so that I will get gross profit. See this 6 lakhs 40 into GP ratio of the last year. So therefore now I know opening stock, purchases, gross profit, sales. So what is the balancing figure? Closing stock. This is nothing but the value of stock on the date of fire, 1,88,000. So value of stock on the date of fire I determined. Step number 1 is done. Step number 2, salvaged stock. In the question clearly said that 28,800 were destroyed. All stock except 28,800. So salvaged stock. So therefore value of stock lost by fire is 1,88,000 minus 28,800. That is 1,59,200 is what value of stock lost by fire. Then calculate insurance claim, the most important. I told you how to calculate insurance claims. You need to compare two things, policy amount with the value of stock on the date of fire. What is the value of stock on the date of fire? 1,88,000. What is the policy amount? Policy amount is 1 lakh. So obviously policy amount is less than the value of stock on the date of fire, so it's an under insurance. In case of under insurance, I told you, you apply average clause. Therefore if I apply average clause, what happens? You tell me, what is the loss, actual loss for me? 1,59,200 into policy amount 1 lakh divided by value of stock on the date of fire. Proportionately you take. That means this 1 lakh is what insured amount. This 1,88,000 is what insurable amount. So the ideal insurable amount is 1,88,000, but you take an insurance only for 1 lakh. So proportionately 1,59,200 is the total loss. Proportionate to this, we will give insurance claim, that is 84,681. 84,681 is the insurance claim. So this is how you need to calculate the insurance claim in case of loss of stock policy. So this question they have tested in December 2024. Okay, this is one question I have solved, sir. Next, one more question we will see. See, for example, see this question. X Limited has taken out fire policy for 1,60,000. So the policy amount is 1,60,000 covering the stock. A fire occurred on 31st March 2023. Exactly at the end of the year fire occurred. The following particulars are available. Stock as on 1/4/2022. See, I told you that first we need to determine current year. Current year is 22-23. Last year 21-22. Correct? So see the details. Stock as on 1st April 2022. Last year closing, current year opening given. Purchases to the date of fire. Sales to the date of fire. That means current year purchases, current year sales up to the date of fire. Carriage inwards. Commission on purchase to be paid 2%. GP ratio 50% on cost given. That means 1/2 on cost. That means 1/3 on sales we need to take. Important. Okay. Because see, suppose cost is 100 rupees, sir. On that 50 profit. So 150 is what sales. So if I find out this on sales, my profit 50, my sales 150. So it will be 1/3, right? So if it is 50% on cost, that is 1/2 on cost, 1/3 on sales. Ideally 33.33 like that. Okay. So what they are asking, you are required to ascertain the total loss of stock and the amount of claim to be made against the insurance company, assuming that the policy is subject to average clause. Stock salvaged 41,360. Okay. So first what I need to do, I need to determine the value of stock on the date of fire. Fire March 31st, 2023. So I need to prepare memorandum trading account. In the beginning with the year, that is 1st April 2022 to 31st March 2023 to the date of fire, and ascertain closing stock as the balancing figure. So in the year 22-23, what are the figures available? Opening stock, last year closing, current year opening available 60. Purchases available, sales available. These carriage inwards, commission will be adjusted to purchases. Gross profit we can ascertain. So obviously value of stock on the date of fire we can ascertain as a closing figure. Closing stock can be ascertained as a balancing figure. See this, actually value of stock on the date of fire, memorandum trading account will prepare 1st April 2022 to 31st March 2023. You say first opening stock available 60,000. Next purchases 2,60,000 available. Now to these purchases, carriage inwards will be added 1,600, and also commission we are paying, right? Commission on purchases 2% you apply. 2,60,000 into 2%, 5,200. So total 2,66,800. And sales automatically, you know, actually given 1,80,000. And GP ratio 1,80,000 into 1/3, because they have given on cost, we need to apply on the sales 1/3, 60. So opening stock, purchases, gross profit to sales. So what is the balancing figure? Closing stock. This is the value of stock on the date of fire. Now in this question, no need to prepare trading account of the last year because gross profit ratio is available. In the last question we solved GP ratio not given. That's why we have prepared the trading account of the last year and ascertain the GP ratio. That GP ratio we applied on the sales of the current year and ascertain gross profit and ascertain the closing stock as the balancing figure. Then we got the value of stock on the date of fire. So here value of stock on the rate of fire 2,06,800. Salvaged stock, I think they have given in the question. How much? 41,360. Take it, 41,360. So value of stock on the rate of fire minus salvaged stock, you will get the loss. Value of stock lost by fire 1,65,440. Now calculate insurance claim. Policy amount is compared with value of stock on the rate of fire. What is the policy amount we have taken, sir? Policy amount is taken. The policy amount 1,60,000. What is the value of stock on the date of fire? 2,06,800. See this. So policy amount is 1,60,000. Value of stock on the date of fire 2,06,800. So policy amount is less than the value of stock on the date of fire. Insurance company expects you to take this amount, at least this amount as your insurance policy amount. But you have taken only for 1,60,000. So ideally this is what under insurance bar. When there is an under insurance, they will apply average clause. So therefore whatever the loss came to you 1,65,440, proportionately we will calculate, we will admit 1,65,440 into what is the policy amount 1,60,000 divided by what is the value of stock on the rate of fire 1,06,800. That means insured amount divided by insurable amount. Proportionate to this we will give the claim, that is 1,28,000 is the insurance claim. Okay, so two questions I have solved in respect of insurance claims. Now one more important question I am going to solve, sir, that is when there is abnormal stock, normal stock concept is there, how we are going to calculate? see sometimes in the question, sir, yeah, they will give you two types of stock details. One is normal stock, one is abnormal stock. Abnormal stock is also known as slow moving item or poor selling line item. See, if it is normal stock, na sir, they will give you regular gross profit. For example, my gross profit is 20%. If I sold my normal stock, I am going to get that gross profit. But suppose if the stock has become abnormal, slow moving, why stock will become slow moving? Maybe it got damaged, maybe it lost its value in the market, nobody is ready to buy this stock, different reasons. So it becomes slow moving item, poor selling line item. Obviously when the stock is become slow moving, poor selling line item, obviously its value, I mean its demand is less, right? So therefore you can't get the normal gross profit, so they will not give you regular gross profit, right? So therefore in the question, if they have given the details of normal abnormal stock, the effect of these abnormal items we need to eliminate to determine the gross profit. Because when you are calculating the value of stock on the date of fire, we will prepare memorandum trading account. I told you opening stock, purchases, gross profit also we need to take. When you're taking gross profit, sales into GP ratio you are applying. That GP ratio is nothing but previous year GP ratio. So when you're calculating GP ratio of the previous year, you need to consider gross profit of only normal stock. You cannot consider the abnormal stock. So that's why the effect of the normal and abnormal will be separated properly. Okay. I think this will be understood only by solving one question, sir. I'm going to show you one beautiful question which is given in the examination, sir. I'm straight away going to solve that question. And you also learn in this way only. Yeah, this question, sir. See this question. You know, the suggested answers, they won't give you the complete solution. They will give you just the final answer. This is the amount of claim of loss by fire. But in my classroom, I will solve everything. Okay. See this question, December 2023 attempt, they have tested. More chances that again they are going to test this, and this type of questions are there in the illustrations also. This is a very good question actually. in loss of stock policy only, this is something little bit different. When in the question, if they have given both normal and abnormal stock, how you are going to tackle it? Okay, see this question carefully. On 1st April 2023, the stock of Mr. Hari Prasad was destroyed by fire, but sufficient records were saved from which following particulars were ascertained. Okay, so on 1st April 2023, stock was destroyed. So date of fire 1st April 2023. Okay, stock at cost on 1st January 2022, 1,47,000. Stock at cost 31st December 2022, 1,59,200. So opening, closing. So they are following calendar year, January to December. Okay, so current year 23 sir, last year 22. So last year opening stock, closing stock given. Purchases year ended 31st December 2022, last year purchases, last year sales given. Purchases 1/1/2023 to 31st March 2023, current year sales up to the date of fire 3,24,000, sales given 4,62,400. Okay, in valuing the stock for the balance sheet at 31st December 2022, so that means when we are valuing the stock at the end of the last year, rupees 4,600 had been written off on certain stock which has a poor selling line. See this, that means some of the stock has become poor selling line, that means it is an abnormal stock. So last year when you are valuing the stock, we have written off 4,600 in respect of a stock which has a poor selling line having the cost of 13,800. See this, the cost is 13,800, 4,600 has been written off. Okay, a portion of these goods were sold in March 2023 at a loss of 500 on original cost of 6,900. See this, actually 6,900 original cost. We sold these goods in the March 2023. Actually see, slow moving item is belongs to last year. Current year 2023 March month we sold it at a loss of 500 and the cost is 6,900. 6,900 cost of the stock is sold at a loss of 500 means the sale value 6,400. So abnormal stock sale 6,400. The remainder of the stock was now estimated to be worth its original cost. The remainder of the stock, actually see, 13,800 is what? Poor selling line item, abnormal stock. In this 13,800, how much worth of stock, how much cost of the stock we sold? 6,900 sold at a loss of 500. That means what is the balance? 6,900 remainder, and that remainder of the stock was now estimated to worth its original cost. That means the value is now 6,900 only. Okay, subject to the above exception, gross profit had been remained at uniform rate throughout the year. Subject to this poor selling line item, GP ratio remains same, because as I told you, if it is a poor selling line item, your gross profit will not be same, because the item has less demand, means if I sold in the market, it is not going to get the normal gross profit, right? That's why. So the value of the stock salvaged was 11,600. The policy was for 1 lakh and was subject to average clause. Work out the amount of claim of loss by fire. So you need to claim out the amount of loss by fire. Okay, salvaged stock given, policy amount also given. So first of all, you identify what is the current year 2023, last year 2022. Okay, so what is the first step? Value of stock on the date of fire. I need to determine the value of stock on the date of fire. In order to determine the value of stock on the date of fire, what I should know? Opening stock, purchases, gross profit to sales. Then closing stock is the value of stock on the date of fire. But in order to determine gross profit, is GP ratio available in the question? No, GP ratio not available. Therefore, we need to find out gross profit ratio. Okay, how to ascertain GP ratio? Prepare trading account for the last year, ascertain gross profit divided by sales, you will get GP ratio. I need to prepare trading account for the last year, trading account. But in the last year, at the end of the last year, there is a abnormal item. Therefore, those abnormal stock effect I need to eliminate to calculate the GP ratio. Because I told you na, If the stock is abnormal, they are not going to give you normal gross profit. Therefore, you cannot combine both the stocks and find out the GP ratio of the last year. So therefore, when you are preparing trading account of the last year, separate one column for normal stock, one column for abnormal stock you need to write, and from the opening stock, from the purchases, from the sales, whatever the effect of this abnormal is there, you eliminate, and you find out GP ratio, gross profit ratio only for the normal stock. Sir, how I am going to do that, sir? I am going to explain. See this. In this question, this is the question I solved in the classroom. I will show you the question. Yeah, December 2023 attempt, right? Yes. See this, how I am solving it. Important. Please carefully observe. I will explain the solution. See. First, I need to determine the value of stock on the date of fire. Correct? For that, I will prepare memorandum trading account from the beginning of the year to the date of fire. So January 1st 2023 to 1st April 2023, I need to prepare memorandum trading account. Okay, I will come back to the memorandum trading account. I know that in order to determine gross profit, I want GP ratio. So first I need to try to find out the GP ratio of the last year. For that, I will prepare trading account of the last year. See this. When you are preparing the trading account of the last year, sir, you need to you need to maintain two columns: normal, abnormal, normal items, abnormal items. See, first, take opening stock. Opening stock is how much? On January 1st, 2022, 1,47,000. Simple. Next, purchases in the last year, 7,96,000. See, important. Purchases 7,96,000. Total column. But at the end of the year, we got abnormal items, 13,800, poor selling line items. How these abnormal items came, sir? So we assumed that in the current year purchases, this abnormal stock is also there. Generally, how stock is coming into the closing stock, it will not come suddenly, right? So it has to be come from purchases. So in this case, 7,96,000 is the current year purchases, last year So last year ending, there is a poor selling line item, abnormal stock. So therefore, in this 7,96,000, this abnormal stock cost 13,800 is there. So therefore, first I am going to eliminate from this 7,96,000 this 13,800. I will write to a separate column, because I told you abnormal stock effect will be eliminated wherever it is included. So first it is included in the purchases. I eliminate it. So therefore, my normal stock purchase is 7,82,200. So 7,96,000 minus 13,800. So 7,82,200. Okay. Now come to sales. Last year sales 9,74,000. There is no sale of abnormal items. Done. Now last year closing stock, very very important. You see this. Last year when they are valuing the closing stock, what is the stock at the end of the given? 159,200. That is the total stock. 1,59,200 total stock. But clearly in the question they said that when they are valuing the stock at the end of 31st December 2022, there is a poor selling line of 13,800. Out of that, how much we written off? 4,600 was written off. 4,600 was written off. That means in the 13,800, if you written off 4,600, how much is the balance? 9,200. So therefore, abnormal item in the closing stock is 9,200. So in this 1,59,200, 9,200 is what, sir? Abnormal stock. So therefore, normal stock is only 1,50,000. Important. Once again, I am telling. At the end of 31st December 2022, when you are valuing the stock, you find out abnormal stock worth of 13,800. Clear? 13,800. So that's why this 13,800 first removed from the purchases. Now come to year end. At the end of the year, they clearly said this 13,800, 4,600 we have written off. That means it is straight away, it is a loss for us. It's a poor selling line item. So 13,800, in that 4,600 is written off in the books because it has lost its value. So by loss 4,600. Therefore, what is the value remaining? 9,200. That is the closing stock for abnormal stock. So the stock at the end 159,200. In this 9,200 is abnormal item. 1,50,000 is normal item. So therefore, I know opening stock, I know purchases, I know sales, I know closing stock, I know the loss. So obviously, I can arrive what? GP, gross profit. ascertain gross profit. Gross profit for what? Normal stock 194,800. Relating to abnormal stock 13,800, 4,600 written off, it's a loss. 9,200 is there in the closing stock. So therefore, if I ascertain the gross profit for the normal stock, it is 194,800. See this, 194,800 divided by 9,74,000. So 20% is the GP ratio. This GP ratio I need to apply in the current year. So current year, when I'm finding the gross profit for the normal stock, 4,56,000 into 20% I need to apply. So therefore, please understand guys, whenever in the question there is a normal abnormal stock, when you are ascertaining the GP ratio of the previous year, you need to ascertain gross profit ratio only for the normal stock. How you are going to segregate? This is how you need to segregate. In the question, 13,800 is the abnormal stock is there. First you need to eliminate from the purchases. Second, at the end of the year, out of this 13,800, 4,600 you have written off, so it's a loss. So therefore 9,200 is included in the closing stock. Okay, accordingly, if my closing stock is 159,200, in this 9,200 is the abnormal stock, 1,50,000 is the normal stock I need to consider, and I need to apply GP ratio only for the normal gross profit, 1,94,800 divided by 9,74,000. So 20% is the GP ratio of the last year. Okay, now come to the current year. Very interesting. Come to current year, because I want to know the value of stock on the date of fire. Okay, first I ascertain the GP ratio of the previous year by preparing trading account of the last year by segregating normal abnormal stock. Now current year memorandum trading account. Opening stock. Last year closing is current year opening. 1,59,200. 1,59,200. 159,200. Last year closing, current year opening. Okay. Purchases of the current year. How much is the purchase of the current year? 3,24,000. Take it. Normal purchases. Sales. Now important. Current year sales 462,400. 462,400. But in the question clearly said that out of these poor selling line items, a portion of these goods are sold in 2023 March at a loss of 500 on original cost of 6,900. See, 6,900 original cost of the items you sold for 500 loss. That means 6,400 is the sale value. Correct? So therefore, in this 4,62,400 sales of the current year, 6,400 is the sale of abnormal items. So deduct it. So write in the separate column. Remaining sales is the normal sales. 4,56,000. Important. Here, what students do mistake now? Sir, abnormal stock 13,800. In that 4,600 is written off. Only 9,200 only remaining now. See, look at the wordings. A portion of these goods were sold in March 2023 at a loss of 500 on original cost of 6,900. A portion of these goods means they are talking about these goods, 13,800 abnormal goods. So abnormal goods, the cost 6,900, you sold it for 500. That means sale value is 6,400. So therefore you need to reduce from the total sales this 6,400, which is the sale of the abnormal items. Then you will get the normal sales, 4,56,000. Then on this normal sales you apply GP ratio of the last year, that is a gross profit ratio of the normal stock. Then you will get the 91,200. Now at the end what happens, tell me. At the end, the remainder of the stock is now estimated to worth its original cost. Sir, this is your abnormal stock, sir. You sold this much. What is the remainder? And you are valuing it at cost. So therefore, it will be shown at 6,900. And at the end, your stock is how much, sir? 6,900 is abnormal stock. And obviously, normal stock is ascertained as a balancing figure, 1,09,200. Okay? So that is the important thing here. So out of this 9,200 opening abnormal stock, sir, not out of this 9,200, sir. In the question they clearly said that a portion 6,900 worth, they sold it for loss of 500. So therefore the sale value is 6,400 abnormal stock sale value. And at the end the abnormal stock is valued at 6,900 because it remains valued at cost. So therefore you see abnormal stock credit side 6,400, 6,900, debit side 9,200. So gross profit of 4,100 is the balancing figure for abnormal stock. Okay, because last year when you are making the valuation, because it's a poor selling line item, you have written off 4,600. But this year maybe it has, recovered its value. So you sold it for 6,400. Now the remaining stock is valued at its cost. So therefore you got the gross profit of 4100. So what is the value of stock on the date of fire, sir? 1,09,200 plus 6,900. See this. 1,16,100 is the value of stock on the date of fire. So step number 1 finished. Next, salvaged stock they have given 1,11,600. Then what is the loss of stock by fire? Value of stock minus salvaged stock 1,04,500. Now calculate insurance claim. Compare policy amount with the value of stock on the date of fire. What is the policy amount? 1 lakh. What is the value of stock on the date of fire? 1,16,100. So under insurance, apply average clause. So what is the value of loss? 1,04,500 into policy amount divided by value of stock on the date of fire proportionately. So 90,009 rupees is the insurance claim. Okay. See, this is revision marathon. Please understand. I can't explain you in detail, but to the extent possible I explained in detail. Okay. You need to practice it again and again to understand this concept. And if you see the study material, these type of questions they have given, but it is very confusing. One problem one way they solved, another problem another way they solved. But in my classroom I make sure that I followed systematically, uniformly, everything is common. And whatever the answer which is given in the suggested answers, that is the base. So based on that I have done, and we got the correct answer, that is 9,009 rupees. So therefore the bottom line is, whenever normal abnormal stock is there, you find out gross profit only for the normal stock. Normal stock GP ratio you find out, and you will apply on the normal sales, so that you will get the gross profit. Any abnormal stock is there, please separate it. Please separate it. And the important thing is, when you are finding the value of stock on the date of fire, you should take both normal as well as abnormal. So therefore if you wrongly value this abnormal stock, if you not interpreted it properly, obviously your answer will go wrong. So again and again you check this question. This is the important question. More chances that it may come exams in exams. So therefore in loss of stock policy, sir, either they will ask you plain question like 2 questions I solved like that, or sometimes they will give you like this, normal abnormal stock. When normal abnormal given, what to do I told you. Okay. So this is loss of stock policy. Okay, sir, let us cover calculation of insurance claim under loss of profit policy. What is this loss of profit policy is all about? Sir, whenever fire accident occurs, there are 2 types of losses. One is direct loss of stock or other assets. Second one is consequential loss because of the business disruption. See, for example, fire happened on 1/4/2024. Now when fire happens in the organization, your stock may get destroyed. For that there is a loss of stock policy. Suppose your assets may got destroyed. Suppose you have 5 planted machineries. Out of the 5 planted machineries, suppose 3 planted machineries got destroyed. Of course you have insurance policies covering risk of assets, and accordingly we will calculate the insurance claim. Now because of the fire, apart from the direct losses, there will be consequential loss. That means because of the fire, your business got disturbed for some period of time. That means it will take some period of time to get back into the normal working condition, right? That period is called period of disruption or period of dislocation. Suppose fire happened on 1/4/2024, sir. Up to 30th September 2024, your business got disturbed. That means 6 months period of time, right? Now tell me what happens within this disturbance period, disruption period. First consequence you can observe is, you are going to achieve less than the normal profit. Suppose last year in this 6 months how much profit you earned, but this year how much profit you earned, it will be obviously less. Why? Because your business got impacted after the disaster. Suppose we have 5 planted machineries. Out of 5 planted machineries, 3 planted machineries got destroyed. That means only 2 planted machineries are in the working condition. That means your production will be less, your sales will be less, your profit will be less. So you need to understand, sir, it is because of the disaster, not only there is a direct loss of asset, but there is a consequential loss. The first consequential loss is what? Profit lost. Our profit will be reduced. Sir, is there any insurance policy insurance company will give or offer which covers this loss? Yes, that policy is called loss of profit policy. So loss of profit policy is a consequential policy. That means once a disaster happens, the coverage of this policy will start. Now once the disaster happens, after the disaster, because of the disaster, what will be the impact on your profits? Obviously your profits will come down, right? Now if I have a loss of profit policy, I can claim that amount from the insurance company. Now not only that, very interesting thing is, suppose in these 6 months, the period of disturbance after the fire, obviously your profit will be less. You lost some of your net profit, so loss of net profit. Second thing is fixed expenses called standing charges. Sir, irrespective of your business condition, position, you have to pay, incur fixed expenses, rent, interest, salaries of the employees, you have to pay now. Can you say my business disturbed for 6 months, so I don't pay interest for the 6 months, I don't pay salaries, I don't pay rent? No, not possible. Some of the fixed expenses you have to incur irrespective of your business condition. Sir, is there any insurance policy? Because already I'm in difficult period. Now in this period also I need to incur fixed expenses. Is there any insurance policy which will recover my fixed expenses back? Yes, loss of profit policy. So loss of profit policy not only covers your loss of net profit during the period of disturbance, but also fixed expenses if you cover it under the loss of profit policy. Whatever the fixed assets you have, in these fixed expenses, whichever the fixed expenses you covered, insured under the loss of profit policy, that will also be recovered from the insurance company. Now not only that, very interesting point is, sir, because of the dislocation or disruption of the fire, sometimes you need to incur some additional or increased cost of working. Best example I will tell you. Suppose this is your factory, sir. In this factory fire happened. Now I can't do production here, right? So we shifted to another factory. Temporarily we have taken this factory for rent. So rental expenses you are going to pay for the temporary factory you have taken is what, sir? Increased cost of working, additional cost of working. Sir, is there any insurance policy which will give my additional working cost I incurred? Yes, loss of profit policy. So they may ask in examination, sir. Generally you need to understand, first thing is, loss of profit policy covers what? Loss of profit policy covers three things. Important. Loss of net profit, standing charges, increased cost of working. All these three things are covered under loss of profit policy. Once disaster happens and your business got disturbed, right? Because of that, in that period, how much profit you lost, normally how much you achieve, but because of the impact of the disaster, how much actually earned, that means how much profit reduced. That is the first thing covered under this loss of profit policy. Second, standing charges, that means fixed expenses, what you are going to cover or what you are going to incur irrespective of your business condition, you can covered under the loss of profit policy. And any increased cost of working because of the disaster, sometimes we may incur some extra expenses to get the company into the working condition, business into the working condition. Any increased cost of working, that can also be covered under loss of profit policy. So this is a beautiful policy offered by insurance companies which is covering all these three aspects. Okay. So if any business organization has taken this policy, loss of profit policy, now they are going to get from the insurance company, or they are going to insured for all these three things. Now we need to understand how the insurance claim will be calculated, amount of insurance claim will be calculated under loss of profit policy. Okay, sir, there is a step-by-step procedure, established practice according to the insurance company. Now that steps we need to understand. We don't have the right to change those steps. So there is an established procedure framework, just we need to learn, or you need to mug up these steps and you need to apply in the questions. Okay, more than a logic, sometimes you need to remember the steps, sir. More than a logic, sometimes you need to remember the steps. Sir, why this? Of course, they have given a framework. When they're drafting this framework, maybe it is very logical for them. For us, it is very difficult to understand sometimes why they have put like this. They can put like this. But my suggestion to the students is, don't bother about what they have put. Just simply remember all the steps and apply it, because this is one area where you will not lose marks. Suppose if at all there is a question from loss of profit policy, just you apply these steps. In these steps, apply the figures, you will get full marks, and you are not required to apply anything logically. Just mug up the steps, apply the things, then work will be done, marks will be come in the examination. Okay, now let us see all these steps, sir. Actually there are I think 7 steps I have given, sir, for calculation of insurance claims in this case. Yeah, 7 steps are there. Now first I would like to tell you one important thing before start discussing these steps. See, suppose you have taken an insurance policy, sir, loss of profit policy. See, fire happened 1/4/2024, sir. Your business got impacted 30th September 2024. That means the period of disturbance is how many? How many months? 6 months. And you have taken insurance policy, loss of profit policy. This policy is also taken for, suppose 5 months only you have taken policy. After disaster, your business got impacted up to disturbed for 6 months, but you have taken insurance only for 5 months, the loss of profit policy. So then insurance company will cover the claim only for this how many months? Only 5 months, whichever is less, the period of disturbance or the policy period, whichever is less. That period is called claim period. Claim period means, sir, for which period I can claim the amount in case of loss of profit policy. How much period your business got disturbed because of the fire, and what is the policy period, whichever is lower, right? The period for which the policy covers is also called as indemnity period. Okay, so therefore the period of disturbance, the policy period, whichever is lower, we need to take. For example, the period of disturbance is 6 months, policy is also taken for 6 months, therefore claim period is also for 6 months. Okay, claim period is also for 6 months. Now see the steps, sir. What are the steps in calculation of insurance claim under loss of profit policy? First step number 1, determination of GP ratio, sir. Gross profit ratio you determine. Generally, how to determine GP ratio? Gross profit divided by sales into 100. But here there is a different way. Net profit you take. See, this GP ratio we are determining for the previous year, not in the year of fire. Previous year you take the net profit plus insured standing charges. Insured, that means out of these fixed expenses, standing charges, insured, whatever the fixed expenses which you have insured under loss of profit policy, you add. Net profit plus insured standing charges divided by turnover of the last year into 100. That means sales of the previous year. You will get GP ratio. Second step, calculation of short sales. Calculation of short sales. Sir, you know, loss of profit policy covers 3 things I told, na sir? Loss of net profit, standing charges, insured cost of working. Now first our focus is on the loss of net profit. How much profit you lost because of the disaster. Now for that, to determine, first we need to know what will be your short sales. Short sales means how much is the actual sales happened in the period of disruption, and if there is no accident last year same period, how much turnover is. Compare, so you will know how much sales have been reduced. That is called short sales. For example, how to calculate it? Take standard turnover. Take what? Standard turnover. Sir, what is standard turnover? Standard turnover means turnover of the previous year corresponding to the claim period. For example, in the current year fire happens. After the fire, 1/4/2024 to 30th September 2024, your business got disturbed. and policy is also covered for 6 months. Now this period, so this is the period of disruption, right? Now this period, this same period in the last year, 1/4/2023 to 30th September 2023, what will be the sales? What will be the sales? That is called standard turnover. So standard turnover means turnover of the previous year corresponding to the indemnity period, corresponding to the claim period. So the period in the current year for which you are claiming the insurance, the period of disturbance or the policy period, whichever is lower, that period in the last year, what will be the sales? That is called standard turnover. For example, in the current year, indemnity period is 1/4/2024 to 30th September 2024, 6 months. Now this 6 months, what will be the last year turnover? Take standard turnover. Now for that, adjust trend. Sir, what is trend? See, sales will have a trend, either increasing trend, decreasing trend. So if there is an increasing trend, add, because this is last year turnover, right? So add. If there is a decreasing trend, less. For example, our standard turnover is 10 lakhs. Last year in the 6 months, our turnover is 10 lakhs. And suppose there is an increasing trend, add. So you will get adjusted standard turnover. From that adjusted standard turnover, less actual turnover during the period of disruption. Actually, what is your turnover deducted? Then you will get the short sales. So therefore, you need to understand, sir. Suppose if there is no disaster, ideally what should be the turnover? 10 lakhs. Same period in the last year, 10 lakhs we earned, and we have a increasing trend of 1 lakh, 10%. So therefore our sales should be 11 lakhs in this period, 11 lakhs. But how much we earned? 5 lakhs. Why? Less, because of disaster. Therefore how much is the short sales? 6 lakhs. This is short sales. Now once you determine the short sales, apply gross profit on the short sales, then you will get the gross profit on short sales. How much profit you lost because of the disaster. First, to find out how much sales reduced, on that you apply GP ratio. Then you will get gross profit on short sales. This GP ratio already determined in step number 1. Okay. Then, so loss of net profit is done. Next, calculation of claim for additional working expenses. Sir, I told you one of the element in covered in loss of profit policy is additional cost of working, right? How to find out these additional working expenses? See, they said list of the following you need to take. First, what is the actual additional working expenses you have incurred? Actually, how much you incurred because of the disaster in the period of disruption? What is the actual additional working expenses you incurred? Take it. Second, additional sales into GP rate. Additional sales into GP rate. See, what is additional sales here means, because of this additional working expenses, how much turnover you have achieved. Suppose for example, I told you, we shifted from this factory to another factory temporarily because of the fire. This factory to another factory we shifted. Suppose we shifted to another factory and we started doing production. Because of that only, at least some turnover is achieved, so therefore some sales is achieved. That is called additional sales. Additional sales means because of the additional working expenses, how much turnover you have achieved into GP rate to apply. And third one is actual additional working expenses into net profit plus insured standing charges divided by net profit plus all standing charges. Proportionately you take. So actual additional working expenses, additional sales into GP rate, second one. Third, actual additional working expenses into net profit plus insured standing charges divided by net profit plus all standing charges. All standing charges means all fixed expenses like insured, uninsured, both you will add. So they have given proportionately you need to take. So whichever is least we need to consider. Whichever is least is need to consider. That is covered under loss of profit policy. Next is step number 5. Calculation of gross profit on adjusted annual turnover. You calculate gross profit on adjusted annual turnover. Sir, what is this adjusted annual turnover? First, annual turnover you take. What is annual turnover? Annual turnover means turnover immediately preceding 12 months from the date of fire. See, suppose fire happened on 1/4/2024. See this, fire happened on, suppose for example, fire happened on January 1st 2025. Okay. Now immediately preceding 12 months, that means January 1st October 2024. If fire happened on 1st October 2025, immediately preceding 12 months, what will be the turnover? that is called annual turnover. So here in loss of profit policy, standard turnover, annual turnover. Standard turnover means turnover of the previous year corresponding to the period of disturbance or claim period, nothing but the period in the current year for which we are making the claim. In that period, what is the sales in the last year? That is called standard turnover. What is annual turnover? The date of fire. Fire happened preceding 12 months. Preceding 12 months, what will be the turnover? That is called annual turnover. So take annual turnover first, adjust the trend. If there is an increasing trend, add. If there is a decreasing trend, less. Then you will get adjusted annual turnover. On that you apply GP rate. Then you will get gross profit on adjusted annual turnover. Step number 5. Sir, why you are determining this gross profit and adjusted annual turnover? Because I need to calculate insurance claims at the end. For that I need to determine whether the insurance is under insurance or over insurance. For that purpose I need to determine this gross profit on adjusted annual turnover. Okay. So how to determine GP on adjusted annual turnover? Come from the last. First annual turnover, then trend adjust, then it will become adjusted annual turnover. On that you apply GP rate, then you will get gross profit on adjusted annual turnover. Step number 6, finally calculate gross claim. How much is the gross claim? Simple. Step number 3, already we calculated what is the gross profit on short sales, how much profit we have lost, take it. Step number 3. Step number 4, claim for additional cost of working or increased cost of working. We in step number 4, what is the additional cost we have incurred because of the disaster? Whichever is least, this one you take. Step number 3 plus 4. And what happens is savings in insured standing charges. Suppose you have insured some fixed expenses, but out of those fixed expenses, some of the fixed expenses you have not incurred, you saved. Now to the extent of the savings in insured standing charges, you are not going to get the amount, so deduct it. So therefore you will get gross claim. Gross claim. Now finally, once you get the gross claim, you need to determine the net claim. Net claim. Now importance. Like in case of loss of stock policy, even in loss of profit policy also, we need to determine whether the insurance is over insurance, full insurance or under insurance. Now in case of loss of stock policy, what we have done, we have compared policy amount with the value of stock on the date of fire. But in case of loss of profit policy, what we need to do is we need to compare two things. What are the two things? We need to compare policy amount with the gross profit on adjusted annual turnover, which we calculated in step number 5. Step number 5, we determined gross profit on adjusted annual turnover now. So we will compare with this. Suppose if the policy amount is equal to or more than this gross profit on adjusted annual turnover, then it is a full insurance or over insurance. Then entire gross claim will be the net claim you are going to get. Suppose for example, if the policy amount is less than the gross profit on adjusted annual turnover, then it is under insurance. Under insurance. If it is an under insurance, we need to apply what? Average clause. That means here the claim is gross claim into policy amount divided by gross profit on adjusted annual turnover. That means insured amount divided by insurable amount. Because according to insurance company, sir, gross profit on adjusted annual turnover is the ideal insurance amount, policy amount, but you have taken some other amount, so therefore they will give you proportionately. So you need to understand, you need to calculate. Once gross claim is determined, you need to calculate net claim. Net claim over or full insurance or under insurance. In order to determine it, compare policy amount with gross profit on adjusted annual turnover. Suppose if your policy amount is equal to or greater than gross profit on adjusted annual turnover, then your net claim is equal to gross claim. That means entire amount you will get. No need to apply average clause because you have taken full insurance. Now suppose if the policy amount is less than the gross profit on adjusted annual turnover, that means it is case of under insurance and they will apply average clause. That means in that case, what is your net claim? Gross claim as per step number 6 into policy amount divided by gross profit on adjusted annual turnover. That means what is the insured amount you have taken, but what should be the insurable amount in proportion to that. For example, gross profit on adjusted annual turnover 20 lakhs, but insurance amount is policy amount is 15 lakhs. So 50 divided by 20 into, suppose gross claim is 10 lakhs. So proportionate to this we will give the amounts. Very important. Okay, that's it, sir. So this is the way to calculate loss of insurance claims under loss of profit policy. Once again, so remember these steps, guys. Loss of profit policy, whenever a question given now, first you need to check how much period we disturbed. You see, period of disturbance. Policy is covered for how much period? Whichever is lower, that is a claim period. First you determine that. Second thing, steps. First to determine GP ratio. How to determine GP ratio? Net profit plus insured standing charges divided by last year turnover. This GP ratio is relating to last year. But sometimes if they give any changes relating to this, subject to current year, take it, adjust it. So adjust this according to the current year requirements. Okay, so determine the GP ratio is over. Second thing, find out short sales. How to find out short sales? Very simple. In the year for which period you are making the claim, the same period in the last year, what will be my turnover? For that you adjust the trend, then you will get the adjusted adjusted standard turnover. From that reduce actual turnover, you will get the short sales, how much you have underachieved the sales. Okay, now calculate step number 3, calculation of GP on short sales. Short sales into GP rate, you will get gross profit on short sales. Next 4, calculation of claim for additional working expenses. Actual additional working expenses incurred because of the disaster, additional sales because of this additional working expenses into GP rate, and then additional working expenses into proportionately net profit plus insured standing charges divided by net profit plus all standing charges. Okay, and step number 5, very important, gross profit and adjusted annual turnover. First take the annual turnover. What is the annual turnover? Annual turnover is the preceding 12 months, immediately preceding 12 months turnover from the date of fire. Adjust trend, you will get adjusted annual turnover. Apply GP rate, then you will get gross profit and adjusted annual turnover. Now calculate gross claim. How to calculate gross claim? Gross profit on short sales plus claim for additional working expenses. Step 3 plus 4 minus any savings in insured standing charges. Then last step, net claim. To calculate net claim, you need to determine whether the insurance is full over insurance or under insurance. For that, 2 things you need to compare: policy amount with gross profit and adjusted annual turnover. If the policy amount is equal to or greater than gross profit and adjusted annual turnover, then your net claim is equal to gross claim. Suppose if the policy amount is less than the gross profit and adjusted annual turnover, then apply average clause. So therefore net claim is equal to gross claim into policy amount divided by gross profit on adjusted annual turnover. See, this is the format, sir. Now I will solve one question relating to it. Study material question, illustration number 9. If you solve this one question, it is sufficient, sir, because this question will give you complete clarity. Okay, see this question. So see this question, illustration number 9. Yeah, from the following details, calculate consequential loss claim. Consequential loss claim means loss of profit policy, sir. Date of fire September 1st. Indemnity period 6 months. What is indemnity period? The period for which the policy covered. The period for which the loss is covered is called indemnity period. Kind of a policy period, 6 months. Period of disruption September 1st to February 1st. That means fire happened on September 1st, sir. September, October, November, December, January. So September 1st, October 1st, November 1st, December 1st, January 1st, February 1st. So therefore 5 months is what? Period of disturbance. Policy is taken for 6 months. So therefore claim period is how much? Claim period is 6 months or 5 months, whichever is lower. Because you disturbed only for 5 months, policy is taken for 6 months. So therefore 5 months insurance will be given. Within this 5 months, loss of profit policy, insured standing charges, additional working cost, all these things will be covered. Okay. Sum insured 1,08,900, that means policy amount. Sales 6 lakhs for the preceding financial year ending 31st March. That means last year turnover 6 lakhs. Net profit for the preceding financial year 36 plus insured standing charges 72. So you can find out GP ratio. Net profit 36 plus insured standing charges divided by turnover. And rate of gross profit 18%. They given actually. Turnover during disruption period, that means actual turnover during the period of disruption 67,500. Uninsured standing charges 6,000. Annual turnover for 12 months immediately preceding the date of fire given. Standard turnover, that is for corresponding months in the year preceding to the date of fire, standard turnover also given. Increase in the cost of working capital 12,000 with savings of insured standing charges 4,500 during the disruption period. Reduced turnover avoided through increase in working capital 30,000. That means during the period of dislocation, because of the additional working expenses, how much is the turnover we have saved from reduction? 30. That means these are the additional sales generated because of the additional working cost, additional cost of working. Next, a special clause stipulated increase in rate of GP by 2%. Okay. Increase in turnover 10%. That means trend is 10%. Okay. Now let us solve this question, sir. Okay. So first step number 1 is what, sir? GP ratio. GP ratio already given 18%, and special clause stipulated that it should increase by 2%. So therefore GP ratio, adjusted GP ratio is 18 plus 2, 20% we need to take. See this first GP ratio of the previous year 18, increase 2%, so adjusted GP ratio 20% we need to consider. First step is done. Step number 2, I told you we need to calculate what? Short sales. How to calculate short sales? Simple. Sir, because of the, the period of disturbance is what, sir? See this, September 1st to February 1st, these 5 months, right? Same 5 months last year turnover is called standard turnover. Given, see this, standard turnover, that is corresponding months in the year preceding the date of fire. Last year, same period, the period of disturbance, what will be the turnover? 2,25,000. Take it, 2,25,000. And I told you we need to adjust the trend. So trend 10%. So add 10%. So you got adjusted standard turnover 2,47,500. From that you reduce the actual turnover during the period of disturbance. What is the actual turnover during the period of disturbance? See this. Annual turnover during period of disruption. See this, 67,500. Reduce it. Then you will get what? 1,80,000. This is called short sales. 1,80,000. Next, calculate gross profit on short sales. So short sales into GP rate. So it will be 36,000 gross profit on short sales. Next, claim for additional working expenses. I told you what is the first actual additional working expenses we incurred. See this, increase in cost of working capital 12,000. Take it. Second, I told you additional turnover, additional sales into GP rate. Sir, you need to understand, sir, clearly reduced turnover avoided through increase in working capital is 30,000. That means because of the additional working expenses, 30,000 turnover generated. So 30,000 into GP rate. What is the GP rate here? 20%. So 6,000. Then additional working expenses into proportionately net profit plus ensued standing charges divided by net profit plus all standing charges. See, additional working expenses 12,000. Net profit they have given 36,000. See this, net profit 36,000. Ensued standing charges 72,000 divided by net profit plus all standing charges means insured plus uninsured 72 plus uninsured 6,000. See this. So proportionately if you take 11,368 came. So least of the above means 6,000. This is the admissible claim. So in respect of additional cost of working, least we need to take. So least is out of these three, 6,000. Now calculate gross profit on adjusted annual turnover. How to calculate? First you need to take the annual turnover, preceding 12 months turnover. They have given annual turnover given 6,06,000. 6,60,000. This is 6,60,000, sir. So take 6,60,000 turnover. Okay. Adjust trend 10%. You will get adjusted annual turnover. And you apply GP rate, you will get gross profit on adjusted annual turnover. And I told you this is used to calculate whether the insurance is full insurance or under insurance. Now gross claim you determine. How to determine gross claim, sir? How much is the gross profit on short sales? 36,000 plus what is the claim for additional working expenses? 6,000. So add both of them. You will get 36,000 plus 6,000 minus what will be the savings in insured standing charges. So insured standing charges saved, given savings in insured standing charges 4,500. See this. So gross claim is 37,500. Now you need to calculate net claim. To calculate net claim, we need to compare two things. One is policy amount with gross profit on adjusted annual turnover. In this question, if you see what is the policy amount they have taken, sir? The policy amount is 1,08,900. See this, 1,08,900. What is the gross profit on adjusted annual turnover? 1,45,200. See this. Compare these two. Now the policy amount is less than the GP on adjusted annual turnover. So ideally insurance company is expecting you to take this as a policy amount, but you have taken this. Therefore there is a under insurance. When there is an under insurance, they will apply average clause. So what is the way to calculate? First to take gross claim 37,500 into what is the policy amount? 1,08,900 divided by gross profit on adjusted annual turnover 1,45,200. So therefore 28,125 is the net claim. So what you have done here? Nothing, just remember the steps, apply the data in the steps, you will get the answer. Okay, so that's it, sir. This is loss of profit policy. Like this, there are, I think, 2 questions are there. Please solve them, including one examination question. You please practice them. Once you solve this question, I think those questions easily you can solve. Okay, that's it, sir. Okay, let's start accounting standard 19, sir. Leases. So basically, what is this standard is all about? See, AS 19 will provide you the accounting treatment for leases. Whenever any asset is taken on lease basis, what is the accounting we need to do in the books of lessor as well as lessee? The person who is the owner of the asset is called lessor, who gives his asset on lease basis. The person who takes the asset on lease is called lessee. So in the books of lessor, in the books of lessee, how we are going to do the accounting treatment for leases? That is what this standard will address. And also what kind of disclosures the lessor and lessee need to make in the financial statements. That is also provided by this standard. So this standard will basically provide the accounting for leases in the books of lessor and lessee, and disclosures to be made relating to leases in the financial statements. See how you are going to learn AS 19, sir. Simple. AS 19, first we understood the object, right? Then scope we need to see. And the most important part in AS 19 is what? Definitions. The technical terms are very, very important. Without understanding these technical terms, it is not possible to understand AS 19. So AS 19 depends upon those technical terms. Okay, those definitions are very, very important. And then types of leases, and then finally accounting for leases in the books of lessee, in the books of lessor. Actually, AS 19 divided the leases into 2 categories: finance lease, operating lease. So finance lease, lessee books, lessor books. Operating lease, lessee books, lessor books. What is the accounting treatment? That is provided by accounting standard 19. And the last concept of AS 19 is sale and leaseback transactions. Sale and leaseback transaction. So from that concept also they are testing sale and leaseback transactions. So this is the things we are going to discuss in accounting standard 19, sir. Okay, first start with the what is lease. First of all, can you tell me, see what is lease, sir? Basically, see, lease is basically an agreement between 2 parties. It is an agreement between 2 parties. Who are the 2 parties? Lessor, lessee. Lessor is the owner of the property who gives asset on lease basis. Lessee is the person who is taking the asset on lease basis. So lease is basically an agreement between 2 parties where one party gives the right to use the asset to other party. I am giving you the right to use the asset to you for a period of time, for an agreed period of time. Suppose I will give this building to you to use it for 5 years, and in return you are going to pay me some consideration. So basically in lease, what are the important things? Agreement, 2 parties, lessor, lessee, for an agreed period of time. That means there is a lease term, and then consideration. These are called lease rentals. Okay, now see why? Because suppose, for example, there is a company, they want plant and machinery. Suppose the cost of plant and machinery is 1000 crores. Tell me, purchasing by spending 1000 crores, blocking this much amount on a capital asset may be not possible for all the companies. That's why this lease concept came into the picture. Taking asset on rental basis came into the picture, because I can't spend this much amount, I can't block the funds this much for a single asset. It will affect my organization working capital. I can't arrange this much funds for purchase of large, capital intensive assets. That's why the lease concept or rental concept came into picture. Okay, now if you look at AS 19, sir, this AS 19 scope, sir, whether AS 19 is applicable for all types of leases? No, there are 3 exceptions. One is natural resources. Any lease given for exploration or use of natural resources like oil, gas, timber, metals, other minerals, those kinds of leases are not covered under AS 19. Second, licensing agreement. Any licensing agreement for intellectual property rights, IPRs. Intellectual property right means motion picture movies, motion picture films like cinemas. I given my licensing agreement of movies to you. So any videos, video recordings, plays, manuscripts, patents, copyrights. We can say intangible assets. These are all intangible assets. If I give my right of intangible assets to you to use, those kind of licensing agreements are not covered under accounting standard 19. And the last one, land. Okay, if I give my land on lease basis, AS 19 will not cover it. Agreement specifically for using land. So land lease agreements are not covered. So there are three lease types of leases AS 19 will not cover. What are those? First one, natural resources. Second one, intellectual property rights like patents, copyrights, trademarks, manuscripts. What is manuscript? Manuscript means originally written books, written or typed document that forms the original content of a book or a scripts, academic papers, screenplays, originally written. Suppose there is an author, he has originally written the book, that is called manuscript. So if he has given his publishing right of that book to any other, so any other publishing company or any other person, that will not be covered under accounting standard 19. So those kind of licensing agreements are not covered under accounting standard 19. Okay, next. Sir, in AS 19, the most important thing is definitions, sir. The most important things are definitions. So listen to these definitions very, very carefully. Now, see, as per AS 19, as I already told you, this standard has classified the leases into two categories. One is finance lease, another one is operating lease. So accordingly, they have provided the accounting treatment. For finance lease, what is the accounting treatment? In the books of lessee, lesser. For operating lease, what is the accounting treatment? For lessee, lesser. What is finance lease? Finance lease, I will transfer risks and rewards of the property also. In the finance lease, the substance is that I am not just giving the asset to you on lease basis. I am transferring risks and rewards also. That means finance lease is not just a lease agreement. It is not like a mere rental arrangement. No, I am giving you the risks and rewards. So since I am giving risks and rewards to you, as per AS1, there is a concept called substance over form. We need to see the financial reality. So therefore, whenever lessor gives any asset on lease basis, and if that lease is finance lease, sir, lessor point of view it is a sale. Lessee point of view it is a purchase. So finance lease is kind of what I am selling the asset to you on finance basis. Generally, what is operating lease? Operating lease is just a rental arrangement between the parties. For example, this building I have given rent to you. Risks and rewards are there with me only. So depending upon the substance of the lease agreement, you need to classify whether the lease is a finance lease or operating lease. Finance lease, risks and rewards will also be transferred. So therefore, in case of finance lease, as a lessor, whenever I have entered an agreement, if that lease agreement is a finance lease, lessor will treat this as a sale. Lessee will treat it as a purchase. So lessor, what he will do, whenever he has given any asset on finance lease basis, whatever the amount receivable from lessee, he will recognize as a receivable asset. And from his books, the asset will be derecognized. Every year you will pay lease rentals, that lease rentals will be recognized by him as a income, he will recognize. But in operating lease, sir, just it is a rental arrangement between the parties. So I have given an asset to you, you pay me rent. As a lessor, every year I will recognize this as a income. As a lessee, you will recognize as a expense. Okay. So again, we will come back to the accounting treatment, but just I have given a brief idea about types of leases. So AS 19 classifies leases into two: finance, operating. Okay. Now come to the definitions. Important. See this. Seriously, there are 17 definitions are there. But not all definitions important, but some definitions definitely very, very important for accounting point of view. See we'll try to cover. First, non-cancelable lease. This is the definition. Sir, AS 19 is applicable only for non-cancelable leases. It is not applicable for cancelable leases. Suppose if lessee can cancel the lease at any point of time, that is called cancelable lease. For cancelable leases, the standard is not applicable. Only for which leases the standard is applicable? Non-cancelable leases. Non-cancelable leases only the standard is applicable. Sir, what is non-cancelable lease? A lease generally which cannot be cancelled by lessee on his own. But there are few exceptions. 4 exceptions they have given, sir. In these 4 cases, even though the lease is cancelable, still standard consider them as non-cancelable and AS 19 is applicable. First point, AS 19 is applicable only for non-cancelable leases. Non-cancelable lease means lease cannot be cancelled by lessee on his own. But there are 4 exceptions. In these 4 cases, lease can be cancelled, but still we consider it as a non-cancelable lease only and we need to apply AS 19. Sir, what are those cases? Upon the occurrence of some remote contingency. Some remote, rare contingency. Contingency means something which we are not expecting may happen in future. Suppose on happening of some remote contingency, if lease is cancelable, still it is considered as non-cancelable lease only. For example, I have given this building to you on rental basis. Suddenly fire came, entire building was destroyed. Lease is automatically cancelled. You cannot say this lease is basically non-cancelable lease. So it is now cancelled. Therefore, I don't apply AS 19. No. Suppose fire came, asset destroyed, obviously lease will be cancelled. So on happening of some remote contingency, lease can be cancelled. That will be still considered as non-cancelable lease only. Second thing, with the permission of lessor. If lessee can cancel the lease with the permission of lessor, still it is considered as which lease? Non-cancelable lease and AS 19 is applicable. And also if the lessee enters into new lease for the same or an equivalent asset. So for example, you are lessor, I am lessee. We enter into an agreement, lease agreement for one particular asset. Now suppose we both are entered into a new lease for the same asset or equivalent asset. Automatically old lease is what? Cancelable. But still it is considered as non-cancelable lease. AS 19 is applicable. And last one, sir. Upon the payment of additional amount, that at the inception of the lease is reasonably certain. Suppose lessee can cancel the lease by payment of additional amount. In the agreement, both the parties have written that if lessee, you want to cancel the lease, you can cancel, but you pay me this much amount. Suppose one big amount, penalty you need to pay. And we know at the inception of the lease itself that lessee is not going to cancel it. Because who will ready to pay that much big amount? For example, lessor and lessee agreed that if lessee want to cancel the lease at any point of time, he has to pay 20 crore rupees or he has to pay 2 years rent as a penalty. Now will lessee cancel the lease? No, definitely. So that means at the inception of the lease itself, there is a certainty that lessee is not going to cancel it, even though there is an option for cancellation. By paying additional amount, he can cancel, but he will not. So that is a non-cancelable lease. So AS 19 is applicable for which type of leases? Non-cancelable leases. But there are how many exceptions? 4. What are these exceptions? Lease is cancelable upon happening of remote contingency, or lease is cancelable with the permission of lessor. Third, new lease with the same asset, or by payment additional amount. But at the inception of the lease itself, we know that he is not going to pay that additional amount. So these are the 4 cases. Even though there is a chance that lease is cancelable, but still we need to consider it as non-cancelable lease and we need to apply AS 19. AS 19 is applicable only for which leases? Non-cancelable leases. This is the first definition. Second, lease term. Sir, in the definition of the lease, I told you, lease is generally given for agreed period of time. 5 years, 10 years. So the standard says lease term. Lease term means 2 things, 2 components. One is non-cancelable period. Another one is renewal period. For example, you see, there is a lessor X, there is a lessee Y. X has given plant and machinery to Y on lease basis. The lease is for how many years? 5 years. This is called non-cancelable period. This is part of lease term. Plus, in the agreement, lessor has given an option to the lessee to renew this lease after 5 years. After 5 years, if you want, you can continue the lease. And if it is reasonably certain that lessee is going to exercise this continuation option, renewal option, then this renewal period, 3 years is there now, that is also included as a part of lease term. So lease term is 2 things. What are those? Non-cancelable period plus renewal period. When renewal period will be included as a part of lease term? Only if it is reasonably certain at the inception of the lease that lessee is going to exercise the renewal option. In this example, original lease term 5 years. Renewal option 3 years. So 5 plus 3, 8 years will be the lease term. So lease term is what? Non-cancelable period plus renewal period. This is the third definition. Second definition. Next. So we completed non-cancelable lease. We completed lease term. Next, inception of lease. Sir, what is inception of lease? Because just now I used the word inception. At the inception of the lease, it is reasonably certain that lessee will exercise the option. What is inception of lease? The standard says inception of the lease means the date of lease agreement, when the parties enter into lease agreement, or the date on which commitment by the parties to the principal terms of the lease, whichever comes earlier. Date of lease agreement, date on which the parties committed for the principal terms of the lease. For example, date of agreement 1st March. The parties agreed for the principal terms on 15th March. Whichever is earlier means 1st March. So this is considered as inception of lease. Because in AS 19, so many places they use the word inception of the lease. So you should understand what is inception of lease. Inception of lease means date of lease agreement or the date on which parties committed for principal terms, whichever is earlier. So this is inception of lease. And the most important definition in entire leases is MLP. What is that? MLP. Understand what is MLP. MLP means minimum lease payments. Everybody please focus. Because in accounting, MLP plays a crucial role. Sir, what is MLP? There are two parties in lease. Lessor, lessee. Now think from lessor point of view. Lessor is what? Owner. He is going to receive the lease rentals, right? Lessor point of view, what is MLP means? Lease rentals, fixed lease rentals he is going to receive from lessee plus residual value guaranteed by lessee or any person on behalf of lessee or by an independent third party. Plus, if lessor has given a renewal option to the lessee, if lessor has given a purchase option to the lessee and lessee is going to exercise that purchase option, it is reasonably certain at the inception of the lease itself that lessee is going to exercise that purchase option. Once the lease is completed, you can purchase the leased asset. If that kind of option is given by lessor to the lessee, that excise price, these three things will be added. Then you will get MLP from lessor point of view. So lessor point of view, MLP, three things. One is fixed lease rentals. Second, residual value guaranteed by lessee or any person on behalf of lessee or by exercise price or by independent third party also. Residual value guaranteed by lessee, any person on behalf of lessee or by independent third party, plus excise price. What is that excise price? Lessor has given an option to the lessee to purchase the leased asset once the lease agreement is completed. You add these three, you will get what? MLP from whose point of view? Lessor point of view. Now come to lessee point of view. Lessee point of view, what is MLP? Lease rentals he is going to pay plus residual value guaranteed by lessee or any person on behalf of lessee. That's it. Plus this excise price. Whatever the price, if there is a purchase option given by lessor to the lessee, once the lease agreement is over, he can purchase the leased asset, then that excise price will also be included. So what is the difference between lessor and lessee MLP? Only one thing, that is, in case of lessor, we will consider the residual value guaranteed by independent third party. But in case of lessee, that will not be considered. Remaining everything is same only. For example, look at this example. Suppose Mr. X, Mr. Y, two parties are there. Mr. X is lessor, Mr. Y is lessee. They entered into a lease agreement for plant and machinery. Lease term is how many years? 5 years. Now look at the terms. Fixed lease rent 1 lakh per annum. That means lessee has to pay every year 1 lakh. There is a contingent lease rent also. Sir, there are two types of lease. Fixed, contingent. Contingent lease rent you should not consider. MLP calculation. Only fixed lease rent you need to consider. Fixed lease rent means what? The rent which is decided based on time. Contingent rent means what? Other than time. For example, I am giving machinery, plant and machinery on lease basis. By using this plant and machinery, how many units you are producing? On each unit produced, you give me some amount. That is called contingent rent. So contingent rents we will not consider as a part of MLP. Only fixed lease rents we need to consider as a part of MLP. And in this lease agreement, sir, lessor has given a purchase option to lessee. How much is the purchase price? 1 lakh. That means once the lease is completed, lessee can purchase the leased asset for 1 lakh. And so in this case, can you tell? And residual value is also there. What is the residual value? 1.5 lakhs. I am going to discuss what is this residual value. Wait. So residual value 1.5 lakhs. Now in this case, how to calculate MLP? First, lessor point of view, see, take lease rentals. Fixed lease rental 1 lakh into 5 years, 5 lakhs plus purchase price, excise price 1 lakh plus guaranteed residual value. Suppose for example 1.5 lakhs is the residual value. In that 50,000 is guaranteed by lessee or any person on behalf of lessee or by independent third party. Lessor point of view कुछ फर्क नहीं पड़ता, whether it is guaranteed by lessee or any person on behalf of lessee or by independent third party. Add. So 6.5 lakhs is what? MLP. From whose point of view? Lessor point of view. Now come to lessee point of view. Lessee point of view also same. 5 lakhs, 1 lakh, GRV guaranteed by him. Both the three things will be added. So therefore, but you need to remember guys, this purchase price will be included in MLP only if the lease agreement provides an option to purchase the leased asset to the lessee after the lease term, include as a part of MLP if it is reasonably certain that lessee is going to exercise the option at the inception of the lease. Only if it is reasonably certain at the inception of the lease that lessee is going to exercise this purchase option, then this purchase price will be included. Correct? Now, so finally conclusion is what? MLP. Lessor point of view, lease rentals, excise price and residual value guaranteed by lessee or any person on behalf of lessee or by independent third party. Lessee point of view, lease rentals he pay, excise price, purchase price, residual value guaranteed by lessee or any person on behalf of lessee. So what is the extra point here coming? Independent third party. That's the only difference. Sir, what is this residual value? What is this guaranteed? I will tell you. Listen. First of all, what is residual value is, this is the estimated fair value of the leased asset after the lease term. Estimated fair value of the leased asset after the lease term. For example, sir, A Limited lessor has given plant and machinery lease to B Limited lessee. For how many years? 5 years. Now, once 5 years is over, this plant and machinery, if I sell, how much I am going to get? That is called residual value. That is called residual value. For example, lessor is expecting that once 5 years lease is over, if I sell this plant and machinery, I am going to get 1 lakh. This is called residual value. But the problem is, whether actually I will get 1 lakh or not depends on what? How this asset is going to be utilized by lessee. For example, I have given an asset to you, plant and machinery. Suppose if you are not utilized properly, if you are not maintained properly, what happens? I am generally expecting, if you use this asset properly, proper service done, everything done, after 5 years, if I sell this asset, I am going to get 1 lakh rupee. But suppose if you don't utilize this asset properly, no proper maintenance, maybe I will get less than 1 lakh. Maybe I will get less than 1 lakh. So to ensure proper utilization of my asset, I will tell to the lessee that, see lessee, I am giving asset to you on lease basis for 5 years. Once 5 years over, I am going to get 1 lakh rupee. So, will you give guarantee that this 1 lakh will be recovered? He said, lessee said, sir, I am giving guarantee up to 50,000. That means, after 5 years, if the residual value is below 50,000, the gap will be given by lessee. For example, after 5 years, the residual value is 40,000 only. But lessee given guarantee up to 50,000. So, 10,000 will be given by lessee to the lessor. Hello. So, therefore, residual value guaranteed by lessee means what? He has given a guarantee up to that amount. Suppose if the residual value is below that, he will give the balance to the lessor. Because I am the owner, sir, I am lessor. I don't want to take any loss. If you don't utilize the asset properly, what happens? My residual value will decrease. That's why I am taking guarantee from you. For example, in this case, the expected residual value is 1 lakh. Lessee has given a guarantee up to 50. Remaining is what? Unguaranteed residual value. Remaining is unguaranteed residual value. Now think from lessee point of view, how much he has given a guarantee? 50. Lessor point of view, 50. Sometimes what happens now, on behalf of lessor, see for example, lessor is A Limited now, he is selling the cars or he is selling buses of a Tata Motors for example. Now the company itself has given a guarantee to lessor. Lessor, you don't worry. If lessee has not given a guarantee now, we are going to give a guarantee to you. In order to encourage your business, because you are selling our assets, right? You are selling our assets on lease basis. So if lessee has not given a guarantee for residual value, we will give. That's how guaranteed residual value by independent third party came. Independent third party means not lessee or not any person on behalf of lessee. Some other third party may also give guarantee to the lessor. That means what? For example, if lessee has not utilized the asset properly, if you are going to get less than residual value, expected residual value, since we have given a guarantee to you, we will fill that gap. Of course, we will give the amount only to the extent guarantee we have given. If the actual residual value is more than the guaranteed amount, we don't give any amount. Hello, that's it, sir. This is the concept of residual value. So tell me, what is MLP? Come on, final conclusion. What is MLP? Lessor point of view, lease rentals, excise price, residual value guaranteed by lessee or any person on behalf of lessee or by independent third party. I explained independent third party also. Why independent third party came into picture? Because lessee sometimes will not give guarantee. Therefore, maybe lessor in a loss position. If you don't see, I am selling assets of a manufacturer on lease basis. I am asking guarantee of the lessee. Lessee, please utilize this asset properly. If you don't utilize now, my realizable value will be less. My residual value will be less. But lessee says nothing doing. I don't give guarantee. Then third party come into the picture and will encourage the lessor. Don't worry, lessor. Since you are selling our products, you are giving our assets only on lease basis, finance basis, we will give guarantee. That if lessee has not given a guarantee, we will give a guarantee. If the expected residual value is less, we will compensate you to the extent of the guarantee we have given. Okay, so lessee point of view, lessor point of view. Lessor point of view, lease rentals, excise price, residual value guaranteed by lessee, any person on behalf of lessee, third party. But lessee point of view, lease rentals, excise price, residual value guaranteed by lessee, any person on behalf of lessee. Independent third party, lessee is not connected. Lessee is nowhere bothered. Lessee point of view, either he has to give or any person on his behalf. On his behalf, maybe a bank, maybe a financial institution, or maybe any other institution may give. Sometimes lessee on behalf of lessee, guarantee is given by any other person. That is only he will consider. If independent third party given a guarantee, that will not be included in lessee's MLP. Okay, so most important definition we have completed, sir, because I am going to use it in so many places, sir. This MLP you have to see. Okay, now next, so in the definition, sir, we have completed non-cancelable lease term, MLP, inception of lease, residual value, guaranteed residual value, unguaranteed residual value. So residual value to the extent given by guarantee, guaranteed, remaining balance unguaranteed. Next, gross investment. Here also important definitions are coming, sir. Gross investment, everybody please see. You need to remember three formulas here. Three formulas. Please remember these three formulas. First formula you need to remember is gross investment. What is the formula? Gross investment in the lease. Sir, gross investment in lease is equal to MLP plus UGRV. MLP plus UGRV. And these are all calculated from lessor point of view. These are all calculated from whose point of view? Lessor. He is the owner, right? So gross investment in lease means MLP plus UGRV. What is MLP? From lessor point of view, lease rents plus excise price plus residual value guaranteed by lessee or any person on behalf of lessee or by independent third party. Simply speaking, GRV. So lease rent plus GRV is equal to MLP. Excise price, purchase price, if it is given, that will also be added. Generally it won't given. So only two things, lease rent plus GRV. Then you will get MLP. To this, if you add UGRV, you will get gross investment in lease. So gross investment in lease means, what is the formula? MLP plus UGRV. What is MLP? Lease rents plus GRV. Lease rents plus GRV. And so gross investment in lease means, what is my lease rentals I am getting? What is my gross investment? Guaranteed residual value. What is my unguaranteed residual value? You add everything, you will get gross investment in lease. What is net investment in lease? Listen. Simple. If entire these things are converted into present value, that is called net investment in lease. So what is net investment in lease? Present value of MLP plus UGRV or present value of GIIL, gross investment in lease. Present value, because lease is relating to futures. These are all the lease rents, guaranteed residual value, unguaranteed residual value. These are all relating to future. I convert them into present value. I will get net investment in lease. Now the difference between these two is unearned finance income. The difference between gross investment in lease, net investment in lease is called what? Unearned finance income. So simple three formulas. Gross investment in lease. Gross investment in lease, what is the formula? MLP plus UGRV. MLP means lease rent plus GRV. Okay. What is net investment in lease? Present value. present value of gross investment in lease. That means present value of lease rent, present value of gross, GRV, present value of UGRV. You convert everything into present value, you will get net investment in lease. The difference between gross and net is called unearned finance income. Unearned finance income. So gross investment in lease minus present value of gross investment in lease. The difference, or gross investment in lease minus net investment in lease. Everything is same only. You will get the unearned finance income. Sometimes in the question they will ask unearned finance income directly. You need to calculate unearned finance income. They will ask, I will show the questions also. Unearned finance income they will ask directly in the examination. Now, sir, okay. Sir, you said present value of MLP plus UGRV is net investment in lease. In order to convert into present value, which discount factor I will use? The standard says there are two choices. I mean, the most important, the first choice is, 1 minute, sir. So the standard, what is the present value discount factor we need to use? Discount factor we need to use is, to find the present value, interest rate implicit in the lease. What is it? Interest rate implicit in lease. Or if this is not available, then lessee's incremental borrowing rate. Lessee's interest rate implicit in the lease, interest rate implicit in the lease, or lessee's incremental borrowing rate. Sir, what is interest rate implicit in the lease? Sir, the interest rate implicit in the lease is the rate, the discount rate at which the present value of MLP plus UGRV is equal to fair value of the leased asset. At what discount rate the present value of MLP plus UGRV is equal to fair value of the leased asset, that is called interest rate implicit in the lease. And you need to check it at the inception of the lease. So at the inception of the lease, if the present value of MLP plus UGRV is equal to fair value, then that is the rate is called interest rate implicit in the lease. Now by using this discount rate, I need to find out these present value factors. Sometimes in the question, sir, they won't give this rate, we need to find out. Now to find out this interest rate implicit in the lease, this is the formula you need to take as a base. So tell me, what is interest rate implicit in the lease? It is the rate at which the present value of MLP plus UGRV is equal to fair value of the leased asset. Correct? Okay. So interest rate implicit in lease is the present value of MLP plus UGRV is equal to fair value of the leased asset at the inception of the lease. So these are the definitions, sir. Total definitions in the standard. We have completed all the definitions. The contingent rent, economic life, useful life. Economic life means what? The total life of the asset. Useful life means the life which is covered in lease. For example, asset life is 10 years. Economic life, I have given the asset on lease for 5 years. So useful life for 5 years. Economic life, which can be economically useful for 10 years. Okay. Now see, since we have completed all the definitions, the next one is what? Types of leases. I told you there are two types of leases. What are those? Finance lease, operating lease. What is finance lease? Risks and rewards will be transferred. That means it is much more than just a rental agreement. I am transferring risks and rewards. That means I am selling the asset to you. But you are not making the payment at a time. You are making the payment over a period of time in the form of rents, lease rents. That is finance lease. So in finance lease, as a lessor, I will treat this as a sale. I am selling the asset on credit basis. So I will, in my books, I will recognize the amount receivable as my asset. I will de-recognize the asset from the books since I am selling the asset to you. As a lessee, what you do? Lessee, you will recognize the asset, leased asset, as your own asset, and whatever the amount you are required to pay to the lessor will you recognize as a asset, liability. So lessee will recognize asset, liability. Lessor will recognize amount receivable from the lessee, and then asset will be de-recognized in his books. That is at the inception of the lease. On the first day of the lease, this is what they will do. Okay. But if you look at the standard, sir, the standard has given some indications, sir. Important, sir, these indications, they may ask a question. They have given some indications which says the lease is considered as which lease? Finance lease. Some indications or some conditions are given. 5 conditions are there, sir. If If these conditions are there, if these conditions are presented, if any one condition is met, then that lease will be considered as which lease? Finance lease. See these conditions. First condition number 1, automatic transfer. For example, the transfer of leased asset to lessee after the lease term. Suppose in the lease agreement, sir, they have written that once the lease is over, automatically the asset will be given to lessee. This is called automatic transfer. If this condition is there in the lease agreement, that is finance lease. Second, lease agreement is providing option to the lessee to purchase the leased asset, and that too at a price which is below the fair value. And at the inception of the lease, it is reasonably certain that lessee is going to exercise such a option. Lease agreement provides purchase option to the lessee to purchase the leased asset once the lease is completed, that too at a price which is lower than the fair market value, and it is reasonably certain that lessee is going to exercise such option. Then if this kind of option is there, then also that lease is which lease? Finance lease. And third important thing, sir, if the lease term occupies the major part of the economic life, suppose the economic life 10 years, lease life 8 years, 80% of the life is covered in lease, this is also finance lease. Fourth, at the inception of the lease, if the present value of MLP is equal to fair value of the leased asset, then also that lease is which lease? Finance lease. And last one, the leased asset is of which nature? Specialized nature. Special nature asset, I have given asset on lease basis to you. Only lessee can use it without any major modifications. So that kind of lease is also what lease? Finance lease. For example, lessor has given a factory on lease basis to B Limited. This factory was exclusively constructed or modified according to the B's requirement. That means this is asset of which nature? Specialized nature. Only B can use it. Anybody wants to use this, they have to make a major modifications. Without major modifications, only B can use it. Therefore, in that situation, this lease is considered as finance lease. So if the lease agreement provides any one of these 5 conditions, then that lease is considered as finance lease. First one, automatic transfer. Second, purchase option is there in the lease agreement, and it is reasonably certain that lessee is going to exercise such option. Third, the lease term occupies the major part of the economic life of the leased asset, and at the inception of the lease, the present value of MLP is equal to fair value of the leased asset. Then also that lease is called finance lease. And the asset given on lease is of which nature? Specialized nature. Only lessee can use it without any major modifications. Then that situation, the lease is called what? Finance lease. Finance lease. Okay. Now, sir, see this example in the study material, sir. Important example. Everybody. Suppose annual lease rent, sir, 50,000 at the end of each year. Lease period 5 years. GRV 25 and UGRV 15, unguaranteed residual value. Fair value at the inception 2 lakhs. That means at the inception of the lease, the fair value of the leased asset is 2 lakhs. Interest rate implicit in lease not given. So interest rate implicit in the lease not given. When it is not given, how to calculate? What is interest rate implicit in lease? I told you. Interest rate implicit in lease is present value of MLP plus UGRV is equal to fair value. At what rate it is equal to fair value? So fair value is 2 lakhs. So at what present value? The present value of MLP plus UGRV is equal to fair value. At what discount rate both will be equal? That rate is called interest rate implicit in the lease. Now sometimes they won't give, we need to find out. How to find out? Simple. First I assume 10%. Suppose discount rate is 10%. Okay. Now see this. Present value of MLP unguaranteed residual value at a 10% discount rate. First year, total 5 years, right? Lease rent 50, 50, 50, 50, 50. Fifth year, we need to add in MLP, GRV is also there. GRV how much? 25. So GRV added. And UGRV also we need to take. Last year 15,000. Discount factors, 10% discount factor, usually they will give in the question. Find out present value. How much came? 2,14,340. But I want how much? 2 lakhs. 2 lakhs. Fair value is 2 lakhs, but the present value of MLP plus UGRV is 2,14,340. That means 10% discount rate is not correct. Hello. Now next I assumed 14%. Next I assumed 14%. Why I assumed 14%? Because when I increase the discount rate, the present value will decrease. See, actually how much I got here? 2,14,340. I want how much? 2 lakhs. That means I need to reduce, right? If I need to reduce the present value, I need to increase the discount rate. That's why. So I assumed 14%. You can assume 15% also. I assumed 14%. Now at 14% discount rate, I find out the present value. How much came? 192,360. So at a 10% discount rate, 2,14,340. At a 10%, 192,360. That means 2 lakhs is in between these two. So by using the concept of interpolation, you know that concept of interpolation? Like for example, see, first I will start with 10% plus what is the difference between these two? Difference between these two, 2,14,340 minus 192,360. This is the total difference. And the difference I want to achieve from 2,14,340 to 2 lakhs. Hello? The total difference 2,14,340 minus 192,360. Correct? 21,980. But the difference we want is 14,340. So therefore simple, sir. The difference between these two is 10, 4, 14, 4%. So 4% into 14,340 divided by 21,980. So proportionately you take 4 into 14,340 divided by 21,980. How much we got? 2.6. 10% plus 2.6. So total 12.6 is the discount rate at which the present value of MLP plus UGRV is equal to fair value of the leased asset. So this is how you need to ascertain, sir, by using the concept of interpolation. I think this is there in the FM also. How to find out the IRR, nothing but internal rate of return. So we don't know the IRR, therefore we need to find out it by using the concept of interpolation. Same thing. First I assume 10%, find out the present value. Next 14% present value. I have seen the difference. But what is the difference I need to cover? If I start with 10%, the difference I need to cover is 14,340. The difference between these two is 21,980. So the difference is 4. So therefore proportionately you take 2.6. So 10 plus 2.6, it is 12.6 rate. That means 12 at a 12.6% discount rate, the present value of MLP plus UGRV is equal to fair value. Fair value of the leased asset. Okay. Next. Now, come to accounting part, sir. So I told you in this standard, first we completed objective, scope, definitions we have seen. Next, accounting. Types of leases also we covered now. Types of leases, finance lease, operating lease we covered. Next, accounting treatment we will see. Accounting treatment. Important. First we will see which leases? Finance lease. Which lease? Finance lease. That too lessee books we will see. Lessee books to finance lease. Sir, lessee. Lessee means the person who has taken the asset on lease basis. Now tell me, you are the lessee. You have taken the asset on lease basis and that lease is finance lease. I told you based on substance or form, when you take any asset on lease basis and if that is lease is finance lease, lessee point of it is kind of a purchase. So therefore, in his books, lessee will recognize the asset as well as liability. Liability means the amount he is required to pay to the lessor. And asset, whatever the asset he is taking on lease basis, that asset he will recognize in his books. So at the inception, what is the entry lessee will write? Asset to lessor account or lease liability. Asset to lessor or lease liability account. At what value he will recognize this asset and liability? The standard says the fair value of the leased asset at the inception of the lease or present value of MLP from lessee point of view, because we are doing lessee books, whichever is lower. They will ask a separate question on this. So lessee point of view, whenever he has taken any asset on finance lease basis, he will recognize the asset as well as liability. At what basis? At the inception of the lease, on at what amount? Fair value or present value of MLP, whichever is lower, whichever is lower. So this is the entry he will write. At this value he will recognize at the inception of the lease. Next, come to year end. Sir, you are the lessee. You need to pay lease rentals every year. So on your lease rent, whatever the interest portion is there, that interest portion you need to recognize. As a lessor, I am paying lease rents. In that lease rent, there are two components, principal, interest. Sir, finance lease, I am just purchasing the asset on finance basis. That means the lessor is selling the asset to me, I am purchasing, but I am not paying the amount at a time. I am paying the amount over a period of time in the form of installments. So definitely there is an interest component in the lease rent. So therefore, as a lessee, what I need to do is every year I need to calculate the interest component which is included in the lease liability or lease rent. How to find out, sir? See this. At the end of the year, over the lease term, apportionment of the finance charges and principal repayment. So first year, what is the opening lease liability? You take it. On that apply interest, you will get finance lease. What is the actual rent you are paying? Lease rent. Next, opening plus interest minus lease rent paid, you will get closing lease liability. Again, this closing lease liability interest will be calculated on the next year. Like that, every year, what is the liability, lease liability outstanding, on that I need to calculate interest. So from the lease rent, this interest will be separated. I mean, this interest will be recognized separately. So lessee point of view, finance charge is nothing but interest now. Interest is what? Expenses for him. So he will write finance charge to lease liability. He will write finance charge to lease liability. This finance charge will be transferred to P&L account, being an expenses. And next he will make the payment of lease rental. When he makes the payment, what is the entry? Lease liability to bank. And he will claim depreciation on the asset. Because in finance lease, he is taking the asset. He is recognizing the asset. So therefore, he will claim the depreciation. So what is the entry for depreciation? Depreciation to asset account. So that's it, sir. These are the entries will come in the books of lessee. Hello? For example, you see, sir, here. Illustration 1 you see. Suppose S Square Private Limited has taken a machinery on which lease? From SK Limited. So S Square is what? Lessee. SK Limited, lessor. The information is under lease term 4 years. Fair value 20. Lease rent 6,25,000 per annum at the end of the year. Guaranteed residual value 1,25,000. Expected residual value 3,75,000. The difference is unguaranteed residual value. Correct? This is residual value. This is guaranteed. The difference is unguaranteed residual value. Implicit interest rate 15%. Discount rates also given. First year, second year, they will give discount rates also for this 15%. What they are asking is this. Calculate the value of lease liability as per AS 19. So, in the books of lessee, you need to calculate the value of lease liability. Just now I told. Here, this is first which type of lease? Finance lease. Whose books we need to find out the liability? Lessee books. At what value we will recognize liability? Fair value or present value of MLP, whichever is lower. What is the fair value? 20 lakhs. I need to find out present value of MLP. MLP means lease rent plus GRV. GRV. So find out the present value. See this. 1, 2, 3, 4. Total 4 years. Every year lease rent is how much? 6 lakhs 25. So 6 lakhs 25, 6 lakhs 25, 6 lakhs 25. Last year 6 lakhs 25 plus guaranteed residual value. What is guaranteed residual value? 1 lakh 25. Total 7 lakh 50. See this 7 lakh 50. Present value factors they have given in the question itself. Convert into present value. How much we got? 18 lakh 55,850. This is the present value of MLP from lessee point of view. What is the fair value? 20 lakhs. Whichever is lower. 18 lakh 55,850. So this is the liability he will recognize. Lessee will recognize the asset and liability at 18 lakh 55,850. Everybody. Next. And also, sir, see this. For example, sir, look at this illustration. Example number 2. Lease rents 50,000. Lease period 5 years. Guaranteed residual value 25. Unguaranteed 15. Fair value at the inception 2 lakhs. Interest rate implicit 12.6. Now, if you are a lessee, how you will do the accounting treatment? First, you ascertain the present value of MLP. 1,91,500 came. Plus, what is the fair value? 2 lakhs. Whichever is lower. So, therefore, he will write asset to lessor. 1,91,500, 1,91,500. This is at the inception of the lease, lessee will do. If it is a finance lease. Now, I told you at the end of every year what he will do. Interest he will recognize. What is the entry? Finance charge to lessor. When you make the lease payment, lessor to cash or bank. So therefore, how to find out it? See this. First liability 191,500. On that 12.6% you apply. See this. 191,500 into 12.6. How much came? 24,129. So this is the interest on this 50,000. So therefore the entry for this is 24,129. At the end of the first year we will write finance charge account debit to lessor 24,129, 24,129. And you will make the payment of lease rent lessor to bank 50/50. And this 24,129 will be transferred to P&L account every year. I mean this year P&L account debit to finance charge because it is a interest. So like this every year they calculated interest. See this. Next year 20,869 they calculated. How they got it? Simple. What is the principal amount outstanding? 165,829, 629. For example, see opening 191,500 sir. In that 50,000 is the lease rent. In that 24,129 is the what? Interest. Principal portion 25,871. So from 191,500 I reduce 25,871. So I will get 165,629. Like that every year I need to find out the outstanding. Only principal amount I need to reduce from the lease rent. Interest will be transferred separately to P&L account. And on that outstanding amount I need to calculate interest. So this is the accounting treatment in the books of whom? Lessee. When the lease is which lease? Finance lease. The most important point is at what value lessee will recognize the asset and liability. Fair value, present value of MLP, whichever is lower. That is the point you need to remember. Now come to lessor books. Lessor is giving asset on lease basis and that lease is finance lease. So I told you based on substance or form, lessor will recognize this as a sale. As if he is selling the asset to you, he will recognize. So tell me, whenever you sell the asset, what is the entry? Sell. When you sell the asset on credit basis, what is the entry? Debtor to sales. Here debtor is lessee. The amount is collected from lessee. Instead of sales, I will write asset. I will de-recognize the asset from lessor books because he is giving the asset on finance lease, and whatever the amount receivable from lessee, that he will recognize as a asset. So therefore, lessee will de-recognize the leased asset from his books. No depreciation in his books. Recognize lease receivable at a what amount? Net investment in lease. So lessor, the entry he will write is this one: lease receivable account debit to asset account. At what value he will recognize, sir? Net investment in lease. What is net investment in lease? Present value of gross investment in lease, or present value of MLP plus GRV plus UGRV. Everything you add, you will get the net investment in lease. Everything of gross investment in lease, if you convert into present value, you will get a net investment in lease. Okay. Next, every year, this is at the inception of the lease. Now every year end, what lessor will do? Lessor will recognize the interest income. From his point of view, interest income. So for finance income, he will write lease, receivable. That means lessee account debit to finance income account. For him, interest is income, right? So he will credit finance income, and later on it will be credited to P&L account, transferred to P&L account. And when he receive the lease rent, bank account debit to lease rent account. Bank to lease rent. So at the beginning, what is the entry? Amount receivable, lessee or lease receivable account debit to asset account. At what value? Net investment in lease. Every year end, what are the entries? Finance income. What is the income? Interest income. So interest income entry is what? So lease receivable or lessee account debit to finance income. This finance income will be credited to P&L account at the end. And when he actually receive the lease rent, bank to lease receivable or lessee account. Hello? Now, suppose, sir, in case of finance lease, if there are any initial direct cost, any expenses incurred for lease, like any agreement expenses, some expenses will be incurred, na, sir, at that, whenever two parties enter into lease agreement, some expenses will be incurred. Those are called initial direct cost. Okay. These agreements, these cost, what we need to do? See, simple. If these costs are paid by lessee, added to the cost of the asset. If these expenses are incurred by lessor, charge them to P&L account, or defer the expenses, charge to P&L, or defer the expenses and charge to P&L account over the period of lease. For example, lease period is 5 years. Charge these expenses to P&L account over a period of 5 years, or directly you can charge to P&L account. Two options given. Either you charge this initial direct cost you incurred to P&L account because you are incurred, these are incurred by lessor, or you can defer these expenses and charge to P&L account over the lease term. So this is which lease? Finance lease. Okay. Now come to operating lease, sir. Sir, what is operating leases? I told operating lease is kind of a normal rental agreement. Therefore, what lessee will do? He will recognize interest every year, whatever the lease rent he is going to pay as a normal expenses. But here the important point is, see, whenever the lease is operating lease in the books of lessee, no asset is recognized, no depreciation he will claim. But in case of finance lease, lessee will recognize the asset liability, he claims the depreciation. But in case of operating lease, he don't recognize any asset, because risks and rewards are there with whom? Lessor only. No depreciation will be claimed. Whatever the lease rents he is going to pay, he will recognize them as expenses in P&L account. On what basis? Either on straight line basis or any other systematic basis. This is very, very important. Lessee will recognize the lease rentals as his expenses, either on straight line basis or any other systematic basis. Sir, what is this any other systematic basis? See this. For example, sir, there is a missionary. Yeah, suppose there is a mission which is taken on lease. The lease is operating lease. Lease period is 3 years. That mission is gives an output of 10,000, 20,000, 50,000 for 3 years. Lease rent first year 25, second year 45, third year 50. Total lease rent for 3 years 1,20,000. Now see this. According to the agreement, what are my lease rents? 25, 45, 50. Total 1,20,000. 1,20,000 divided by 3. 40,000. This is called straight line method. Can I recognize every year 40,000? This is operating lease. The lease rentals will be recognized as an expenses either on straight line basis, any other systematic basis. Here straight line method I cannot apply because I will see the cost benefit. Here what is the output I am producing? So based on this output I need to recognize the rental expenses. For example, you see output 10, 20, 50, total 80,000, correct? So see total 1,20,000, first year output 10,000 divided by total output 80,000. Proportionately you take for first year. 1,20,000 into 10,000 divided by 80,000, how much came? 15,000. So this is the lease rent for the first year, 15,000. But actually as per agreement, how much I am paying? 25,000. Therefore the difference is transferred to an account called lease equalization account. So therefore first year what are the entry I will write now? Lease rent account debit 15,000, lease equalization account 10,000, to lessor account 25,000, and I will pay lessor to bank 25. That means I am paying 25, but actual expenses 15. So extra I paid 10,000 will go to lease equalization account. This is kind of a prepaid expenses for me. This is my asset. Second year you come, based on output, what is my lease rent? 30. So I will recognize lease rent 30. But second year how much I am paying? 45. Another 15,000 will be transferred to lease equalization account. So lease rent account debit, lease equalization to lessor. When you make the payment, lessor to bank. Now come to third year. What is the lease rent as per output? 75. So lease rent account 75. But what is the rent I am paying? 50. So therefore you see lease rent 75, lessor 50. That means whatever the lease equalization account already debited will be cancelled, 25,000. Therefore by the end of the lease term, the lease equalization will become nil. So simple, sir. Here how lease rents are recognized, sir? Based on the output. Either straight line method or any other systematic basis. Here the systematic basis is available. When systematic basis is available, recognize the rent based on that only. Here output is available. Based on the output you recognize 15, 30, 75. If you make total, it will be 1,20,000 only. Hello? But the difference, what is the difference between the lease rents we are recognizing and paying? That is transferred to a separate account called lease equalization account. That lease equalization account, first 2 years debit to debit. Debit means asset. Last year it was cancelled. Because last year your expenses 75 but you paid only 50. That means that 25,000 already paid. Extra paid. Now it is cancelled. This is how you need to recognize, you need to do the accounting in the books of lessee when it is which lease? Operating lease. So if the lease is operating lease, he will recognize lease expenses every year. on straight line basis or any other systematic basis available. Come to lessor, sir. When he give any asset on lease basis, which lease? Operating lease. What he will do? He will recognize income every year. Just lessee is recognizing every year lease rentals as expenses, na? Lessor will recognize every year whatever the lease rents he is going to receive from the lessee. So lease rentals will be recognized as income on straight line basis unless any other systematic basis is available. For example, one important question is there in the study material. I will show you. Yeah. This question you see, sir. This question you see example. Suppose outputs from the mission of economic life of 6 years are estimated. There is a mission, sir. This mission is gives output for 6 years. 10,000 in year 1, 20,000 units in year 2, 30,000 units in year 3, 40,000 year 4, 20,000 units in year 5, 5,000 units in year 6. Okay. The mission was given on 3 years, which lease? Operating lease. By a dealer of the mission for equal annual lease rentals to yield how much? 20% profit margin on cost of 5 lakhs. So 5 lakhs plus 20% margin. So it will be 6 lakhs. 6 lakhs. What is the total output for 6 years? 1 lakh 25. You add output for every year. 1 lakh 25. And how many years you are giving for lease? 3 years. 10, 20, 30, 60,000. So proportionately, what will be the amount? 6 lakhs divided by 1 lakh 25 into 60. How much, sir? 2 lakh 88,000. 2 lakhs 88,000. See this, 2 lakh 88. This is the total lease rent. But here, the amount is collected in equal annual lease rents. So 2.88 divided by 3. How much it is? 96,000. That means 96,000 every year. As a lessor, my lease rent is 96. But I have to recognize based on output. Based on output. Here output is I know. First year output, second year 20, third year 30. So therefore, this 96,000 every year. That means total 2.88 lakhs is there now. This 2.88 lakhs, see, based on output. 10,000 into 60,000, 48,000. 2 lakh 88 into 20,000 divided by 60, 96,000. Third year 2 lakh 88, 30,000 divided by 60, 1 lakh 44,000. This is how I will recognize the lease rentals. First year 48, second year 96, third year 1 lakh 44. See this, based on output I will recognize. Here depreciation, how I will calculate? Sir, in case of operating lease, the asset is there with lessor only. So who will claim depreciation? Lessor. So how he is going to claim the depreciation? Here the cost of the asset is how much? 5 lakhs. Here depreciation is calculated based on the output he has given. Straight line depreciation in proportion to output. So output proportion you see 10,000, 20,000, 30,000, 40,000, 20,000, 5,000 in this ratio 10, 20, 30, 45. So therefore depreciation 5 lakhs into first year output 10,000 divided by total output 1 lakh 25. So proportionately you take how much came? 5 lakhs into 10,000 divided by 1 lakh 25. 40,000 is the first year depreciation. Like that you need to provide depreciation every year. So therefore as a lessor he will write entries like this. At the end of the year he recognized the amount receivable from lessee at 96. But actually according to the agreement what is the lease rent? 48. So therefore remaining will be transferred to lease rent, lease equalization account. See this actual rent 96. But according to the output the lease is how much? 48. So therefore this is my actual revenue 48. This will go to P&L account. But I receive 96 from lessee. Bank to lessee 96. So the extra amount I am receiving now 48,000, it is like lease received in advance, is kind of a liability for me that will be transferred to lease equalization account. So every year I have to recognize like this. Okay. And I will claim depreciation, sir. See 40. This depreciation will go to P&L account. So this is the accounting treatment in the books of lessor when the lease is operating lease. And the last concept of this standard is sale and leaseback transactions. What is that? Sale and leaseback transactions. Now before sale and leaseback transactions, I would like to solve some questions here. I will come back to it. Wait. So first question I done. Second question, you see illustration number 2, everybody, in the study material. Prakash Limited leased a mission to Badal Limited on the following terms. Fair value of the mission 28.3, lease term 5 years, lease rental per annum 8, guaranteed residual value 1.6, expected residual value 3, internal rate of return 15, discount rates given. What they are asking, ascertain unearned finance income. Can you tell me how to ascertain unearned finance income? Unearned finance income is equal to gross investment in lease minus net investment in lease. Or else I can say gross investment in lease minus present value of gross investment in lease. Correct? Huh? What is gross investment in lease? Gross investment in lease is equal to MLP plus UGRV. Correct? Huh? MLP is nothing but what? Lease rent plus guaranteed residual value. So therefore the formula is lease rent plus guaranteed residual value plus unguaranteed residual value. If I add all three, I will get gross investment in lease. So see this question, lease rents. How much? 8 every year. Like this 5 years. So 8 into 5. 40. Hello? Plus what is the guaranteed residual value? 1.6. So take it. Plus what is the unguaranteed residual value? See this, residual value 3 minus guaranteed 1.6. So 1.4. See this. So you will get 43 lakhs. This is gross investment in lease. Now I want present value of this. Present value. Present value factor is given in the question. Na? So take it. Convert them into present values. So all these amounts. Lease rentals, 5th year GRV and UGRV also. Because GRV, UGRV also part of gross investment in lease. Convert them into present value. You got how much? 28 lakh 30,920. So the difference between gross investment and the present value of the gross investment is 1469.80. This is called unearned finance income. Unearned finance income. Okay. Sir, you should remember this is a marathon, not a complete session. Please understand. Marathon this is. Leases. Usually the standard is a very big standard. You know this. Okay. Now come to scenario based question, sir. This question very, very important, sir. See this, classify following either operating or finance lease. You have to tell me. First, lessee has an option to purchase the asset at lower than fair value at the end of the lease term. Suppose if the lease agreement providing an option to the lessee to purchase the asset at a price lower than the fair value, that is which lease? Finance lease. I told you if this option is there. In 5 conditions I told. Second condition. So finance lease. Second, economic life of the asset 7 years. Lease term 6 years. But asset is not acquired at the end of the lease term. Sir, third condition. For if the useful life, lease life covers the major part of the economic life. So here economic life 7, lease life 6. So 6 divided by 7 into 8. So 85%. So that means it is covering major part. So it is which lease? Finance lease. Next, economic life of the asset 6. Lease term is only 2 years. But the asset is of special nature and has been approved only for use of the lessee. So I told you if the asset is of special nature, that lease is finance lease. And last one, present value of MLP X, fair value of the asset Y. So I told you if the present value of MLP is equal to fair value, that lease also which lease? Finance lease. So therefore in this case if X is equal to Y, this is called finance lease. Everybody? This question, sir, this question, 13th question, you see, important question this is. Same, mostly repeated questions will be there here, sir. Yeah, this question already asked in exams also. Same question, question number 3. It was there in the study material. So please solve study material questions. Come to question number 13. B&P Limited availed a lease from NL Limited. The conditions of the lease term are lease period 3 years. In the beginning of the year 2009, the equipment costing 10 lakhs and has an expected useful life of 5 years. The fair market value is also 10 lakhs. Property reverts back to the lessor on termination of the lease. Once the lease is completed, the asset is given back to the lessor. The unguaranteed residual value is estimated at 1 lakh at the end of the year 2011. Okay. 3 equal annual payments are made at the end of each year. IRR 10%. The present value of 1 rupee due at the end of third year at a 10% rate of interest is 0.7513. The present value of annuity of rupee 1 due at the end of the third year at a 10% IRR is 2.4868. State whether the lease constitute finance lease and also they are asking unearned finance lease. So they are asking whether the lease is finance lease or operating lease. So first thing you need to understand is what is the expected life? 5 years. What is the lease period? 3. So 3 divided by 5, 60%. That may be one of the parameter, but that is not sufficient. We have to see some other parameter. What parameter you will check here? Present value of MLP is equal to fair value. Fair value is how much? 10 lakhs. Find out present value of MLP. What is MLP? Lease rent plus guaranteed residual value. Hello. So therefore, see this. First, they are saying that cost of the equipment you take. Unguaranteed residual value given 1 lakh. Convert this 1 lakh into present value. 75 130. Unguaranteed means which is not going to be realized, which is not going to be guaranteed. So from this 10 lakhs reduce 75 130. Therefore 9,24,870 is the present value of lease rentals. Present value of lease rentals. What is the total present value factor? 2.4868 for all discounting factors adding together. So 9,24,870 divided by this. So I will get annual equal installment. See this annual lease payment 371,911.70. Sir, the important point in this question is you need to understand unguaranteed residual value I need to deduct from the cost of the asset. Then I will get the remaining amount. That is the amount I am going to collect it in the form of lease rentals. So I need to divide it with the total annuity factor. Here they are given an IRR 2.4868. Then I will get the annual lease rent. So I know every year the lease rent is 3,71,911.7. See this. The present value of the lease payment, that is 924,870, which is equal to 92.48% of the fair market value. Therefore, the present value of the minimum lease payments substantially cover the fair value of the leased asset. Because the fair value of the leased asset is how much here? 10 lakhs. What is the present value of MLP? 9,24,870. So 92% covered. Parameter 2 you see. The lease term covers the major part of the life of the asset. So therefore, it constitutes which lease? Finance lease. Now they are asking unearned finance income also. How to find out unearned finance income? Simple. First to take the total lease payment. 3,71,911.7 into 3 minus add unguaranteed residual value. You will get gross investment because gross investment is MLP plus UGRV. MLP means lease rentals including guaranteed residual value. Now unguaranteed residual value I added. Now present value of the lease payments is 10 lakhs, which is nothing but the fair value. The difference is unearned finance income in this question. So please check this question once, sir. Okay. Remaining questions and all very easy, sir. Once you solve them, I think you'll understand. Okay. Now come to the last concept of this standard, sir. That is sale and leaseback transaction. See, listen. Most of the students are leaving this concept, but in examination they're testing. This is not difficult, easy only. Listen. What is sale and leaseback transaction? See, I am selling my asset. Upon the understanding that the same asset again I will take it on lease basis. So here the lease, sale and lease both are interconnected. All this is negotiated as a single package. For example, Mr. A is there. Mr. B is there. Mr. A is selling his asset to Mr. B. Upon the understanding that the same asset will be taken on lease basis. This is called sale and leaseback transactions. So therefore, this is a kind of a finance arrangement between the parties. For example, I want money, sir. Mr. A want money. He will show in his books that he sold the asset to Mr. B. Okay. So he has taken the amount from Mr. B. And the same amount he will pay by lease rentals, by taking this asset as a lease. So it is kind of a finance arrangement. So therefore, here what happens? Mr. A initially seller. Now he becomes lessee. Mr. B initially buyer. Now he becomes lessor, buyer lessor. So, sir, in case of sale and leaseback transactions, what is the accounting treatment, sir? Here there are two transactions, right? One is sale. Whenever sale happens, what will come? Profit or loss. So we need to understand profit or loss accounting treatment. Second, lease. What is the lease accounting treatment? Just now we covered. If the lease is finance lease, if the lease is operating lease. If the lease is finance lease, lessee books to lessor books. If the lease is operating lease, lessee books, lessor books. So that means this lease is already covered. The thing we need to focus is on what? Profit or loss on sale. Profit or loss on sale. Okay. So now the standard says, sir, the profit or loss on sale of asset under sale and leaseback transactions depends upon the type of leaseback involved. What is the type of leaseback involved? Whether the seller lessee, the seller selling the asset, same asset is taking back for lease, right? If the lease is finance lease or operating lease, depending upon that, the accounting treatment of profit or loss on sale of asset will depend. Because I told you both are interconnected. Hello? Now see this. Suppose if the leaseback is a finance lease, the standard says if the leaseback is a finance lease, the standard says, sir, if the leaseback is a finance lease, whatever the profit or loss arising on sale, it will not be recognized immediately. It should be deferred and amortized over the lease term. So I sold the asset, same asset is taken on lease. If the leaseback is finance lease, at the time of sale I got profit or loss. What I need to do that profit or loss? Here profit or loss will accrue to whom? Lessor. Seller lessor. Sorry, seller lessee. Seller lessee. I mean profit or loss accounting treatment we are discussing in the books of seller lessee. So seller lessee point of view, whatever the profit or loss he got on sale, he should defer and amortize over the lease term. For example, sale price 100, carrying amount 80. Compare these two. The book value of the asset is 80, sir. I sold it for 100. So what is the profit? 20. And if the leaseback is finance lease, this 20 you cannot recognize immediately. What you need to do? Defer and amortize over the lease term. Suppose the lease term is 5 years. So 20 divided by 5. Every year 4 will be recognized by seller lessee. Seller lessee. Now the most important thing is if the leaseback is a operating lease. So I sold the asset, same asset I have taken back for lease. And if the leaseback is which lease? Operating lease. Then there are 3 cases here. The standard says if the leaseback is operating lease, you need to check sale price is equal to fair value, sale price less than fair value, sale price greater than fair value. Sale price equal to fair value, then the standard says any profit or loss will be recognized immediately. If the sale price is equal to fair value, profit or loss will be recognized immediately because sale price fair value. So you can recognize immediately. Suppose if the sale price is less than fair value, see this, if the sale price is less than fair value, profit came, recognize immediately. Loss came, important. If the sale price is less than fair value, loss came on at the time of sale, the standard says if this loss is compensated by future lease payments, if this loss is compensated by future lease payments, deferred and amortized over the lease term. If this loss is not compensated by future lease payments, recognize immediately. The logic is very simple, sir. I sold my asset below the fair value. Why I am selling below the fair value? That means I am giving benefit to you. But in future, I am the same asset I am taking on lease basis. So I will pay less rentals to you, less rent. Today, 100 rupees worth of asset I am selling you at 90 rupees. That means 10 rupees is loss for me. For you, that is a gain. In future, I am paying lease rents. This 10 rupees I will deduct from the lease rents. That is called compensated by future lease payments. So therefore, when the sale value is less than fair value, if there is a loss on sale, you need to see whether this loss is covered, compensated by future lease payments. If answer is yes, defer and amortize. Otherwise, immediately recognize. And the last case, sir, if the sale price is above the fair value. Sir, sale price above the fair value, standard what says now? Anything above fair value. Sale price in excess of fair value, deferred and amortized over lease term. So tell me, I sold the asset, same asset is taken on lease basis. If the lease is operating lease, how many cases will come? 3 cases. What is the first case? Sale price equal to fair value. When the sale price is equal to fair value, profit or loss will be recognized immediately. Second, sale price is less than fair value. When the sale price is less than fair value, profit came, recognized immediately. Loss came. Loss compensated by future lease payments, deferred and amortized. Otherwise, charged to P&L account immediately. Last case, sale price above fair value. Sale price in excess of fair value will be deferred and amortized. Deferred and amortized. Deferred and amortized. That's it, sir. See here, the last case is an interesting case, sir. See this. For example, sale price 100, sir. Fair value 90. You need to see what is the original case. Original case is sale price above fair value. Suppose fair value 90. Sale price 100. Carrying amount 90. So now you tell me what is the profit. In order to get the profit, I need to compare 2 things. What are those? Sale price to carrying amount. Sale price 100, carrying amount 90. What is my profit? 10. So anything in excess of fair value will be amortized. See this, deferred and amortized over the lease term. Now second case, come to second case. Sale price, fair value 90, carrying amount is only 80. First, how you are going to check now? Compare these two, sale price to fair value. Here sale price 100, fair value, sale price is above fair value. So which case? Third case. Third case says what? Anything in excess of fair value will be deferred and amortized. How much is the difference? Excess 10. See this, 10 rupees the selling price, carrying amount 80. So what is the difference? 20. This is the profit. In this 20%, 20 profit, the difference between sale price and fair value is 10. This will be deferred and amortized. The remaining, that is the difference between fair value and carrying amount, the remaining 10 rupees we will recognize immediately. And the last case you see, sale value, fair value, carrying amount is 100. Carrying amount is 100. See, actually sir, here what I am doing now, first 3 cases. Sale price equal to fair value, sale price less than fair value, sale price greater than fair value. In each case what you need to do now, you need to every time compare carrying amount, fair value. One case, carrying amount equal to fair value. Second case, carrying amount less than fair value. Another case, carrying amount greater than fair value. When you change the carrying amount, with the fair value, by comparing the fair value, the situations will change. So therefore, 3 main cases, you should not forget main cases, and in each case you need to compare carrying amount with fair value. For example, you see here, if you see first case, carrying amount equal to fair value, next carrying amount less than fair value, last case carrying amount greater than fair value. Suppose you see carrying amount how much? 100, sale value 90, fair value 80. Original case tell me. Original case means what is the case we are discussing? Sale value in excess of fair value. That will always satisfy. See this, sale value is above the fair value, correct? But carrying amount I am changing. Suppose you see, in this case, when my carrying amount is 100, my sale value 90, my fair value 80. What standard says? Anything in excess of fair value will be deferred and amortized. 90 minus 80. This 10 will be deferred and amortized. Sir, but tell me one thing. Your book value of the asset is 100 and your fair value is 80. Can anybody show the carrying amount of the asset above fair value? No. Impairment loss. We cannot show more than the recoverable amount. Here, this is the fair value, but you are showing in the books 100. First, you need to bring this 100 to 80. That means straight away how much loss? 20. This will be recognized immediately. Once the asset is now come to fair value, you compare fair value and sale value. Anything in above fair value is deferred and amortized. So therefore here 2 things you need to do. The difference between sale value and fair value will be deferred and amortized, and the amount you brought from carrying amount to fair value 100 to 80, 20 rupees loss, you recognize immediately. So these are the cases, sir. Different cases you need to cover. Hello. So first case you see, sale price is equal to fair value. What standard says? If the lease back is operating lease, sale price is equal to fair value, recognize immediately. Whether it is a profit or loss, recognize immediately. Suppose second case, if the sale price is less than fair value, profit recognize immediately. Loss compensated by future lease payments, deferred and amortized. Otherwise, immediately. Case 3, anything in excess of fair value, sale price in excess of fair value will be deferred and amortized. Correct? And this concept, there are questions also. I will show you. Yeah, come to this question, sir. Illustration 3. Carefully think here. A Limited sold a machinery having WDV of 40 lakhs to B Limited for 50 lakhs. WDV means book value, carrying amount. Sale value 50. And the same machinery was leased back by B Limited to A Limited. The lease back is which lease? Operating lease. Comment if sale price 50 lakhs equal to fair value. First see the main case. Here sale price equal to fair value. Sale price equal to fair value. What standard says? Recognize immediately. How much is the profit here? See, the sale price 10, correct? Carrying amount 40. So 10 is the profit. This will be recognized immediately. See this. A Limited should immediately recognize the profit. Second case, fair value is 60. Sale price 50, fair value 60. So sale price is less than fair value. Which case? Second case. This says profit recognized immediately. Loss. Here profit or loss? See this. 50, 40. So there is a profit. Profit how much? 10. It should be recognized immediately. Recognize immediately. So second case you see should be recognized immediately. Next, third case. Fair value 45, sale price 38. Sale price 38, fair value 45. So sale price is less than fair value. Which case? Second case. Sale price is less than fair value. Now in this case, loss or profit? 38 is the sale value, book value 40. That means 2 rupees loss. What standard says? If the sale price is less than fair value, loss, if it is compensated by future lease payments, deferred and amortized. Otherwise, recognize immediately. That is what they say. See this. 2 rupees loss immediately if it is not compensated by future lease payments. Otherwise, deferred and amortized. Next, fair value 40 lakhs, sale price 50 lakhs. So, fair value, sale price. Sale price is greater than fair value. Case 3. Anything in excess of sale price, deferred and amortized. Now, here what is the carrying amount? 40. Correct? Sale price 50. So, see here. Sale price 50, fair value, sale price 50, fair value 40. Correct? And then carrying amount also 40. So, what is the difference? 10. This is deferred and amortized because anything in excess of fair value, deferred and amortized. Next, fair value 46, sir, sale price 50, sir. So, sale price 50, fair value 46. So, case number 3. Carrying amount 40. Now, you see. So, profit, total profit how much? 10. In that, the difference between sale price and fair value 6. So, this will be deferred and amortized. Remaining 4 recognized immediately. Correct? E case you see. In the E case, the total profit is 10. In that 6 will be immediately recognized. 4 lakhs will be deferred and amortized. Yeah, correct only. Fair value 46, right? 4 rupees, sorry. 4 rupees will be deferred and amortized. And 6 rupees will be recognized immediately. Because anything in excess of fair value will be deferred and amortized. Last case, sir. Fair value 35, sale price 39. Hello? So last case. Can you tell me the last case? What is that? Last case, what is the sale value? 39. Fair value? 35. Carrying amount? This is the important case where students confuse. See this. First, the carrying amount is more than fair value. This is not correct. First, brought this from here to here. 40 will become 35. That means there is a loss. How much loss? 5. You recognize immediately this loss. Now the asset value came to 35 now. Anything in excess of fair value will be deferred and amortized. How much? 4. So this will be deferred and amortized. So therefore here carrying amount first will come to fair value. So there is a loss of 5. Then the difference between sale value and fair value 4, that will be deferred and amortized. So that is the answer, sir. See this. So 4 should be deferred and amortized over the lease term. You understand this? That's it, sir. This is accounting standard 19. We have completed, sir. It's a very big standard, sir. But you can practice this. Not difficult, easy only. Big but easy. You can score in examination. Okay, sir. The next accounting standard we are going to start is AS 22, accounting for taxes on income. See, this standard basically talks about accounting for income tax, sir. Taxes on income means income tax, basically. So this standard is talking about what, sir? Accounting for income tax. Income tax. First, you need to understand some important technical terms in order to understand AS 22. First is tax expenses. What is tax expenses? AS 22 says tax expenses are current tax, deferred tax. Tax expenses are two: current, deferred tax. And you know, if you prepare P&L account as per schedule 3, today you go and check schedule 3 P&L account. So you will get one head called tax expenses. PBT, first profit before tax. After that you will show tax expenses. These tax expenses will consisting of two: current, deferred tax. Then you will get profit after tax. And also one more thing I will tell you. When you are preparing balance sheet as per schedule 2, schedule 3, balance sheet non-current liability side, equity and liability, non-current liabilities, there is one head, deferred tax liabilities. Go and check, it is there. Balance sheet, when you prepare as per the schedule 3, balance sheet, equity and liability side, non-current liabilities. In non-current liabilities we have deferred tax liabilities. This concept of deferred tax liability, deferred tax asset is derived from AS 22. And if you see asset side, non-current assets, one of the item is deferred tax asset. Now in this standard you are going to learn majorly this concept only, deferred tax asset and liability. Okay. So as per AS 22, the tax expenses are current tax, deferred tax. Sir, what is current tax? The tax which is required to pay based on the tax provisions. See, you know, in income tax, I think by this time you have an idea about income tax. In income tax, you will calculate the total income. Total income you calculate. On that you apply tax rates. You will get taxable income. Total income. From the total income you will get taxable income. On the taxable income you apply tax rate. You will get total tax payable. That is called current tax. Current tax is nothing but the tax payable as per the Income Tax Act. Hello? So now what is deferred tax, sir? Current tax I know, because as per income tax I will calculate. I will know. What is deferred tax? See, that is what the main thing of this standard. What is deferred tax? Understand the concept of deferred tax, everybody. Understand the concept of deferred tax. Please listen. Sir, there is accounting income, taxable income. There is accounting income, taxable income. Accounting income. What is accounting income? Accounting income is nothing but net profit or loss from the P&L account. Every year you prepare P&L account, sir, for company. In that P&L account you will get net profit. That is called accounting income. So accounting income is nothing but what? Net profit or loss before tax from P&L account. Now how you are going to prepare P&L account? Schedule 3, okay. Next, you will follow accounting standards, accrual concept, double entry system, all these principles, generally accepted principles, generally accepted accounting principles you will follow, and you will prepare the P&L account, and you will get net profit or loss before tax from P&L account. That is called what? Accounting income. Now come to taxable income. What is taxable income? The income which is determined by following the provisions of tax laws. Hello? As per Income Tax Act, you will calculate total income, na? And from that you will arrive taxable income. On the taxable income only you will apply tax rate and you will get the tax liability. So basically taxable income is what? Income which is determined as per provisions of tax laws. This tax liability is determined based on what? Taxable income. So this is called generally current tax. This is called what? Current tax. Current tax is calculated on what? Taxable income. So there is accounting income, taxable income. Now you tell me, as per P&L account I will get net profit. As per taxable income I will get taxable income. Whether both will be same or different? Different. Why they will be different? Because of the provisions of Income Tax Act. Because Income Tax Act says some expenses they won't allow. Some expenses they will allow over a period of time. Some expenses they will allow in the year of incurrence itself. In the year in which you incurred, they will allow. Best example is depreciation. You know, when you purchased any asset for scientific research, 100% of the cost of the asset is allowed as depreciation in the Income Tax Act. But in the company, as per the P&L account, as per accounts, we don't allow 100% of the cost of the asset at a time. Na? We will follow straight line method. We will follow straight line method. And Income Tax Act, you know, generally how depreciation is provided? WDV. Generally we will follow WDV. But as per accounts, I mean P&L account, when you prepare, we will follow straight line method. But you need to observe, overall depreciation is same. Whether you follow accounting principles or income tax principles, the total depreciation allowed is cost of the asset only. But the difference is only every year amount. They are following WDV method, I am following straight line method. Hello. So therefore you need to understand, sir, accounting income, taxable income is there. Both are not same. They will not same. Why they will not same? Because of the provisions of the Income Tax Act. Income Tax Act, sometimes some expenses they don't allow. For example, interest on loan. Tell me, sir, as per Income Tax Act, interest on borrowings, interest on loan, is it allowed? When it is allowed? In the year of payment. You know, 43B payment. Interest on capital or interest on loans will be allowed in the Income Tax Act only in the year of payment. But in P&L account, we will recognize as expenses when it is incurred. That means we will debit to P&L account, but we don't allow in Income Tax Act. That means when you compare accounting income and taxable income, sir, they are not matching. Why they are not matching? Because of the provisions of Income Tax Act. Because of the provisions of Income Tax Act, they are not matching. So therefore what we need to do is, we need to identify the reasons. We need to identify the differences. The standard says these differences are divided into two types. One is permanent differences, another one is timing differences. If it is a permanent difference, ignore. For example, any penalty, Income Tax Act, any interest paid on income tax, never allowed as per Income Tax Act. We will allow as per P&L. Sir, any expense, any income, we will take it in P&L, but income tax has restrictions. For example, any donations. Generally, donation is allowed only some specific conditions are satisfied as per Income Tax Act. Suppose when a company gives a donation, sir, P&L account we will allow, but income tax we don't allow. That means it's a permanent difference. So if it is a permanent difference, ignore. If the difference is a timing difference means the difference which originate in 1 year and capable of being reversal in future years. This year there is a difference, but it will reverse in next year's future years. That is called timing difference. The standard says if the difference is timing difference, on that timing difference, whatever the tax is there, that is called deferred tax. The word defer means postponement. Either tax benefit has been postponed or the tax liability has been postponed. That postponement, that timing difference now came. It is going to reverse in the coming years. Therefore, you anticipate and recognize now. For example, because of this difference, in future tax liability will come. That is deferred tax liability. Because of this difference between income, accounting income and taxable income, in future there will be savings in tax. That means my asset, deferred tax asset, recognize this year. So why AS22 came? AS22 came to match the tax expenses with the income. Your accounting income and tax expenses should match. They are not matching. Why they are not matching? Because in P&L account you are getting one net profit, but current tax you are calculating as per Income Tax Act. As per Income Tax Act, the taxable income is different. As per P&L account, your net profit is different. But tax is calculated based on taxable income. That the tax expenses you are showing it in the P&L account. But P&L account, accounting income is different. Suppose, sir, my accounting income 30 lakhs came, sir, net profit. Okay, taxable income 20 lakhs came, sir. See this, 20 lakhs came. I will pay tax on what? 30 lakhs or 20 lakhs? Sir, my accounting income 30, my taxable income 20. I will pay tax on what? 20. On 20 lakhs, suppose 30% tax, sir. 6 lakhs is my liability. I will show this on the P&L account. See this, in P&L account, suppose 30 lakhs is my net profit. I will show 6 as expenses. These two are not matching. Why they are not matching? Suppose if my income is 30, I should pay 30% on 30. It should be 9. But I am showing tax expenses as 6. That means my accounting income and tax expenses I am showing, they are not matching. Why they are not matching? Because tax I am considering as per Income Tax Act. And the tax expense is the current tax I am showing in the P&L account. In P&L account, my net profit is 1. My net profit, which is different from the income tax. Correct? So these differences I need to identify. And if the difference is which difference? Timing difference. Timing difference means which originates reversal in future. On that I need to calculate deferred tax. I will show you. I will see this. For example, there is a company X Limited. Everybody please see this. There is a company X Limited. Now I am preparing P&L account for the year ending 31st March 2024. My revenue 100. My expenses, you see, interest on loan 20, other expenses 20. So what is my PBT? 60. This is called accounting income. This is called, which is prepared as per P&L account. Okay. Now come to income tax computation. PBT how much? 60. But in this interest on loan is there na 20. Is it allowed as per Income Tax Act? Not allowed. Interest on loan 43 payment allowed only in the year of payment. Suppose assume this 20 was not paid. This 20 was not paid. So add back. So therefore your taxable income is 80. Taxable income is 80. Accounting income 60. What is the difference? 20. Why the 20 difference? Interest on loan. Is it temporary difference, permanent difference? Temporary. Because next year when you pay it is allowed. Next year when you pay as per income tax, this 20 is also allowed. Na? That means this 20, which is the difference between accounting income and taxable income of the current year, has the capability of reversal in the coming years. Therefore on this 20, you find out the tax. 20 into 30%. How much? 6. 20 into 30%. How much? 6. That 6 is your deferred tax. You recognize in the current year itself. Is it deferred tax asset or liability? Deferred tax asset or liability? Simple. Simple principle I will tell you. Save now, pay later. Pay now, save later. Save now, pay later. Pay now, save later. Now you are saving or paying? Paying. Because on this 20 also you are paying tax. That means in future you are going to save. Because this 20 is allowed. Therefore that 6 is deferred tax asset. Deferred tax asset. So therefore, simple sir, have you suffered the tax liability? Have you enjoyed the tax benefit? If you enjoyed the tax benefit today, in future there is a liability. If you suffered the liability, in future there will be tax savings. So therefore, in future liability is coming sir, deferred tax liability. In future I am going to save some tax sir, deferred tax asset. Now you see here, my taxable income is 80. On the tax liability I calculated 24 came. Now this 24 where I will present? P&L account. In P&L account I need to show tax expenses. Current tax how much? 24. Now the question is, see this, everybody please see. Here these two are not matching. My PBT here is 60, but my tax expenses 24. See, ideally on 60, 30% means it should be how much? 18. But I am showing how much? 24. That means they are not matching now. That's why this standard came into the picture, which says the accounting income is not matching with the tax expenses. You are showing tax expenses 24, which is as per the Income Tax Act, but your accounting income is only 60. On 60, ideally 30% means 18, but you are recognizing 24. Why you are recognizing excess 6? Because of the Income Tax Act. Why? Because of the Income Tax Act. Income tax does not allow the 20 lakhs. Is it timing difference or permanent difference? Timing difference. This year not allowed, but next year they will allow. Next year when they allow means next year my taxable income is reduced by 20. My taxable income reduces by 20 means I will save a tax on the 20. 20 into 30, 6 lakhs tax I will save. Therefore create deferred tax asset this year itself. So that's why I created deferred tax 6. So what is the entry for deferred tax asset? Asset to P&L. Asset to P&L. Deferred tax asset to P&L. Or else you can write like this. Deferred tax asset to deferred tax. Deferred tax. Deferred tax asset to deferred tax. This deferred tax will be transferred to P&L account. P&L account will be created basically. Sorry, asset to P&L sir. Asset to P&L. That means P&L account is created with 6, debited with 24. Current tax entries, current tax to P&L to current tax. P&L to current tax. this 24 debited to P&L account, this 6 credited to P&L account. That means what is the net effect? 18. Net effect is what, sir? 18. So this net effect is 18. Therefore, my total tax expenses is 18. I told you now, what is tax expenses as per AS 22? Current tax plus deferred tax. What is my current tax? Minus 24 plus what is the deferred tax? 6. So therefore, what is my total tax expenses? 18. Now it is matching. See this. 60, 18. On 60, if I apply 30%, it will be exactly equal to 18. This is what this standard will do. Hello. So therefore, what is the entry I will write at the end of this year? P&L to current tax. 24, 24. Deferred tax asset to P&L. 6, 6. See this. P&L account is debited with 24, credited with 6. That means net debited with 18, which is exactly matching with my income. So therefore, see here, I am paying now, save later. Then deferred tax asset will come. See, on this 20, now I am paying tax. So in future, there will be savings. So therefore, I need to recognize what? DTA. Suppose if I save now, I have to pay later. Then it is called deferred tax liability. Or else you can see, when your taxable income is greater than accounting income, taxable income is greater than accounting income means obviously you paid more tax, correct? So tax benefit was deferred. So therefore DTA. When your taxable income is less than accounting income means your tax benefit enjoyed in the current year itself. So therefore in future you will get tax liability. So therefore it is a deferred tax liability. Sir, next year what happens now, sir? Next year when the company pays this 20 is allowed in the next year. Therefore, next year what happens now? This deferred tax asset will be reversed. So P&L to DTA. 6, 6. Because in the year of origination you recognized. Next year when the difference reversed, this DTA you cancel it to the extent of the difference. See, first year you recognized DTA. How much you recognized? 6. Now, next year when you pay interest, this DTA realized. Tax saving happened. Therefore, DTA will be cancelled. P&L to DTA. Hello. So that's it. This is the deferred tax concept, sir. I will take one more example, sir. You will understand it better. Don't worry. Depreciation is the best example, sir. Depreciation is the best example. Suppose, sir, see, there is a company, sir. As per P&L account, their PBDT given, sir. Profit before depreciation and tax. Every year 1 lakh, sir. 1 lakh, 1 lakh, 1 lakh. This is PBDT. Profit before depreciation and tax. They purchased one machinery, sir. The cost of the machinery is 30,000. Cost of the machinery is 30. When you prepare P&L account, how depreciation is allowed? SLM. Straight line method. So 30,000 divided by 3. Every year 10, 10, 10. Correct? But as per income tax, you see, when you are computing income tax, sir, entire 100% of depreciation is allowed in the. So, as per income tax, entire depreciation of 30,000 is allowed in the first year itself. As per P&L, over a period of 3 years it is allowed. But overall depreciation allowed in P&L as well as income tax, 30 only. Understand? This is a classic example. Overall depreciation allowed as per books, P&L as per income tax is what? 30. The difference is only time. That is why it is called timing difference. See here, in 22-23, 10,000 depreciation allowed. Next year 10, next year 10. But here entire 30,000 is allowed in first year itself as per income tax act. Now you see, just common sense you use. In the first year itself, 30,000 depreciation I claimed as per income tax act. But as per P&L only how much allowed? 10,000. That means excess depreciation 20. I enjoyed the benefit. On the 20 I am not paying tax. But I know next year this is going to be reverse. Why? Next year no depreciation is allowed now. But as per the accounts, next year also 10 depreciation is allowed. But as per income tax, entire 30,000 I claimed it in the first year itself. That means 20,000. The difference between accounting and taxable, on the 20,000 tax benefit I enjoyed today. So when I enjoy today, tomorrow I need to suffer. Therefore, on this 20,000 I create deferred tax liability. So 20,000 into 30%. How much? 6,000. Create deferred tax asset. What is the entry? Deferred tax liability. Create deferred tax liability. What is the entry? P&L to deferred tax liability. When is an asset? deferred tax asset to P&L. When it is a liability, P&L to deferred tax liability. That's it, past 60,000. Now next year what happens, sir? See this. Next year, this 20,000, whatever the difference is there, another. In this 20, how much reversed? 10,000 was reversed. 10,000 was reversed. So 10,000 into 30%. 3,000. So from this deferred tax liability, 3,000 cancelled. Remaining balance, 3,000 will be there. Next year, another 10,000 reversed. That means deferred tax liability will be 0 by the end of the third year. Hello? This is the concept. So, you see here, as per P&L account, accounting income, see this. Every year my depreciation is 10, 10, 10. That means total 30. But as per income tax, 30,000 is allowed in the first year itself. But overall depreciation remains same, 30. Therefore, the difference is only timing. First year, how much excess depreciation I considered? 20. In this 20, how much reversed? Next, 10. So therefore, what the standard is saying is, in the first year, 20,000 is there na difference between accounting income and taxable income. On this 20,000, you enjoyed the tax benefit. But you know, this 20,000, you enjoyed the benefit, you saved the tax na. In next year, you need to pay. Next coming years, you need to pay tax on this 20,000 also. Because next year, no depreciation is allowed as per Income Tax Act. But as per the accounts, it is allowed. Therefore, first year, whatever the benefit you enjoyed na, this benefit is going to become a liability for you. So therefore, you do one thing. On this 30% means how much? 6,000. You create deferred tax liability. So therefore, in the balance sheet of the first year, when I prepare balance sheet of the first year, I will show DTL. How much DTL I will show? 6,000 I will show. Next year what happens? 10,000 reverse na sir. So 3,000 I will reverse. That means when I prepare balance sheet for the next year, from this 6,000, 3,000 reversed. So what is the balance? 3,000 will be shown. Next year another 10,000 reversed. So therefore another 3,000 will be reversed. So next year when I prepare balance sheet, so 3,000 of balance minus reversed 3,000. So what is the balance? Nil. So therefore deferred tax liability for the first year and how much? 6,000. Second year 3,000. Third year nil. What are the entries? P&L to DTL 6,000, 6,000. Second year reverse DTL to P&L 3,000, 3,000. Third year. That's it, pa. This is the standard. Very simple. Identify the difference. That difference is only timing permanent. Permanent differences are there. See, in order to understand this standard, sir, little bit of income tax knowledge is also required. PZBP chapter is there, na sir? PZBP. That chapter you should have the knowledge. Otherwise, you won't understand this standard. Because which is permanent difference, which is a timing difference, you need to understand, sir. Permanent difference means it is not going to reverse. Not going to reverse means income tax says not allowed means not allowed. There are some expenses which is not, for example, goodwill written off. Goodwill written off, sir. We will debit to P&L account. P&L account, everything is allowed. But income tax act says, no, nothing. Goodwill written off, we won't allow. That means the difference is there. But the difference is permanent difference. So you cannot calculate deferred tax. So deferred tax is calculated only on timing difference between accounting income and taxable income. So tell me the simple way, how will you identify whether it is liability or asset? Deferred tax asset or liability? Save now, pay later. Pay now, save later. Simple. Am I enjoying the benefit, tax benefit? If I am enjoying today, liability, I need to suffer. If I am taking the liability this day, savings in future. So here asset means savings in tax. That's why it is deferred tax asset. Understood? Okay. So, see this. Come to illustration number 1, sir. See this illustration number 1. See, these are the questions they are asking. 5 marks, just like that you can get it. See illustration number 1. Everybody please concentrate. There is a company Rama Limited, sir. Depreciation as per accounts. Accounting records means as per P&L. As per income tax. Now you tell me. I am not, just think. As per income tax, how much depreciation I am claiming? 5 lakhs. As per accounts, excess depreciation claim. This 3 lakhs I am saving. On the tax I am saving today. I am claiming 3 lakhs excess depreciation as per income tax. That means on 3 lakhs I am saving the tax na. The tax rate is 50%. That means 3 lakhs into 50%. 1 lakh 50. What is this 1 lakh 50? Deferred tax liability. DTL. DTL I need to recognize. On this 1 lakh, I mean on this 3 lakhs. Why? Because depreciation I know it is which difference? Timing. Because whether you take income tax or P&L, overall depreciation is cost of the asset only. But the only difference is year wise. Year wise if we see there is a difference. But overall if I see total. Same interest on loan. For example, if I take an interest on loan, on that if I pay interest, P&L account I will debit. Income tax also will allow. But when they allow? Only when I pay. So therefore the difference is only timing difference. When I pay they will allow na. That means the difference is only temporary difference, timing difference, which is going to reverse. For that we need to recognize deferred tax. So deferred tax is recognized only for temporary timing difference. Next one. This one also very important. See this. Unamortized preliminary expenses as per which records? How much is there? 30. Now I want every one of, I think there is one section called 35D. Amortized preliminary expenses. 35D or 35D, I think D, 35D. How many years they will allow, sir? Preliminary expenses? 5 years. So that means if at all any preliminary expenses is there, I will debit to P&L. But income tax side says we will allow for 5 years. So that means there is unamortized preliminary expenses. That means this unamortized balance is what? Is going to allow in the future. Is going to allow in the future as per income tax. But because sir, income tax act says unamortized preliminary expenses will allow over a period of 5 years. Now this 30,000 is going to allow in the future years. That means this year I have paid tax on this 30,000 also. But next coming years, out of this some amount will be allowed as deduction. For example, total 1 lakh, sir. 1 lakh divided by 5. Every year 20,000 they will allow now. Like that still 30,000 they are going to allow as per income tax act. But as per P&L I claimed everything. So the difference of 30,000 is what? So it is my deferred tax asset because it is going to give me some tax savings in future. Today I am suffering. I am paying tax on this 30,000 also because income tax excess we will allow in future over a period of time. Now that means you suffered tax on this 30,000. So that means when you take in the burden of tax liability today and pay now, definitely you are going to save later. So this 30,000, 50% means 15,000. DTA. Correct? DTL how much? 1 lakh 50. On depreciation DTL, sir. On unamortized preliminary expenses DTA. So therefore overall 1 lakh 35,000 net deferred tax liability. See this. Excess depreciation as per tax records 3 lakhs is a timing difference. Calculate deferred tax liability 1 lakh 50. Unamortized preliminary expenses amount 30 timing difference deferred tax asset. Sir, you understand how deferred tax asset came? What is deferred tax asset? Savings in tax. Savings in tax. When savings will happen? When you take in the burden today. When you pay tax today, there will be savings. On this 30,000 you are paying tax now. Because they are not allowed, they are going to allow in future. That means this 30,000 you are paid the tax. That means it is going to give savings in future. So therefore deferred tax asset. Hello? I will give you one more beautiful question, sir. This question I think I already asked in the examination. See this question, illustration 4. There is a company Omega Limited, sir, which is working on different projects which are likely to be completed how many years? 3 years. It recognizes revenue from these contracts on what basis? Percentage of completion method for financial statements during 10, 11, 11, 12, 12, 13 for 11 lakhs, 16 lakhs, 21 lakhs respectively. That means this company Omega Limited, sir, in when they are preparing financial statements, revenue they are recognizing. On what basis they are recognizing? Percentage of completion method. Amounts given, sir. Now see, however, as per income tax purpose, it has adopted which method? Completed contract method. As per books we are following percentage. As per income tax we are following completed contract method. Under which it has recognized the revenue of how much? 7, 18, 23 for the year 10, 11, 11, 12, 12, 13 respectively. Income tax rate is 35. Compute deferred tax asset or liability for the years. Simple. Take a calculator. Okay. Add these things. 11 lakhs, 16 lakhs, 21 lakhs. Tell me how much came. 11, 16, 21. 40. This is what? Total revenue as per P&L. Now, as per income tax, add everything. Revenues 7, 18, 23, 48. That means overall revenue recognized as per books, as per income tax, same. The difference is only years. So this is called timing difference. On timing difference, we need to recognize deferred tax asset or liability. Now see first year. First year, everybody see. First year, as per P&L, what is my income? 11 lakhs. As per income tax, 7 lakhs. That means as per P&L account 11 lakhs, as per income tax 7. That means as per income tax 7 lakhs only I considered. So therefore, save now, pay later. I have saved 4 lakhs. The difference is 4 lakhs. On that 4 lakhs, I saved the tax. I have not paid it because as per income tax I considered only 7. But as per P&L 11. That means 4 lakhs less considered. Na? That means 4 lakhs into 35%. 1 lakh 40,000 is my deferred tax liability. Liability. Because I enjoyed the benefit today. Tomorrow I am going to pay. Hello. So first year timing difference how much? 4 lakhs. 4 lakhs into 35%. Second year you see. Second year what is my P&L account income? 16. As per income tax 18. That means the first year timing difference of 4 lakhs was reversed now. 2 lakhs reversed. So 2 lakhs into 35%. 70,000 you reverse deferred tax liability. Reverse. So the balance is 70. Last year you see as per P&L how much? 21. As per income tax 23. Another 2 lakhs reversed. So 2 lakhs into 35. So nil. Deferred tax liability at the end of the third year is nil. Very simple concept. See this. Accounting income first year 11. Taxable income 7. Your taxable income is less than accounting income. Sir, the moment your taxable income is less than accounting income means you have enjoyed the benefit today, this year. That means you paid tax on this 7 lakhs, not on 11 lakhs. That means this 4 lakhs is the timing difference. On this 4 lakhs you enjoyed the benefit. Therefore in future liability will come. So 4 lakhs into 35%. Then deferred tax liability 1 lakh 40. Next year you see, next year your accounting income is 16 but taxable income is 18. Taxable income is more than accounting income by 2 lakhs. That means 2 lakhs was reversed. First year timing difference was reversed by 2 lakhs. See this timing difference 2. So on that 35% means 70,000 reverse. So the balance is how much? The balance, sir, first total deferred tax liability 1 lakh 40, sir. In that 70,000 reverse means how much will be there? 70. Third year another 2 lakhs reversed. So deferred tax liability will be nil. What are the entries? Can you tell me? First year P&L to DTL 1 lakh 40, 1 lakh 40. Second year DTL to P&L 70, 70. Third year DTL to P&L 70, 70. That means third year and DTL is 0. First year 1 lakh 40. Second year 70. Third year 0. See this 1 lakh 40, 70, 0. Okay. So timing difference, permanent difference, theory question, same question which we solved. Just now we solved na? Illustration 1. That question only they have asked. Okay. In examination, recent examination question I will show you. Very simple question. See this. September 2025 attempt they asked one question. Same depreciation. You have to tell me. See, come on. This company has purchased what? A building. What is the cost? 20 lakhs. Life 4 years. Scrap value expected is 0. Depreciation allowed how much? First year. Rest balance in second year for which purpose? Straight line method is considered for accounting purpose. So that means 20 divided by 4. 20 divided by 4 means 5 lakhs. So that means as per P&L every year 5 lakhs, 5 lakhs, 5 lakhs, 5 lakhs. As per income tax, first year 10 lakhs, second year 10 lakhs. Now see the first year difference. As per P&L, what is the first year difference? First year depreciation 5. P&L 5. As per income tax 10. How much excess you claimed? 5. Which will give you deferred tax liability. You enjoyed today. You claimed excess depreciation. So 5 lakhs into 30%. 1 lakh? 1 lakh? So deferred tax liability for first year. 1 lakh 50. Correct? Second year also same. As per P&L 5 lakhs. As per income tax 10. Again you claimed excess depreciation, which will give you deferred tax liability. Same, 5 lakhs into 30%. How much? 1 lakh 50. So that means total DTL is 1 lakh 50 plus 1 lakh 50. Total 3 lakhs. Correct? Now come to third year. Third year, as per in P&L, 5 lakhs. As per income tax, 0. That means timing difference is reversed. First year timing difference 5 lakhs, second year timing difference 5 lakhs, total 10 lakhs. In the 10 lakhs, how much reversed? 5 lakhs reversed. So 5 lakhs into 30%. 1 lakh 50,000. So from this 1 lakh 50 reversed. Last year, as per P&L 5 lakhs, as per income tax 0. That means another 5 lakhs reversed. So 5 lakhs into 30%, 1 lakh 50 reversed. That's it, pa. What is there? Simple. They have given PBDT as per accounting depreciation. This profit before taxes, tax expenses, current tax, or deferred tax. So here they have given. See this. This is the timing difference for first year. On that DTL will come. Second year also there is a timing difference, DTL. Third year reversed. Fourth year reversed. That's it. But this question they have asked for 5 marks. Jackpot. What is there? Nothing. You know the concept. So you understood the difference between accounting income and taxable income. Here is only depreciation. First year I claimed excess depreciation. On that excess depreciation I will create deferred tax liability. Next year also deferred tax liability. Next year cancelled, reversed. Okay. Same manner this question also you practice. One examination question is there. So okay. So that means we have completed the main concept of AS22, sir. Deferred taxes concept. So can you put it in simple? What is deferred tax? What is deferred tax? What is deferred tax? Deferred tax is tax effect on timing differences. Tax effect on, that's it. So they are saying this. See this. What is deferred tax? Tax effect on timing differences. What is timing differences? Difference between accounting and taxable income that originate in one period, reverse in future periods. Best example, suppose if I purchase a machinery for scientific research, it is fully deductible in year 1 as per income tax. But as per P&L account, it is allowed over a period of time. But the difference is only timing. Overall cost of the asset only allowed as a depreciation, whether it is income tax or P&L. The difference is only in the years, the amount. What is permanent difference, sir? Difference that originate in one period, do not reverse later. Example, fine for late tax payment. Suppose in the income tax act, sir, if I make any payment late tax, I should pay fine, sir, fine penalty. Is it allowed as per income tax act? Never allowed. Any fines, penalties, late taxes you paid, it is not allowed. Therefore, since it never reverses, it is a permanent difference. Will you calculate deferred tax on permanent difference? No. Ignore. Everybody. Next. So accounting income means net profit or loss before tax. Taxable income I told. Tax expense means current tax plus deferred tax. Current tax I told. Tax payable on the taxable income. Okay. Now recognition. Now once the main concept is over, deferred tax concept is over, here onwards some small points are there. I will tell you. Sir, one important point, sir. Deferred tax asset. Sir, what is deferred tax asset? Hello? What is deferred tax asset? What is deferred tax asset, pa? Deferred tax asset means savings. Tax savings in future is called deferred tax asset. Okay? That means today I suffered, tomorrow there will be savings. I paid the tax today, but there will be savings tomorrow. Correct? That I am calling it as deferred tax asset. So deferred tax asset is basically tax savings in future. Now listen. The standard says, sir, in future, this deferred tax asset must be realized. How asset will be realized? Here in this case, by way of savings in tax. Generally, suppose if I have this building, this is my asset. How this asset will be realized? When I sell, amount will be realized. But deferred tax asset is an asset. But it is not realized in the form of cash. It is realized in the form of tax savings. But the question is, in order to have tax liability in future, there must be sufficient taxable income in future. Then only this deferred tax asset will be realized. Na? For example, you said, my deferred tax asset is 10 rupees. That means this 10 rupees is a tax savings in future. In order to have this 10 rupees tax savings, first of all, there must be tax liability in future. Suppose you are a company, loss making company. You don't have any future taxable income. You don't have any tax liability at all. Then standard says, don't recognize DTA. DTA will be recognized only if there is sufficient future taxable profits against which this deferred tax asset will be realized. The logic is what? Prudence concept. Don't anticipate assets, but anticipate liabilities. Asset will be anticipated only when there is absolute certainty. So in future, if you are sure that your company will have sufficient taxable profits, you get a tax liability. Against this tax liability, this deferred tax asset will be realized. Savings, sir, savings when will happen, sir? Only when there is a liability. When there is a tax liability, in the tax liability, savings will happen. Correct? That is what standard says. Here, two situations they are creating. One is, if you are creating DTA for reasons other than unabsorbed depreciation and carry forward losses. You created DTA. For which reasons you created DTA? For which timing differences other than unabsorbed depreciation and carry forward losses? You remember in Income Tax Act, unabsorbed depreciation and carry forward of losses. Sir, in income tax, any unabsorbed depreciation is there, it can be carry forward. That means in the future years, against taxable income, this unabsorbed depreciation will be adjusted. That means in future, because of this deferred tax, this unabsorbed depreciation, my tax liability will be reduced. So it will create deferred tax asset. Hello. Similarly, carry forward of losses. If any losses is there as per income tax, it can be carry forward to future years. So that means this carry forward losses will give savings in future. So therefore, if you create any DTA because of reasons other than unabsorbed depreciation and carry forward of losses, they say you must have a reasonable certainty. Which certainty? Reasonable certainty that you should have sufficient taxable income in futures. Then only DTA will be recognized. Sir, what is reasonable certainty? Based on the past records. You check the previous year data. Previous year records you check. Based on the past records, if you can able to come to a conclusion that this company will have sufficient taxable income in future and there will be tax liability, then only DTA will be recognized. If you are creating DTA due to reasons other than unabsorbed depreciation and carry forward of losses. Sir, if you are creating DTA for reasons of unabsorbed depreciation and carry forward of losses, suppose in your company already unabsorbed depreciation is there, carry forward losses is there, and you are creating DTA. You are creating DTA. In this situation, they are saying you should have virtual certainty. What is this virtual certainty? Here reasonable certainty, here virtual certainty. Why? Why the difference? Standard making absolutely clear that see, already your company have unabsorbed depreciation carry forward losses means you are already suffering losses. Therefore, in future, whether you will get a taxable income, you will get tax liability, very big question. You don't get profit at all. Therefore, the question of arising tax liability will not arise. Therefore, unless you are absolutely confident, that's why they use the word virtual certainty. What is virtual certainty means? 100% pakka evidence you should have that you have definitely some taxable income in future against which there will be tax liability. That means, for example, company got a export order, export contract. Suppose if I export this, I will get revenue. That concrete evidence should be there in my hands. That is called virtual certainty. See, here reasonable certainty is sufficient, but here virtual certainty should be there. For what? That there will be sufficient taxable income in future years, against which this DTA will be reversed. DTA will be realized. So simple listen. DTA means savings in tax. In order to realize this DTA, there will be tax liability in future. So the standard says you are creating DTA. Yes. In your company, you don't have unabsorbed depreciation carry forward of losses. Then you should have reasonable certainty that in future your company will have a sufficient taxable income against which tax liability will be there. Only when there is a tax liability, this deferred tax asset will be realized. Suppose you said, sir, my tax liability 100 rupees. Then only I can say you can save 20 rupees. Suppose if you say, sir, I don't have tax liability, how can I say savings in tax liability? So therefore your company says DTA. DTA means tax savings. In order to realize this asset, you should have reasonable certainty that your company is going to get what? Taxable income in future. When you create DTA due to reasons other than unabsorbed, that means your company does not have any existing losses. Suppose you already have existing losses. Existing losses already means worst condition. In future, there is no guarantee that you are going to get profits. Correct? Therefore, in this case, they are increasing the degree. They are saying reasonable certainty not sufficient. What is required? That's it. Nothing is there. So therefore you understand reasonable certainty, virtual certainty. Reasonable certainty is judged from past records, but virtual certainty, 100% pakka evidence you should have in your hands. See, strong evidence should have, sir. Please understand, strong evidence such as binding export order. Okay. And one more thing, sir. Sir, how I am going to measure these deferred taxes? If it is a current tax, no, sir, I should measure by using the applicable tax law rates and laws. You know, every year I will calculate tax liability. So whatever the tax rate applicable for that period I will apply. But what about deferred taxes? Which rate I will apply to calculate deferred taxes? Because this deferred tax is relating to future. Which rate I need to apply? For example, this year, this assessment year, you know the income tax rates. Suppose when I am calculating deferred tax, the same rates can I apply? The standard says enacted rates. Government already announced future tax rates. Enacted or substantively enacted rates, use them. When you are calculating current tax, only this year applicable rates. But deferred tax, you apply enacted. What is enacted rate, sir? The rates which is approved in the parliament. Government already approved. Substantially enacted means almost confirm they will come. Sir, every year government tax rates they will update na, sir. So when it comes to deferred tax, timing difference into tax rate I need to apply na, sir. Which tax rate I will apply? Enacted or substantively enacted tax rate I will apply. Discounting, no question of discounting, sir. You cannot discount the deferred tax to present value. Discounting is not allowed. It cannot brought to present value. Some students will say me, sir, deferred tax is relating to future. Can I convert into the present value? No. Today we discussed AS15, DBO. DBO, current cost will brought to present value. But similarly, can I recognize deferred tax asset liability to its present value? No, not allowed. Next. Okay. Next, sir, presentation and disclosure. Sir, important, one point, sir. Sir, can I set off both current taxes, assets and liabilities? Current tax, assets and liabilities. What is current tax asset? Advance tax. Hello? Advance tax is current tax asset. Current tax liability? Provision for tax, correct? Every year we create provision. Can I set off both? Standard says yes. Allow, but two conditions. It is a legal enforceable right to set off should be there, and intent to settle it on net basis should come. For example, my advance tax 10 lakhs, provision for tax 8 lakhs. So I can set off and I can pay 2 lakhs. Now similarly, deferred tax assets and liabilities, can I set off? Yes, same conditions. There must be legal enforceable right to set off, and the company, both related to taxes levied by same tax laws. Important, sir. Deferred tax asset and liability can be set off only if the both should arise from the same tax laws. Same tax laws. For example, DTL came in India. DTA came in foreign country. Foreign. Suppose in foreign also we have one branch, sir. There in the foreign country transactions we got DTA. Indian company transactions DTL. Can I set off both? No, cannot. They may ask a question on this. DTA, DTL will be set off only when they arise from same tax laws. Same tax laws. That's it. Now special cases. Two special cases are there. I will discuss them. One is tax holiday. Important. Listen to me. They may ask this. Tax holiday. Sir, what is tax holiday? You know, in income tax there is a concept called tax holiday. 10A, 10B, 80IA. Tax holiday means what? For some period of time government will say no tax. Hello? For some period of time there is no tax liability to you. So that is called tax holiday. See, if at all there is a tax liability, tax holiday, sir, what we need to do? Suppose for example, there is a company, sir. For you, first 10 years there is no tax liability. Government income tax says there is no tax liability for first 10 years. Now standard says any timing difference which originates and reverses within the tax holiday period, ignore. Any timing difference originates, reverses within the tax holiday period, ignore. Don't recognize DTA or DTL. Why? First 10 years no tax here. When there is no tax, why to recognize? So whatever the timing difference originates, for example 100 lakhs timing difference, Out of these 100 lakhs, 60 lakhs was reversed in the next 9 years. Therefore, this 60 lakhs ignore, don't recognize DTA or DTL. Now, any timing difference which originates in the tax holiday period, but reversal will happen after tax holiday period, then on that you need to recognize DTA or DTL. For example, 100 lakhs timing difference came between accounting income and taxable income in the first year. Out of these 100 lakhs, 60 lakhs was reversed, ignore. Remaining 40 lakhs is there now. When it is going to reverse? After tax holiday period. Sir, this year there is a difference between accounting income and taxable income, 100 lakhs. Out of this 100 lakhs, in the next 9 years tax holiday period, suppose 60 lakhs reversed, ignore it. That means what is the balance? 40. On that 40 you recognize DTA or DTL in the year of origination. In the year of origination. So that is what tax holiday concept is. So only two principles you need to remember. What are those? Tell me. Any timing difference originates, reverses. In the tax holiday period, ignore. Any reverses, any timing difference originates but reverses after tax holiday period. What you need to do? Recognize. Recognize DTA or DTL. Hello? Suppose this question you see. Scenario based question 6. Y Limited is a company, sir, is a full tax free enterprise. Tax free enterprise means tax holiday. For the first 10 years of its existence. So first 10 years tax holiday given, sir. And in the second year of its operations. Now depreciation timing difference is there. Directly given. How much is there? 200 lakhs. And INR 400 lakhs respectively, which will result in a tax liability for year 1 and 2. So there is a timing difference of 200 lakhs in the first year, 400 lakhs in the second year. From the third year, it is expected that timing difference would reverse each year by how much? 10 lakhs. Now you tell me, come on, simple. First year, what is the timing difference? 200. Reversal will happening from third year. How much reverses? 10. Third year 10, fourth 10, fifth 10, sixth 10, like that 10 years. Correct? That means 8 into 10. How much? 80 lakhs. So 80 lakhs reverses. So first year, whatever the timing difference originated 200, on that 80 lakhs is reversing within the tax holiday period. Ignore that 80 lakhs. So from this 200, if I reduce 80, what is the balance? 120. This 120 will reverse after tax holiday period. On that you recognize deferred tax asset or liability. You need to in which year? In the first year itself. In the first year itself. Because first year difference is 200. In this 200, how much is reversed? 80. Remaining balance 120 you recognize. Second year, how was the timing difference? 400. Entire 400 will reverse after tax holiday period. Therefore, on that 400 also you recognize deferred tax liability or asset. Hello? See this tax rate how much? 40%. Find out the deferred tax liability they are asking for the end of the second year and any charge to P&L account. Very simple pa. See this. See this. Out of 200 lakhs timing difference due to depreciation, difference of 80 lakhs will reverse in the tax holiday period and therefore should not be recognized. However, 120 lakhs deferred tax liability will be recognized for 48 lakhs. How much? 48 lakhs. How much came? How 120 into 40% in the first year. In the second year, the entire amount of timing difference 400 lakhs will reverse only after tax holiday period. Hence the recognition in full. So deferred tax liability amount into 40% of 400, 160 lakhs will be created by charging to P&L account. Therefore, the total balance of deferred tax liability at the end of the second year is how much? First year balance 48, second year 160. Total 208 will be recognized. Hello? So any timing difference which originates, reverses. Both happen within the tax holiday period, ignore. Any difference originates but reverses after tax holiday period, recognize. In the year of origination. And here you need to follow FIFO. First in, first out. Whatever the difference originates first, assumed reversal first. That means here the first difference came 200. Only that will be reversed. You cannot assume second year I will assume, sir. No. On this 280 reversed. On this 280 reversed. Remaining balance you need to recognize deferred tax asset or liability. So this is a tax holiday concept, sir. Very simple concept I explained. Now next there is one more concept, sir. MAT. Not mad, sir. Mad. Not mad. MAD. It is MAT. MAT. You know MAT? Minimum alternate tax. You know, this is also called as what? AMT, right? In some places. Alternate minimum tax. Listen. You know AMT or MAT. In income tax, we calculate tax liability as per the regular tax rates. One tax liability will get. We will compare with AMT, right? We also calculate tax liability as per AMT. Okay, MAT. Whichever is higher, we will pay. Correct? As per MAT, if it is 1 lakh, as per regular, it is only 80. How much I need to pay? 1 lakh I need to pay. Now, my question is, if any year you are paying tax liability as per MAT, because MAT tax liability is more than regular tax rate, will deferred tax will also be calculated based on MAT rates? Because MAT rate is different from normal rates. Suppose in any particular year, your tax liability is more than MAT. That means you need to pay tax to the government on basis of MAT, current tax. Whether deferred tax is also calculated based on MAT rate? The answer is no. The standard says no, never. Deferred tax is always calculated on regular tax rates, no MAT rate. No MAT rate. No MAT rates. Okay. So DTL and DTS for timing difference must be measured using which rates? Regular tax, not 115 JB rates. Please understand, sir. And relating to this, one question is there, sir. This is important question. They have tested already, I think, this question, this type of question. I will solve that question. See this illustration number 2. See this question, everybody. Illustration number 2. From the following details of A Limited for the year ending 31st March 2011, calculate what? Deferred tax asset or liability as per AS 22 and the amount of tax to be debited to P&L. Can you tell me how much amount of tax we need to debit to P&L account? Tax expenses are two parts. What are those? Current, deferred. So how much amount I need to debit? I need to know current tax, deferred tax. Both I need to know. Correct? Accounting profit, how much given? What is this accounting profit? Net profit as per P&L. Book profit as per MAT means minimum alternate tax. Book profit we will calculate there. That one given. Profit as per income tax. This is regular. In income tax, regular tax rates. Tax rate 20, regular tax rate. MAT rate 7.5. Now you first you see. I calculate current tax first. Current tax. Can you tell me how to calculate current tax? Simple. What is my profit as per income tax? 60,000 into 20%. Normal tax rate apply. How much? 12,000. This is as per normal, regular, correct? See MAT also once. MAT. In MAT you take book profit. What is book profit? 3,50,000. MAT rate 7.5. How much? 26,250. Which one you pay? 26,250. Sir, I will pay 12. Income tax they won't allow. They say whichever is higher. 26,250 pay. So this is your current tax. So what is current tax? So one component we got 26,250. This is called current tax. Now I want deferred tax. Hello? Deferred tax means what? Tax on timing differences between accounting income and taxable income. What is my accounting income? 6 lakhs. What is my taxable income? Is it 3,50,000 or 60,000? Can I consider as per MAT, as per profit, as per normal income tax? Normal. Always. Don't compare with this one. Hello? So tell me, 60,000 my accounting profit, as per income tax 60. 6 lakh 60. So difference is how much? 5,40,000. On this 5,40,000, which rate I will apply? Normal rate. What is the normal rate? 20. Apply 20. 1 lakh. That's it. This is my deferred tax. Important the difference between accounting and profit as per income tax. Don't consider MAT. Even though this year my current tax liability came as per MAT, when it comes to deferred tax, don't take MAT. Rate we should not take. Income also we should not take as per MAT. So as per normal book profit 6 lakhs, as per income tax 60. So 6 lakhs 60,000, how much is difference? 5,40,000. 20%, 1,08,000. Is it deferred tax asset or liability? Asset or liability? Asset or liability? I think, see, you are paying tax on 60,000. Your accounting income is 6 lakhs. So it's a deferred tax liability. DTL. So 1,08,000 DT deferred tax. Current tax 26,250. Total 26,250 plus 1,08,000. 1,34,250. This is the total expenses which is debited to P&L account. See this. 1,34,250. See, you follow what I am teaching, because here some hard way they present it, but this is a simple way. Simple way explained. So how much will be debited to P&L? 1,34,250. That's it, pa. This is AS 22. Over AS 22. So AS 22, the only important concept is what? Deferred tax concept. What is deferred tax? You understood? Huh? What is deferred tax? Can you tell me? Tax effect on timing difference. What is timing difference? Difference between accounting and taxable, which originates and reverses in future features, and which originates but will not reverse. Permanent difference. Ignore. Don't calculate. Correct? And deferred tax asset. If already there is unabsorbed depreciation losses in your company, then you recognize DTA only virtual certainty. Virtual certainty. In other cases, reasonable certainty. Reasonable certainty, past records will judge. Virtual certainty, 100% pakka, strong evidence. And current tax is recognized based on normal tax rates. I mean, current tax, applicable tax rates. Deferred tax, enacted or substantively enacted rates. I told na, if nothing gives, whatever the rates available we'll take. But if enacted, substantively enacted rate gives na, that we will take it. Okay, sir. The next standard we are going to cover is Accounting Standard 10, Property, Plant, Equipment, sir. So this standard, first we need to understand what is the definition of PPE, sir. Then objective of the standard, scope of the standard, and when to recognize PPE, the recognition criteria. Initially, PPE will be recognized in the books, how it will be measured, at what value initially PPE will be measured. Subsequent measurement on balance sheet date, at what value PPE will be shown. Depreciation topic, there is one concept called component accounting, and then derecognition concept. These are the things we are going to cover in this standard, sir. Property, plant, equipment. Okay. So let us start the standard, sir. First of all, what is PPE? PPE means tangible items, which is held for sale, held for use in production or supply of goods or services, or for rental to others, or for administrative purposes. And condition number 2, which is expected to be used during more than one period, 1 year. So in order to become PPE, 2 conditions, sir. First of all, PPE is basically what, sir? Tangible item, which is held for. Why the organization is holding them? For use either in production, like plant and machinery, factory, like this. Supply of goods. For example, we have delivery vans, trucks for supply of goods. Services, if you are a service provider, anything, any asset you are using for providing services, or rental to others. Suppose, for example, I have a building. My main object is to get rental income. Or for example, we purchased any asset for earning rental income. So that is also okay. Administrative purposes. Administrative purposes means the scope is so wider. Administrative purpose includes selling and distribution, financing and accounting, personnel and other functions of the enterprise. For selling and distribution of goods, we purchased some assets. And for example, finance and accounting. In finance department, accounts department, computers we purchased, scanners we purchased, printers we purchased, equipment we purchased, all these things. Personnel, I mean like employees. For example, for transportation of employees, we purchased a bus. That is also covered under administrative purpose. So here the word administrative purpose scope is so big, sir. It includes selling and distribution, financing and accounting, personnel, and all other functions of the enterprise. So any PPE, any tangible asset you held for either in production use or services or rental to others, or your object is to use it for administrative purposes. And the most important thing is it is to be used for more than one period. Suppose, sir, even spare parts, standby equipment also covered under PPE if they meet the definition of PPE. If this definition they satisfy, na, sir, then even spare parts, standby equipment also covered under Accounting Standard 10. Now what is the object of AS10? To provide the accounting treatment for PPE. Okay. Scope of the standard is very, very important, sir. Sir, the standard says the standard is applicable for all kinds of PPE except those PPEs for which the accounting treatment is provided in other standards. For that, we are not applicable. If there is any other specific standard, we need to follow that. For example, leases. Just now we have seen. If any asset acquired on lease basis, if the lease is finance lease, at what value the asset will be recognized? Fair value or present value of MLP, whichever is lower. That is prescribed in which standard? AS 19. So therefore follow AS 19. Okay. And AS 10 is not applicable to, important, listen to me. Sir, the standard says AS 10 is not applicable to biological assets. Any biological assets are there. Other than bearer plants related to agriculture activity, the standard is not applicable. And any wasting assets like any mineral rights, expenditure on exploration and extraction of minerals, natural gas and similar non-regenerative resources. That means any rights relating to intangible assets. Any rights relating to intangible assets, the standard is not applicable. So first one is what, sir? Biological assets. The standard is not applicable. Biological assets relating to which activity? Agriculture activity. The standard is not applicable. But here, if you see carefully, they are saying other than bearer plant. That means for bearer plant, the standard is applicable. First of all, what is this biological assets? See this. The standard says biological assets means living animals and plants. Living animals, plant, or biological assets. Now, what is bearer plant, sir? Because they said biological assets other than bearer plant related to agriculture activity, the standard is not applicable. That means the standard is applicable to bearer plant. When a plant is called bearer plant, three conditions are there. If all three conditions are satisfied, then that plant is bearer plant and AS 10 is applicable for that bearer plant. It is also treated as PP. AS 10 is applicable. What are the three conditions, sir? First, that plant must be used in production or supply of agriculture produce. That plant must give agriculture produce. Second, it is expected to bear produce for more than 12 months. It should give us, or we are expecting that it is going to give produce for more than 12 months. And has a remote likelihood of being sold as an agriculture produce. Remote means very rare chances that it is sold as an agriculture produce, except for incidental scrap sales. That means that plant is not meant for sale. Except for incidental scrap sales means once the life is over, we can cut down and we can sell it. That's okay. But in general, that plant is not meant for sale. Okay. Then if these three conditions are satisfied, that plant is called bearer plant. So it must give produce, expected to bear produce for more than 12 months, remote likelihood of being sold as an agriculture produce. Best example is what? Mango tree, for example. You take mango tree. Is it giving agriculture produce? Yes, mangoes. It is expected to bear produce for more than 12 months. Yes, mango tree will give produce more than 12 months. Third, is it mango tree is grown for its wood or for its mangoes? Mangoes. That means there is a remote likelihood of being sold as an agriculture produce, except for incidental scrap sales. That means once the life is over, companies or farmer, whoever having these plants, they will cut down and they will sell. That's okay. But in general, these plants will not be grown for their wood. For example, there is a teak wood, teak tree. Teak tree is exclusively grown for its wood. Therefore, it will not a bearer plant. So, to become a bearer plant, it must give agriculture produce. That produce will be given for more than 12 months and it is not sold as an agriculture produce. The plant itself cannot be sold as an agriculture produce. Another example would be coconut tree. Coconut tree will give agriculture produce. Coconuts, more than 12 months it will give. Yes. Whether coconut tree will be cut down and sold as a scrap? No. Generally, it is grown for its coconuts. Right? So, these kind of plants are what? Bearer plants. Like tea plants, coffee plants, these are all bearer plants only. Because they will satisfy the definition of bearer plant. Now, you need to understand, sir. Biological assets means living animals and plants. Plant includes bearer plant. But for bearer plant, the standard is applicable. So that means if any company is having this bearer plant, treat them as PPE and apply this standard. But they must be related to which activity? Agriculture activity. And now, which are not bearer plants? For example, any tree is grown for use as lumber. Lumber means wood. Any tree exclusively grown for its wood, like teak tree, is not a bearer plant. Because the tree itself is cut down and sold. Any tree exclusively grown for their lumber and as well as their fruit. Sir, some trees will give you both fruit, lumber, wood. So these trees are grown for their wood and fruit. They will be cut down, fruits will be taken and sold as a wood. So they are also not a bearer plants. And also annual crops. Annual crops. Annual crops means this paddy, maize, wheat, annual. Every year they will give 1 year, less than 1 year crops will be there, na? They will be. They are also not a bearer plants. So 3 plants are not a bearer plants. You understand? So tell me, what are the exceptions to AS10? AS10 is not applicable to biological assets. But exception, bearer plant. Bearer plant, this standard is applicable. When a tree is called bearer plant, it must give agriculture produce more than 12 months. Remote likelihood of being sold as agriculture produce. That means it is not grown for its wood generally. 3 exceptions is what? Any tree grown for wood, not a bearer plant. Any tree grown for its wood and fruit, and annual crops like paddy, wheat, maize, they are not bearer plants. Next, recognition criteria. Sir, when PPA will be recognized in the books? 2 conditions: probable future economic benefits and cost is measured reliably. Probable future economic benefits, we must expect some probable future economic benefits, and the cost is measured reliably. Then only we will recognize this. PP will be recognized in the books. Hello? Now see this illustration number 1. Suppose there is an entity who is having a supermarket chain. Now it is renovating one of its major stores, sir. They are doing renovation. Because of renovation, they will get more space, sir. So what they will do is they can store promotion outlets after the renovation, and it will include a restaurant also. Management is preparing budget for the year and after the stores reopens, which include cost of remodeling and expectation of 15% increase in the sales resulting from the store renovation. Sorry, after renovation their sales will increase 15%. Now which will attract the new customers. State whether the remodeling cost will be capitalized. So there is a store, sir, they are doing remodeling. Because of the remodel, after renovation and remodeling, the sales will increase 15%. Now tell me whether that remodeling cost will you capitalize? Will you treat it as PPE? Will you add to the building cost or not? The answer is yes. Because the standard says what? Probable future economic benefits, cost is measured reliably. Here what is the probable future economic benefits, sir? Sales increases by 15%. Therefore, we will capitalize it. We will recognize it. Next. Sir, measurement of PPE. This is very, very important, sir. Questions generally will come from this only. Measurement of PPE. Listen. First, at recognition, initially, first time when you want to recognize PPE, you purchased PPE or different ways. PPE you want to recognize in the books. Initially, you follow cost model. Balance sheet date, you follow cost or revaluation model. You have 2 options. At what value the asset will be carried in balance sheet? Either cost model, revaluation model. But initially when you want to recognize, cost model. See this. Initial recognition. The standard says initially you need to recognize PPE at its cost. For example, you purchased a PPE. You purchased a PPE. You need to find out the cost of PPE. At that value, you need to recognize the PPE. And the standard says the cost of PPE. 3 types of cost are included. First is purchase price. First is purchase price. See this. Purchase price is the first type of the cost. See this, purchase price. So when you purchase any asset, sir, whatever the taxes you are paying, non-refundable duties and taxes, you add. Any other expenses you incur. For example, you purchase an asset, machinery. Whatever the transportation cost, insurance cost, loading, unloading cost, whatever the expenses you incurred at the time of purchase, add everything. Minus any trade discount rebate given by the supplier, deduct. You will get the purchase price. This is the first component of the cost of PPE. Okay. Next, any directly attributable cost. Any directly attributable cost. So here I have given purchase price means import duties, non-refundable duties, non-refundable purchase taxes, trade discount and rebates must be deducted. Now directly attributable cost is the second part of the PPE, cost of PPE. So the standard says what is directly attributable cost? Directly attributable cost means the cost which is incurred to bring the PPE to its present location and condition. Whatever the cost incurred by the management to bring the PPE to its present location and condition. Necessary for it to be operate as intended by management. to bring this PP to the manner as intended by management. What are all the expenses we are incurring to bring this PP to its present location and condition, capable of operating in the manner intended by management? All these expenses are directly attributable cost. See this, these are the costs which we incurred to bring the PP to its location and condition necessary for it to be capable of operating as intended by management. So guys, important, directly attributable cost like employee benefits, directly linked to the construction or acquisition. For example, you are acquiring an asset, you used some of your labor, whatever the salaries you are paying to them, which is directly related to acquisition of asset, capitalize. Suppose for example you are making own construction, in your own construction you are using your own labor, the salaries you paid to them for construction, that will also be directly attributable cost, we need to add. Similarly, any site preparation cost, for example you purchased a machinery, you are installing, so you make the site ready, so site preparation cost. Delivery and handling cost, installation and assembly cost. The most important thing is testing cost. Testing cost means trial run. Even trial run cost is also directly attributable cost. But in case of trial run, the important point is you do the trial run, your samples are produced na? First these samples, whatever the amount generated from sale of samples will be deducted, only remaining amount will be added to the cost of the PPE. See this, after deducting proceeds from selling assets and also professional fees. Suppose if you appoint any professional for acquisition of a machinery, the professional fees, the brokerage, the commission you pay will be added. But you need to remember, standard says there are some cost, any cost you should not include. You should not include some cost. What are the costs, sir? Simple. Opening cost, like inauguration cost, cost of opening a new facility or business, such as inauguration cost. Suppose inauguration cost you incurred, you done some puja, some ceremony you done. For example, you are opening one plant and machinery, for that some puja expenses, inauguration expenses done, don't include them. And also cost of introducing a new product or service, including cost of advertising, promotional activities. You are launching a new product, advertisement expenses, promotion expenses don't include as a part of cost of PPE. Next, cost of conducting business in new location with a new class of customers, including staff training. Any cost you incurred for conducting the business in new location, like shifting, transfer from one location to another location, giving training to employees, these costs you should not include. You should not include. Administration and other general overheads you should not include. So here also you can see this. Any and also initial operating losses, any losses initially you will get, don't capitalize them. And also relocation, reorganization cost of operations. Relocation should not include. Relocation, for example, you shifted from one premises to another premises, the relocation expenses will be there now, don't include. And also reorganization cost, and also cost incurred before the asset is fully operational or running at full capacity. For example, the asset is running at full capacity. Once the asset is ready, after that whatever the expenses incurred, it should not be capitalized. Guys, you need to understand, guys, training, see this, advertisement cost, promotion cost, inauguration cost, staff training cost, relocation cost, reorganization cost, administration and general overhead cost, these costs not to be included in the cost of PPE. See this question, entity has an existing freehold factory property. They have one factory, sir, which intends to knock down and redevelop. They want to completely knock down and they want to redevelop the factory. During the redevelopment period, the company moved its production facilities to temporary site. Following incremental costs were incurred. Tell me, setup cost, how much incurred? 5 lakhs to install the machinery in the new location. Will it be included? No. Rent? No. Next, removal cost? No. To transport the machinery from old location to new temporary location? No. Can these costs be capitalized into the cost of new building? No. Just now I told, any relocation cost, reorganization cost should not be included, should not be treated as cost of PPE. The cost to be incurred by the company are in the nature of cost of relocating, reorganizing operations of the company and do not meet the definition requirement of AS 10, therefore cannot be capitalized. Okay. And now one more important point, sir. Sir, for example, there is a site, sir, vacant site is there, vacant site. In that vacant site, we want to construct a building. Okay. Meanwhile, it was vacant, so we have given it for parking. So from some parking rent amount is coming. Whether this rent can I deduct from the cost of the asset? The building which I am going to construct now. From that cost, can I reduce this parking amount? Before construction, there is a vacant land. That vacant land I have given for rent purpose. From the rent, whatever I am receiving, can I adjust to the cost of the asset? The answer is no, you cannot. See this. If you earned any income during development of PP, if that income is not directly related to the asset, like car parking rental income, so recognize this as an income. Don't adjust to the cost of the asset. Suppose there is a directly attributable income. Like for example, there is a site, sir. In this site there is a factory. Now this factory we want to remove, and in this place we want to construct a new factory. Now we demolished this and we got some scrap. This scrap was sold. We got 5 lakh rupees. Whether this 5 lakh rupees can I capitalize, can I reduce from the cost of the new factory I am going to? Yes, because this is directly attributable income. Example, sale of scrap material on demolition in case of redevelopment. So existing asset I need to demolish and I need to redevelop another asset. Now from the scrap of the demolition of the existing asset, whatever the income generated, that will be adjusted to the cost of the asset, sir. Hello. So the cost of PP, 3 types of cost I told. What is the first one? Purchase price. Second one, directly attributable cost. What is directly attributable cost? Any cost which we incur to bring the PP to its present location and condition as intended by management. Site preparation cost, employee benefits who are directly involved in the acquisition, construction. Next, loading, unloading. What is that? These costs are delivery, installation, assembly, testing cost to professional fees. Which cost should not be included? Inauguration cost, advertisement cost, promotion cost, relocation cost, reorganization cost. These things, and any asset is already running at full capacity. After that, if you incur any expenses, no, you should not include them. And also when it comes to income, if you are redeveloping any asset, any directly attributable income relating to the redevelopment can be deducted from the cost. Otherwise, it should be charged to P&L account, treated as income. Car rental example I have given. What is the third type of cost, sir? Decommissioning cost. What is decommissioning, restoration and similar liabilities? This is important, sir. Sir, decommissioning, restoration, similar liabilities means, suppose you have installed an asset in a leased premises. Suppose there is a premises. This premises you have taken for lease. In this premises you have built plant and machinery. And the lease is for 10 years. Now as per the lease agreement, sir, once 10 years is over, I need to remove this plant and machinery from this place and I need to restore the land as it is. For that some cost is going to be incurred now. In order to remove this plant and machinery from this place and restore the land as it is, I need to incur some cost. When I am going to incur this cost? After 10 years. Therefore what company will do now? This is for this amount. For example, they are expecting that we are going to incur 20 lakhs. For this 20 lakhs we need to create a provision and we need to capitalize to the asset. This is called decommissioning, restoration and similar liabilities. So decommissioning, restoration means any cost which we incurred to remove the asset or restore the land as it is after its removal. Those costs are decommissioning, restoration cost. The standard says this decommissioning, restoration cost will also be included as a cost of PP. But the one important thing is this decommissioning, restoration cost you need to convert into the present value. You need to convert into the present value and then add. So what is the entry here? PP to provision for decommissioning. PP to provision for decommissioning. PP account debit to provision for decommissioning. Why present value we need to take? Because I am deciding the cost today. This amount is going to pay after 10 years. Therefore only the present value is relevant for capitalization. Hello. So therefore this 20 lakhs is after 20 years. After 10 years. So I need to convert this 20 lakhs into present value. Okay. Next, cost of self-constructed asset. Sir, sometimes we will construct asset on our own. Hello? Sometimes we will construct the asset on our own. Self-construction. When you make any self-construction, sir, how to determine the cost? When you make self-construction, how to determine the cost, sir? 1 minute. Sir, when you make self-construction, how to determine the cost of asset, sir? Self-construction means on our own you are constructing the asset. So what material cost? See this, whatever the material cost, labor cost, variable overheads, fixed overheads, any directly attributable cost, decommissioning, restoration cost, everything will be added. You will get the cost of PP. When you construct your own building, for example, factory building, whatever the cost you are incurring now, everything will be added. Till now, whatever the discussion we had made, directly attributable cost to purchase price, all these things, same manner only. But important point is 3 points you need to remember. Whenever you are determining the cost of self-constructed asset, 3 points you need to remember. First point is internal profit should be eliminated. What is that? Internal profit should be eliminated. What is this internal profit, sir? Simple. For example, division A is constructing plant and machinery. Now division B is a cement division. They are supplied cement, 500 bags they supplied. The cost per bag is 800, sir. And right now in the market it can be sold at 1000. For example, sir, division B send 500 bags at 1000 rupees each. That means 500 into 1000, how much, sir? 5 lakhs cost, cement cost. So I added this 5 lakhs to plant and machinery. Correct? Because I am making a construction. Now the question is, in this 5 lakhs there is a profit of how much? 1 lakh profit, because the cost is 800, the sale price is 1000. So therefore 1 lakh profit is there. Now this profit is which profit? Internal profit, because you are both are same company. So therefore this asset is for the organization. So whatever the internal profit is there in this 5 lakhs, 1 lakh should be eliminated. So when you are making a self construction, internal profit should be eliminated. Second point, as per AS2, inventory cost should not include abnormal wastage. I told you, any abnormal wastage of material, labor, overheads, same thing they are saying. In self-construction, any abnormal loss may occur. Abnormal wastage of materials, labor, overheads, please don't include it. Because the reason is your inefficiency cannot become your asset. I told you, in AS2, same principle. Third, interest cost. Sir, whether interest cost will be capitalized? Answer is yes, subject to AS16. If AS16, borrowing cost, if the PP is a qualifying asset, capitalized. If PP is not a qualifying asset, then interest cost is charged to P&L account. So this is how the self-constructed asset will be determined. You understand this? So how the self-constructed asset cost will be decided? Same manner like purchased, self-acquired. Same manner like purchased asset. All cost will be added. Directly attributable cost, purchase cost, any material, labor, everything will be added. Only 3 points you need to remember. What are those? Internal profit you should not include. Second, abnormal wastage you should not consider. Third, interest. Interest when will you add? If it is a qualifying asset. If it is not a qualifying asset, don't add. Interest will be charged to P&L account. Next, PP acquired by exchange of assets. Sir, sometimes we will acquire PP by exchange of assets. Exchange. Now important, listen to me. When you acquire any PP by exchange of assets, sir, what we need to check is whether the transaction has commercial substance or not. We need to check whether the transaction has commercial substance or not. When PP acquired by, sir, PP acquired by exchange of assets. Sir, when any PP is acquired by exchange of asset, how the cost will be decided? You need to see whether the transaction has commercial substance or not. You need to see whether the transaction has commercial substance or there is no commercial substance. If there is a commercial substance, the standard says fair value of the asset given up. Whatever the asset you are giving up in exchange, the fair value of the asset given up, that is the first priority. That will be the cost of the newly acquired asset, PP. Second, if it is not available, fair value of the asset given up not available, fair value of the asset received, you take it. If that is also not available, carrying amount of the asset given up. Carrying amount of the asset given up. So these three. So tell me, when there is a commercial substance, so at what value the asset which is acquired by PP, exchange, will be recognized? Fair value of the asset given up. See, this is the first priority. If it is not available, fair value of the asset received. Third, WDV of the asset given up. WDV or carrying amount of the asset given up. Now the question is, what is commercial substance? What is commercial substance? Simple, sir. If my amount, risk, timing of cash flows are affected by the exchange, then I say there is a commercial substance. If my cash flows, the risk, the timing, the amount of cash flows are got affected by the exchange, then there is a commercial substance. If they are not affecting, there is no commercial substance. Okay, sir, when there is no commercial substance, then at what value the PP acquired will be recognized? Simple. In such cases, assets acquired will be measured at the WDV of the asset given up. Whatever the asset we are giving up, na sir, whatever the book value, WDV of that asset is there, na, that is the cost of the newly acquired PPE. Because when there is no commercial substance, no need to consider fair value. Just whatever the book value of the asset is there in the books, that value only carried for the newly acquired asset also. Hello? Now see, what is commercial substance? I will tell you. For example, sir, imagine your company is having one old truck, sir, old delivery truck. Now I am exchanging this with a new one, which is advanced GPS fuel efficient technology. Now you see, you compare nature first. Old truck generates inconsistent cash flows due to frequent breakdowns. New truck offers more reliable operational cash flows. Second, amount. Maintenance cost of the old truck is very high, reducing the cash inflows, while the new truck reduces the cost and increases the net cash inflows. Timing. The new truck delivers cash flow savings earlier due to reduced fuel and repair cost. So you see, if I exchange my old delivery van with the new one, obviously my maintenance cost will reduce, my fuel cost will reduce. Obviously, that means my cash flows are getting affected. That is called commercial substance. Commercial substance. So if I am exchanging the same assets, same type of assets, same nature assets, there is no commercial substance. That means if I exchange homogeneous same type of assets, there is no commercial substance. If I am exchanging heterogeneous assets, different assets, obviously there is a chance that my cash flows got affected. When my cash flows, that is the risk, timing, amount of cash flows are getting affected, then we say there is a commercial substance. When there is a commercial substance, the fair value of the asset given up, or the fair value of the asset received, or WDV of the asset given up. In this order, I need to recognize the asset acquired. You understood? Next, some special cases you see, sir. Determination of cost in special cases. Special cases means, for example, deferred payment beyond normal credit terms. Sometimes we will acquire a PPE by asking more credit period. When we ask more credit period, the supplier will charge extra amount. So anything we pay, the total payment minus the cash price. Right now, if I purchase the asset, what is the price? That is called cash price. What is the total payment I am making? The difference is treated as interest expenses. Okay, the difference is treated as interest expenses, and it will not be capitalized. It will not be capitalized. Sometimes, sir, PPE purchased at consolidated price. Consolidated means single price. With single price, if we purchase multiple assets, sir, this consolidated price will be apportioned between all the assets based on their fair values at acquisition date. For example, we purchased 10 assets. 10 assets we purchased for 100 lakhs. Now, how much cost will be allocated? Based on the fair values, this 10 lakhs, this whatever the cost 100 lakhs, you apportion. PP is held under finance lease. Any asset acquired under finance lease, how the cost will be determined? As per AS 19. And then government grant related PPA. You know, sometimes we will receive assets from the government grant in the form of government grant. You know, in that case, AS 12 is applicable. AS 12. If any asset is received free of cost, if we receive free of cost, we will recognize them at a nominal value. You remember AS 12 says. If you recognize if you receive any asset from government at a concessional price, then we will recognize at acquisition price. At whatever the price we acquired, we need to recognize at that value. Okay. Next. So that means we have completed the cost of PPs. Cost of PPs are completed. Now see this question, sir. Illustration number 3. Wait. Some questions we'll do, sir. Important questions. We completed the initial measurement of the cost of PPA. Yeah. Come to scenario based question 13. See this question. ABC Limited is installing a new plant at its production facility. It has incurred these costs. Cost of the plant. Cost per supplier invoice plus taxes. Definitely it will be taken. Initial delivery and handling cost, capitalize. Site preparation cost, capitalize. Consultant used for advice on the acquisition of plant, professional fees, add. Interest charge paid to supplier of plant for deferred credit, don't include. Just now I told, when you acquire any PP beyond deferred credit terms, beyond the normal credit terms, That means whatever the payment we make, we compare with cost price. Anything extra we paid is interest. Interest should not be included in PPE. Next, estimated dismantling cost to be incurred after 7 years. Dismantling cost, add. But we need to convert this into present value. But they have not given. Not given means ignore it. Just take whatever the value given. Operating losses before commercial production? No. Just now I told you. Any operating losses, initial operating losses, we should not include. Important pa. Any initial operating losses I told na, we should not include as a part of cost of PPE. So see this. So this is the answer. 43 lakhs. Correct? Ah. Next. See, come to question number 18. I think this question they have asked in examinations also. Question number 18. Yeah. Preet Limited intends to set up a steel plant for which it has acquired a dilapidated factor having an area of how much? 5,000 acres at a cost of 60,000 per acre. Okay. Preet Limited has incurred 1.1 crore on demolishing the old factory building. A sum of 63 lakhs including 5% GST was realized from the sale of materials salvaged from the site. Preet Limited incurred stamp duty registration charges of 7% of land value, paid legal and consultancy charges 8 lakhs for land acquisition and incurred 1,25,000 on the title guarantee insurance. Compute the value of the land. Sir, see this. First of all, land cost, purchase price how much, sir? 5,000 acres into 60. Correct? 3,000 crores. 5,000 acres, sir, into 60,000. Okay, 3,000. I think they are taking in lakhs. Yes, lakhs. Rupees in lakhs. 3,000 lakhs. Next. Preet Limited incurred 1.1 crores on what, sir? Demolition of the old factory. Will you add this 1.1 crore? Demolition of the old building. And see, from demolition we got some scrap. The sum of 63 lakhs was realized from the sale of material salvaged from the site. Now, but the 63 lakhs including GST. So therefore, 63 lakhs including GST. That means it is at 105. Correct? 100 plus 5% GST. So how much is the GST? 3 lakhs GST. You remove 3 lakhs. That means what is the scrap value without GST? 60. That 60 will be deducted from this 1.1 crore. Only remaining net demolition cost will be capitalized. See this, demolition expenses 50. Correct? 110 lakhs minus 60 lakhs only they considered. See this. So this is one thing. Next. And also stamp duty registration charges 7% of the land value. Land value 3,000 on that 7% apply. 210. Correct? And legal and consultancy charges capitalize. And title, see 1,25,000 on the title guarantee insurance will also be added. So total cost of the land 3269.25. That's it, sir. This is how you determine the cost of PPE, sir. This question, sir, I think question number 5. This is a very important question. Examination question. This question is there in the study material also. Srishti Limited contracted with a supplier to purchase machinery, which has to be installed in Department A in how much time? 3 months time. Special foundations were acquired for the machinery, which are to be prepared within the supply lead time. The cost of the site preparation, laying foundation is how much? 141,870. So site preparation cost will be capitalized. These activities are supervised by technician during the entire period, who is employed for this purpose 45,000 per month. So 45,000 into 3 months. How much, sir? 1,35,000. This is the employee benefits we pay, who is exclusively engaged in construction, acquisition. So this is also capitalized. The technician services are given by Department B to Department A, which billed services 49,500 per month after adding 10% gross margin. Hello. Sir, I told you here department B has provided services to department A. They are charging how much, sir? 49,500 per month. After adding how much? 10% profit margin. That means this 49,500 into 100 divided by 110. Correct? You will get the true cost. 45,000. So 45,000 only cost we need to consider. Okay. Because the technician who is supervising these activities is given by department B to department A. Anyway, we have considered only 45,000, right? This is including profit. But I told you internal profit should not be included. The mission was purchased at 1 crore 58 lakh 34,000 including IGST of 12% for which ITC is available. Sir, I told you any non-refundable taxes will be added. Refundable taxes will be deducted. But this 1 crore 58 34 already including 12% GST na. So therefore 1 crore 58 34 into 100 divided by 112. So suppose cost is 100, 12% GST, it is equal to 112. Make it for 100. It will be 1 crore 41 37 500 only we need to consider. 55,770 transportation charges add. Architect was appointed at a fees of 30,000 add. Ascertain the amount at which machinery should be capitalized. See this. This is the purchase price after reducing GST. Site supervision cost 141,870. Site supervision cost is there na, added. And technician salary important, we need to consider only for 45,000 for 3 months. Don't consider 49,500. Initial delivery cost 55,700. Transportation nothing but. Professional fees for installation 30. Architect fees. So total 1 crore 45 lakhs 140. Hello. That's it, sir. This is the question, sir. And the same question, sir, if you see question number 7, sir, actually same question. See this question number 7 also. They have tested this question in May 2025. The same question. Here also see they are first purchasing 250 acres at a cost of 25,000 per acre. Stamp duty, registration fees 5% of the land value. Legal fees 4,75,000. Incurred 37,85,000 for demolishing the old premises. A sum of 12,60,000 including 5% GST thereon realized from sale of materials salvaged from the site. Same question we solved na? Same. Here some extra information given, sir. The following increment cost will be incurred. The company needs to remove the present production facilities. For that, setup cost 7,50,000 they need to incur. Rent 12 lakhs. Removal cost 2,50,000 to transport the machinery from old location to new. Tell me, setup cost, rent, removal cost. Will you add in the cost of the new building? The answer is no, no, no. I told you. Hello? So all these costs we should not include. I told you. When you are shifting your premises to some other place, any relocation cost, any reorganization expenses, setup cost, they are not part of cost of PPE. Okay. So that means we have completed the cost initial measurement we have completed, sir. What is we completed, sir? Initial measurement. Now treatment of subsequent cost. Sir, once you recognize PPE, any subsequent expenses you incur. Like for example, there are some machineries. For these machineries, you are incurring regular day-to-day repairs and maintenance. Generally, they will be charged to P&L account as an expenses. Regular day-to-day repairs. First, any expenditure you incurred on the PPE which increases the life and efficiency of the asset, then capitalize. Beyond the previously assessed levels of performance, if because of the subsequent expenditure, if the capacity of the asset increases, the efficiency of the PPE increases, capitalize. And the most important is this one. Suppose, sir, you done any major repairs, major replacements, major inspections, major overhauling. Overhauling means complete examination. Generally for aircrafts, ships, they will do this. Complete overhauling examination. For that some cost will be incurred, sir. So how to deal with them? Major replacement. For example, there is a huge aircraft or there is a machinery. In that machinery, we replaced old part with new part. Then how to determine the cost? Simple. Take the WDV of the total asset. Old part is there now, old part which we are replacing. The WDV of the old part you deduct. Cost of the new part you add. you will get the revised WDV. So whenever you are replacing any part, WDV of the old part will be minus, cost of the new part will be added. Similarly, major inspection and overhauling cost also. Whatever the cost you are incurring, major inspection cost, major overhauling cost. So old WDV of the old part will be removed, cost of the new part will be added. You see question number 2, I think RTP November 2022 question. In this question there is a company RS Limited, sir. They have acquired a heavy plant, sir. What is the cost? 2 crores. Estimated useful life 10 years. At the end of year 2, one of the major components, that is boiler, has become obsolete, which was acquired at a price of 50 lakhs and requires replacement. A further maintenance is uneconomical. The remainder of the plant is perfect and it is expected to last for next 8 years. The cost of the new boiler is 60 lakhs. Can the cost of the new boiler be recognized as an asset, and if so, what should be the carrying value of the plant at the end of the second year? First of all, original cost of the plant, how much, sir? 2 crores. Correct? And now life is 10 years. They are asking at the end of the second year. First, to remove depreciation for first 2 years. 2 crores divided by 10 into 2. 40 lakhs depreciation will be deducted. So WDV at the end of the second year is 1.6 crores. Correct? Now, what is the cost of the new boiler you want to add? 60. Add. See this. Cost of the new boiler. Add. And the new boiler we are adding now, the old part. WDV of the old boiler we need to remove. This old part was acquired at what price? 50 lakhs. 2 years already over. Correct? So this 50 lakhs divided by 10 into 8. Now I want WDV, right? Correct. 50 lakhs at the original cost divided by 10. That means every year how much cost? 5 lakhs, right? 5 lakhs into 2, 10 lakhs. So WDV is 40 lakhs. So 40 lakhs. I remove 40 lakhs, I will add 60 lakhs. So therefore 1.8 crores is what's the revised carrying amount of the plant. So this is treatment of which cost? Subsequent cost. Subsequent cost. Now next. So till now in accounting standard 10, what we have covered? Initial measurement. Initially PP will be recognized at cost. Different cases. Self-acquired, self-construction I covered, exchange I covered. Relating to exchange also, we'll see some questions. 7, sir. Illustration 7, you see. Exchange of assets that lacks commercial substance. Suppose entity A exchanges a car X with a book value of 13 lakhs and a fair value of 13 lakh 25,000. Mr. Entity A exchanges car X with a book value 13 and a fair value of 13 lakh 25 for a cash of 15,000 and car Y, which has a fair value of 13 lakh 10,000. That means we are giving away what? Car X. What we are receiving? Car Y as well as cash. Cash is 15,000, car Y fair value 13 lakh 10. The transaction lacks commercial substance. So tell me, when there is no commercial substance, at what value assets received will be recognized? WDV of the asset given up. What is the WDV of the asset given up? 13 lakhs. So therefore, you see, this is the asset we are giving up. So in our books, car X will be de-recognized, credited 13 lakhs. And 15,000 cash we are receiving now. Cash or bank 15,000. The remaining balance will be the car Y value. Because you need to recognize that WDV of the asset given up. The WDV of the asset is 13 lakhs. So 13 lakhs is the value at which you need to recognize the assets. In that 15,000 fixed na cash. So remaining 12 lakh 85,000 I need to recognize. Hello? Yes, now come to measurement after initial recognition, sir. Okay. Initially you have recognized PPE at cost. Now you need to measure the PPE in the balance sheet. In the balance sheet. See, there are two methods, sir. There are two models. Okay. What are the two methods available for recognition of measurement of PPE after initial recognition? Cost model, revaluation model. In cost model, how the PPE will be measured, sir? Cost of PPE minus accumulated depreciation minus accumulated impairment loss. Till now, what is the total depreciation, total impairment loss? You deduct. You will get the carrying amount. that value will be shown in the balance sheet. Suppose there is a revaluation model. This is important model, revaluation model. In revaluation model, what we do? We will show the asset at its fair value. We will recognize the asset at its fair value. For example, there is an asset. The carrying amount is 10 lakhs. Fair value is 15 lakhs. So now we want to revalue the asset at 15 lakhs. So from now onwards, the asset value is how much? 15 lakhs. That means how much increase happened? 5 lakhs. This is called revaluation surplus. This will be transferred to revaluation surplus. So suppose if you are following revaluation model, na sir, first take the fair value of the PP, the value at which you have revalued the asset. After that, any subsequent accumulated depreciation, subsequent accumulated impairment loss. See, once you brought, suppose an asset 10 lakhs into 15 lakhs. This is the value now, 15 lakhs. On this, from now onwards, whatever the depreciation impairment loss came, that will be deducted. That's why subsequent accumulated depreciation, subsequent impairment loss. In cost model, initial cost minus accumulated minus impairment loss. But in revaluation model, we will start with what? Fair value. So once you done the revaluation at the fair value, that value, after that any subsequent depreciation impairment loss is there, you will be deducted. So basic idea is what? Recognize the assets at its fair value. Okay. Now sir, okay. No problem. Suppose I want to apply revaluation model. Can I apply selectively? So for example, our company has 5 buildings. Can I apply for 3 buildings cost model, 2 buildings for revaluation model? The standard says you need to apply revaluation model for entire class of PPE. Selective application is not allowed. So suppose revaluation model is applied for entire class of PPE. For example, if you have 5 office buildings, all 5 office buildings, if you want to apply revaluation model, you can apply. Same class of PPE should be applied. That means selective application of revaluation model is not allowed. Second, frequency of revaluation. Sir, how frequently I need to revalue the PPE? See, that depends upon the change in the fair value. If the changes in fair value is significant and volatile, fair value is fluctuating, every year it is changing, very significant and volatile changes in fair value, then every year you need to do revaluation, annual revaluation. Sometimes significant changes are there but not frequent. There is significant but they are not volatile. Significant, not frequent changes in fair value, then once in every 3 or 5 years is okay. And what is this fair value? The fair value is nothing but market based evidence. In market, this asset, what is the value available? That will be the fair value. Hello? Now, the important thing is account. So frequency of revaluation, I told you, no sir. How frequently we need to do the revaluation? If fair value changes significantly and volatile changes, annual. There are significant changes but not volatile, then every 3 to 5 years you can do revaluation. Now what is the accounting treatment for revaluation? This is important, listen to me carefully. Sir, the standard has given two techniques, sir. For accounting, there are 2 techniques. Listen to me carefully. 2 techniques for revaluation accounting. First technique, restatement approach. First technique is what? Restatement approach. Restatement approach. What is this restatement approach, sir? For example, PP is there. Before revaluation, the cost is 10 lakhs, sir. Accumulated depreciation on it, 5 lakhs. So net book value, 5 lakhs. Now, I want to do the revaluation. Fair value is 7 lakhs. So therefore, 5 lakhs asset must brought to 7. So what is the revaluation gain? 2 lakhs. Now this approach says, restatement approach says, when you are revaluing the net book value of the asset to fair value, proportionately cost and accumulated depreciation also increase. For example, see this. If 5 lakhs has become 7, 5 lakhs has become 7. So if my cost is 10, if my cost is 10 lakhs, net book value 5 lakhs na? Everybody. Suppose if my net book value or fair value is 7, what should be the cost? Proportionately you do. You understanding? Suppose net book value 5 sir, cost is 10 na? If it is 7, what should be the cost? So 10 lakhs into 7 divided by 5. 14 lakhs is the PPE after evaluation. Similarly, accumulated depreciation also. See this. For 5 lakhs net book value, 5 lakhs accumulated depreciation. For 7 lakhs, how much it is? 5 lakhs into 7 by 5. 7 lakhs. So therefore, your cost of the asset 14, your accumulated depreciation 7. 14 minus 7, 7. That is exactly the fair value of the asset. So what is the entry here? PPE account debit. How much? 4 lakhs. 2 accumulated depreciation. How much? 2 lakhs. Remaining will be revaluation gain. That's it. PPE 4 lakhs. Accumulated depreciation 2 lakhs. Revaluation gain 2 lakhs. Everybody, this is called restatement approach. This is called restatement approach. Very, very important. I think I explained very easily. So therefore, cost of the asset, accumulated depreciation, book value. Now, fair value. Proportionately, you increase cost and accumulated depreciation. If net book value is 5, cost is 10. If net book value is 7, if this fair value is 7, what will be the cost? 14. If 5 is the accumulated depreciation. If net book value is 7, what will be the accumulated depreciation? 7 lakhs, proportionately you increase. That means cost of the asset increased 10 to 14, 4 lakhs gain. So asset value. Accumulated depreciation has 5 to 7 depreciation, accumulated depreciation 2 lakhs. So it will be created. So therefore the net is revaluation gain of 2 lakhs. This is one approach, sir. Second technique is also there. What is the second technique? Elimination approach. What this technique says is, in elimination approach, whatever the accumulated depreciation is there, first you adjust this against the cost of the asset. So therefore the entry is accumulated depreciation to PPE. This entire accumulated depreciation is just adjusted to cost. Once you brought this cost, accumulated depreciation is adjusted with cost, then you compare with fair value. For example, see here, original cost of the asset 10, accumulated depreciation 5. After revaluation, this will become 0 because entire accumulated depreciation is adjusted against cost. So it is 0. Now the cost will become how much? Tell me. 5 lakhs reduced because of this, plus now I am doing revaluation. Because of the revaluation, how much added? 2 lakhs. So therefore 7 lakhs. So therefore the entry is, see this, first accumulated depreciation is adjusted against the cost of PPE. The entry is accumulated depreciation to PPE. Then adjust PPE to its fair value. That means PPE to revaluation gain. PPE to revaluation gain. So that means 2 entries. First accumulated depreciation is adjusted against the asset. The entry is accumulated depreciation to PPE 5. Then PPE will be brought to its fair value. PPE to revaluation gain. Revaluation gain 2 lakhs. So what is the net effect of both the methods? Same. Sir, net effect is same. Here in this method you see cost 14, accumulated depreciation 7, 7 lakhs is the carrying amount of the asset. Here also see cost 7, accumulated depreciation nil. So carrying amount of the asset is 7. So what is the difference between restatement approach and elimination approach? In restatement approach, cost to accumulated depreciation both were proportionately increased, corresponding with fair value. But in elimination approach, accumulated depreciation is completely adjusted, first adjusted, and then brought to fair value. Okay. Sir, what is the accounting treatment for revaluation? See this. See, when you do revaluation, sir, when you bring the asset to its fair value, either there can be upward, there can be downward revaluation. For example, upward revaluation, first time you are doing, that will be transferred to revaluation surplus or revaluation gain account. For example, PPE to revaluation surplus, 10 lakhs, increase. Suppose downward revaluation is there, downward. Asset value decreased. Whenever asset value is decreased because of the revaluation, loss will be transferred to P&L account, first time. Next, subsequent revaluation. First time upward, sir. Second time also upward. Same entry will be written. Upward means PPE to revaluation surplus. First time downward, sir. Second time also downward. Same entry. P&L to PPE. Now see, important. First time upward, sir. Second time downward. What we need to do is, second time, for example, asset value decreased by 15 lakhs. First time increase how much? 10 lakhs. That increase is transferred to revaluation surplus. So second time when there is a decrease, na sir, to the extent of this 10 lakhs adjust to revaluation surplus. Remaining excess loss will be transferred to P&L account. So therefore revaluation surplus P&L to PP. First time downward, second time upward, sir. Second time when there is an upward, suppose 15 lakhs increase. First whatever the amount you transfer to P&L account, na, first that will be adjusted. See this, P&L account previously debited to 10. Now to the extent debited 10 earlier, it is created. Remaining will be transferred to revaluation surplus. Hello? Now, one interesting point I will tell you, sir. This revaluation surplus arised, na? Why revaluation surplus arising? Because you are valuing the asset at its fair value. Now, whenever you sell the PP, that asset is sold, the revaluation surplus will also be closed, transferred. Where it will be transferred? It will be transferred to retained earnings, revenue reserves, not to P&L account. Important. Sir, whenever an asset which is revalued earlier, so there may be revaluation surplus. That revaluation surplus, when that asset is sold, transfer it to retained earnings. That means revenue reserve, not to P&L account. Simple. Sometimes, sir, you sold only part of the asset. For example, there is a PP, property, plant, equipment is there. It was revalued. Now in that PP, part of the PP you are selling, na, part of the revaluation surplus will be transferred to retained earnings. How much part I will transfer? The standard says is this. If part of the PP is sold, depreciation based on revalued amount is how much? Depreciation based on original cost. Suppose if there is no revaluation, what is the depreciation on original cost? Take it. What is the depreciation on revalued amount? The difference only will be transferred from revaluation surplus to retained earnings. This is the important point. Whenever any asset is sold, in respect of which there is a revaluation surplus, if that asset is completely sold, that revaluation surplus will be transferred to revenue reserve. Suppose only part of the asset is sold, then you need to transfer only part of the revaluation surplus to retained earnings. How much is that part? Simple. You calculate depreciation based on the revalued amount. Without revaluation, what is the depreciation? Suppose if there is no revaluation, what is the depreciation? 7. Because of the revaluation, what is the depreciation? 10. Generally, sir, because of the revaluation, depreciation will increase. So whatever the increase is there, na, sir, to that extent I need to transfer from revaluation surplus to retained earnings. This is the important point. So we have completed the subsequent measurement also. We have completed subsequent measurement. So these are all the points I claimed. And the last concept is remaining. What is that? Depreciation. So depreciation of the asset. See this. First of all, when to commence depreciation? When the asset is available for use. When the asset is available for use. Important, sir. Depreciation begins when the asset is available for use. That is, when the asset is in the location and condition necessary for it capable of operating in the manner intended by management, you start depreciation. Not when the asset is actually started using. The moment the asset is ready for use, you can provide depreciation. Next, when to stop depreciation? When to stop? The standard says when the asset is classified as held for sale or when the asset is derecognized, whichever comes earlier. That is the point you need to stop providing depreciation. When the asset is classified as held for sale, that means when the asset is, you don't want to use it, you held it for sale, you want to sell it, you want to sell that asset, dispose that, or the asset is derecognized from the books. Suppose that asset is derecognized from the books, whichever comes earlier, that is the starting point. For example, the asset is held for sale on 1st January 2024. Asset was derecognized on 31st March 2024. Now tell me, when will you stop providing depreciation? 1st January onwards you stop providing depreciation because the asset is held for sale. Important, sir. The moment the asset is held for sale, you please stop providing depreciation. And next, depreciation method. Sir, which method I need to follow? Standard saying depreciation method should reflect the pattern in which the economic benefits are generated from the PP. Sir, that asset is generating economic benefits. What is the pattern of those economic benefits? Based on that, you need to select the method. For example, if the asset is constantly giving same benefits, straight line method. If the asset is giving initially high benefits, later on gradually decreasing, WDV method. So therefore, the method selection is depending upon, it should reflect the pattern in which the asset's future economic benefits are consumed by the entity. You can follow straight line method, WDV method, units of production method. Whichever method you want to follow, you follow. But that method should reflect the benefits I am receiving from that particular asset. These wordings are very, very important. They should reflect the pattern in which the asset's future economic benefits are consumed by the entity. And sir, whenever you change any depreciation method, what is that? Change in depreciation method is change in accounting estimate. And you need to do which accounting? Prospective, not retrospective accounting. Only prospective accounting you need to do. Next, retirement concept. What is retirement? I told you just now. When the asset is held for sale, see this, items of PP retired from active use and held for disposal. See this. For example, there is a plant and machinery, sir. That plant and machinery we don't want to use. Okay, just we put it in the godown. That means it is retired from active use and held for disposal. The moment you are hold any asset for sale, you are not using it for active use, the standard says you need to value that asset at a lower of the carrying amount, net realizable value. Compare the carrying amount of that asset and net realizable value. Whichever is lower, you need to show. For example, carrying amount is 1 lakh. NRV 80,000. So 20,000 loss you need to book, sir. This is 80,000, sir. So suppose the carrying amount of the asset is 1 lakh, sir. Net realizable value 80. So how much decreased, sir? 20. So that 20,000 you need to recognize as a loss. The standard says any write down will be recognized immediately in the statement of P&L. This when will you do? When the asset is retired from active use and held for disposal. The moment the asset is held for disposal, you stop providing depreciation also. I told you when to cease depreciation. When the asset is held for disposal or the asset is derecognized, whichever comes earlier. That means if the generally earlier event is what? When the asset is removed from the active use and held for disposal. That is only initial event will come. Okay, generally. Now derecognition. What is derecognition? When the asset is sold. You sold the asset. Or when asset is no longer generating future economic benefits. You derecognize it. When the asset is sold, derecognize. We will remove from the books. Or when the asset is no longer generating future economic benefits, then also derecognize. If any one of these things happens, then asset will be derecognized. Now, when you derecognize, you will get any gain or loss. Gain or loss. For example, you sell at the time of sale. If the sale value is more than carrying amount, gain. If the sale value is less than carrying amount, loss. Loss or gain will be recognized and transferred to P&L account. Sometimes you don't sell. You just scrap that, written off that asset. Entire carrying amount is a loss that will be transferred to P&L account. So net gain or loss is net disposal proceeds minus carrying amount of the item. So relating to depreciation, you need to remember, I think 4 points. What are those, sir? First point, when to commence depreciation. First of all, what is depreciation? Systematic recognition of loss of an asset. What is depreciable amount? Cost minus residual value. Correct? And when to start depreciation? When the asset is available for use, not actual usage. Asset is available for use. When to stop providing depreciation? When the asset is held for disposal or asset is derecognized. Whichever comes earlier. Whichever comes earlier. This is the second point you need to. Next, third method. Which method you need to select? The method should reflect the economic benefits generated by that asset. Fourth point, retirement. The moment the asset is retired from active use and held for disposal, the asset will be recognized at a carrying amount, net selling price, whichever is lower. Any gain or loss will be transferred to P&L account. And derecognition, when the asset is sold or when the asset no longer generating future economic benefits, you derecognize the asset from the books. Remove. At the time of removal, any gain or loss came, that will be transferred to P&L account. That's it. This is accounting standard 10, sir. Entire standard we have discussed it, sir. This question, sir, illustration 10, very good question, sir. Actually, this is important question actually. You see, entity A is a large manufacturing group, sir. It owns a number of industrial buildings. What are the buildings? Industrial. Such as factories, warehouse and office buildings in several capital cities. Industrial buildings are located in industrial zones, whereas office buildings are central business districts of the cities. Entities A management want to apply revaluation model as per AS 10 to the subsequent measurement of office buildings, but continue to apply historical cost model to the industrial building. State whether it is acceptable. Sir, revaluation model, I told you. Can I make selective application of revaluation model? I need to apply revaluation model for entire class of assets. Here, what are the assets? Buildings. Which buildings? Office buildings, industrial building. Both are same class or different class? Different class. That is the twist here. So industrial buildings are different from office buildings. Therefore, company want to follow what? Cost model to industrial buildings, revaluation model to entire office building, which is accepted. So company can do so. Suppose, for example, within the industrial buildings, for some industrial buildings, for some godowns, they want to follow cost model. For some godowns, they want to follow revaluation model. Is that allowed? No. So therefore, you need to understand the nature of the asset. Depending upon that, you need to decide which belongs to which class. Hello. Next. This question, sir, I think examination question this is. See this question, illustration 6. Gain on replacement of insured asset. This question they have asked once in examination. Entity A carried plant and machinery in its books at 2 lakhs. These were destroyed in fire. The assets were insured new for old and were replaced by the insurance company with the new machines that cost 20 lakhs. The mission was acquired by the insurance company and the company did not receive 20 lakhs as cash compensation. State how entity should account for the same. First, what happened? There is a plant and machinery. What is the cost book value of the plant and machinery? 2 lakhs. It was destroyed by fire. And we have insurance. Insurance is what? New for old. That means in place of old one, insurance company will give new machinery they will give. They won't give cash. Hello. So it was replaced by insurance company with new mission. What is the cost of the new mission? 20 lakhs. Mission was acquired by the insurance company and company did not receive 20 lakhs cash compensation. So tell me how you are going to do the accounting in this case. How you are going to do the accounting, sir, in this case? Hello? How you are going to do the accounting? Simple, sir. See this. So first, loss of accident. We have loss, na, sir. How much worth of asset lost? 2 lakhs. De-recognized from the books. So loss of plant and machinery by accident to plant and machinery. 2 lakhs, 2 lakhs. Next, you are going to receive insurance. Insurance claim. IC receivable. 20 lakhs. Loss of plant and machinery by accident. 2 lakhs. Gain on settlement. 18 lakhs. Your asset book value 2 lakhs. But you are receiving plant and machinery worth of 20. So therefore, insurance claim receivable 20 lakhs. Loss adjusted with this. So remaining is gain on settlement. Everybody. And finally, you need to record the new plant and machinery. Plant and machinery to insurance claim receivable 2020. So 3 entries, sir. First entry, loss. What is the entry? Loss by accident to plant and machinery 2. Next, insurance claim receivable. IC receivable to loss. Loss is adjusted against insurance claim. Balance is gain. And finally, you record the new asset which you received from insurance company. Plant and machinery to IC receivable. Insurance claim receivable. Settle. Correct? So this is one question they have asked in examination. Please check this question. Next, theory questions are there, sir. Here, please check all these questions. 13th done. 14th. 15th you see. 15th question. Skanda Limited acquired a machinery for 2 crores 50 lakhs for 5 years ago. Depreciation was charged at 10% on SLM basis. 5 years ago they acquired, sir. Useful life 10. At the beginning of year 3, see this. The machinery was revalued to 3 crores with the surplus on revaluation being credited to revaluation reserve. Depreciation was provided on the revalued amount over the balance life of 8 years. The machinery was sold in the current year for 1 crore 12 lakh 50. Give the accounting treatment for the above in the company books. What will be the treatment if the machinery is fetched only 42 lakh 50? First of all, you have to be very careful here. When I purchased the machinery 5 years back, how much is the cost? 2 crores 50 lakhs. So take the first cost. Second thing is, now I am at the beginning of year 3. That means 2 years already over. So on this 2.5 crores depreciation you calculate for 2 years. What is the depreciation amount? 10%. 2.5 crores into 10% means 25 lakhs for 2 years. That means 50 lakhs. So what is the WDV value? 2 crores at the end of second year. Correct? Now they have done the revaluation. What is the revaluation amount? 3 crores. Correct? So therefore asset will be brought to 3 crores. So there is a gain of how much? 1 crore. See this revaluation surplus 1 crore. Everybody, now what they are doing? Depreciation was provided on the revalued amount over the balance useful life of 8 years. Correct. The revalued amount is 3 crores, right? So 3 crores divided by 8. 3 crores divided by 8. That is depreciation from third year onwards. Third, fourth, fifth. Now what happened? The machinery was sold in the current year for 1 crore 12 lakh 50. What is the current year, sir? We purchased asset 5 years ago. 5 years ago we purchased. That means we are at the beginning of the 6th year. That means revaluation happened at the beginning of 3rd year. That means, see, first cost 2.5, depreciation reduced. This is the WDV at the beginning of the 3rd year. 3rd year beginning there is a revaluation, so 3 crores. That means 3rd year, 4th year, 5th year, you need to provide depreciation on the revised carrying amount. What is the revised carrying amount? 3 crores. So 3 crores divided by remaining life is how much? 8. Divided by 8 into 3. 1 crore 12 lakh 50. Remove it. You will get the carrying amount at the end of 5th year. What is the carrying amount? 1 crore 87 lakh 50. Now you sold this for 1 crore 12 lakh 50,000. Hello. So therefore disposal proceeds 1 crore 12 lakh 50. Carrying amount is this. So there is a loss of 75 lakhs. Now I told you, whenever an asset is sold, in respect of that asset already there is a revaluation surplus that will be transferred to retained earnings. Here the revaluation surplus is how much? 1 crore. So entire 1 crore will be transferred to retained earnings. Now suppose they are asking one more question, sir. What will be the treatment if the machinery fetched only 42 lakh 50,000? Suppose if it fetched only 42 lakh 50,000, your loss will be 1 crore 45 lakhs. 1 crore 45 lakhs. And here also entire revaluation surplus will be transferred to retained earnings. This is one question, sir. I will not take much time. See this question number 17. Important question, examination point of view. Make an RTP January 2025 attempt. This question given. There is a company, Bharat Infrastructure Limited. They acquired a heavy machinery at a cost of 1000 lakhs. Okay. The breakdown of its component is not provided. It is estimated useful life of the machinery is how much? 10 years. At the end of year 6, see this, at the end of year 6, the turbine, which is a major component of the machinery, needed replacement, as further usage and maintenance was uneconomical. The remainder of the machine is good condition and it is expected to last for remaining 4 years. The cost of the new turbine is how much? 450. Give the accounting treatment of new turbine assuming SLM depreciation and discount rate is 8%. Sir, tell me, this question is relating to replacement of major part. Correct? How to find out the WDV after replacement? First we need to take the WDV of the original asset. For that, cost of the new part will be added, WDV of the new part will be deducted. Correct? So see this. First, here there is a machinery, 1000 crores, 1000 lakhs. Life is 10. In this machinery there is a component called turbine. Now we are replacing this turbine. The new turbine cost is how much? 450. See, first you take the cost of the machinery. For that, add cost of the cost of the new turbine you should add, cost of the old turbine you need to deduct. And this is happening when? At the end of 6th year. So therefore first you take the cost, sir. From that reduce depreciation for 6 years. You will get the WDV. Depreciation how to provide, sir? What is the life? 10 years. So 1000 divided by 10 into 6 years. 600 lakhs. So therefore what is the WDV? 400. For this you add cost of the new turbine. What is the cost of the new turbine? 450 given in the question. Now I want what? WDV of the old turbine, carrying amount of the old turbine. But I don't know the original cost of the old turbine. If I know the original cost of the old turbine, from that 6 years depreciation I will deduct, then I will get the carrying amount of the old turbine. In the question, have they given old turbine cost? No. They have not given any breakup. Then how to find out it? In the question, they have given you discount rate of 8%. Now what we can do is, based on the cost of the new turbine, what is the cost of the new turbine? 450. Now it is at the end of the 6th year. At the end of the 6th year, the new turbine cost is 450. Based on that, you estimate. You go to past and estimate. Before 6 year, what will be the cost? before 6 years. How to find out it? See this. The formula is to find out the past cost, current cost divided by 1 plus r whole power n. Current cost 450 divided by 1 plus 8% for 6 years. 283.58 lakhs. This is the cost of what? Old turbine at the beginning of the first year. From that 6 years depreciation you deduct. 283.58 divided by 10 into 6. 170.146. This is the WDV. Remove it. So therefore, the same question may come in exam, sir. What is the twist, sir? You understood the twist? Based on the current value, you need to find out past. What is the formula we used? 450 cost divided by 1 plus r whole power n. That's how we need to find out. That's the only thing. So this is one question, sir. Okay. So remaining questions you solve, sir. I think this question is also very easy question. Simple question only. Okay, with this we completed AS 10. Accounting standard 12, sir. Accounting for government grants. Accounting for government grants. Whenever you receive any kind of assistance from the government, what is the accounting treatment we are going to do in the books of business enterprise? Basically, that is what covered under this standard, sir. Suppose you are a company in India, A Limited. Definitely you are going to receive so many benefits, assistance from the government. Now, when you receive any kind of benefit or assistance from the government, what is the accounting treatment we need to do in the books of business enterprise is what this standard addresses. But of course, this standard has its own limitations, sir. It may not cover all kinds of government assistances because first of all, the assistance which is given by the government must fit into the definition of government grant, which is prescribed under this standard. Then only this standard is applicable. So basically, this standard deals with what? Accounting of government grants. And government grant can be called with different names, sir. You can call it with subsidy, you can call it as duty drawback, or you can call it as cash incentives, or sometimes you can call it as tax holiday, sometimes you can call it as tax rebate, whatever. Name is not the matter, whether you received the assistance from the government or not. Now the scope of the standard, very important, sir. Sir, whether accounting standard is going to cover all the government assistance? Just now I told you, no. The answer is no. This standard has its own limitations. Now this standard has prescribed 3 situations, 3 circumstances. You cannot apply this standard. The first one is, this standard does not address accounting for government grants in the financial statements reflecting the effect of changing prices or supplementary information of similar nature. This standard does not address accounting for government grants where in the financial statements reflecting the effect of changing prices. Whenever there are changing prices, sir, to reflect the changing prices, what is the accounting treatment we do in the books of accounts? This standard does not address it, sir. So basically what they are talking here is, they are talking about higher inflationary economies. When you are a business enterprise operating in a inflationary conditions, sometimes you need to adjust the assets and liabilities to the inflated prices. Suppose you have received any assistance, any government grant in the form of an asset. Now you want to increase that asset value to the inflated price, that is called changing prices. You want to reflect the changing prices. Now whether to reflect the changing prices, for that what is the accounting treatment I need to do in my books? For that also I need to follow accounting standard 12. Accounting standard says no, we are not applicable. Whenever you want to reflect the changing prices for any kind of assets you have received in the form of government grant, we are not applicable. Basically what they are talking about here is, actually sir, in Indian accounting standard, Ind AS, we have a separate standard for higher inflationary economies, financial reporting in higher inflationary economies. So I will show you. In my regular class I have discussed it, sir. See this. Inflation adjusted financial statements, higher inflationary accounting. Suppose a company operates in a higher inflationary a company operates in a country with a high inflation and prepare its financial statements using inflationary adjusted figures.
As per Ind AS 29, Ind AS, not normal AS, Ind AS 29, financial reporting in higher inflationary economies, the company receives a government grant of 50 lakhs for purchasing a machinery. Due to inflation, the machinery historical cost 50 lakhs is restated to 80 lakhs. AS 12 does not specify whether the grant should also be restated in proportion to the inflation adjusted value. So the adjustment of grants in higher inflationary economies is handled by Ind AS 29, not accounting standard 12. Actually, what they have done is, first time when they introduced accounting standard 12, so they want to release a separate standard relating to the financial reporting in higher inflationary economies, but that is not possible. They have not released any new standard relating to higher inflationary economies accounting in the normal series, normal accounting standards. But later on, when they developed Ind AS, they have came up with a separate standard. Maybe that is the reason why they have excluded this accounting for government grants in the financial statements reflecting the effect of changing prices. Or similar supplementary information, any additional information you want to disclose in respect of these inflationary situations. For example, you have increased the asset value from 50 lakhs to 90 lakhs or 80 lakhs. Now, generally that information we will disclose in the notes to accounts, right? So that is also not covered as per this standard. Next, second one, sir, this standard does not deal with government assistance other than government grant. Sir, when you receive any assistance from the government, if it is not fit into the definition of government grant which is prescribed under this standard, definitely that is not covered under this standard. And the third one, sir, this standard does not cover government participation in the ownership of the enterprise. Even governments also will invest in the shares of other companies, right? Shares of different companies. Now that kind of investment in other companies is not covered under this standard. How to do the accounting of government investment in the shares of a company, that is not covered under this standard. So there are three things which is not covered by accounting standard 12. First one is accounting of government grants in the financial statements reflecting the effect of changing prices. That means when you are operating in a higher inflationary economies, if you want to do any kind of adjustments to the assets for which you have received a grant, so how to do the accounting to reflect the changing prices, not addressed by accounting standard 12. And also this standard does not deal with any government assistance other than government grants. This standard is not applicable. That assistance must fit into the definition of government grant which is prescribed under this standard, then only this standard is applicable. And the last one, government participation in the ownership is not covered under this standard. Now the definitions, sir. Two important definitions, sir. One is government. Sir, here government means what? Government means central, state, local, even government bodies, government agencies, even international government bodies also covered. So here government includes government agencies, any similar bodies, whether local, national or international also. Now what is government grant as per accounting standard 12? Very important, sir. Sir, what is government grant is, government grants are assistances provided by the government in cash or kind, to an enterprise for meeting certain conditions, some conditions. But it excludes those forms of assistance which cannot be valued, which cannot have a reasonable value placed upon it. Suppose when you receive any government assistance but you cannot measure it monetarily, financially, then it cannot be recognized as government grant. For example, you are a startup company, government has provided some services to you, government has given some assistance in the beginning. Now you cannot value it. The support which is given by the government, maybe in the form of managerial services, maybe in the form of structuring your organization initially, government has given some support to you, but there is no reasonable value placed upon it. Then obviously in accounts, sir, when you can't value something, if there is no reliable measurement, we can't bring it to the books of accounts. So therefore assistance excludes those forms of assistance which cannot have a reasonable value placed upon it. And also, sir, any transaction you have done with government which is not distinguished from the ordinary trading transactions. For example, you are a company, you are a furniture dealer, you have sold furniture to the government. Any government department you sold the furniture, can you say it is a government grant? It is an assistance given by the government, so government has purchased the furniture from us, so it's a kind of benefit to us? No. Like normal trading transactions, you have done any transaction with the government, that is also not covered under government grant. So what is government grant? Government grants are assistance, help provided by the government in cash or kind. It must be in cash or kind. Sir, suppose there is no cash or kind, then it is not covered under this definition. For example, in the electricity charges, sir, suppose electricity charges per unit 50 rupees, sir. Government said you pay only 30 rupees. That means they have given a 20 rupees subsidy, sir. Now this 20 rupees, are you receiving in the form of cash or kind? No. Therefore, it is not a government grant as per accounting standard 12. Of course, it's a kind of an assistance, but it is not measured in cash or kind. It is not in the form of cash or kind. Then it is not covered under this standard. For meeting certain conditions, sir, whenever government wants to give some assistance to you, either the conditions you already fulfilled or you are going to fulfill the conditions. Subject to that only government will give you assistance. Very rarely government grants are very gracious in nature. Freely they will give. But majority of the times it is subject to certain conditions. Excludes. Government grant excludes two things. What are those? Those forms of assistance that cannot be valued. When you can't value the grant, assistance given by the government, that cannot be government grant. Or a transaction that cannot be distinguished from the normal trading transactions. When you do any transaction with the government, so which cannot be distinguished from the normal trading transaction. That means like a normal regular course of the business, you have done some transaction with the government. So that cannot be considered as government grant. Okay. Next, what is the accounting treatment of government grant? Sir, accounting standard 12 has given two approaches, sir. Basically, whenever you receive any government grant, the accounting treatment, there are two kinds of approaches in the standard. One approach is capital approach. Another approach is income approach. Capital approach says when you receive any assistance from the government, when you receive any government grant, okay, you have to treat it as a part of shareholders fund. And income approach says when you receive any grant from the government, treat it as income. So which approach I need to follow, that depends upon the nature of the grant. When you receive any grant, what is the nature of the grant we need to see. Depending upon the nature, we need to do the accounting treatment. Whether I will follow capital approach or whether I will follow income approach. Whether I will treat the government grant as an income, I will credit to P&L account as an income, or whether I will treat the government grant as a part of shareholders fund. That means it is part of reserves and surplus. So the grant is treated as part of shareholders fund, suitable for grants similar to promoters contribution. So as a promoter, whatever I contribute for my business, so it is like government grant is also treated like that. So that is called capital approach. Income approach says the grant is recognized as an income over one or more periods, typically used for other grants, other types of grants. Sir, what are the arguments in favor of capital approach? What are the arguments in favor of income approach? Simple, sir. When government is giving any grant to you, if they put any conditions, and to fulfill those obligations or conditions, if you are going to incur any expenses, then you can treat the grant as what? Income. Because income means what? Income is something which is earned. You are earning this amount subject to fulfillment of conditions or already conditions were fulfilled. Therefore, the grant is income and the expenses you are going to incur to fulfill the conditions attached to the grant, the corresponding expenses. So obviously, there is a income means there must be expenses. But capital approach says, when you receive something from the government which is freely, graciously, there is no conditions attached to it, then generally we say these are the grants in the nature of promoters contribution. Like a promoter, so who brought capital to the organization, government is giving something which is very gracious in nature, they are not expected us to repay it back. So therefore, which approach you follow, that depends upon the nature. So the choice of approach depends upon the nature of the grant. Nature of the grant. So whether I will treat the grant as income or capital. So that depends upon the nature of the grant. Okay. But trust me, sir, next I am going to explain you the accounting treatment of government grants. So when I am explaining the government grants, sir, you are not supposed to think about this capital approach, income approach. Automatically you will understand. Next, recognition of government grants, sir. Okay. Sir, when as a business enterprise I have to recognize the government grant in my books. Sir, accounting standard 12 says there are two conditions must be satisfied to recognize the government grant. First of all, there must be reasonable assurance that you are going to receive or you are going to fulfill the conditions attached to the grant. Second of all, there must be a reasonable assurance that the grant will be received. So, two conditions must be there. There must be a reasonable assurance that you are going to fulfill the conditions attached to the grant. For example, sir, you are A Limited, sir. Now, government wants to give a grant of 50 lakhs to you, cash assistance. Now, when can I recognize this 50 lakhs in my books? So, government has put some conditions, sir. The condition is, in the next 5 years, you need to provide 10 jobs per annum. Every year, you need to provide 10 jobs. Like that, 5 years, you need to fulfill 50 jobs. You have to create 50 jobs. This is the condition attached to the grant. Now, whenever organization wants to recognize these 50 lakhs in the books of accounts, there must be a reasonable assurance that whether we are going to fulfill the conditions attached to the grant or not. That means top management has to take a call whether we are going to fulfill these conditions, these 5 conditions that every year we are going to fulfill 5 new job opportunities will be able to create or not. If the top management is reasonably assured that yes, definitely we are going to create this, so then first condition is satisfied. Sir, whether reasonable assurance that we are going to fulfill the conditions attached to the grant is sufficient? No. Second thing is that there must be a reasonable assurance that you are going to receive the grant, or the reasonable assurance that the grant will be received. Sir, we have a reasonable assurance that definitely we are going to fulfill the conditions, sir. That is not sufficient, sir. Actually, there must be a reasonable assurance that you are going to receive the grant also. So, government grant is recognized only when there is a reasonable assurance that enterprise will comply with the conditions attached to the grant. And there is a reasonable assurance that the grant will be received. And here, one more important point, sir. Suppose you received the grant, sir, but you don't have the reasonable assurance or confidence to say that we are going to fulfill the conditions attached to the grant. Then the standard says don't recognize the government grant, because both the conditions must be satisfied. Whenever you want to recognize any government grant in the books of accounts, there must be a reasonable assurance that you are going to fulfill the conditions attached to the grant. So therefore, receiving a government grant does not automatically mean the conditions have been or will be fulfilled. Suppose in your bank account, company bank account, 50 lakhs were credited. So since amount is credited, that means government has trusted us. So therefore, can I recognize government grant in my books? Whether government is trusting you or not doesn't matter. What is accounting standard 12 is saying, sir? Standard says government grant will be recognized only when there is a reasonable assurance that you are going to fulfill the conditions attached to the grant. So that means if you receive a government grant, fine, but first condition must also be satisfied. You should have the reasonable assurance. Your top management must be assured that yes, we are going to fulfill the conditions attached to the grant. Then only government grant will be recognized in the books. For example, see, sir, X Limited applies for a grant from a local authority for a social cause. Okay, the grant is conditional and X Limited has a reasonable assurance it will receive the grant. However, if there is an uncertainty about the meeting the conditions of the grant, X Limited should not recognize the grant until it is certain it can fulfill the conditions. So this is about recognition of government grant. The next, the remaining standard is different types of grants, sir. First, non-monetary government grants. When you receive any kind of non-monetary grants other than monetary in the form of assets. Next, presentation of grants relating to specific fixed assets. Then presentation of grants related to revenue, and presentation of grants in the nature of promoters contribution. So in different situations, different nature of grants when you receive, what will be the accounting treatment? So that is the next thing, sir. So see this, I will discuss from my class notes book. So see this, accounting of government grants, sir. Basically, government grants can be divided into two categories. You follow this chart, sir. Easily you can understand the accounting treatment of government grants. Government grants are basically divided into two categories, sir. One is monetary grant, another one is non-monetary grant. Monetary grant means cash. Non-monetary means other than cash, like land, plant and machinery, etc. First, we will talk about non-monetary grants. See, when government has given any non-monetary grant to you, that means any kind of any kind of asset. For example, government has given a land, government has given a plant and machinery. So non-monetary, that means other than cash. It is given in the form of kind, asset. Here two possibilities, sir. One thing is, these assets can be given at free of cost, or these assets can be given at a concessional price. So assets are given at free of cost, assets are given at a concessional price. Assets are given at what? Free of cost, sir. Assets are given at concessional price. Suppose government has given a land, okay, worth of 5 crores freely. That is called non-monetary grants given at free of cost. Now the standard says whenever you receive any asset from the government at free of cost, then you need to recognize the asset at its nominal value. Some immaterial value you can recognize. So assets are recognized at a nominal value. Assets are recognized at nominal value. For example, land given freely. When land is given freely by the government, what is the entry? Land account debtor to government grant. That is nothing but it is transferred to capital reserve. Capital reserve. Because entire asset we have receiving freely now. So land account debtor to government grant. That is nothing but created to capital reserve. 100. Some value, sir, we need to recognize at nominal value. Nominal value could be 100, maybe 10, maybe 1000. Some immaterial value. Suppose when you receive any government grant, non-monetary asset at a concessional price, then these assets are recognized at acquisition price. For example, sir, there is a land whose market value is 10 crores, but government given this land at 8 crores. So that means 2 lakhs concession they have given, right? So here government given you at a acquisition concessional price, then you need to recognize at acquisition price. So what is the acquisition price here? Land account debtor to bank, 8 crores, 8 crores. So this is the first non-monetary grant, sir. So in non-monetary grant means assets, sir. There are two situations here. Government can give you assets free of cost or at a concessional price. When government has given any asset at free of cost, you need to recognize at nominal value. So land account debtor to capital reserve in this case. Suppose government has given anything, any asset at a concessional price, then you need to recognize at acquisition price. What is the acquisition? Acquisition price means the price at which you have received the asset. Next is monetary grant, sir. Monetary grant means cash. Now these monetary grants are divided into 3 categories, sir. One is grants related to fixed assets. Suppose you are purchasing fixed assets, sir. Government is giving some cash to you to purchase the fixed asset, to acquire the fixed asset. For example, you are purchasing plant and machinery, and out of the total cost of the plant and machinery, certain portion is given by the government in the form of grant. That is called monetary grant related to fixed assets. Grants related to fixed assets. Second, grant related to revenue expenditure. Sometimes to meet any expenditure, government may give you some grant. That is called grants related to revenue expenses or revenue nature. Third one, grants in the nature of promoter's contribution. When government is given something which is in the nature of promoter's contribution, so that is another category. So there are 3 categories here: monetary grants, grants related to fixed assets, grants related to revenue, grants in the nature of promoter's contribution. First one, grants related to fixed assets, sir. See, whenever you receive any cash from the government for acquisition of fixed asset, first you need to see whether that fixed asset is a depreciable or non-depreciable. So depreciable or non-depreciable asset you see, sir, first. If it is a depreciable asset, accounting standard 12 says there are 2 methods for accounting of government grant. One is deduction method. Another one is deferred income method. In deduction method, sir, whatever the grant you received in respect of the fixed asset, you reduce from the cost of the fixed asset. You reduce directly from the cost of the fixed asset. In deferred income method, sir, whenever you receive any government grant relating to fixed asset, you need to credit the grant received to deferred income account and transfer this to P&L account over the life of the asset in proportion to its depreciation. So here government grant is reduced from the cost of the asset in deduction method. In deferred income method, government grant received is credited to deferred income and transferred to P&L account over the life of the asset in proportion to depreciation. For example, you are purchasing a plant and machinery, sir. The cost is 10 lakhs. Government grant you received 2 lakhs and the life of the asset is 5 years. So tell me, first when you are acquiring the plant and machinery, what is the entry? Plant and machinery account debtor to bank account. Next, when you receive the government grant, you reduce directly from the cost of the asset. Therefore, bank account debtor to plant and machinery. See this, plant and machinery was reduced by government grant 2 lakhs. Now, therefore, what is the revised cost of the asset? 8 lakhs. 8 lakhs divided by 5. That means 1.6 lakhs is the depreciation per annum. Now, second case, deferred income method. Sometimes whenever you receive any grant relating to fixed asset, if it is a depreciable asset, whenever whatever the grant you received, what you can do is you can transfer to deferred income. That means you cannot credit directly to P&L account at a time. First you transfer to deferred government grant account or deferred income account and then credit this deferred income, deferred government grant to P&L account over a period of time in proportion to the depreciation. For example, here for acquisition of plant and machinery to bank. And for receipt of government grant, will you directly reduce from the cost of the asset? No. See this, bank to deferred income, deferred government grant account. Then when you provide depreciation will be provided on the original cost, 10 by 5, 2 lakhs, 2 lakhs. And transfer this deferred government grant to P&L account. So deferred government grant to P&L, that is 2 crores divided by 5, 0.4. So ultimately the net effect is same under both the methods. Suppose here when you reduce the government grant from the cost of the asset, sir, what will be the depreciation per annum, sir? 1.6. 1.6 lakhs is charged to P&L account. In second method, suppose if you treat the grant as deferred income method, so how much you have created to P&L account as a depreciation? 2 lakhs. But how much you have debited depreciation to P&L? 2 lakhs. How much you created deferred government grant? 1.6. So the net is what? How much? Sorry, 0.4 you credited deferred government grant. So the net is 1.6, which is same. So therefore under both the methods, sir, the net effect is same. Okay. So whenever you receive any government grant relating to depreciable assets, there are two methods available. One is deduction method, another one is deferred income method. In deduction method, you reduce the grant directly from the asset. The remaining asset value is depreciated over the remaining life. Suppose in deferred income method, whenever you receive any government grant, you credit to deferred government grant account and you transfer to P&L account over the asset life in proportion to the depreciation. So the ultimately what happens is the net effect on the P&L account is same under both the methods. This is in respect of what? Depreciable assets. Suppose non-depreciable assets, sir. Suppose we have received any grant from the government to purchase a non-depreciable asset. For example, we are purchasing a land. Cost of the land is 1 crore. Now government has given 20 lakhs for us. 20 lakhs cash to purchase the land. That means these are the grants relating to which assets? Non-depreciable assets. Monetary grant which is received in respect of non-depreciable asset. So here also two conditions, two things, sir. When you receive any grant relating to non-depreciable asset, whether any conditions attached to the grant or not. Suppose no conditions to be fulfilled, then simply grant will be credited to capital reserve. Directly whatever the amount you received now, you credit to capital reserve. Because no conditions to be fulfilled, you are purchasing a asset. In respect of that asset, some amount you have received from the government. So therefore bank account debtor to capital reserve. Suppose if there are conditions to be fulfilled, government has put some conditions. So in that situation, whatever the grant you are receiving, sir, you credit to deferred government grant account and you transfer to P&L account over the period of time. Okay, in proportion to the cost to be incurred to fulfill the conditions. In this case, government grant received is credited to deferred income and transferred to P&L account over the period in proportion to the cost to be incurred to fulfill the conditions. So in the first case, suppose you are purchasing a land, cost 10 lakhs, sir. You have received a grant of 2 lakhs, no conditions. So simply land to bank and bank account debtor to capital reserve. So when you purchase land to bank account, 10 lakhs, 10 lakhs. When you receive a government grant, bank to capital reserve. Suppose in the second case, so land cost is 10 lakhs, government grant 2 lakhs. Conditions, company need to provide 5 new jobs every year in the next 3 years. So the cost of the new job is 1 lakh per annum. Therefore, bank account debtor to deferred government grant 2 lakhs, 2 lakhs. And this 2 lakhs every year we need to credit to P&L account in proportion to the cost which we are going to incur. That means equally over the next 3 years. Therefore, 2 divided by 3. So every year 0.67, 0.67, 0.67 we need to credit to P&L account. This is grants which we received in respect of fixed assets, sir. Depreciable, non-depreciable. So can you tell me what is the conclusion? Whenever you receive any grant from the government relating to fixed assets, first you need to see whether it is depreciable or non-depreciable. If it is depreciable, two options are available. Either you reduce from the asset value or you transfer to deferred government grant and credit to P&L account over the life in proportion to the depreciation. In respect of non-depreciable asset, whether any conditions attached or not, you have to see. If no conditions are attached, then directly transfer the grant to capital reserve. If there are conditions attached, then transfer this to deferred government grant and credit to P&L account in proportion to the cost what we are going to incur to fulfill the conditions attached to the grant. Next is revenue grants. What is this revenue grants? Suppose any amount paid by government to meet expenses like salaries, R&D expenses, etc. Suppose for example, we are doing research, sir, R&D. Now for that some amount is contributed by the government. Revenue grant. Suppose for example, we need to pay salaries to the employees, but the company position is not good. The government has given some cash assistance to meet the salaries of the employees. This is basically what revenue grants, to meet any kind of expenses. Now here in case of revenue grants, sir, we have two choices. Either the grant received is deducted from the related expenses or it may be shown as other income in the P&L account. For example, our company is A Limited, sir. Our salary per annum is 10 lakh rupees. Now we have received a government grant to meet the salary expenses 5 lakh rupees. So therefore, what is the entry we will write? First, when we pay the salary, what is the entry? Salary to bank, 10 lakhs, 10 lakhs. And then for receipt of the grant, bank account data to salary, 5 lakhs, 5 lakhs. That means the salary received is directly adjusted from the expenses. So in the P&L account, salary 10 lakhs, government grant 5 lakhs. So net amount 5 lakhs we will show. Or else there is other way. Whenever you pay the salary, salary to bank. Whenever you receive a grant, bank account data to government grant account. 5 lakhs, 5 lakhs. You credit directly to P&L account. So in the P&L account, credit side, other income you show 5 lakhs, government grant, salary 10 lakhs you show. So which one you need to follow, you take a choice. Either government grant received can be directly reduced from the expenses, or it can be shown as other income in the P&L account. Now sometimes, sir, you receive any government grant to meet, see, current year expenses. This is, suppose already you met some expenses in the past year, sir. Now government has given a compensation to you for the expenses you already met. Government grant is received as a reimbursement for past year expenses. Suppose last year I incurred some expenses, sir. Now as a reimbursement, government has given back that amount to me. For example, we spend 10 lakh rupees. So 10 lakh rupees on the corporate social responsibility. Imagine example. Now government said this 10 lakh rupees we will give refund to you. We will reimburse to you. So refunded it. Now therefore, this 10 lakhs, whatever the amount we spend in the past years, we have received it back from the government in the form of government grant. Now simply transfer this to capital reserve, bank account data to capital reserve. And sometimes, sir, you may receive government grant to meet multiple years expenses. See, when you receive any grant to meet any particular year expenses, either the grant received is directly reduced from that year expenses or treated as other income. Suppose when you receive any government grant to meet expenses for the multiple years, then what we need to do? Simple. Whenever government grant is received, we will transfer that to deferred government grant account. Later on, this deferred government grant either will be directly adjusted from the salary or we will be transferred directly to P&L account. For example, we have received a government grant to meet a salary expenses for 3 years. Okay, 20 lakhs. Now when we receive a grant, what is the entry? Bank account data to deferred government grant 2020. And every year out of this 20 deferred government grant, either we will adjust to salary account or directly created to P&L account. So that means when you adjust directly from the salary in the P&L account, salary 10 minus government grant 6.67, net 3.33 we will show. Or else you can follow other way, that is salary income, salary expenses you will show at gross amount and government grant received will be transferred to other income in the P&L account. Whatever be the treatment you want to follow, you can follow. So this is grants, revenue grants, sir. So what is revenue grant, sir? Any grant which is received from the government to meet any expenses, salary or R&D expenses. Now there are two choices. Either you reduce from the concerned expenses or you show it as a other income. Sometimes for the past expenses you incurred, government has given something, a reimbursement as a past expenses, directly transfer it to capital reserve. Because see, already expenses were incurred. That means last year expenses were recognized. Now for the expenses you have incurred, there is a reimbursement. So obviously that is a capital nature profit. So that's why it is allowed to transfer to capital reserve. Now sometimes if you receive any revenue grant to meet multiple years expenses, then you transfer to deferred government grant. Next year proportionately you either adjust to the particular expenses or you credit to P&L account. Next, government grants in the nature of promoters contribution. Sir, promoters contribution, here what is promoters contribution is when you receive any government grant in respect of total capital investment or total capital outlay. Suppose you are setting up of a factory in a backward area. So government has given some assistance. So government has given some cash to set up this project. That is called grants in the nature of promoters contribution. So when you receive something, amount received from the government with respect to total capital outlay. Suppose you are setting up of a factory in a backward area and ordinarily no repayment is expected. Those types of grants are called grants in the nature of promoters contribution. So what we need to do? We need to transfer to capital reserve. So bank account data to capital reserve. So whenever you receive any grant in the nature of promoters contribution, bank to capital reserve. And finally, refund of grants. Suppose, sir, if you are failed to fulfill the conditions which is attached to the grant, then obviously you need to refund the grant to the government. So what is the accounting treatment of grant? Simple, sir, reversal. Suppose when you receive the grant, you adjust it from the asset. Now you need to add back to the asset. That means fixed asset account data to bank. Suppose when you receive the grant, you transfer to deferred government grant. Now when you are giving the refund, whatever the unamortized balance in the deferred government grant, first you need to adjust it. Remaining balance we need to transfer to bank or P&L account. Remaining balance we need to transfer to P&L account. Suppose when you receive the grant, you have created to capital reserve. Now you debit to capital reserve. So there are only three possibilities now. Either when you receive a grant, you adjust it to the asset. Now you add back to the asset. Or when you receive the grant, you transfer to deferred government grant and every year you create it to P&L account. Now whatever the unamortized balance is there at the time of refund, you just reverse it. And you are giving refund in excess of the unamortized balance that will be debited to P&L account. And when you receive a government grant, you have created to capital reserve, now debit to capital reserve. So that is the accounting treatment. See this. If government grant is created to capital reserve, now debit to capital reserve when you are refunding. So that is capital reserve to bank. When government grant received is transferred to deferred government grant. Now deferred government grant, unamortized balance. Suppose you are refunding 10 lakhs. And the unamortized balance in the deferred government grant is 6 lakhs. So what is the balance? 4 lakhs. That is debited to P&L account. And see, when you receive a grant, you have adjusted to the asset. Now, you add back to the asset to bank. Okay. So this is the accounting standard 12, sir. And finally, disclosure, sir. In respect of accounting standard 12, you need to disclose what is the accounting policy adopted by the company in respect of government grants, including what are the methods of presentation we followed in the financial statements. And also we need to disclose the nature and extent of government grants. Disclose the nature and extent of government grants recognized in the financial statements, including non-monetary assets given at concessional rate or free of cost. So that's it, sir. This is accounting standard 12, sir. So predominantly all the points I have covered, sir. So you see this ones, and questions also, very simple questions are there in the study material, sir. Nothing, I think you can easily solve all these questions. So you listen to this 40 minutes video and you try to solve the questions. I think all questions will be solved, sir. Okay.